And there we are. Good morning,
Hello.
Jason. Good
Hey,
morning,
buddy.
fools.
How are
How you
you?
doing today?
I'm very, very good. We're off sync. Now we're back on sync. We're
Okay,
there.
there we
Yeah.
are. All
Yeah.
right. Hey, fools. It is 8 a.m. on a Saturday morning. It's 5 a.m. on Pro Shop's beautiful veranda out back. We are, this is Fool24. I'm Lou Whiteman. That's Jason Hall. We're here to talk finances, talk whatever else you want. Still want to do that relationship show, but you know, the thing about whether or not it's personal finance or dating advice, we're not here to give personal advice, right, Jason? This is
Yeah.
for educational purposes.
We
We're
can't
here
make
to
an
share our
individual.
views.
We can't
Yeah,
tell you who to date. We can't tell you what stock to buy or sell.
right. And nor do you want us to.
No.
We are out there in the world available for you to ask questions. That's on your Slido, sli.do, keyword Fool24. We're here. I'm here. I feel I'm here until Dan Caplinger takes over for the rest of the day, basically, Jason. That's the schedule. But you get 2 hours of us. We're going to talk about the week. The one thing, Jason, I've told you this before, the one thing I really like to do, and I guess it depends on how the week in stocks went, is the nice thing about Saturdays and weekends is you can either take the time to kind of reflect and really think about what happened, or if it was a bad enough week, you can just totally block it out altogether.
Yeah.
But and as you know, Motley Fool does do kind of a weekly summary for you, so you don't need to think. Bill, I just shared a screenshot of this week's weekly news, kind of giving us a menu, Jason, we can talk about, or wherever that we want to go on the Slido. But the weekly news, the big thing of the week, obviously, Google making its biggest bet to date. It's very interesting looking at that chart for as big as Alphabet is, just kind of how the two things that stand out there to me is, hey, how little M&A they've done in terms of big time. And secondly, we've all said it, but God, they got a deal on YouTube. Look at that. Why isn't
Oh
that
my
lower?
gosh. You're not kidding. That just incredible value. I mean, basically, and it's the fact that it's been the better part of 20 years ago, but YouTube is essentially as big as Netflix now, right?
Yeah.
That's what they bought for $1.6 billion. Essentially Netflix with far lower content creation costs.
Yes, yeah. Only the good side of Netflix, as it turns out. And by the way, welcome to the YouTube viewers who are out there today too, because that is just
Right.
streaming through Motley Fool. But if you found us, you already know that, so I guess I don't need to say that. What else went on in the week? Just a quick kind of menu, and then we can break down this. And I think we'll get to this in a second, and maybe we'll go through it, and then maybe we can start there after we just kind of go through a menu. But very, very interesting. We can talk about this more in a second, but very interesting what came out of BYD, or kind of what did come out of BYD this weekend. Going through real quick, there was the GTC conference. I don't know. There's been enough ink maybe spilled on that, but we can go there. The biggest thing that I thought, and this is probably a good sign for the long-term bulls, last year, Jensen Huang, anything he said, it was almost like adding .com to your ticker back in 1999. It's just worth a good 20-30% off the top, or adding blockchain a few years ago. Last year at this conference, he said the word Dell, and Dell was up 20%, like within an instant. The fact that that didn't happen this year may be it may be a short-term bearish signal for stocks, but it's probably good long-term if that's what's going on.
Absolutely.
We did have the big macro. I know Dan Cap's going to come on and talk about that later, but we did have that the nothing happened, but did it. I'm going to spend a lot of time on this later because Jerome Powell went back to one of his favorite words, and last time it didn't work out so well. So very, very curious about that. And then, yeah, we finally had someone finally got dogged by Doge. We had, and Jason, as you know, I do a little earnings summary thing to help out the Motley Fool, kind of the instant take. And the problem with instant takes is, so I read the report. It looked pretty good to me. I saw the stock up 3% in pre-market trading. I said, okay, all is well. And then I go to take my daughter to school, come back an hour later, the market is open and the stock is down 8%. So this always well, listen to the conference call, fools. That's, I guess, the lesson there. But interesting. We can dive into that a lot. There was a lot
I would like to talk through this for Accenture, because again, the key thing there for anybody that's listening and not reading what's on the screen is that first paragraph, the last sentence. Federal contracts make up about 16% of Accenture's America's revenue. Again, so not 16% of its total revenues, because Accenture's is a pretty international business.
Just under 8% of total.
Yeah, but that's the key. Cut that number in half.
Yeah,
and it's still that is a meaningful portion of its revenue. But we'll unpack it a little bit more in thinking about what it actually means.
And then, this one, I don't know what to say about Nike anymore, but we can talk about that big thing. And I want to make sure, fools, everyone saw this, because it's a Tom Gardner, pretty heck of a statement. But buy now, pay later. Jason, remember that?
Oh, it's still around. Klarna's talking about going public.
Well, so Klarna's talking about going public. Tom Gardner in commenting in Monday's Lunchtime News, and fools, this is why you have to read these. In fact, I'm just going to bring up the whole quote. Let's see if I can do that real quick, because it was just snipped here. But you go down to the comments. I made the statement before Facebook went public in 2012. I will definitely be recommending the stock. Hidden Gems will be buying Klarna. We may not choose to buy it at the IPO. We may wait a bit on price, but we will definitely be. So there it is. That's breaking news, Jason. But on that too, fools, there's a great little poll. Are you excited about it? So I'm kind of curious. So go ahead, go against Tom. But that's just a little bit of a menu. There was a lot more that happened in the week. We want to talk about whatever you want to talk about. But
get those questions to us.
Shall we start with BYD?
Yeah, I'm going to say one thing about Klarna, and then we'll do BYD.
Sure.
All I want to say about Klarna is this is a 20-year-old company. This is not a startup, right? This is a company that's been around for a long time and is really established in Europe. So there's probably something there.
Yeah.
But this is the last part of it. Plug Power's also been around for more than 25 years. So that doesn't mean it's going to create value for shareholders.
Right.
All right, let's talk about BYD.
Okay, so BYD, a little Chinese automaker who, Warren Buffett, I think, not personally, but Warren Buffett introduced me to the stock. I like saying that, even though it's not exactly as it
sounds really good.
Yeah. But they have been A, a real innovator, and B, sort of kicking the patooey out of everybody over there in terms of Chinese electric vehicles in what is the most important market, including a little company we call Tesla, who has, ceded its top EV market share in China. And BYD,
that is because its sales in China are down by roughly half, I believe.
Right. Well, yeah. So just to give you the stats for the last month, because monthly sales we can track from insurance registrations. In February, Tesla Chinese sales down 49%. That's its lowest total since August 2022. Arguably not because of Doge, too. Before we go there, I don't think the Chinese consumer is really worried about what is going on with USAID.
Not at all. It's not the same story as in Germany, for example.
Right. But the other side of it too is that, look, it's not just a Tesla story there. BYD sales up 90%. Because A, they make good cars, and B, they are really, really, really working on efficiency. All right. BYD, the big news this week is that they say they have, and in fact, they unveiled a line of cars to use this technology. So it's not just, it's the other weird thing about that market relative to this market. If this same news from GM would be, we will have in production in 2028 or something, but no, BYD unveils this and they will have it I think in a few weeks, they'll be selling it, a range of vehicles that it claims, electric vehicles, that you can recharge in about the time it takes to fill a gas tank. And why is this important? Well, I think, and I don't know, I don't own an electric car. Part of the reason that I have a hybrid instead is if I'm on a 700-mile trip, I don't feel like stopping off for 30, 40 minutes with the kids and the dog and whatever to recharge. Range anxiety, the idea that you're out somewhere and you can't get home and it's 30, 40 minutes, but also just long road trips and the pain that is the current charging setup. That is a real hindrance to this, what we think is going to be a long-term move towards electric vehicles. It is the holy grail. A lot of people have been trying to solve this. If BYD has really gotten this, then that is a huge marketing thing, not just here, but look, China has a lot fewer charging stations than the supercharger network that Tesla has. So arguably, especially if you need to leave the big cities in China, it is of more value there than it is.
Yeah.
And also and Jason, I'll let you get in, but look, how long it takes to charge impacts how many charging stations we have to build, right? If a car is only going to be there, or a vehicle is only going to be there for 5-10 minutes, you have a ton more capacity with your existing infrastructure than you do if, vehicles have to be there for 40 minutes each time and the lines back up. So this is very, very Jason? It's interesting, but what are your thoughts here?
Yeah, I think we need to unpack it a little bit. So what are the what have they announced? The short version of what they announced is the ability to add 400 kilometers of range via charge in 5 minutes. That's just a little under 250 miles. So that is exceptional. That is absolutely exceptional. There's no getting around it. So that's great. Now, let's kind of extrapolate that out a little bit and talk about the implications. Lou, you talked about a little bit there with the faster you can charge, the fewer chargers you need. Again, the idea, if you've got a line of 10 cars waiting to charge and it takes 5 minutes versus 15, that's, you're charging 3 times as many cars in the same amount of time, roughly, right? Directionally, at least twice as many, call it 2.5 times for the car pulling out and the other car pulling in and plugging it into the charger and all that kind of stuff, right? So it is a massive increase in the productivity of the charging stations, right? Answers not just the question of, as a consumer driving the car, but also for the deployment of those stations, the viability. So that's great. I want to take this and step it up market a little bit, because we think about this in terms of our daily drivers, right? And those long commutes, and maybe you forgot to plug your car in when you got at home last night and you drove a long drive and now you got to go to work the next day. And
we've all done it with our phones, right? We could do it with our cars too.
I mean, that's the thing. Yeah. It's human nature. We forget sometimes. You ever forget? I forgot. Happened to me, happened to you. So we're thinking about it through that framework. My guess with BYD, because BYD also manufactures commercial vehicles, is that they're developing this technology for larger vehicles with much larger batteries, where you're talking about substantially long charge times for, say, a dump truck, right? And vehicles that maybe their typical usage cycle is different. So you think about like transit buses and things like that also are large and heavy, but they go on known routes. So the ability to do things like overnight charging reduces the need for some of this. But there's a lot of commercial vehicles out there that don't operate in that way. Delivery vehicles, dump trucks, lots of heavy equipment that over the road tractor trailers, they're class 8 trucks in the US, the class 8 tractors. One of the reasons we've seen a lot of haulers, Lou, and you know this better than me, that have been very reticent to make the switch is because of that. The small haulers, they need to be able to go wherever the trailer needs to be delivered. They don't have these like line haul things where they're going to the same distribution center, every day. So the ability to have more flexibility about where to go and to be able to charge quickly, the implications are significant for markets beyond just our daily driver. So now those are all of the reasons why this sort of advancement is great. I also think it to some extent was inevitable, Lou. Material science is going to continue to advance. We can just look at solar panels and how much more efficient solar panels have become over the past 20 years. We're talking doubling, in a lot of cases, tripling in the amount of power that they can generate per unit size of the wafer, while the costs per watt have fallen. So you think about like the total implications for that have been enormous in driving the growth of solar, and making solar more viable from a cost perspective. So all of those things are good. But Lou, the big questions right now is, and the legitimate questions that a lot of people in the industry are asking, is the downside of fast charging is increased rates of battery degradation.
Right.
So what are those implications?
And that is, I think that's where we should go with this. And it's not, and it's just pure speculation. And I'll even go, because look, it's 8:15 in the morning. I can say I was still asleep, right? So I can even make wild speculation here at this hour, right? Yeah. I was up late last night, so I don't even know what I'm saying now, Jason. But it's interesting. And maybe it's just for proprietary reasons, which I get, but I don't really get, because that's not the way this industry has worked. BYD is pretty just kind of not like, a lot of people had a lot of questions about the chemistry here and didn't get a lot of answers. Okay. Which I don't think that means there's anything like not untrue going on, but I do think what it tells me is that there are a lot of people working on better battery solutions. If this was a real tech breakthrough, if this was, hey, we're using solid state batteries here or something, they would have triumphed that from the rooftops. So I do think the logical conclusion here is that they are using existing technologies better. Which is incremental progress. Nothing wrong with that.
Yeah. Well, that's what's gotten us to where we are with the viability of. Look at all of our technology. Right.
So there's nothing wrong with that, but it also is different than where we need to go. The most interesting stock reaction to me on this, Jason. And again, I don't think they are claiming that they have solved the puzzle. They have just improved the puzzle. Yeah. But I saw a lot of headlines suggesting that they had solved the puzzles, that they got there first.
I think Bloomberg's was my favorite. Did you read the Bloomberg
headline? What was the headline there?
It was just absolutely money. Chinese BYD cemented its lead on Tesla in 5 minutes.
Yeah.
It's clever. It's clever.
Here's the problem with this.
It's not.
I think I used this probably on with you, and I just butchered it. But back in the old days when cold fusion was going to be a thing, and there was a little lab in Utah that had claimed to have solved cold fusion and was going to save the world. And none of the physicists outside of this lab in Utah, Dr. Pons, could figure out how they were doing it. But it seemed like there would be all sorts of particle release. And the joke, it turned out it wasn't exactly real. And the joke at the time was, did you hear the bad news from the Pons lab? They're all still alive. Because it was basically what they were claiming to do, would have nuked them. Did you hear the bad news about the BYD announcement, Jason?
No, I didn't know.
QuantumScape is still alive. And in fact, QuantumScape, which is a solid state battery technology, full disclosure. I mean, I'm talking my book here because I think, Jason, you may as well. But I
own shares and I have options too.
Yeah. So. Yeah, but so QuantumScape is trying, and they're not alone here, but they are trying to quote unquote solve the problem with all new battery chemistry. It's called a solid state chemistry that's more stable, charges faster, also requires less battery because it's stable. Shares of QuantumScape were up 5% this week, in kind of a weird week.
Yeah.
That, and again, I'm not saying BYD is claiming that they solved this with solid state, but before we get too far ahead of ourselves with what this is and isn't, I do think it's worth noting that the race is still on and there's still a lot going on here. The one other thing, and this is the part that we'll have to delete later, Jason, because it is too wild of speculation, because I respect BYD.
All right, Bill, Corey, be sure to make a note of the timestamp right now.
Yeah,
It's a little
yeah.
after 8 a.m.
I'll just hit my mute button here, okay? But this
there you
is this is a thought experiment. This is not the most likely thing that is going on, but this is a possibility. China's going to China. Yes?
Yeah.
China does China. It's a different set of rules than it is in here, okay? China has a history, and people said this about DeepSeek too, of timing announcements to make sure they have the maximum geopolitical effect, not just you might not be aware of this, Jason, but the United States government right now is getting a lot of advice from the head of Tesla.
I read something about that. Yeah.
And there has been a lot of back and forth with China. If China wanted to China and take a shot at Tesla,
it's a perfect way to do it. Yeah.
Well done. Yeah. And so again, I think the technology is real. I think all this is real. I talked about the fact that this sort of came out of nowhere, similar to DeepSeek, where all of a sudden, like, I believe the vehicles will be on the road later this year. Like it's
April. They're saying delivery starting in April. So
yeah,
I want to go ahead when you're.
But yeah, just that. But I mean, in the bigger picture, Bill, I'm going to share that screen one more time because I do want to get back. Or I don't know, Jason, if you have anything on that, but we should probably move past all of my just crazy man rambling.
No. You're sane man rambling. I do have a couple things I think like the implications.
Go ahead. So we'll save the share. Bill.
Yeah. So again, thinking about the things we talked about, battery degradation and that BYD did not announce a disruptive technology advancements, right? This is a process advancement, probably more than anything. What we haven't heard, and here's my prediction, I'm going to make some predictions here, is that they probably have tweaked the battery chemistry a little bit to make it a little more okay with launching lots of electrons into it at a high rate of amperage. Probably have done that. Yeah. We do know that does affect the long-term viability of the battery when you change the chemistry, because they're optimizing for two hard things to do for batteries: make them last a long time and also make them reticent to take in and give up their electrons quickly, because you need that current to move 6,000 pounds of electric vehicle quickly. So I think we're probably also going to find that some things that they did revolved around cooling the batteries while they're charging, because that thermal overload, right? That's the risk. Is you got to get that heat out of the battery as it's charging. So probably something to do with cooling the battery. They've added some technology, which probably adds cost and weight, right? Which we'll find out when we actually see the specs of the vehicle. And my bet is that my other prediction is that BYD is going to limit how often drivers can use those chargers at their highest rate of charging. You probably can't do it every day.
Right.
You can probably do it once a week, twice a week. Which again
is still a great advancement. Yeah. If you only use it when you have the kids in the back.
That's not the way. That's not the way you need to charge the battery every time.
Right.
It's a way that you can do it when you need to.
Yeah. Right. And this is, and again, I mean, it's incremental progress, but look, I mean, I don't know about you iPhone users, but one of the things I love about my Android phone is that I stick it on a charger at night. It knows I have a 7 a.m. alarm, say. It will actually slow the charge. It will program it so it will be at 100% by 7 a.m., but not before then, to slow the charge. The same sort of thing.
Optimizing for the battery integrity lasting over the lifetime of that phone.
Right.
Yeah. Right.
But here's the thing, and we could share the screen now in a second. But I think it's still up, Bill. But this is a problem for Tesla, even if everything we just said is true, because Tesla now isn't just losing to BYD. Charging rate matters. Okay, it may not be the only reason people buy, and now granted, 2 of the 4 companies in that table you can't buy in the United States, but again, China's very important. But this is sort of one chart that is Tesla's bigger issue in a nutshell. they were the innovator. And I mean, again, there's all sorts of buts and caveats here. I think some of this is cherry picked and some of this is, Tesla has gotten better. But
yeah, it's not an accident that the two Chinese automakers are on the top of this list.
Right. And not too long ago, they were the pioneers in this industry. Mm-hmm. And look, if I was going to buy an EV and I had these 4 options, this chart would resonate with me. And in terms of, there's been a lot of just craziness going on around Tesla and a lot of things that probably are best left to other streaming platforms to get to. Yeah. But the lack of refresh in the cars and kind of the thud that some of the refreshes they've done, I mean, look, every year the Honda Accord looks a tiny bit different. I mean, the lack of a cadence in the automaker and the lack of not tech innovation, because Cybertruck was innovation. So there is still innovation going on in that company, but just the lack of just the nuts and bolts doing what they did in their early days to just push bleeding edge further. That's now dancing robots, not battery technology. And it's mostly, there's slides on that, but if you want to quote unquote fix Tesla right now, for all the talk about the stuff on the other YouTube channels that are coming out of a city on the Potomac, this is the bigger fundamental problem, is just the technology, the refresh rate of the vehicles, all of that just boring old-fashioned auto stuff that you got to get right.
Yeah, that's exactly right. I mean, Tesla's success is largely being the anti-automaker, right? But now they're an automaker, and means they need
to not a particularly good one in a lot of the things that maybe
that's the point, right?
Yeah,
that's the point. So, all right, we've got some questions that have come in.
Yes,
that we should get to. I want to say this, Lou. The market was up last week. That's
I know.
Maybe that's getting a little bit lost in some of the vibes out there, but even the NASDAQ 100 finished the year up just a tiny bit from where it started the week before.
Can I tell you too? And this is kind of just how the sausage is made. At like 3:58, we had to change the weekly news because we were heading towards S&P ended up 0.5% for the week. If not for that late little triple witching weirdness rally, we would have had our longest weekly losing streak since May 2022.
Right.
And so so there you go. So we were this close to it, and not something to celebrate, but we were up ever so slightly this week, which is something.
It is something. Well, and here's the thing. You know what matters the most about those weird little trivia things about worst or best or whatever since less than 2 years ago, why those things matter is because it's the noise and the distractions and all of the things that the financial media is throwing at us.
Because we were going to yell that number if it was true. Yeah.
Right. But it's our capacity to just either kind of embrace all of that noise and just have fun learning along the way and doing nothing, or only buying and selling when it makes sense on our financial goals, not the noise that's going on, or to ignore all that stuff and only focus on acting based on our financial goals, short and long term.
Right. So just to underline that a bit, how different would it be if not for 0.5% on the S&P? All of the headlines this morning is stocks face longest slump in years.
Right.
And if not for a little, and because like I say, as of 3:30, it was true.
That's right.
Then we just had just a tiniest little boost. It probably, if we really wanted to break it down, we could figure out one particular stock or something, probably just because of options trading, options expiring, exactly. Just got a tiny bit of a boost, and the whole narrative is different. Yeah. Fun.
All right. Let me do this. Let me start with,
a lot of great questions coming. Good morning, fools.
Good comments too. Matt, thank you for this one, Matt. Lou, the only problem with your 8 a.m. appearances is that it's a little too early to be getting out the popcorn.
I know.
No, it's not.
And I already spouted a conspiracy theory.
Yeah, no, you're doing good. Lou, you're on track. You're on time. There's no doubt about it. What I was going to say, Matt, is that the popcorn that you bring out is the Popcornopolis, though, like the sweet chocolate and white chocolate, like that goes so good with coffee. That's what I would have suggested.
I'll also say honeycomb cereal is a good alternative to popcorn for the morning. I think just the texture,
right
the
out of the bowl
size.
too. Just you can do it. It's a little hard though. It's a little, because they're big. Those things are kind of big. So but I like it. I like that. All right. So I need input. This is, man, I want to this is one that I really struggle with. So I need input. Writes, hey Jason, you got off easy with my not clear question. This is, yes, I believe yesterday. What is your current highest conviction stock for the next decade?
You got to pause right here though, Jason.
Okay.
Because I need input as being quite kind to you. I need input as kind of throwing themselves under the bus, saying that it was a not clear question. Now you just weaseled out of it. I was on with you then, and so
thank you for
there will be no blaming the question.
Yeah, I need input. Your question was perfect. Yeah, I did that thing of not answering the question, but giving the answer that I wanted to. So I'm probably going to do that again. You know. So you're loving listening to me and Lou both. Your follow-up comment. Appreciate the compliment. You might be changing your sentiment here.
Yeah. Well, it happens with most people with Jason, so it's okay.
That's true. That's true, especially my family. Here's why I struggle with this one. And this is also part of the reason that I have a diversified portfolio of over 90 stocks. A lot of my concentration is in stocks that when I first bought them, I saw a seed of something great, but I didn't necessarily have the imagination that a lot of other more insightful investors do to see all of the potential for that company. Mercado Libre, for example, I think it's still my largest holding. Meritage Homes might be. No, Meritage isn't anymore because it's come down so much over the past few months, Lou. But Mercado Libre over the past few years has been one of my largest or top 2 or 3 consistently across the volatility that we've seen with a lot of stocks going up so much over the past few years. And it's one of my oldest held stocks too. I think I bought my first shares back in 2012, 2013. I flipped my portfolio a lot during that time frame. I'd gone through a job change and moved from a lot of 401k index funds, flipped into individual stocks. So that was when I really launched into full on 100% stocks with all of my resources. So a lot of my longest held stocks, that's kind of when I bought them. And I bought just a little tiny bit of Mercado Libre. And it's been a huge winner to me because I've added to it consistently over the past decade plus. So I could say the same thing about Trex, is one that's been one of my best long-term investments because I've consistently added to it since roughly that same time and looked for opportunities to add to it. All of that to say, back when I first bought Mercado Libre, it was pretty established back then, but nothing like the behemoth that it's become over the past decade. And just like with Amazon and the success of AWS, Mercado Pago was not on my, it was not on my bingo card for Mercado Libre's success. It should have been, because again, operating an e-commerce platform in a series of countries, over a dozen countries where the unbanked and underbanked population is the majority of the population, you got to figure out how to get to grease the skids for people to be able to pay you for their stuff. So it shouldn't be a big surprise that it's done. But the thing is, it's become such an outsized portion of its profits over the past few years. And the thing that keeps me from saying Mercado Libre as my answer to this is my concerns about banks. And Mercado Libre has created part of the biggest risk of being a bank, and that's credit risk with largely unsecured debt. Now, we had Fede on a couple weeks ago, the former head of investor relations at Mercado Libre, Federico Sandler, and he pointed out rightly that Mercado Libre has a tremendous amount of data about its borrowers because of Mercado Pago and the Mercado Libre platform. So where the Mercado Pago platform is powerful in terms of information is the people that use it spend more money for payments for things off of Mercado Libre than they do on Mercado Libre. So you know your users' spending patterns. You know what they're prioritizing. So they're able to see the ones that are prioritizing paying off like utility bills on a consistent basis versus when they get paid on a Friday or whatever the typical payday is in the country that they operate in, and that cash gets put onto the Mercado Pago account, and then they immediately spend it on online gambling, right? They know, is my point. So that data does help inform their decisions, but it's such a different skill set.
Right. That's what I was going to say. Yeah.
Right,
yeah.
Right. Of building a credit risk business than building a technology business and an operations business. That is my biggest concern is, I mean, so far over the past few years, as they've really been levering this credit business up, they seem to have done well, and they've had a couple of periods where we saw risk kind of creep up in delayed payments and defaults, but it looks like they've improved that. But we don't have the accumulation of knowledge of, a decade across economic conditions and the different markets that they operate in. So that's the one thing that keeps me from saying Mercado Libre. As much as I would love to say like a Meritage Homes or one of the home builders I've been talking about ad nauseum for a month on Fool24, it's too cyclical of a business for me to cast the net out 10 years and say, I think these are going to be the best stocks to buy today, 10 years from now. So I'm going to say Shopify. I'm going to say Shopify here. $125 billion company, roughly. And last I checked, I'm going to steal from our good Canadian pal, Jim Gillies here. And I'm going to say, I don't know how big that number is, but I know it's a lot bigger than what Shopify is doing now. I have found myself anecdotally doing more and more online shopping and buying off of Amazon on companies' websites that I found, and I get to the button and I click on the cart and it says pay with shop. And then I'm like, and I fire up my Shopify, my shop app, where all of the merchants, it's like Shopify's Amazon, basically. And I see my cart down there, and it's got the stuff I put in that merchant's cart on there. And I can use my Shopify, my Shop Pay rewards and apply towards the cost for a lot of those things. And as a result, I will go into the shop app and search for things now and see what comes up. The stickiness and the integration across their merchants is a lot more powerful, I think, than a lot of people realize. And they continue to build on the things that make it strong to make it stronger. And they continue to seek for weak points for their merchants where they can build tools to make those things stronger for their merchants. And that makes it so sticky for their merchants. So I will say Shopify. And we haven't even really seen how AI could get deployed across its platform in ways that could be like absolute rocket fuel for tools for merchants, in ways that Shopify could sell those tools to merchants in ways that provide substantial value for merchants that just want to do their business, right? They don't want to have to be an accountant, and they're not maybe really great at like the marketing stuff, and they need support with that. Like really unlocking AI in ways that can be an accelerant for productivity for small businesses could be a real driver for Shopify that maybe we aren't even fully appreciating. So I'll say Shopify. Yeah. I could pick 10 other stocks here, but I'm gonna go with that one.
I mean, I think I like the logic. A couple things. Just thinking about, For one thing, the Mercado Libre thing is really interesting, and that's a big holding of mine too. The one thing I will say, and I don't think you'd argue with this, is the good news is that to me, or I don't know, maybe you wouldn't agree with this, but the financial risk that I think is real, and while I take some comfort in we have data, I agree with you. It's a different world to do this sort of analysis on your customer versus just kind of marketing analysis. But the good news is there's so much else there. I don't see it as Mercado Libre could become Silicon Valley Bank. I see it as this could be a bummer for earnings for an extended period of time. So we're just talking about
and even
lack of outperformance.
Take it one step further, Lou. It could be not just a bummer for earnings, but it could also gut the cash flow machine that funds expansion.
Very true, very true. But yeah, I mean, we're talking toe stubbing, not
right. Oh,
not
absolutely,
disaster.
absolutely.
Which,
yeah,
it's funny
because at the end of the day, Mercado Libre is lending out its own money.
Mm-hmm.
It's not lending out depositors' money.
Mm-hmm. This has always been, and I mean, my background years and years and years ago was in commercial banking in the U.S., and this has always been the two-edged sword. Normal companies in the U.S. can't own banks except for a weird Utah exception because they're worried about companies kind of stealing or being a little too liberal with taking the reserves and making the banks unsafe. The other side of that is that's sort of in this not really bank but banking model where you have a ton of other revenue and income generating things to sort of backstop. It's almost more of an insurance model. I share your concerns, but also it doesn't keep me up at night, but I do get it. The broader thing, and I yelled at you for criticizing I need inputs question. So now I'm going to be me, and after throwing you under the bus, I'm going to criticize the question. Okay. But
fantastic.
The really funny thing about this, and I get the question, and I think it's a fair question and it's a great to talk about. But the longer you go out, the more boring this is going to be in your answer, because 10 years, honestly, 10 years, it's probably a total market index is the choice, as far as the highest conviction. So, I mean, to me anyway.
Funny. It's funny you say that, because we got a question the other day where I don't think it was the same question, but it was along the same lines. And I said, look, I got to go with Berkshire Hathaway here, because was that the same question?
I think it was.
Yeah. But to that point, right? And the reason is like, I had to de-risk. The question was, if you could only buy one stock and hold for the next 10 years, right? That was I need inputs question.
Mm-hmm.
That's a hard, because I mean, you have to change everything about the way you're thinking about stocks, because you're no longer diversified, right?
Right.
Yeah.
Right. Yeah. It kind of, Sina's, and good morning, Sina. Good to talk to you. It's not like Sina and I, Jason, as you're talking, are in the background.
Some other regulars here. Sina, Ed's got some questions for us. Good morning, Ed.
Yeah.
John Gallegos on the other. He's also one of those Westish side.
Yeah. No, and I should say, fools, I appreciate all the aerospace stuff, and we're going to go there. Trust me.
Yeah.
But Sina, I think.
Well, Lou and I, for those that haven't looked at the schedule, Lou and I are going to be here for another hour and 17 minutes. So
yes. But Sina, I think right on this point, do either of you do any kind of holistic 5-year reviews of your active investing effort? If so, what questions do you ask yourself? I think it gets into this, like highest conviction for 10 years. I don't have like a process where but I'll tell you what I do, Jason, and this is just more fodder to make fun of me. I actually, a long time ago, decided to just sort of treat our household like a business to review. And two extremes. I have pages and pages of Excel spreadsheets looking at things like debt to quote unquote equity, debt to cash flow, all sorts of measures like this. And for a while, I was writing a quarterly shareholder letter. I don't journal, but I will. And the sad thing is, and my wife can probably hear this, if she would actually want an investor presentation every 3 months, I'd probably do that. I mean, thank God that she's smarter than that and doesn't want it. But I will.
There's also, I guess, there's got to be a little bit of like intellectual curiosity that's just hardwired in you to do that sort of thing.
Well, I sort of like thinking about the world that way, and part of that is I will print out, because I'm old and I like paper, but I just sort my individual stock portfolio by portfolio size, and at the end of every quarter, so I'll be doing it in the next week or so, just do a printout. And it's really cool to look at like the top 15 in percentages and then just go back like 3 years to the printout then and look at what it is. But as part of this process, I do keep every purchase date and relative to the S&P 500 and see how they have performed with each other, because I am a believer that, you know, you should never ever just look, I'm up 12% on the stock. If the market's up 14%, you know, good on you. But, you know, so you should always compare it to the alternative. And the alternative for me, because I'm not going to just every stock I could have bought, the alternative is I just put it in a total market return fund or something like that. So I sort of do a review like that to just, is it worth it? And I'm constantly having an existential question about, is it worth it to do individual stocks? And I say that as someone who a lot of our household wealth is tied up in passive mutual funds, and I'm very happy with that. So, Sina, I guess the answer is kinda. I don't know, Jason. What about you?
Yeah, I do some of the same things. I do zero journaling, but as a writer and producer of content, there's a pretty long back catalog of things that I've written to share my thoughts about the companies that I own and have bought. So so that approach I think that I take is a little bit different, but I do regularly, you know, once or twice a year, at least once a year, do a closer look at how has my portfolio performed against the indexes. I do that. Because I do think, to your point, I have to rigorously hold myself accountable. And if I'm not doing better than an index, what am I getting out of it of value? Right? Because there has to be something of value that I get out of it. And over the past, and some things have changed with my investing too. Over the past year, I have underperformed the S&P, but that's also because I moved substantially, and I've talked about this a lot, I've moved substantially more of my portfolio to cash and bonds than I have historically held. I've historically held 0 bonds, and my cash was usually around 5%. Now I carry at least 10% of my portfolio in unlevered cash, meaning I can do whatever I want with it whenever I want with it. And that matters because I also have begun using options for income a lot more. And also to create long positions in stocks that I don't like the current price, but I want to buy that stock. And if I can use something like selling a put, and the strike price of the put is a price that I would be willing to pay, it's a way that I can create a path towards that price. And if I don't get it, the premium that I got paid for selling the put, I earn it. But if I do that, I have to, because I'm doing this in a 401k. The cash value of that options contract, I have to have that much cash in the portfolio. So that cash is not available to trade, right? So that's why I'm very clear that it's 10% of my cash available to trade. The good thing is that with those puts, I'm earning interest on the cash, about 4% in the Fidelity money market right now. And then potentially the premium that I got paid, right? That if I don't get the stock, I'll keep the premium. So I can get pretty decent double-digit returns on that cash, total double-digit returns, even if I don't get the stock. So, and then the bonds, right? So now I'm roughly 10% bonds now too. So that's a lot of weights on a portfolio in a roaring bull market like we've seen the past couple of years. So that's again the keys. So it helps me contextualize how is my portfolio done within the context of the market and also my goals, right? And that's the most important thing that I try to do whenever I take a close look. So you talking here about this holistic 5-year review, I'm not regimented that I do it this certain number of years, but I do regularly take a look because every few years you need to reevaluate, how are you on track to your financial goals? When are those goals? And does your current portfolio structure still support reaching those goals based on when they are? If you're 2 years from retirement, the mix of things that you would probably want to own unless you have $100 million portfolio, is probably going to be very different than somebody that's, 2 decades from retirement, because volatility, downside volatility is really only risk when you're closer to your financial goals. Because the sell-off means you have to sell a lot more of the stock to get the money, right? Where bonds don't have the upside, but generally they're a little bit more safe on the downside. And cash is as rock solid on the downside as it gets, but is the least productive asset over the long term in terms of generating a positive return, right? So the biggest thing that I've tried to do is look at periods of time. Is the mix of assets that I own, does it still make sense? When do I need to start changing that? So I started making those changes over the past year. One more thing that I do, Lou, that I do think is useful is because I'm regularly looking at all of the stocks that I own and thinking about, do I want to continue to own this stock? If no, why am I letting it sit in my portfolio now? If yes, when do I want to add to it or not, right? Having those conversations on a regular basis as I'm adding new money as somebody that's in my earning years. But what I like to do is look at the edge cases, look at my best performing stocks and look at my worst performing stocks. As a starting point, I want to look for lessons. Are there any takeaways besides I'm an amazing investor or I'm an awful investor that I can use that can be signal, like, and that can actually inform my future investing decisions to get better results or less bad results, right? So I do look at those edge cases to try to look for anything that I can learn to just help me do better or to do less worse. And I think that's a healthy thing to do because it can help you check your ego and also help you look for just lessons that can help you be a little bit better investor, particularly if you're trying to pick individual stocks. So that's that.
Very good. So, Jason, I just realized something, and we probably owe everyone watching an apology, but we've been on an hour. I think we've gotten to one question.
Oh, we've gotten to
ish, but yeah. Anyway, and the thing is, there's so many great questions in here, so so we can focus on that, and I appreciate all of you. Great, yeah. I mean,
before we do answer your questions, just for anybody that's joined that didn't join at the top of the hour, and you haven't noticed the Chiron scrolling across the bottom of the screen, whether you're watching us on YouTube or you're a Motley Fool member, behind the paywall we use Slido. So go to slido.com. The event code's Fool24. Put that in there and get us your questions. Again, remember, when we answer your question, we're not telling you what to do. This is not a forum for personalized or individual financial advice for a litany of reasons. That's, you don't want this to be from us as your advisor's advice in this kind of forum. But we know some stuff and we're happy to answer the questions. So which one do you want to start? Should we take Let It Ride? This is the oldest question that's in here. So I think we should.
Okay, sure. Yeah.
Yeah. So Let It Ride. Good morning. Good morning to you too. Let It Ride. With high rates and inflation, I'm concerned about increasing default rates for buy now, pay later and all lenders. So when Let It Ride asked this question, we were probably talking about the buy now, pay later space and Klarna, with its potential IPO coming up here. So Lou, I will say that I'm trying to think about how to say this. When I'm looking at companies that are affected by credit risk, this is something that I make sure that I understand as much as I can about those particular businesses. I don't know that I would say that I'm concerned. I'm always concerned for those companies, but I wouldn't say that I'm worrying about it. What about you? Maybe you could almost invert it and say it the other way around, depending on how you take my definition of those terms.
I'd probably say that I am a little more worried, and nothing against Klarna or Affirm or anyone, but here's sort of my rule of thumb, and just playing by this framework, I think I need to be worried, is that I say this a lot, but I think one of the biggest loads of balderdash out there in the market is the idea of financial services innovation. This is my hill to die on, because it is such a simple business. You're buying and selling money. You've eliminated factories, widgets, and all of that. It is just a very simple game, and it is a highly regulated game. So you can only really, quote unquote, innovate on the fringes. And when you have real innovation, which I would say buy now, pay later, kind of, that passes the test more than a lot of what I see out there called innovation. You really, really, really have to slow play it. For things like this, and it's the same way I feel about Upstart, a company that I am mildly, at least, more optimistic about in the long term. You need a good decade to figure out if something new works, because you just can't tell anything until we have at least a full cycle, if
you
not
have to see it across a continuum
cycles.
of economic.
Right. Right. Which is exactly what the question is talking about. Higher rates, inflation. As the consumer has more pressure on them, how do they react in terms of, do they pay their bills? I don't know if this makes it uninvestable to me, but I do think that just because these things have now been around for a few years and they aren't as weird and as, oh, that's different as it was a few years ago, do not equate that to it is settled science. And we know the one downturn we have had in the history of buy now, pay later as a thing we're all watching was a really, really, really weird downturn. It was, the pandemic and all the craziness and money flying out the door and supports and all sorts of stuff. I don't think, and I say this about Upstart too, again, as much as positive, I don't think we know anything yet. And I think it is inevitable that the concern is accurate. Higher rates and inflation will lead to higher default rates. Now, what we'll find out, though, is that whether it's within a manageable range and how well they are able to account for it, how lucrative is this business to offset it? Because the question is going to be, like, even if things go wrong, does it go wrong as in, well, almost kind of what I said about Mercado Libre earlier with its lending. Will it go wrong in such a way that it ruins a quarter or multiple quarters? Or will it go wrong in the way of, like, okay, we can't keep the lights on anymore?
Right.
There's a whole continuum there, so it doesn't need to be but no, I think you are very, very right to be concerned about that. And the answer to me is that if you're also intrigued, this should still be a part of a diversified portfolio, which, not to put words in Tom Gardner's mouth when he was saying that, we'll definitely be buying. I would be willing to bet that they would say, they're not going to say you should sell everything else and do this. I think that's the idea too, is that we talk a lot, Jason and I both, about having ballast in your portfolio and sort of speculative in your portfolio.
Mm-hmm.
This is for the foreseeable future, not part of the ballast side of it.
Yeah, no, that's I think that's exactly right. So here's an interesting thing I just want to say about Klarna, because we think about these businesses as being new and innovative, and like you said, when it comes to financial tools, new and innovative hasn't necessarily proven to be of any, like, real shareholder value. Klarna is not new. I said that at the beginning of the hour too. This business has been around for a couple of decades at this point. Here's another cool thing about it. Because throughout its history, a lot of the capital that it has raised, largely to fund its core business, which is buying and selling money, it has taken on a lot of public debt. Companies that do this generally have to release financial statements. So we actually have a tremendous amount of reported financial statements for Klarna. You can go on its website, in its investor relations page that this privately held business has, and you can get years and years and years of data, which I do think will probably help when it does go public, because that track record is usually, you get 3 years of financials with public companies when they IPO.
Yeah,
I mean, there's financials back there that are a decade old, so you can really look through this company's history, and I think that is very, very useful. But again, it's also, hey, this company's been around; they figured something out to keep the lights on. So So that, that does make Klarna to me a little different than some of the other ones we've seen more recently, because it is an established business that has a track record of results that we can look at. So I think that's useful. I will say lastly, before we wrap up the hour here, Lou, that again, it's not leveraged in the same way that banks are, right? It's understanding how these lenders work and where they get their capital from versus banks, which have to give their capital back instantaneously to a depositor that walks in and says, I want to make a withdrawal. Understanding the takes and puts of those businesses when it comes to risk for capital is important as well. We'll talk a little bit more about this in the second hour too, because I do think thinking about the economy and banks and those industries is really important. But let's wrap up the first hour here, Lou.
All right.
Okay. First hour's wrapped up. Kick us off.
Yeah. We'll just move on for Clara. Yeah. So there are a lot of good questions here. I was looking, and again, about the same time it came in, 39 minutes ago, Ed. And yeah, we finally had aerospace news, Jason.
Aerospace news is good. Those that are just joining us here, remember, get your questions to us at slido.com or sli.do. The event code is Fool24. Lou's about to give a great answer on an aerospace business here, defense business. Yeah, but he's not going to be giving the questioner individual advice. We don't do that here. Lou, let's hear the question and your answer.
So Ed says, do you get good value investing in Lockheed Martin LMT after yesterday's 6% price decline due to losing a fighter plane contract to Boeing BA? And yeah, let's talk about this deal, Jason, because you don't get platform deals very often, and you don't get something as sexy as a fighter jet. And so I'm going to break this down real quick, but what's going on here is this is NGAD, the next generation air dominance fighter, the replacement not for the F-35, but for the F-22, the Raptor, which was sort of always an orphaned failed aircraft. It kind of was designed at the end of the analog era and released into the digital era. So it was sort of always kind of bandaging together as tech was getting bleeding edge. And it never really was. A lot of thoughts here. For one, kudos to Boeing. Matt, you always claim I never give Boeing credit, but they won this. And of course, the hard part now is to execute and actually make it work over the next 10, 15 years. But look, what are we talking about here? Air Force is going to spend $19 billion on R&D on this on the next 5 years or so, okay? Some of that will be funded, some of that will be out of pocket, but you have that 19. There's no real estimates from the Air Force now, but we estimate maybe 30 billion or so if you're thinking about it, and another 50 for procurement. You usually, rule of thumb here is that maintenance and after the fact is 2x the investment portion. Put it all together, you got $240 billion of value to Boeing and its subcontractors over the life of this program. If it goes well, I mean, that's over 30, 40 years, but that is a really, really big thing. I mean, Boeing's defense business, maybe 25 billion in sales, including space. So this is a real needle mover. It's important for Boeing, I think, more than Lockheed, because look, Boeing has lost every fighter competition it's been involved in until this, since basically the big McDonnell Douglas merger. They lost the F-35, they lost the F-22. The only fighter planes they have in their portfolio are things that they acquired. So this is generational R&D. I just said 19 billion or so the Pentagon is going to pay. That is hiring the next great scientists and next great engineers for a whole bunch of programs. So these things do layer on themselves. Boeing's issue in recent years hasn't been winning contracts. They've been delivering on contracts. Their biggest win prior to this, I always like to point out, executives ended up in jail in this win, but they did win the program, however they did it. But the K-46 tanker, that came in, that cost Boeing, they're still costing them, but we are still getting charges on that. It ended up Boeing spent more than double what they were allocated for this. It all came out of pocket. And when they finally delivered these things late, the Air Force had to turn around and send them back because Boeing forgot to clean out the hull of just spare parts and debris. Yeah.
Yeah.
So that's where Boeing is as a company. This is a huge opportunity for them. The market moving on it is, I guess, it was up, but look, we're talking over the next 20, 30, 50 years. This is going to be a benefit if it works out. Not exactly the, tomorrow. So just a little caveat there. And that whole big commercial business that is still 3-4x, they have to get that right too. But look, Boeing Defense was just as lousy as an operator in the last decade as Boeing Commercial. So this is a big deal. Question, however, was about Lockheed, down 6%. Not only did they lose that, but they have, I'm going to call it now, we get early state projections. We have 2% of the vote in, Jason. There's a separate competition going on for, unlike with the F-35, where it was just one plane for everybody. The Navy is running a separate competition, and we're going to spend another equal amount on a new, they call it an FA. It's not a pure fighter. It's not a dog fighter, but it's an attack. It's sort of like the F-35. Northrop Grumman is going to win that. Lockheed is going to lose that one too. Okay. What does this tell us about Lockheed? For one, the F-35 has not been the success operationally that the government wanted. Yeah. I think part of the message here is focus on that. Now, I should say the F-35 is still orders of magnitude bigger than either of these programs. I said maybe, and I'm kind of stretching to get to $250 billion over the lifetime for this new Boeing plane, the NGAD, assuming it happens. Trillion two over the life cycle for F-35. So Lockheed Martin is fine, but this removes a catalyst. Do you get good value investing them after the decline? I think they are fairly valued. I wouldn't say good value.
I did make the stock cheap.
Yeah. No, it was very expensive 6 months ago. It is much more reasonable of an entry point now. But this is Lockheed right now. You get a 3% dividend yield. You get sort of flat growth, but we're totally kind of coming out of that. Look, they've been working on NGAD for 5 years. All of this is classified. We don't know exactly what happened, but it's good that we have a president who decided to announce this personally, which we don't normally get, because we got a lot of stuff that may be a little more classified than what we normally do. This is going to be a Mach 2 plane. Boeing and Lockheed have been flying experimental versions of this for the last 5 years without really talking about it. So there's already been a lot of R&D funded, which helps. Lockheed is fine. Lockheed could be an even bigger winner in this administration if the U.S. Iron Dome happens, which we've talked about as sort of a new generation of missile defense, because Lockheed will be all over that. Most of the systems we use now for that are either Lockheed Prime or Lockheed subs. Lockheed also has a lot of dark stuff that we don't know what it is, but we can track what they're spending and what they're getting back from the government that seems to be progressing better than the fighter. I think if you want to hold Lockheed for the next 10 years, I think it's a pretty safe investment. You get a 3% dividend yield along the way, but has it become value because of this loss in the 6%? I don't think, given their trajectory and how long it takes to get there in this industry, I don't think it is, huge value here. So, take that for what it's worth. Yeah, it's a dogfight. Sorry.
Oh, you nailed it, Lou. You nailed it. Okay, we're going to end Fool24 for the rest of the day now. We after that, Lou, we can't. There's nothing else we can add. So I'm kidding. I'm kidding. Nice job, and you beat me to the dad joke for the hour. So that's good. That's good. All right, we got more questions that have come in. We've also got Jeffrey Mulvaney. It's awesome having you tune in as a new follower. That's great. We're going to get to your questions here in a minute. I wanted to
Jeff, wait, hold on. We should say, Jeff, though, I'm great that you're loving this, but I got to warn you that, most of the people on here aren't as talented as Jason and I. So, you're starting at the best. So just be ready for that. I mean,
there's low.
What can you do? But yes, go ahead.
Yeah, no, that's good. So there's a good number of questions coming in, and I want to take John Gagos's in a minute because I want to hear from you on HEICO, because I know how much you love TransDigm. But there are a few questions that have come in. This is related a little bit to what I was talking about with transitioning, as we were answering Cena's question about thinking about goals and your portfolio and looking at it and trying to be holistic with your investments and making sure that your portfolio fits where you are in your kind of life cycle as an investor. And Ed had a really good comment. It's difficult when you're getting near retirement, trying to change your investing style and become less tech heavy and invest with safer type stocks. So, I think this is the skill set to create wealth in many ways is very different than the skill set to retain wealth, right? Lou, have you ever read Once in Golconda?
I have not.
It is a wonderful, wonderful book that's about the U.S. Stock market history and also a little bit of the banking history too. That's because they're so intimately tied together, going back to the early 1900s all the way through. And I'm drawing a blank on the name of the individual, which I do that on Fool24. But there was a famous investor of his era who made and lost pretty vast fortunes 5 or 6 times over his career, and ended up committing suicide in his early 60s when his latest scheme had backfired, and he was worse than insolvent. So just the most extreme example of that. And I encourage people to read that book because it is just amazingly entertaining and like building the historical knowledge of investing in the US. Lou, like the fact that you could be a CEO of your company and short your company's stock, and that was okay. The world has changed. I mean, it was the Wild West, and the number of times that JP Morgan and other capitalists, to the true name of the word capitalist, providing capital, basically saved the U.S. stock market is remarkable. Like it's remarkable to go back and look at that history of the market. So I encourage people to read that book. But the point is that this is a story as old as time of making that transition based on when your goals are and what your goals are. One of the things that I do think is interesting though is that if we look at the modern blue chips, there's a lot of technology companies that have become lower risk investments because they've built, pretty sizable economic moats. And true tech innovation, you could say that there are no moats, right? That your moat is one disruptive technology away from evaporating. But you think about the scale that some of these businesses are at and their profitability. I wouldn't be so quick to just kind of turn away from technology, but I will say that's one of the reasons that I have largely been drawn to infrastructure and, manufacturing and real estate, that do make up a big core part of my portfolio and have for a long time, is because making stuff and delivering stuff, and that includes making power and delivering power, right? Getting wastewater out of the system and getting it clean. Like all of those things they're timeless, right? And you can beat the market owning a lot of those things too. So to me, it's less about investment style and more about just how you allocate across different buckets of risk. Because inside my portfolio, I still take those big swings. You mentioned QuantumScape, the not quantum computing company. We've got some quantum computing company questions in here. This is the solid state battery startup. That's a big swing. This is either going to be a home run or you're going to strike out, most likely, right? So I still have that risk in my portfolio, but it's more about segmenting risk and assets across it. So I think it's important still to kind of be able to scratch that itch to a certain extent with enough capital that if it works out, it can create economic value for your family, but not so much capital that if it doesn't work out, it hurts you. You're not able to live the life that you want to when you need to be counting on that income after you no longer want to, or you're no longer able to be working. So Ed, I feel you as somebody that's, not there yet. I'm still, hopefully I'll still be working in 20 years because I'll want to, because I love doing what we're doing right now. But the key is that making those transitions in small steps versus having to do it all in one big step, I think is certainly something that's helped me. Your mileage may vary based on a lot of different factors. Lou, anything to add there?
Well, just I was going to say the getting near versus in, I think, is so important, and kudos
really is.
for starting this or thinking about this ahead of time. The easy, simple way, but I think you might be talking more mindset than actually doing it.
Absolutely.
Which I mean, as far as the practical way,
it's not the blocking and tackling so much as how you're thinking about the blocking and tackling. Yeah,
right. The practical way, as far as the how to do it, is, and again, not individual advice, but to the extent that you can, just sort of while you're still adding, just make deliberate decisions on where you add. And I mean, that's sort of where I am. Is that I didn't ride the Magnificent 7 up intentionally, or so I tell myself, because I got to put a kid through college. I'm at the point where income matters, and my new money was being deployed to a different sector of stocks. And that is how I am rebalancing over time. But yeah, the mindset of, and this is why I think what we do is fun, and it really, really gets what.
You still with us here, Lou?
Huge winners in the non-high tech growth area, and kind of the fun, if you kind of want to gamify it, sort of, is to kind of make that the game, make it like, wow, can I find NVIDIA type companies? Maybe not, NVIDIA is a high standard for anything, but to sort of try and find those companies outside of big tech and maybe get that growth in income and rebalance your portfolio that way. Gamify it. That works for me. Anyway.
Well, and like I said before about my situation, your mileage may vary, but again, thinking about these things in different ways can help you get to the right answer for yourself. Mm-hmm. You ready to take the John's question?
So do we want to get to a company that is outside big tech? And again, full disclosure, I am very biased here when it comes to this company. Okay, but John Gallios said, "Good morning, my infrastructure brothers." Gosh, I've been called worse, so I'll take that. Lou, is HEICO a great alternative to TransDigm? We're talking tickers HEI and TDG. All right, so those are your tickers. And for those who don't know, and really, fools, you should know these companies. Both of these are basically airplane spare part makers. They do other things, and we'll get to that in a second, but they are basically just making component systems that go into aerospace and defense, mostly commercial, mostly what we call the aftermarket or spare parts. And despite the boring nature of these businesses, on TransDigm side, you have consistently 40-50% margins, software-like margins, making airplane parts. How do they do that? They are basically a private equity firm. They do not integrate. They acquire left and right, and they kind of let business units run. They kind of take some of the back office, but they very much have a private equity model. They focus on rare and protected. So parts that are either under patent protection, so you can't just go commoditize it, or parts that, while necessary, don't do the volume that you can just set up a competing factory to make knockoffs in some lower cost area and kind of drive them out of business. The example I always use is, and it was actually just on the podcast this weekend talking about this kind of great industrial stocks. If you are Delta Airlines and you have to fly 100 or 350 paying customers from Seattle to Atlanta, and you need a part, and your choices are either to pay whatever it takes to get that part or refund 350 paying customers. Jason, how price sensitive are you in that moment?
Yeah, you buy the part.
Not at all.
Yeah.
And, say what
cost. At that point, you're not talking about the cost of the part. You're talking about the lost revenue and then pulling that aircraft out of your productive assets for a period of time. And that's unacceptable. You can't do it.
And say what you will about the model. it works, and I mean, this is business. And to be honest, look,
and their customers willingly and happily continue to come back to TransDigm.
Right. Oh, they do. I mean, hey, they have no choice. But look, I mean, for Delta, if you want to keep your planes flying longer, and we've already mentioned Boeing, and yeah, you have to keep your planes flying longer than you used to. You need these supply chains. And, the last thing you want is, I mean, you may not like having to pay through the nose to TransDigm, but the last thing you want is to not be able to source that part. So it's it's a relationship that works. So, but this is a question about HEICO, not TransDigm. HEICO has a similar model. Okay, it's a little different. For one, they are more diversified. TransDigm is only aerospace. They are stubbornly so. On the call, I asked them this question about a year ago, and they're like, you know what? We see so much in the area we know we're not going to diversify. HEICO is in electronic components, especially for a lot of other industries. The diversification pays off sometimes. I'll give you an example, Jason. During COVID, when nobody was flying. Now, mind you, TransDigm did just fine because 80% of their costs are variable, so they actually kept the margins in place. But we saw revenue plunge. HEICO revenue held up a lot better. Why? Because they make one of their electronic systems went into those what do you call them? The ventilator machines that
their medical business is meaningful. It is meaningful.
Right.
What is electronic technologies group? I think that's their other segment. That's not the flight stuff.
Right. So what do you get with HEICO? It's about a third of the size. So you do have, like, I guess, more big growth potential. You get that diversification, which honestly hasn't really worked out over time for them, but it worked out in that instance. We have to note that this is sort of a weird, and whether or not this bothers you or not, but it is a business that is run by a very, very charismatic CEO, and his sons run the units. And so there is kind of something there. But Bill, I'm sharing the screen. Is it a great alternative? Let's let the numbers describe from the screen. That's not bad, right? In terms of, is it an alternative? This is a 10-year chart. I do total return here because I think it's important. Neither of these are regular dividend payers. Definitely on the TransDigm side, all the cash they generate either goes into acquisitions, debt payment, or every now and then we get a nice surprise, a $35 or $40 special dividend. But on a total return basis, great alternative. They've both just walloped the S&P 500.
Lou, if you could, click on chart options up there, and let's do the annualized. So go down to data in legend.
Yeah.
Annualized value only. I just want to contextualize what that means against the market's long-term averages. So over the past 10 years, we've gotten 12.4% CAGR from the S&P.
Mm-hmm.
That's about 25% better than the market's long-term average. So let's start there. So the market's done about 25% better than the long-term average. These two companies have done double the market over this period, which was 25% better. So exceptional returns.
And just so you don't think I'm cherry picking, if I click on all these times, max is probably, TransDigm's been around longer, so the max. But even if you go in, I'm guessing TransDigm here. Yeah. We're going to get a HEICO beating in a window at some point. No. Okay. Maybe not. Last year, HEICO was beaten. Yeah. Okay. So, but HEICO has had, a special year. So here's how I have always thought about this as an investor. I respect both companies. TransDigm is a really, really, really long-term holding for me. So I've done very well in it over those times. A lot of that 10-year chart is reflected in my current price. I've never seen the need to buy both, and TransDigm is the one I own, so I have never personally bought HEICO. I think if you are drawn to the diversification or drawn to the smaller story, and it's hard to just, the bigger you get, the harder it is to move the needle. I think there are arguments for HEICO, and I think what the numbers will tell you that over a 10-year period, and I'm biased towards longer term, that yes, it is a very, very viable alternative. I still see great things for TransDigm. I really do. And that's why I own it. I don't know if the past will definitely reflect the future, because just their ability to return, but they see a lot of opportunities. They're right now in for a Boeing asset that would be a $7-8 billion deal. So they are bigger businesses that still have this kind of proprietary or special or you can't easily duplicate. I think the model works. And I would urge anyone who, is looking for, to diversify away from tech. I don't know about these two companies, but the point is that might not match up with NVIDIA, Jason, but those are pretty exciting companies in boring areas. And I would suggest to you that they are all over the market. So back to Ed's question about kind of diversification and getting out of big tech, they may not be as easy to find and they may not get as much airtime on CNBC, but my favorite way to diversify is to do my best to find companies like this out there and, get just as excited about them as I am about the Mag 7.
Yeah, I think that's the key is you have to look, you have to turn over stones, and they're definitely out there. Another question from Ed. Ed made some comments about some of the fintech companies, and Ed's kind of shared this thought pretty regularly whenever they're dropping comments here, talking about the turnover with the fintech companies and these high expectations that are set that don't seem to materialize. But the specific question that I want to answer is, why is there so much love for PayPal at the Motley Fool? I don't think it's as broad as you would maybe think, that there's broad love for PayPal across the Motley Fool, whether it's contributors like us or it's the lead advisors and analysts that are actually doing the stock picking and the capital allocation in the services, whether it's a real money portfolio or just a stock ideas service like Rule Breakers or Stock Advisor. But I will say this, that there is a very vocal minority that is largely making the case about PayPal on a couple things. So number one, there were a lot of us that thought PayPal's kind of everything app that they were trying to build, if you go back 3 or 4 or 5 years ago, that they were onto something. But what we found is that they just weren't prioritizing very well and they weren't being disciplined. They did some smart things. They bought a buy now, pay later business for, I don't know, less than $1 billion, when others were spending like Block spent many more billions of dollars to buy a buy now, pay later business. So PayPal's made some good decisions, but has not completely delivered along the way. But the more recent vocal call for PayPal is largely based on two things. The first thing is that since Alex Chris, I believe, became the CEO, we're over a year ago now, was this rigorous discipline of focusing on where are we strong? Where are we resonating with users that are using us more and using us often? And which of those things are ones that actually we can make money at? So they've really kind of rationalized the business. And through a lot of that beginning phase, we saw metrics going backwards with users, where they were losing users, and user growth in other areas might not have been as attractive. But over the past couple of quarters, we've seen that stabilize, Lou, as they've kind of shrugged off parts of the business that where there was a user base, but it wasn't a meaningfully valuable user base, and really focused on their core markets and products where they can continue to grow and leverage those things. So you have a stabilized business. That's the first part. And Bill, I just sent a screen share over if you can share it. This is the second part of that. You have a PayPal that's cheap, that is reasonably priced on that cash flows basis, less than 11 times free cash flow, that's sort of priced that management's going to continue to kind of stumble. And also that the business has not really much of an attractive way to grow cash flows from here. I believe that the business is going to be able to start growing cash flow per share from here. I think it's a solid business if you have the right expectations. The risk right now with PayPal in the near term, and it could, this is the one thing that I think could kind of upend the business a little bit, is they do a lot of payments processing through their white label business, where it's not branded PayPal, but it's a pretty meaningfully sized part of the business. and they have some pretty big partners. And there's a risk that if they lose some of those partners, you lose one partner and you lose 5% of your revenue, right? It's meaningful. And if they lose some of those agreements, it could be a step backwards for the business. And some of that concern is priced into the business right there. But I do think that the turnaround is starting to work, and the stock is probably cheaper than the business merits right now. And broadly, the people that I think are, and I don't want to speak for anybody, but I think directionally, a lot of the people that are saying positive things about PayPal are saying, look, this is a good business that's stable, the turnaround is working, and the stock is more discounted than the turnaround is being given credit for working.
Yeah,
Lou?
I think that's right. It's fine to me. Yeah, I don't know. A real quick follow-up on TransDigm, because I should have mentioned this as well. Jeffrey asks, are they going to split? Because, yeah, I kind of buried the lead when I talked about, I think their last dividend was $75 per share, and that sounds pretty good. The shares do trade, they close Friday at $1,346.12. So that is, the 75 in context. TransDigm has never done a split. I think they've been asked a lot. I think the answer is very similar to what Warren Buffett has said. They don't have a huge workforce to give incentives to, like shares, which is one of the big reasons you see companies split. Look, I mean, it's funny. The TransDigm corporate headquarters is like a 3-story nondescript building in downtown Cleveland with maybe 20 or 30 people, just kind of all accountants. But this is so they
build it more than 3 stories. There's a chance that the winter snows and winds are going to blow the thing over. Yeah.
Oh yeah. No, I'm not criticizing. That's actually a pro. Heiko, on the other hand, I would bet they've done definitely more than a dozen stock splits. So that could be, especially if you like to buy whole shares. I think most of these companies think that fractional shares has sort of eliminated the need to have to do splits. But if you want to buy whole shares, Heiko is definitely more likely to split. And I wouldn't. I mean, it's fine if they do. It doesn't really change the business case one bit for me. But I would not expect to see a TransDigm split again. They very much view themselves as a permanent capital fund, as just this, wait, I almost used a word that made it sound like a Ponzi, and I didn't mean to, but a perpetual motion machine of they are just generating gobs of cash. They watch the balance sheet very closely. They do have a ton of debt. I will say that, because that's sort of their financial firepower. They, I think, manage the debt, and they don't have a lot of maturities right now, which is good, but they manage the debt as part of their core competency. But they don't. I mean, the retail part of this is almost just kind of, that's how we got our money originally. And I don't think they're focused on doing things like a 10-for-1 stock split to make it more enticing.
Right.
Which, is a bummer, because I think everyone should get a shot at this one. But no, I would not expect a split. Okay,
let me so Ed had a question here. I'm just going to say, I want to leave this one in here. Maybe somebody later in the day can get it. I don't follow Snowflake closely enough to really weigh in. And I don't want to weigh in on Salesforce and not weigh in on Snowflake. Beyond one comment I'll make, Ed, on Salesforce, the ticker is CRM for that, is that I think we're starting to see how they can leverage AI as a revenue generating tool, and something that unlocks productivity for their core customers that use Salesforce's CRM, its customer relationship manager, in ways that are going to do things that people won't do, consistently following up with either customers that you have or leads, people that you're trying to get turned into customers. I don't know if we're giving them enough credit for their ability to actually to monetize that, not just be a defensive tool to stave off competitors where it's kind of zero sum. You're just kind of keeping your business there, but ways that I think can actually deliver growth in the company's revenue. So we'll have to let that play out. So that's the only thing I wanted to say.
I will. Well, just quick on that. I will say that, yes, I think you're right, but it's interesting, and I think it's deliberate, but they are not monetizing that yet. The way, I mean, that was one thing that came out of
the last quarter. They talked a little bit about the small amount of money that they're starting to
Right, but with the guidance, it appears they're not. Snowflake,
Right.
and again, we should leave it up there. But I'll tell you, I am an owner of Snowflake. I think they're boring. I don't think they're like crazy high growth, but I continue to like the way they are positioned as sort of a mature software stock, but I don't think it's anything more than that. So I don't know what my opinion is on them in that case, but that's one I own. But anyway, go ahead.
Yeah. Okay. So we got from Jeffrey Mulvaney, dropped this in earlier. You touched on this. I'm retiring December 25th. And I want to supplement my income by selling covered calls. Friends of mine are killing it and making $100,000 plus. A couple things. First, yeah, Lou, I'm with you. But first, Jeffrey, congratulations.
Yes.
You have an amazing goal that you're going to cross a finish line. And here's the thing: stop and look around and just find some way to just celebrate that moment for yourself. But also don't think about it as a finish line. That's the starting gate, right? That's the starting gate for everything in front of you. So it's awesome that you're on here with us now as a new follower, for what a lot of people view as the end of the journey. And this is just the beginning of the next leg of that journey. So that's fantastic. If you didn't see Lou's reaction on screen,
which apologies, Jeffrey, I shouldn't have done that. No, let's talk about it. Yeah,
I think Lou, I think your reaction was externally what I was going through internally when I read it. Is that whenever I read somebody about anything insert investing topic here, friends of mine are making a killing, are killing it. It scares the hell out of me.
Right.
When I see that, because typically the thing that follows it are some pretty painful lessons and losses that are the price paid to learn those lessons. So the particular strategy that Jeffrey's describing here is selling covered calls. So some things about selling covered calls. Number one, it can be a wonderful way to generate income. It can also be a wonderful way to sell great companies that you want to continue to own for a lower price than you plan to ever sell those stocks for. Over the past couple of years, as we've gone through this incredible bull market, things like selling covered calls can be a good way to strip your portfolio bare of companies that can continue to grow in value over the long term. Now, hear me out. What happens, you've got your block of 100 stocks that you want to sell some calls on, and the premiums are really high because the stock's been really volatile. And let's say the stock's $100 now, and you're selling next month's calls, and you set a strike of $110. And what that means is that whoever buys the call on the other end, they get to buy the stock from you at $110 when that option expires. So if the stock goes to 112, 115, they get to pay $110 for that stock, right? And you have to sell it. You got money from them. You sold the option. You sold somebody the right to make that future decision, and traded that right for an amount of money today. What I see happen a lot with people that go into options the first time and they go into selling covered calls because this is like a safe way to start generating income is they end up selling a stock that they didn't really want to sell, and it gets called away. And they say, well, wow, man, that stock jumped up to $120 and it was $100 last month when I wrote that call. So they're a little bit mad because they sold it for 110 and it's at 120 now. And sure, they got a few bucks of premium there along the way, right? But they're anchoring on that 100 and that 110. And they're saying, oh, it's going to come down. It's going to come down, right? So they leave the cash in their portfolio from the sale and they don't reallocate it to something else because they're watching that one stock waiting for it to come back down so they can buy it back, right? So you can get so myopic and so focused that you completely throw your strategy out the window. The emotions take control and you start compounding bad decision after bad decision. So it's really, really important to have a plan, to have the right mindset going into it, and accept the results, do an autopsy and try to figure out what happened, what worked, what didn't, and then reevaluate going forward what your plan is going to be. It's trading options is very, very different. So you have to accept that reality. Selling covered calls is a great way to make money when the market's not necessarily doing great, or when it's going down. That can be even better because the premiums get better because of the volatility. And you're less likely to have those stocks called away. And then you can, you sell another call, keeps going down or sideways. So the risk, again, is having stocks that you want to own called away for prices that are lower than you wanted to really sell it for. And then that poisons your brain and causes you to make bad decisions. So just be mindful of what's going on. And I would suggest anybody in this situation, look at Motley Fool Options. Jim Mueller does a wonderful job. The percentage of profitable trades is very, very high. And it's a great way to cut your teeth as an investor using options for the first time with safe strategies that have a high rate of success. So that's my one pitch for a service that the Motley Fool offers. It's in one of the levels. I'm honestly not sure which one, but I just would encourage anybody that's looking at options to think about that, or to find somebody they know that's actually traded options that you actually can trust what they're telling you, and not that they're just beating their chest about, it's the old, I went to Vegas and made $5,000. Well, they don't tell you they also lost $6,000, right? So right. It's important to find an expert that is actually trustable when it comes to something like options for the first time. And then start small too. You don't have to start big. Small. I mean, you have to have 100 shares of the companies, but don't aim for $100,000 in income your first year. Aim for building an income of a couple $1,000s a month by the end of your first 6 months or year or whatever. So take your time and take a year or two and build up some knowledge before you really kind of crank this up. What am I missing? This is not. I want to be clear too, Jeffrey. I'm not giving you personal advice here.
Yeah, Jeffrey. For the record, and we need to say that Jeffrey, I was not, reacting to you because Jason, he also stuck it there. I think this is probably just a comment suggesting that with our thick Boston accents, you could barely hear us. But maybe the greatest compliment I've ever gotten, calling it, you're like car guys. So Jeffrey. We don't pick favorites.
Who's click and who's clack?
Oh, definitely. We all know. Come on. But look, we love you all. We don't pick favorites, but Jeffrey. But yeah, no. The reaction was definitely to the. I get nervous anytime I hear my friends are killing it, and that. So just look. I don't have a problem with options. Jason uses them. I don't. I will say it. I mean, I stand by my status that boring is better, and there's so many fun things to do in this world. I don't want to be stuck by a computer screen worrying about things, and that's how I invest. And options is a pretty poor choice for that. Just understand that with options, you are sort of, especially done wrong, it's growth serum or it's serum for growth, and it's also serum for risk. And that the more you go out on the potential growth side, the more risk you're coming on, the more aggressive you're getting. Know what you're getting into. And as Jason said, I love the Fool option service. I don't personally use it, but I think it, and really, really, really please understand what you're doing. Understand it in such a way before you do an option thing that you could explain it to, a fifth grader or something like that, because yes, you can do very, very well. And I'm sure there are people out there who are killing it. No strategy works forever. As I think Jason said, as strategies are kind of, reliant on the current market to some extent, especially if you're really, really doing to the high end. You can do pretty consistent things, but they tend to be just more income. And just please understand what you're doing, because it's boring to get rich slowly, but it's also allows me to go do other fun things. And so just, nothing wrong with that. I'm not gonna tell anyone just hide from options, but just please understand what you're doing if you do it.
I have nothing to add.
Yeah, we have a couple of questions on Rocket Lab, and Rocket Lab's fun, so let's talk about it. RKLB. Rod Williams about, okay, this was 19 hours ago. Hi, guys, what do you think about Rocket Lab? I read on a page, Yahoo Finance, it has great potential as a market bagger. And this morning we have one, can you give your opinion on Rocket Lab? Kartik, did I say that right, hopefully? So yeah, so I highlighted the old question and not the new one because I do think that it's interesting here. Full disclosure, I'm a Rocket Lab shareholder. I really do. I would generally agree with this statement. It has great potential to be a market bagger. However, this is one of those cases where I do think you need to discuss the company and the stock separately. All right. I am a shareholder of Rocket Lab. I also, in full disclosure, I sold off part of my stake in the last year. It's not because I don't believe in the company, but in a period of a few months, the stock went up 400%.
When sometimes we see these themes get caught up in the zeitgeist of the market and the animal spirits take over, and next thing you know, you look back and it's like, wow, I've essentially earned 5 or 10 years of returns in a business that's moved forward about 6 months.
Right. And I like money. I took it. I kept some because I still believe in the company. But yeah, so I would argue that the company didn't improve its operations by 400 to 500% during that time, which kind of, and it wasn't exactly undervalued before. It's given up about half of that too, for what it's worth. It's still up, I'm pretty sure, from November, but we've seen it come back. So here's the deal. Rocket Lab is, I think, the only one of these space SPACs from when we had the SPAC period, just companies that came out of that I really think has cracked the code. Because with space, look, fools, this is literally rocket science, right? So it is not easy. There are two independent variables here that they have to get right for us as investors. Both have to be right. A lot of this is very experimental. So there is the science project side of it. And science projects are fraught with risk. And in this case, literally, when things get screwed up, there are massive explosions and people see it. So you have to get the science project right. You also have to get the business case. Once you get that science project right and you prove it's possible and you can do it on a regular basis, you also have to make the business case for it. That double bar eliminates a lot of these companies for me, because even the ones that are doing cool stuff, and there are companies, I won't name them, that I don't think are great investments, that have done a lot better on the science project part of it than I would have imagined 3 years ago. So I tend to be wrong. But, it is really, really hard to build a sustainable business here. What Rocket Lab is trying to do.
Lou, what's your favorite 3 words about these businesses?
Space is hard.
There you go.
Space is hard. Yeah. But Rocket Lab wants to be the answer to a lot of my questions about the space economy. And, Morgan Stanley did something a few years ago. I think it was a $15 trillion market. And yeah, okay, good luck. I don't know how you got there, but the only way you're going to get there is it's not going to be that all of the Fortune 500 hire an rocket scientist and start an aerospace team. A lot of it is going to be outsourced. Rocket Lab is not just a launch company. They want you as a non-space customer to come to them. They will design your satellite. They will build your satellite. They will operate and control and maintain your satellite while it's in orbit. Oh yeah, and also they will launch it into space. I like this model. I think this is the winning model if you get it all right, because again, the size of the space economy we're talking about is not going to be that every company builds it out internally. But look, to their credit, Peter Beck is a great CEO, the CEO of this company. He is an engineer.
Isn't that Sir Peter Beck?
I believe so now, but I don't acknowledge New Zealand as a country. So,
wow. Shots fired, ladies and gentlemen.
No, I'm jealous because I can't move there. Okay. But look, by design, this is a multi-decade process. That is how this engineer's brain works, and that is how they are building out a company.
Our lens, the problem is our lens as I shouldn't say the problem, but the reality is, like, our lens as investors is skewed. That the lens has been reground on the expectations of companies that can deliver growth in quarters to a few years. That historically we haven't seen, right? So that's one of the realities that again, it takes us back to, this is a very blocking and tackling, doing the fundamentals of building things that are on the leading edge of risk, that is going to take decades, like you said, to scale up.
Right. And let's give a real world example of that. Just like, why has it gone from up 400 to up 180 in the last 2 months? Well, there's a short report saying that they're having trouble with the Neutron rocket, which is their next generation rocket. And then in the earnings call, they changed their wording from the Neutron will launch mid 2025 to in the second half of 2025.
Yeah.
Now, Jason, we can, be the actually guy and say that, if it goes up for the first time on August 1st, the original guidance was right. And like they really didn't change things, but it doesn't matter really,
right?
Because the Neutron is a 20-year project.
Right. Well, that's exactly right. But I want to say this too about the short report, because this is important. And this is coming from somebody that views shorting as a necessary and important, healthy part of the market to help us with price discovery. I think it is.
I love shorting. Yeah. I love shorting.
And I try to, if I own a company, I will skim to dig into, depending on what I see, a short report that comes out. But the short report on Rocket Lab did not come out because Rocket Labs is struggling with Neutron. It came out because the stock 5x'd in a matter of months. Yeah. And there was an opportunity to short the stock. It's the ready, fire, aim approach for a lot of these short shops, where you find a stock that's expensive, you find the prop that's expensive and highly followed and volatile, and then you find the problems, you short the stock, you publish your material about the problems, and you profit, right? Now, again, I'm casting a very wide net here, right? And I'm trying to avoid, dispersion here, but that's the general model for a lot of the short operations out there, is you find the stock that is a good candidate to short, and then you figure out what are the problems and uncertainties, because every company has problems and uncertainties. You leverage that by finding the highly volatile ones that have a popular following, particularly with retail investors, because that's the tree that you can shake and make investors fall out of.
Right. So to sum it all up and to answer these two questions, I read on a page, Yahoo Finance, it has great potential as a multi-bagger. I don't argue that. I think that over time, if it goes to script, this is going to be a substantial company. Opinion on it, though, just do understand they are playing, not that they don't care about the stock price or anything like that, but they are on a long-term timetable that probably doesn't mean the business is going to improve 400% in any short period. The volatility of the stock and the valuation are kind of separate from the way this business is run. If you buy in knowing this and understanding it's going to be a roller coaster ride of a stock, even if the company is just fine. This is, for all the good things I say about it, best as a small part of a diversified portfolio, and just go in knowing that it is going to be a wild ride, and don't jump out at the first downturn and then jump in at the high time. Just, this is one of those stocks that is going to be traded and people are going to lose money on. If you decide that you like this business and want to be a long-term holder, understand going in that there is a price and volatility and just headline risk that comes along with this, and be prepared for that, and size your proportion, size your position, kind of how you can sleep well at night with a stock like this. Because for all the good of it, don't underestimate the risk, especially if you separate the stock from the company.
I think you nailed it there. To me, this is the epitome of a start small and build out your position over time as the business shows that it's worth buying more and the stock price is appropriate to buying at that time. Mm-hmm. Those three things have to align, and it's a perfect one where you buy just a little bit and maybe you never add to it because the story doesn't pan out. Yeah. You buy it over time as the business is delivering and the stock price stays reasonable. Can I go ahead, Lou? Go ahead.
Well, just one more thing, because we need a hot take. We need a Jim Cramer yelling at the wall. there is more there with Rocket Lab potentially than there is with SpaceX.
I'm not going to argue that, but that is hot. Coming in hot.
There you go. So let's just leave it at that and move on.
Yeah. A lot less counterparty or closely held party dealings going on. When you have to sell to people that don't also own you and the businesses that you're selling to. There you go.
And making products that people want. Yeah.
Oh, wow. There you go. Okay. All right. Let's take tax accountants. This is a follow-up to the conversation about options. Our conversation that Jeffrey Mulvaney kind of kicked off for us here. So tax accountant writes, $100,000 premium is useless out of context for covered calls. I want to know what their portfolio size is and how aggressively they are with strike prices. That's exactly right. So going back to the tape, Jeffrey Mulvaney's comment was just that. They know friends that are earning those 100K premiums with options. So that's exactly right. If you've got a $10 million stock portfolio, it's easy. I should say easy. Easy is a terrible description, but it's far more viable to be able to generate $100,000 in premium using covered calls with more conservative strikes, where you're earning a lower premium, but you're also reducing the probability that those shares are going to get called away from you, right? So that's exactly right. It's the context with options and these sorts of numbers can vary very, very wildly. So I just wanted to touch on that. But again, the key is that you can use options in just about every way you want to generate levels of return, reduce risk in your portfolio. You can actually reduce risk in some ways using options, but you can also use them as an accelerant to destroy wealth. Jesse Livermore, it just came to me. Jesse Livermore is the name of the early 20th century investor who is one of the most interesting stories about building and losing wealth that you'll ever read. So, all right, so that's that. We've got about 4 minutes left here.
And then, and unfortunately, from what I understand, that Jason was so smitten with the car guy's comment that he's heading down to NPR to apply somewhere, right? Is that your plan? Is that why you're leaving us?
Yeah, my name though is far too uninteresting to be an NPR correspondent or host.
You're right. Mine's not great either, if we're honest.
Yeah. I was going to test that.
But anyway, Jeffrey, thank you for that. And hey, tell your friends. Right?
Yeah, absolutely.
Absolutely. Yeah. All right, Jason, we only get you for a few more minutes. Anywhere else you want to go before we go?
Let's see. I don't want to talk about quantum computing, but I want to talk around quantum computing. So one more from
you and the rest of the investing world, but go ahead.
Yeah. So again, this our new friend Jeffrey Mulvaney put this question in, talking about quantum computing. Now I've lost the question. Where did it go? Talking about quant. So put in quant, but we're not talking about quantitative analysis or quantitative easing. Quantum computing. Won't I benefit by owning the big boys like Microsoft, IBM, Alphabet, etc.? Do I need to add the singular stocks? I'm not even going to get into the names of the companies that have popped up like mushrooms in poo after a rainstorm. That some of them may or may not have.
Hey, just real quick, maybe not with the NPR. Yeah, go ahead.
yeah, that would. Yeah, that. Well, that's we're on YouTube and behind the paywall for Motley members. So we, I think I can get away with it here. But the point is that we always, again, it's in these themes. We were talking about rockets and AI and the cloud. Like every time there's a big theme, mushrooms pop up. Mushrooms can be delicious, but they can also be toxic, right? And that's there's always layers with me with these analogies, Lou. So there may or may not be some legitimacy, like Rigetti computing. So like there may be something there, right? With more than one of these when it comes to quantum computing. But to Jeffrey's point, just as with artificial intelligence, as we have seen so far, some of the biggest winners were companies that were already really big winners, right? And when it comes to something like quantum computing that is so extremely expensive at this phase, and getting to the point where you can actually develop stable quantum computers that can work. It's like the rocket industry early, where most of the rockets exploded before they got off the launch pad. I shouldn't say most, but a lot. Kind of the same thing happens with quantum computing, where these things destabilize, right? So we're so far out that having the resources to develop it is so important. But again, circling back, I'm not going to talk about that technology, but around the idea, because it has value to be thinking about it. If you see something that is compelling and it helps you learn more about it, this is something that I do in a lot of cases. And I started out with QuantumScape this way, is I took a very small stake, just a little nibble, just a little bit to get some skin in the game and exposure. So then I'll start actually paying closer attention, do the research, read up about the technology, look at the companies that are playing in the space, and try to get some idea, where are we really? And then this is the big one. What is the likelihood of there actually being shareholder returns in this area? Is it just going to be really good for the world? Or is it going to make me some money along the way too, right? Those two things are not always coupled together, right? There have been plenty of wonderful advancements that have been great for the world, like solar panels I talked about, but most of the companies have not made money for their shareholders. So I think that's a big thing you have to think about with these sorts of things. And sometimes taking that small stake gets you enough exposure to pay attention, but not enough so that if it doesn't pan out, it hurts you, but get you enough in a position where if you do see more opportunity, maybe you build out a position over time. So that's it, Lou. We're at the top of the hour. We're at the bottom of the hour. And I think you're going to kick me out here, right?
I mean, I've been asking for about an hour now. So if we can finally do it, I got good news though, fools.
Years, buddy.
Hours. I see Dan
years.
Cap.
Yeah. Where's Dan? Dan, come on out here, buddy.
It's not my choice. It's not my choice. Bills, keep me in the cage. Here I am.
Luke, Luke, Cap, you guys have a great hour here together, and I'll see you next time.
Thanks, sir.
Thanks, Chase. And pause.
That's right.
All right, it's 10 a.m. Dan, how you doing today?
I'm good. How are you?
I'm good. Fools, for those tuning in, we should say Dan and I are here to give opinions. We are here to provide educational advice. We're not here to provide personalized financial advice. We're not going to try and do that. Dan, just to give you a summary of where we've been this morning, I started the day by kind of talking about conspiracy theories, and it's kind of gone downhill from there. But I
missed the good part. Darn
it. Well, the good part is still to come, because I think you're on basically all day, and that's. But fools, look, we are here at Slido. Keyword Fool24. Get your questions in. We have a lot of great questions coming in. Dan, it is the week in review. It was a week. It actually, I mentioned this earlier, and kind of how things are made. We were sitting there with the weekly newsletter, summing things up, about to talk about this S&P 500 having its longest weekly losing streak in more than 2 years, which, isn't really that long of a time or a big a deal, but it makes for a heck of a headline, right? And then that triple witching volatility right at the end there. The S&P ended up like 0.5% for the week, and we had to do, but it got me thinking about just how different like that 0.5% move is to market psychology, because we would have had headlines this morning had the S&P just not been up 0.5%. If it would have been down just a bit, markets on longest losing streak in years, versus it was a week, which I think kind of gets into the nice thing about weekends is we can sort of take a break and focus on the long term. Or kind of, what do you think of the week? What are your thoughts coming out of kind of the week we've had, or where are you right now?
Well, let me respond to that triple witching deal. I would not take much. I would not take much comfort out of a triple witching bounce, because
no,
those options expirations you will often see after you've seen a big move like we've seen in the past couple of months. You'll often see sort of a reversion to the mean, where some folks that are underwater on their options positions, they kind of do what they can. I mean, there's only so much that you can do, but traders do what they can to try to make it so that they can minimize their short-term losses on their options positions. Now, I will say this. I don't think that triple witching has the impact that it used to have, because so much of options trading has shifted to shorter time frames. You know, it used to be all you had were monthly expirations of index options. Now you have freaking daily expirations of index options. And so the mythical third Friday of the third month of each quarter is like, it's just another day, folks.
Right. And to define what we're talking about here, just because it is sort of just a term that people like to say, as Dan said, the third Friday of March, June, September, December, the end of each quarter, it is a day where just the stars align. You have the perfect eclipse, index futures, index options, and stock option contracts all expire at the same time. The net is that people have to rebalance. They have to get in ahead of that. They have to cash out, whatever they're doing. It tends to create volatility and volume more than anything in the final hour of the trading day. And then, as Dan says, it all unwinds for your positions. And as long-term investors, I can't ever remember, like, oh, Dad, you remember the second triple witching of 2014, don't you? So for long-term investors, it's mostly just noise. But yeah, to your point, it does cause a good half hour of craziness, even if it is less, and under the radar, that most of those are just kind of unwound or rewound Monday at 9:37.
So I'm going to share my screen real quick, because one thing that hit me this week, what we're looking at here is the American Association of Individual Investors, AAII, does a sentiment survey every week. And it is something that a lot of people follow. Some follow it as a contrary indicator, where if you get extreme bullishness, it indicates froth in the market. And so it might make sense to expect a downturn. Similarly, when investors get super bearish, it may be a sign that people are kind of overreacting to negative news and that you might get a bump up. Take a look at those bearish readings over the past 4 weeks now. It's 4 weeks in a row. If the type is too small on your screens, I apologize. 60.6% in February 26th, 57.1 the next week, 59.2 the next week, 58.1 this current week. That's 4 weeks in a row, 57% or worse. And one of our Fool technicians kind of took a look at this and did the history and went back as far as you can go back, and found that there had only been a few times when you'd had even a couple of weeks in a row where you had that when you were in the high 50s, low 60s as far as bearish sentiment was concerned. And so, not drawing any conclusions for where the market's going to go from here, but am going to say that clearly individual investors are not comfortable. And they are trying to figure out what the lay of the land is. It's kind of like, I don't know if you've watched the new golf, the indoor golf thing, but I've heard that they have this putting green, where like they have the mechanical thing, and it's like it pops up piece of the green and then it depresses the other piece, and then when they want a different green, they hit the button and it kind of goes up, stuff like that. And that seems to be what's happening with market sentiment right now, is that every week you get some new lay of the land that is kind of like, oh, whoa, we went this direction, huh? Oh yeah, we went this direction. This one I knew was coming, but this other way, huh? That's interesting to me.
Yeah, no, I'm a basketball guy, not a golf guy, so I'm plenty busy. But let's stay on the big macro, and I'm going to play radio here, Dan.
Yeah,
because this week, Fed Chairman Jerome Powell, he said a bad word. He said a bad word.
I remember the word. Yes, he did.
He did. So again, with that, we're supposed to go to break and then come back, right? That's how you play radio. But we won't do that to you fools. We'll just keep going. Aww. So as you may be aware, the Federal Reserve had its meeting today or this week, and they did hold rates steady. I don't think that was a surprise. They are still calling for 2 cuts this year. However, I would note, if you want to really kind of be a Fed watcher or whatever, back in December, the forecast for 2 rate cuts this year, 2 to 3, was 15 of the 19 dot plots. Now it's down to 11 of the 19, which again, I think sort of speaks to it kind of it's and I don't know. But here's the bad word, Dan. And here's the thing that I think really, really was interesting.
It's the T word.
Yes.
It's the T word. And it's not the T word you might be thinking.
All right. Now we're all Googling. But okay, so that's fine. That's fine. But you're going to pay attention to. But Jerome Powell was asked about tariffs and was asked if that could cause inflation.
Tariffs is not the T word, folks. Just telling you.
And he did. I mean, look, the Fed has raised its forecast for inflation for 2025 to 2.7% from 2.5. So, not insignificant, not huge. But he said, yes, there will be inflation coming out of tariffs. But that inflation is, Dan?
Transitory.
And fools, why is this a bad word? Why are we thinking about this? Because Jerome has used that word before, okay? Mr. Powell, if we go back in the Wayback Machine a couple of years to the period of COVID, and we had these same questions, like what does a one-time event, a pandemic that causes all sorts of changes in supply chains and shipping ability and retail demand, what does that do to inflation? And he said, I'm not worried about it because any inflation that comes out of a pandemic is transitory, right? What happened from there? I mean, I guess, look, on a long enough time scale, everything is transitory, right, Dan?
Exactly.
But I think maybe market watchers wasn't totally reassured hearing Chairman Powell say that word now, because the last time he said it during COVID, consumer prices from there soared to a 4-decade high. So if it was transitory, it sure as heck wasn't short.
Yeah, nobody wants 9% inflation again.
Right. So here's where we are. We are here in an area where, once again, just like in COVID, the Fed is saying, yes, inflation is going up, but we got this, guys. We know what's going on, and we're not going to panic about it. And, glass half full, I don't want my central bankers panicking. I don't want them overreacting. If anything, I am sensitive to the idea that at times in the recent past, not Jerome Powell, but in times in recent past, the Fed Reserve was overly sensitive to the near term and the Wall Street and stuff like that. And I want them taking the big picture. But I also want them to be the ones manning the wall. And I want them to be our first line of defense on all sorts of things like inflation and stagflation, which frankly really does scare me right now, the stagflation part of it. But I want them to be, maybe not to articulate it to us, but I want them to be hypersensitive and hyper paranoid about this stuff because they are the ones that have a chance to solve it. So I kind of get, like, Jerome, you couldn't have thought, I mean, we all have computers now. We all have amazing thesauruses.
Oh, we'd be making fun
in
of
our
if we
hand.
did that. Come on.
But did you have to say transitory? I don't know, Dan. How worried are you? Am I making a big deal out of? Am I just playing radio here, or is this?
It's a fun gotcha moment. I mean, let's face it. If you found a synonym, there's enough Fed watchers out there. If you found a synonym, we'd all be making fun of him.
Mm-hmm.
Ephemeral. Yeah, you pick ephemeral. Why didn't you just say transitory again? And so we'd all be making fun of him there. But the Economist has a point. Let's put it. Let's be clear here. When you put a fixed additional cost, when you bake in a fixed additional cost into a good, then the price of that good will go up. But it'll be a one-time shocker. I mean, yes, there's the amount of the tax, there's the amount of the tariff. And then there is the adjustment in supply and demand that comes when you have a price shock. And that will have some impact on the price as well. But once that works itself out, assuming no further changes in the tariff structure, you're at the new price. So the question becomes, what happens next? Because economists are great, but there's always second order effects. And the second order effect will be that companies that had to make price adjustments in order to incorporate the additional cost of importing goods, will see what consumers do in response to that. And Mr. Powell is assuming that the companies will make the conclusion that it was a one-time thing. It did not add to or detract from their pricing power. And so they will continue to make whatever decisions they made in the past. What I suspect is a possibility is that, in contrast to that, is that if companies find that demand for their products is more inelastic than they expected based on the price increase from tariffs, they might say, hey, we're faring better than we expected. Maybe we'll just keep on sending those prices up, especially now that consumers have this expectation that prices are going to keep going up, because a lot of the inflation battle in the Fed's watch is psychology. And the thing that they are most worried about, it's not the T word, it's the E word. They don't want the inflation to become entrenched in the psychology of American consumers and American businesses. Because once that becomes entrenched, then companies start to raise prices, not because they have to, but because they can, and because consumers almost expect it. And at that point, central banks start to lose control. Inflation starts to have behavior that doesn't necessarily correspond with what you're seeing from the macroeconomic factors, other macroeconomic factors. And then you can have a situation like stagflation, where it's like, it's not because the economy is booming. It's just, in fact, it may be because the economy is not booming. And these companies say, well, what lever do we have to pull? We can't get people to buy more. Let's charge the ones who are being resilient. Let's charge them more in order to keep our profits up. And then you have a stagflation type situation. So, yeah, I'll be curious how that works out. And I'll also be curious, you're going to see probably increasing political pressure to the extent that the Fed remains resolute in trying to fend off any inflationary pressures. You're going to see increasing criticism from the executive branch. I would predict that the Fed is working against the national interest of the United States. And, we'll see what happens when and if that movement starts to mobilize and, take more concrete form than it has in the past.
Yeah. And certainly, to your point about companies realizing they can get away with it, that was the argument. And I think there's some merit to it, with COVID, that prices didn't come back down. I'll say the other side too is that we had come off of a period where, free money, et cetera, where I do feel like, in the company's defense, some of those price hikes that they made permanent, that were a long time coming in a way. Yeah. So, it's hard to say. And there is an equilibrium, I believe, in classical economics. I don't think it's always, I think the second order effect, and I don't think it's always, just as simple as, as it works out. So both things can be true. There is an equilibrium, but there's also probably a lot more wiggle in the system at times to keep elevated prices than maybe companies would think until they try it. And that is, I think, as you say, the risk. Yeah. No, it's an interesting time. And I think, to your point on the politics too, one thing I think that I've thought, like, all through this cycle and back, Jerome Powell didn't like being at zero. And I don't think his predecessor.
Nobody liked being at zero.
Well, look.
Actually, that's a lie. There were a lot of people who loved it being at zero.
There were whole zip codes in Northern California who really, really, really liked it when money was worthless. As I'm going to put it, that's the other way. If you're paying zero for money, then you're saying money is worthless, right? But I don't think, if you are the Federal Reserve and you only have very few tools, I don't think you like neutering your biggest one. So I think I have always been of the opinion that the market's kind of assumption that the Fed couldn't wait to get back to where it was pre-COVID was probably naive. I think, and Dan and I are a couple of old men. I think both in our lifetimes, I don't think current interest rates would be considered wacky or zany or high. I think that the Fed's probably more comfortable in this range and just reacting versus sort of a perception last year that, oh, the Fed is dying to bring the rates down and they're just looking for excuses. So I think transitory or not, or how long is transitory, which I think is the real question for you, Jerome, is like, transitory could be 5 years and that's not great. I do think that with the geopolitical, with the uncertainty about tariffs and all that, I think that as a group, they're probably much more likely to be content to just sit around and find out and not be proactive than some in the markets would have hoped for a few months ago. We'll see.
Jeffrey Mulvaney says raising prices because they can. Isn't that what happened during COVID with the supply chain stuff?
Yeah.
Jeffrey, I mean, prices did rise. I don't know, it is an interesting question. Was there, this comes up. It's interesting when you get free market economics folks in a room in situations where there are supply shocks or demand shocks, because people throw around the term price gouging a lot when there's a quick shortage of supply or when there's a huge increase in demand or when both happen at the same time. And it's like, well, okay, the free market makes those prices go up. You would expect those prices to go up based on economic principles. And I'm not taking a pro or con stance here. That's just what the economic principles say.
Right.
It's the decision that you make as a policymaker, that legislators, that other policymakers may take with that and say, you know what, we don't want the economic principles to work that way in this situation. It's that public policy that when you've got a hurricane hitting up towards Florida and everybody's gassing up at the same time and trying to get out of Dodge, that you don't see gas prices go to $10 a gallon, because people would pay it. But policymakers say, yeah, that's a part of the free market that we don't want to deal with.
Mm-hmm. Yeah, that's
but yeah, I just don't know where the right line is. When it comes to, policymakers have reasonable differences of opinion about what is a good policy and what is a bad policy. And, in some cases you try things out and you see what works and you see what doesn't, and then you adjust on the fly, hopefully, and do more of the good and stop doing the bad and figure it out.
Yeah, there's two ways to look at it. I think you just articulated kind of the philosophical conundrum here, and Jeffrey's mentioning Robert Reich. The other, I think, pushback, and I don't know if this is my opinion, but the idea of price gouging that Robert Reich has talked about, and companies raising prices more than what they needed to, just the word needed, I don't know what that is. But I think while you can argue they did more than they needed to, if you want, there's also a really good argument to be made that companies were pretty timid to raise prices in the period leading up to COVID, just because of various things going on in the economy. And so they were swallowing lower margins, or there was a lot of pressure on margins in some areas. And so maybe what happened is they raised it beyond what they wanted to. Maybe they raised it in a temporary thing, realized that they could, quote unquote, get away with it, and then kind of reset the norms, which they hadn't done. So it's a complicated question. It's funny to me that, when you talk about price gouging in Kroger or something in groceries, and then you look at the profit margins of the grocery business, it's a lot more complicated than political sound bites. And I would hate to be too strong a defender of either side as being pure and lily white here. I think it's a complicated question, and at some point we are going to end up somewhere in the middle.
There's a supply chain that a lot of people don't don't realize what it is, and that you don't look far enough down the road to do things. I'm going to have to find a new provider other than, I can't do this. I'm going to have to find a different provider than Yahoo Finance. Every time I bring Yahoo Finance up, my internet stutters because they have to serve me 20 ads at the same time, which is no good. But, egg prices, a great example. Are you going to blame Kroger for high egg prices? Really?
Yeah.
Because, or how far back do you go? Do you blame Cal-Maine Foods, ticker CALM? They're the producer. They're the ones that are selling to retailers like Kroger, ticker KR. And so, Cal-Maine had some pretty good results the last time egg prices were heightened. But then you have to ask, okay, do they actually have control of supply? Or are they getting hit by the inputs that they need in order to get stuff done? Are they having to pay more for egg-laying hens? Because there's so few of them, wherever they get the hens from. Mm-hmm. So you always have to ask the question. And the price gouging, very few people ask the question, and so very few people end up pointing at the right place in order to do that. And Jeffrey, I agree with you. It's always a value judgment when you say that a company needs to do something because there's countervailing balancing factors, right? In one sense, if a business has a mission of serving consumers, then they want to do right by consumers. If a company has a fiduciary duty to serve its shareholders, then it is obligated by law to take actions that benefit its shareholders. When those two things are not aligned, then you have situations where one group or another is going to disagree with the actions that a company takes. And so, at that point, different parties have different rights. Shareholders have the ability to vote boards of directors out of power and to name new directors in their place, assuming that one person doesn't have such a huge majority of the shares that it is basically a corporate dictatorship. On the other hand, if you are a consumer and a company doesn't do something that you like, then you vote with your pocketbook and you either find a company that will do it the way that you want, or you do without. And that's an economic decision that a lot of people make every single day, if only because they can't afford to buy something that they used to buy because they don't have the money and the price went up. And that's supposed to be how economics works. And if you realize that's how economics works, then you can take a more proactive stance with it, realizing, as always, that you are one person among millions and that your marginal impact will be minimal. But nevertheless, when you add up all those marginal impacts, they do add up to something. And so, Jeffrey, I think it'll be interesting to see what happens if and when various companies take action based on, what we're seeing geopolitically and macroeconomically across the globe. And, we'll see what happens. That's what we're here for. That's why we'll be here next week. We'll have something else to take a look at and say, yep, that looks like what I was talking about. Oh, nope, didn't see that one coming. But that's why we're here.
I'm going to stay somewhat big macro related, but kind of hit the questions. And good morning, Lily. Good morning, Mike. Happy spring, MH. Yeah, I don't know how it feels up there, Dan, but it feels like spring in Atlanta, kinda. We're getting there. So
I've got frost in the yard again today. It's going to be like that for another week. But this is what you get in New England, and you know.
Well, Atlanta, we had 80 degrees on Wednesday. My daughter had a track meet on Thursday, and it was 32, and now we're back up to 56. So yeah, but fools, we are at Slido Fool24. Get your questions in. We are here for you, and on YouTube 8 to 8. Dan's going to be here till 8. I'm not going to be here, but I get the questions.
No, not at 8. No.
Almost. Ed, you asked this hours ago, and I hope you're still around because I think it's a good kind of play off of the big macro and what's going on. Ed said, do you have any concerns about FedEx? FDX is the ticker. Earnings report yesterday, was it a surprise or expected? Do you think UPS will have similar earnings warnings? We're kind of in a weird, vicious circle right now with the FedEx UPS. So to the surprise part, and we can talk about what's going on, but I don't think we were surprised because we saw UPS earnings, and we weren't surprised about UPS because we saw the last quarter of FedEx. But what happened? FedEx reported 451. That's 30 cents below estimates, I think, or maybe a little less than that. I've seen the high part. Revenue beat, but it was a poor margin quarter. We talked about the pandemic before, Dan, and we talked about kind of what went on in the economy there, and there was a surge in shipping. And for the last few years, we've had sort of a blowback on that. It's been a crummy 18 months or so for transportation and logistics company. Part of that, if Dan and I were sitting here a year ago, instead of talking about, price gouging and stuff like that, we would be yelling at each other, hard landing versus soft landing, right? Because that was all the rage this time a year ago. Here's the thing. When those are the discussions going on, corporate customers, which drive most of the transportation volume, that's not a time when you're stocking up inventories. When your macro forecast is a recession or just a slowdown, if those are your two choices, you're not adding a lot of inventories. That rippled through transportation, and it has just been a crummy year or so on volumes. Now, I'll be honest, and this is where I'm wrong a lot, Dan, and this is where I was wrong, because I came into this extended earnings season, and good Lord, every year, the fourth quarter, just the earnings season takes so long. But I came in sort of thinking I'm smarter in the markets, and we would see the turnaround in transportation this quarter. Kind of a couple things. For one, we are now a year removed from the hard landing talk. I don't hear anyone, maybe it's starting to pick up again, but if you think back November, December, we were not hearing fears of a hard landing. Secondly, we were hearing a lot of talk post-election, pro or against tariffs. And I thought it was pretty logical to think that corporate customers that, again, drive most of the movement of goods around the country are A, less worried about a hard landing, and B, maybe trying to get out in front of the potential for tariffs. So we would see a huge volume pickup. And quite frankly, I was really wrong. That didn't happen at UPS. That didn't happen across most of the truckers. And we're certainly not seeing it from FedEx here. The big takeaway from FedEx, and they are in, I think, their fiscal third, I think. So yeah, when they're talking about,
remember what their fiscal year is,
but so there were a lot of headlines that they lowered their full year guidance. Remember, mostly that's backwards looking now. They're not really talking about the next 9 months. They're talking about the next 3. But there is just continued sluggishness. All right. So were we surprised? I will say I'm disappointed that we haven't seen volumes return. I don't think at this point I'm surprised. I've been saying my big macro call, and it's about as good as, I think we are careening towards a recession or a slowdown or anything right now. I think we're at risk to it. What I think is that, like it or not, what's going on in Washington, the volume, the pace of just change is elevated relative to normal. Tariffs on, tariffs off, tariffs here, tariffs there. We're going to do this. We're going to do that. There are plenty of other YouTube streams to discuss the merits of all of these things. And I don't think Dan and I really want to get into the political discussion. But one thing I have found is a well-run company focused on the long term can navigate through almost any environment. It might not be pretty, but they can. You give a good management team a set of rules and tell them this is what you're playing by, they will follow those rules and navigate. The one thing that corporations and consumers, based on the consumer confidence numbers, don't like is uncertainty. When you don't have the set of rules that you're going to play by, so you can't plan. In times like that, the natural reaction is the fight or flight. It is to just pause, to do less. And what we are seeing right now in the economy is, I think that it's not that management teams that are doing business with FedEx and that are just deciding what we're shipping. It's not that they're saying the sky is falling. It's they're saying, I don't know. And so I'm not going to overcommit. So do I have concerns? Was I surprised? No, I am disappointed. And I do think that that this whole earnings season, FedEx just as another underline on that, is just the story of this quarter was things aren't that bad, but we're not sure where we go from here. And I think FedEx is the latest example of that. I don't know, Dan, very long-winded way to answer that question. I don't know if you have anything to add there or want to move on, but
Jeremy and I talked about this a little bit last night, and FedEx, a little bit more international exposure, a little bit more the go-to for international air transit. I would, like I said last night, I don't think that international air transit is the most sensitive to the macroeconomic stuff that we've seen, and especially to tariffs, because it's expensive to ship stuff internationally by air. Yeah. And so if you are doing that, it's generally a mission critical part or something like that you need. And frankly, if you're going to pay up for the expensive shipping, then you're probably going to pay up for the tariff too, because you need the part. And so, I don't expect that part of the business necessarily. The tariffs are the issue there. I think it's really more just the more general uncertainty about what's going on with consumer demand. What's going on? How much are we going to see further e-commerce related shifting in logistics? You've got Amazon that's built up its own huge logistics network. That's had an impact on FedEx, on UPS. These things, it takes a while. It takes time for them to play out. And, every time I see one of those smiley faced Amazon trucks, I'm sort of like, yep, that's one less FedEx with the arrow embedded in the logo that I'm going to see at some point. And I don't know how I feel about that. Yes, vertical integration can be good for a company. I do own Amazon stock, so, that's good from that standpoint. But the closer that you get to one provider, vertical integration can lead to single providers of things that can, in the long run, eventually, if a company chooses to exercise its power this way, lead to kind of a dominion over consumers in a way that can be detrimental to the public good. So, I'm a big fan of competition. And I always like it when competitors are able to succeed against each other. And so, yeah, like you say, seeing FedEx kind of, again, underperform, the question is, is it really, every time that FedEx has traditionally been considered a bellwether of economic activity. And so, that assumes that it is doing the best job possible in the industry to handle the transportation logistics needs of its clients. But if that changes, if that assumption is incorrect, if disruptors are making it so that FedEx is no longer the go-to solution, then that's a different thing. And that's something I think that it'll take time for it to play out, but it is a trend that I think you have to be aware of, that you have to watch if you're invested in any of these stocks, because it seems to be going on. And yes, there's a lot of noise about tariffs and trade, and you can't even tell how much of it's noise and how much of it is clear transmission that you need to pay attention to. But underneath that is a whole bunch of business and corporate planning that, where big companies are fighting against each other to try to figure out how to be the shipping and logistics company in the future.
Yeah, real quick, and then we can move on. I will say I'm quite bullish on FedEx and UPS getting out of the Amazon business. I actually really, really like that long term. It's near term volume disruption, but we're not really seeing that. FedEx did this years ago. It was the best thing they did, and UPS is finally doing it in the second half of this year. I'm also pretty bearish on Amazon getting anyone at scale other than themselves. I don't see most of Amazon's competitors handing over all that customer data and other data to Amazon to save a penny on logistics. So I think Amazon, I think it is vertical integration and not a real threat. As far as like, I think FedEx found this, and I believe this to be true of UPS. And I'm going to make some logic assumptions here, so I could be wrong. But Amazon has its own in-house logistics, as you say. I am going to bet that the packages that they choose to pay someone else to do instead of handling in-house are not the ones that they thought they could do cost effectively on their own. It was sort of the low margin, the hardest of the business is what they were outsourcing, because why would you pay someone for stuff you can do easily? But
so you basically say your position basically is Amazon had enough power as a supplier of, as a company that needed shipping services, that they had enough power on that to basically tell UPS, and it was largely UPS if I recall correctly, we want you to do this, and we're going to give you like not a very good price because we can, and you're going to do it because you're going to make a little bit of profit, and you don't have an alternative at this point. And so, like, it was never like that's. Right. Am I restating your position?
Well, basically, and yeah, I mean, it was FedEx before it was UPS. Remember, a few years ago, Amazon and UPS hated each other, and it was all FedEx. And FedEx just stopped playing the game, and UPS jumped in. But yeah, look, if you're building out a massive delivery system, you probably the parts that you don't do are not the ones. Were not the low-hanging fruit.
Yeah.
And I do think the path forward for FedEx has been to focus on to not try to be the biggest, but to focus on areas where they can gain margin. UPS is belatedly, and which is weird to me, kind of come to the same conclusion. And I do think it's a better path forward. And frankly, it's not a short case for Amazon, because Amazon does so much more. I do wonder the incremental headaches on their logistics and delivery post breakup of UPS. Maybe with their scale, it will all work out in the end, but I still sort of question the original premise of getting into it in terms of, for them. And I think post UPS is when that judgment really has to be made, because suddenly it is, all right, guys, you're on your own. But anyway, I know there's a lot of questions on here. So Dan,
let me go back. I mean, Ed asked a question back when you and Jason were talking, and I wanted to grab that. Ed says, the problem with fintechs is you build your position over 3 years. Stock does whatever it does. You lose your gains if you have any, because then a new shiny fintech enters the market. Ed, I got to tell you, I couldn't agree more. I have struggled with this with PayPal, ticker PYPL, because you keep expecting it to bounce back, but then, you hear about some other, like you say, shiny new fintech that's doing it a little bit differently. I've seen it with the buy now, pay later stuff. You had Affirm Holdings, AFRM. It was this big innovator. It was doing things. And then now suddenly everybody's talking about Sezzle, ticker SEZL. It's doing things a little bit differently. And I mean, it's this rotation of, like whoever has the best idea. It's the competition of ideas. It's what makes the market. Consumer preferences notably fickle, and so whenever you get into this kind of environment, it's a challenge. I find the area, I talk sometimes with Matt Frankel. Matt is all into fintechs, likes a bunch of them. I'm like, God, these guys hand out money left and right. I cannot tell you how much money SoFi Technologies, ticker SOFI, has paid me as a consumer to do business with them. They pay me above market on cash back on a credit card. They paid me several $100s to, I'll tell you, I did this. I really did. I'll tell you. They paid me several $100s to take a personal loan. I took the personal loan. I pocketed the several $100s. I paid the personal loan back in 1 month. I paid $6.22 in interest. I got a $300 bonus, if I remember correctly.
That's
and I got a favorable thing on my credit rating too, because I paid my personal loan. So really, guys, I mean, come on, and yes, hardly anybody games the system this way. And sure, a company like SoFi, more often than not, when you get a bonus for opening an account, you will more than compensate them for that bonus over the lifetime of your relationship with the financial company. But the pace of innovation is just so high,
right?
That like nobody's.
But wait,
yeah.
Time out.
But wait,
all
there's
right,
more.
Because like I'll see you're a grumpy old man and I'll double down. I said this earlier, and I'm glad you brought this up because you're making the point for me. 99% of financial innovation, of financial services innovation, is marketing balderdash, and it just pretends to be innovation. You mentioned SoFi. I don't want to hate on SoFi because they seem like a decently run bank. I have a nothing that touches Jack Dorsey, so
they've been a huge success. I mean, they've done really well.
But here's what it is: they're a bank. They are not innovation. They are a marketing story. Dan and I are old. We can probably, Dan, do you remember the Super Bowl commercial? This is the dawn of Discover. The Discover card.
Oh, I missed that one.
Fools.
But I am a Discover card member since 1986. This was the first card that I ever had.
So the commercial worked on him, whether or not. But okay, so Fools, the Wayback Machine, for those that still have their hair. So this was Sears Roebuck, and it was Dean Witter. A few of them were going to get together, and they were going to reinvent the credit card with innovation. And don't do it now because Dan and I are much more interesting. But when I'm gone, go find on YouTube. Go find.
Don't
Discover.
hate on Rick. That's not fair.
Oh no! Rick is far more entertaining. So no, but go go when neither of us are on. Go find Discover Super Bowl commercial and just see it's great 80s like LA Law theme music, and it's talking about sunrises and all this about how they reinventing the credit card. And you know what they did, Dan? They just made another credit card with marketing. Okay. A few years later, I got a chance to invest, not personally, I don't have that kind of money, but a group that was coming out of, remember when credit card banks were separate and it was MBNA and all of these guys, and now they've all been swallowed up. What's the one? Capital One it came out of Signet Bank and they became a bank, I think. But anyway, so you had all of these really smart people from MBNA, this credit card giant, who were going to take their knowledge and reform the system with an innovative new credit card. And they were going to use innovation and technology. And they created something called Juniper Financial. Dan, I'm sure you have a Juniper card in your account too.
I've never heard of these people.
They raised a ton of money. They started a whole thing. They reinvented credit cards. They had a pretty slick marketing campaign, got the account for a new airline called JetBlue that was coming. Ended up, it was just a credit card, and they got sold to Barclays a couple years later, okay? But you know what their innovation was, Dan? Do you know what their number one, and I'm not kidding you,
was it shiny?
For all of their talk of innovation, and it was ended up card? It was stolen by Amex for their blue card, which was another innovation. They made the credit card translucent.
Yes.
That was the innovation, which is all just to say that, yes, there are companies, and buy now, pay later is sort of in a gray area. Definitely what Upstart is doing would count as innovation. But most of what you see presented as fintech innovation is marketing, because all they're doing is buying and selling money. There isn't, you can't add bells and whistles here. You're in a highly regulated market. So even if you do find a way to reinvent the mousetrap, you're going to make heads explode over at the FDIC, and you can't do it. So just not that it can't happen. And look, if you can be a good bank, SoFi is a decent bank, but just value them as a bank and be careful about fintech innovation. I'll get off this hill now, but I mean, that's just, I don't know.
I gotta say, I did not have the translucent credit card, but I did have the metal one. I think
Yes.
it's the Chase Sapphire maybe or something like
Yes.
that. I can't remember which one it was, but I did have the metal one.
Can I tell you, even the new Chase Amazon card is literally about this thick, like in electronics, it gets smooth. But anyway, that's now we're really ranting.
Now we need to be putting up affiliate links and yeah, all that.
Yeah. I feel like 80% of that rant might have been financial advice. And fools, I'm not trying to disparage any of the companies, including SoFi. I just feel as though if you're a long-term investor, you need to look at these for their core business and value them relative to the other competitors in the space, and not believe that magic fairy dust, like overpaying Dan to open a loan so you can say, look at we're the fastest growing bank in the world. Those aren't sustainable advantages. That's marketing.
I mean, I will say this. There are many aspects of financial services that could do with some reform. And so companies that are trying to do something to do that, I know Sezzle is set up as a B Corp, or, it's set up with an idea of having stakeholders beyond investors. And that is, there's something to be said for that.
Right.
Investing in these things, it's difficult sometimes to figure out how best to invest in these sorts of things. But, David Gardner will say, invest in things that'll make the world the way that you want it to look. That is a terrible paraphrase of how David said it much more eloquently. But that's kind of where you go. Ed, I totally understand where you're coming from.
Yeah.
And,
just one more on that. Upstart too. I mean, whether or not it ends up being a good investment, the FICO score was dying to be disrupted. It was just begging to be disrupted. It is outdated. So yeah, I mean, they got to get it right. So there are examples.
I just want to get Cyber Mikey's question from 45 minutes ago. I want to get that off the queue. Cyber Mikey says a lot of recommendations dropped for AI Playbook this week. Is this a coincidence? Is it based on the thesis and the PGI for the market? Cyber Mikey, I mean, AI Playbook, one of our premium services, and you will find a lot of Motley Fool premium services, especially when they're still in the initial phase of their development. They will have a set schedule where those real money services will get infusions of cash from the Motley Fool in order to make new investments or to add to existing investments. I'm not going to get into the details of exactly what investments AI Playbook decided to put that capital to work in. But that capital usually comes in on a prearranged schedule. And so I would not draw conclusions from the timing of those recommendations necessarily on market conditions, but read the recommendations if you have access to them. And sometimes the recommendations will make timeliness comments. It may be something that goes into the thought process about whether a particular stock is one that gets selected for getting some of that new capital that gets added. But don't conclude, if a service, if you hear that a service has made a bunch of new recommendations, take a look at the kind of the about the service stuff if you have access to it. Oftentimes you will find out that from the beginning, these services were set up so they get, a certain amount of money in December, a certain amount in March, a certain amount in June. And so that's when you can probably expect to see recommendations, because that's when they've got the money to do it.
Yeah. Yeah. Cadence matters. Yeah. So real quick, and we can get off shipping, but Jeffrey asks, why doesn't Amazon just buy FedEx, UPS, or Post Office? I mean, Post Office, we'll see. I mean, we've gone through like 13 news cycles since I got on this morning, Dan. Exactly. But so far, I don't think Post Office is for sale. I mean, theoretically, the others are. I would say that I guess at the end of the day, with the amount they've spent, maybe. But, I think there's an advantage to organic growth if to kind of get what you need. Also, back to the other point, if they did it, it would be for in-house, because I don't think you'd see FedEx and UPS's other customers kind of going along for the ride and wanting to give up all of that customer data and data. So I do think you'd just be buying it internally. A lot of what FedEx and UPS does is of very little interest to Amazon, or would only be long-term interest for Amazon. I think it's better for them to just invest in how they are. And I think that the real advantage they have, and this was back at AWS too, they needed to build out their data center capacity for their own business. The brilliance of the way Amazon was able to do that is they took what should have been a massive cost and turned it into a revenue generator, right? Because they needed that capacity for themselves. They said, all right, well, what if we build it out and offer it to others? That was always presented as the plan for logistics too. I think that was a little Pollyanna for kind of the reasons I've said. And I don't think Amazon is really a competitive threat to FedEx or UPS outside of the Amazon business. But I mean, I think the real answer to that is that I think they just rather grow and invest in what they need and not just buy a ready-made system that does not necessarily line up with what they need. So they would have to adjust and carve and do all that work. But look, they probably spend FedEx's market cap every year in just shipping costs, both indirect and direct. So I guess
you've also had the Trump administration say, there was a lot of talk after the election that antitrust scrutiny is going to go away. You've had the Trump administration affirm that no, antitrust is not going to go away, and that in particular tech companies are going to be kind of in the crosshairs when it comes to figuring out exactly does an acquisition make sense. I just don't see Amazon being able to justify on competitive grounds a purchase of these companies still have $100 billion market caps, Lou. I can't remember for sure whether FedEx and UPS are still.
FedEx is well below that. UPS might be under it now too, but let me say.
I'm looking FedEx. FedEx is at 60 and
UPS is 98.
Okay, so
yeah,
but too big. I think they're too big. I've wondered too about there are some smaller companies out there that I've been sort of like, when is that going to be the takeover? But just hadn't happened yet.
Yeah.
Let me get Lovely Lily's question from 23 minutes ago. What can you say about on stocks? Serve Robotics, ticker SERV, BigBear.ai, ticker BBAI, and Wolfspeed, ticker WOLF. I'm not a big semiconductor guy. I do know that Wolfspeed's, I think it's silicon carbide. I'm going to goof this up. The new semiconductor technology that Wolfspeed, the stock hasn't really done terribly well. And so it seems like, even though there are some advantages to this new technology that, it's not necessarily catching fire in terms of business. But Lily, I would save this question, frankly, if I had to pick one person, I'd save it for Jose Najarro because he's the semiconductor guy. He'll know more about it. Big Bear AI, I just have to say, companies that change their names to take advantage of new trends, I'm always a little bit concerned about. New Wave Solutions at the beginning of 2023 is the predecessor to BigBear.ai. And again, that stock has not done well. Serve Robotics is an interesting one. They're trying to take. I've tried to liken this to if you've seen Star Wars.
Yeah,
the original Star Wars.
That's what it looks like.
If you remember that they're in the Death Star and they're carrying Chewbacca around, and there's this little guy on the ground. He's about a foot tall. He's on wheels, and he's like running around. Chewbacca roars at the little robot guy, and the robot scurries around. He's like squeaking around and doing stuff like that. That's essentially what Serve Robotics is doing. They're trying to cover last mile delivery with sidewalk-oriented robots. And I'll tell you, I think it was Rick. Rick and I did a scorecard on Serve Robotics not long ago, and Rick ripped the heck out of it. It was funny. Oh my goodness! And Rick, if it wasn't you, I'm gonna have to look this up now because I thought it was Rick, but it may not have been. If I'm putting words in Rick's mouth, it was Rick.
It was him.
Good, and it was funny. So I can't remember. Oh, it's not out yet.
Oh, all right.
Oh no!
Real quick, Bill, as we're talking, share the screen. Yeah, this is what we're talking about. All right, there you go, right there. That is a blurry. So Rick, I'm dying to hear Rick's thing. I will say that Atlanta is one of the rollout cities, and it's really, really cute. First of all, I mean, I've seen them. They are all over the Georgia Tech campus, which is what you'd expect. But I will say that you know how we had the bird scooters, and then all of a sudden, everywhere you look, there'd be broken down bird scooters over the side. If you do a drive, and so I go that way a lot. And if you drive through Georgia Tech's campus, you will see the adorable thing going through and seeing to its drive, and you will see like 4 or 5 of them, like just going in circles or spinning, or it. And I might have the ratio wrong. It's really cool. I get the point, but from my very, 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 very limited exposure to them, I'll take the over on how long it takes to mainstream those.
There you go.
We'll see.
That's a good place to end, Lou. That's awesome.
It is the end of the hour. It is 11 a.m., which, like those serve robots, my battery's about done. But let's get Rick in here, because Rick, have you actually played with one of these serves, or have you seen it, or?
Yeah, so just to be clear, I've seen like other companies' versions of it. There's a bunch of them in Miami. I've seen them like nervously skating down the going very slowly down US 1. I've seen them not necessarily not these SAMOs, not the serve robotics, but just basically these R2D2s, food stores with these Yeti cooler on wheels, so to speak.
Yeah.
Basically navigating like the mall food court. At a hotel, I've seen them come up and deliver, like, oh, you need something from downstairs from housekeeping. They'll actually bring it up to you, and it's cute. But again, to me, always my problem with serve, and again, I hope it works, because that would be great. It's just these things are so slow, and I know they go up to 11 miles per hour. They don't. That's not how they fast. They got a nap. That's like on a straight runway. I mean, these are basically sidewalks with a lot of stuff. They're going very cautiously, navigating crosswalks and all these things. There was even an accident with actual crash into a Waymo car. So it was kind of like it's like, if you look it up, it happened in LA back in December.
An insurance adjuster's dream come true, by the way.
But oddly enough, I mean, again, this is to the technology's credit of both Waymo and Serve. Is that they sort of like bumped into each other in like about a minute and a half. They were sort of like negotiating, like, all right, you move, I move, and eventually they made their way with minimal damage, so they still were able to continue their course. But again, to me, I love the idea of it, but the practicality of all this machinery, electronic, to deliver my chicken parm sub from, basically like half a mile, because the range is very limited right now. And even though they're working with drones, to me, it's just a silly process where they have to bring a drone and then hand it off to the SAMO and do it. And I know it's cute, because I mean, if you see the John Mulaney specials last year, now it's come back. SAMO is it's a TV star right now, so everyone's going to be excited about it, but financially feasible, I don't know. I don't think anyone would pay a premium for that. And even though you're saving labor costs, you're saving on a lot of things. I mean, I dig deeper into the financials and everything. There were only 59. I think there were 57 of them in service at the end of last year, back in December. And it was down from 59 three months earlier. So they have good deals in place. And obviously the fact that it was spun off from Uber / Postmates, that is good. There are people out there that want it to succeed, but to me, it just feels like a novelty to me. I don't know how feasible it is, the actual terrain that it can cover. I mean, it's proven and it's doing everything, but the same people that are critical about Tesla's FSD are just fine with these things basically crossing the street, on their own, with much lesser technology and not the 9 cameras all the way around, like 11 cameras, like some of these cars do. So, yeah.
So I've overstayed my welcome. But
let
me just say, Rick, if there were only 60 out of them, and it was just a Friday night last night, if there's only 60 out there, I'd say a good 10% of their fleet is probably lying sideways on the Georgia Tech campus right now. So, okay. It's been a pleasure. Dan, I think I'll see you tomorrow morning. We're doing 3 more hours, so I'm going to go plug in and recharge my battery.
Enjoy your Saturday, day, buddy. And Motley Fool viewers, thank you for joining us for the 11 o'clock hour. This is an Ask Us Anything with Rick Munarriz. I'm Dan Caplinger, and we are happy to take your questions. Please get them into Slido. We love answering questions. I can't tell you. I mean, it sounds silly, but it is true, and if you can stump us, that's always a good feeling too, because you know what? If we can't answer something, then we won't be afraid to tell you that we can't answer it. And we will inevitably have someone coming on later who will be able to answer that question for you. And so it's just a matter of digging through the archives and figuring out when that answer got put in. We just like to help. We're trying to educate, we're trying to amuse, and we are trying to enrich. And so that is something definitely that we're interested in. So please do take advantage of that. Get those questions into Slido. Hashtag is Fool24. Just bear in mind, we cannot give personalized investment advice. I have been an attorney and a financial planner in my career. I cannot give personal financial advice. I cannot give legal advice. I cannot give accounting or tax advice. But we are happy to point folks in the right direction, share our thoughts, and kind of hopefully show you some resources that you may not have been aware of that can help you in your own investing journey become a better and more confident investor and be able to handle your financial life in the best way possible. Rick, how are you doing this Saturday?
I'm doing great, and I love questions too. But like you, I think we love questions because we love asking them too. And I think that's for any investor. You have to be curious. We're here ideally, hopefully, to provide answers or at least some semblance of our perspective of an answer. But I think we also ask questions too, and I think it's. If you're not asking questions, if you're assuming everything is just status quo and ignoring the questions that need to be asked, then you're not doing yourself a service as an investor. So obviously, right now, this show is basically Q's come your direction, A's go back in your direction. But it's we ask questions too. So yeah, and I'm very happy to be here with you, Dan. Thank you.
All right. So, well, Rick, you just said it. So if you love to ask questions and to answer questions, well, I'm going to ask you a question.
Yes.
Which is, Lou and I kind of talked a little bit about the week and what happened this week. Was there anything that caught your eye this week that you wanted to talk about that you thought was something that maybe investors didn't get the full story? Maybe there was some hidden detail that you saw that you didn't see other people talking about. Anything catch your eye that was particularly interesting to you this week?
What I found interesting, not that it was like a great market reaction to it, but Five Below reported earnings. There were a lot of retailers reporting earnings. That's what happens this time of year. We still had some exciting non-retailers, the companies, the Lennar, the Microns of the world report. But to me, I found it was an interesting report because here's a company that had basically had the worst first half of its fiscal year ever through the first half of this year, to the point where its CEO was showing the door. A lot of things were happening. And negative comps, everything was happening. So Five Below, you probably know them. Odds are, if you live in any kind of dense populated city, and these are actually in the suburbs, but in these actual big cities, you'll see these Five Below stores. They're a magnet for like teens and preteens to get a lot of stuff for $5 or less, even though they have stuff well above $5, but $5 is the bread and butter. It's their moniker. And in the third quarter, they sort of stunned everyone by posting positive comps, by putting out negative, like a disappointing guidance. And in the fourth quarter, yes, comps slipped back into the red a little bit, marginally, like about less than 3% negative on comps. But they did manage to come out ahead with putting out decent guidance. So it was a beat. It was actually better than what they had projected. They projected 3 to 5% decline in comps in the fiscal fourth quarter. It actually landed ahead of the at the high end of its range, the good end of its range, and they did issue a guidance which makes it seem like the year ahead will be flat to 3% growth in comps, which isn't a lot. But again, when you've been negative for 3 of the last 4 quarters, to say that they're going to be at least positive, if not break even, not positive on the comp side, positive is very good. And again, this is a company that is also expanding, and they've been expanding perhaps too quickly, but they're doing a lot of neat things in stores, and a lot of interesting things happening with the company. And I think, well, I don't think it's a full turnaround. I think you still have to watch it. I'm just impressed that here's a company that you seemed all right. This is the next, on a week where we saw like Party City go bankrupt earlier this month. You're saying, oh, okay, this is just the next novelty that's going to go kaput. And here it goes. It says, hey, there's still some, tread to these tires. And Five Below came through as one of the more interesting retail reports today in a week that had about maybe a dozen or plus retailers reporting.
Yeah, that is ticker FIVE for folks wanting to follow that. And yeah, it was an interesting, we talked, I was on with Jeremy Bowman yesterday. We talked a little bit about Nike in the retail area, Nike kind of struggling lately. And, it's been a situation where you just kind of keep expecting that brand to reassert its value, to see consumers kind of recommit to Nike, but it just hasn't happened yet. You got a new CEO in, and so you're going through sort of this period of expected transformation where you're trying new things, trying to reestablish relationships with third-party retailers, retail distribution partners. That is a trend that's counter trend to where Nike had been going in recent years, with more of an emphasis that you've seen it really across the retail spectrum, more of an emphasis on direct to consumer, building out Nike stores, building out the Nike e-commerce experience, even a Nike metaverse presence. And yet that did not give Nike the competitive oomph that investors would have expected. Instead, you've seen the rise of competing brands, smaller disruptive brands like Hoka One from Deckers Outdoor, ticker DECK. Brands like On Holding, ticker ONON. Do not get confused by the similar ticker for a semiconductor company of the same name. But interesting watching Nike and seeing Nike just, kind of just can't get out of the gate. I mean, it's just like it's a bad start from a 100-yard dash, and you're just not sure whether there's enough room on the track for them to catch up the way that they just seem to be tripping over themselves.
Yeah. So again, I know you mentioned that Nike's. Sorry for the crackling voice, but you've been mentioning that Nike's been struggling lately. I think, in my eyes, they've been struggling for a long time. Again, and I pointed this out before when the Nike question comes up. Is I feel just like I know I bashed Serve Robotics at the beginning of this call. Lovingly, I hope Serve Robotics survives. It's very cool technology, and I hope it appreciates for everyone that owns it. But Nike is a different kind of stock to me because Nike has never been. Not never, but let's say lately, and I don't mean late, I mean the past dozen years, the past 12 years, just 1 year of double-digit growth. The past 18, 19 years, just 2 years of double-digit growth. This is a company that grows in the single digits, and revenue is clearly declining here in what the fiscal year that will end in May. And this is the second time it's happened in the last 10 years. So this isn't a company that has necessarily ever been in the last, like in modern times. I'm not saying, obviously in its prime. When people were lining across down the street just whenever a new pair of Air Jordans came out, that era for Nike is gone because there's a lot of competitive footwear. You mentioned obviously Deckers Hoka and On Holdings On shoes, but again, it's just people are they're not as brand loyal as it seems, at least not to the point that they have to do this. And you think this would be a great environment for Nike because when the pandemic came, people were very fit. They were basically said, "I got to get out here. I got to do stuff." It's why you saw spiking companies like the Dick's Sporting Goods. People are saying, "Hey, we have to get more. We have to get active. We have to get out there." And Nike did not benefit from that bump. Obviously, a lot of other things happen. But if this is when the economy is going well, as it's been for most of the past few years, I'm not hopeful. For Nike, I don't know what's next. I don't know if they need some kind of major acquisition or something. Operationally, they're great. They're able to squeeze out great margins on what they're doing. So I have no complaint about that. I'm just saying, eventually, there's only so much profit you can squeeze from a pair of shoes, and eventually they have to start growing the sale of shoes. And I just have not seen that at all.
I think you need a product. I think you need a product revamp. You just need something because I think where Nike has had trouble is that. You used to go to Nike for technical footwear that was state of the art. And if you were a specialist, you could count on Nike having a shoe that was something that was tailored for you, was tailored for your specific needs. It was going to give you an edge over the competition in that area. And now I think that it's lost that edge. I think that increasingly consumers are being kind of trained to, yeah, Nike's got great shoes and they're there and they're going to be there and they get the job done. But if you are an ultra runner, then maybe you should take a look at Hoka. And if you are, take your pick, then maybe you should take a look at an On shoe. And if, all these ifs, if you're Nike, you don't want people asking the ifs. You want people saying, oh, I need a shoe, I'm going to Nike. And that just hadn't been there. And so I don't know whether it's a brand revamp or what, but what Nike has the ability to do that these smaller companies do not is to generate a huge amount of marketing hype, to pull all the levers and get something out there that will make a splash. And so what they have to do, like, you get one shot at that. If they do it right, then it can reinvigorate the business. If they don't do it right, then it becomes a laughing stock, and it might just be what sinks them. And so, like, I get it. There's a lot on the line, a lot of pressure on the new CEO to figure this out, but it is there.
Yeah. Long story short, just do it, Nike. Just do it. Just do everything Dan just said. There you go.
There you go. Cyber Mikey with a question an hour ago. I am considering AIT as the ticker. It's Applied Industrial Technologies for its strong balance sheet and its growing free cash flow. Motley Fool is cautious. How should I weigh this in a barbell strategy? So Cyber Mikey, I want to be clear here. I'm looking at Fool IQ, which is the quotation service that the Fool has embedded in its premium offering. And when I see you say that the Motley Fool is cautious, I want to translate that just to be clear that everybody understands, because I think a lot of people watching this might think, oh, Motley Fool is cautious, that means I shouldn't buy it. And that's not what we're talking about here. When you go down and you look at the investing type is what we generally talk about here. There are 3 investing types that Fool IQ uses for the Motley Fool: cautious, moderate, and aggressive. And the idea behind those is that depending on your risk tolerance, a stock might be more or less suitable for your investing needs based on which of those categories you identify yourself in. And so if you are an investor who likes high growth stocks, is not afraid to be at the forefront of a new emerging trend, is willing to accept high risk of loss in exchange for the high potential for multi-bagger returns, then the odds are good that you will favor more aggressive stocks. Aggressive, the higher end of the moderate stocks. If you are an investor who is more who's more risk averse, who doesn't necessarily feel comfortable when stocks have really incredibly high levels of volatility, then you may favor stocks that are at the lower end of moderate, or that are classified as cautious, as AIT is in this scenario. I got to tell you, I had not looked at Applied Industrial Technologies, but I have looked increasingly at a lot of these companies that are doing things that are similar to what AIT is doing. A lot of companies that are distribution and service providers in the industrial industry that are serving highly fragmented industries, but that are slowly starting to consolidate and build up economies of scale in their particular areas. I'll tell you, the valuations, even though some of these stocks have done really well, and AIT is one of them, we've seen, I'm looking off to double check the chart here. Looks like we've gone from under 50 5 years ago. We're hanging out around between, let's say, like 230, something like that, 225 it looks like. Incredible success stories, and yet we're not really at the point where you're starting to see the kind of inflated earnings multiples that you might expect after a move higher like that. Just looking at price to earnings, just in the low 20s, which is pretty consistent with the overall market at this point. Would not expect AIT to be a huge grower going forward, but it is kind of nice to see the market giving companies like AIT credit for the consistent growth that they have demonstrated over the long term. Nice profit potential as well. And so, it may well be something that, if you're using a barbell strategy where you have a sampling of stocks that you consider to be more cautious, that are more, that are less likely to have huge amounts of volatility. And then at the other end of the barbell, you invest in some highly aggressive, highly speculative stocks that might do extremely well or might suffer pretty big losses. AIT is probably one that I would put on the first side of that barbell, where I think that the volatility is generally not necessarily going to be what you would see in some of these high growth companies, but it's more of a financially reliable business that has indeed made some strides forward.
Yeah, that's fair. I don't have any data on that, but JBL asked 11 minutes ago, thoughts on BBB Foods. This is ticker symbol TBBB, long-term hold. So BBB Foods is a Mexican grocery store chain, and right away you're thinking, well, grocery store chain, not exciting. Mexico, well, that's there's a lot of currency risks and all these other factors to consider, but it is a very dynamic growth stock, and I think that's why I've seen it come up a couple times on here on Fool24, and so. Just to put it in perspective, because most of you, I definitely haven't been into a BBB food store, but I've seen videos, I've seen how the concept works, I've seen photographs. It's similar. It's the easiest comparison is maybe to an Aldi, where it's like this bargain price supermarket, but of course a little smaller than an Aldi's, which is more like a traditional size supermarket. But I think more if you live in the West Coast, you're probably familiar with Smart and Final. They used to have a presence here in the Southeast. They were definitely playing them in Florida about a dozen years ago, but they've left Florida. But there's like 255 of them out in California and Arizona, out there out west. And it's sort of that same concept where it's sort of like the closeout, sort of like the big lots approach to retail, but not necessarily closeouts, but just they're getting a lot of overstocks in warehouse, sometimes bulk sizes, some regular sizes, but just really great prices, sort of like Aldi's. And again, without the warehouse club model, and that you're not paying a membership. And the key here is that BBB Foods is growing quickly. It's been growing at 29, 30, 35% each year the last couple of years. A good chunk of that is coming from expansion, but comps have also been very positive, and it's always great to see a brand expanding and comps being strongly positive, because it tells you it's not just sort of just taking the easy way. Let's just build more stores to grow revenue. They're actually organically at the store level improving as well. And while obviously building out an empire takes time and money, and they weren't profitable, they have been profitable through the first 3 quarters of 2024. So they finally turned profitable, an interesting growth stock. But again, to me, it's the kind of thing where with these things, there's, as far as like discount grocery, you have Costco, and everything else is sort of just, sort of in the shadow of it, as far as being able to, as far as moat goes. And BBB, I'll just give you the quick Spanish lesson. Stands for bueno, barato, bueno, bonito, y barato, which is basically, good, attractive, and cheap. So it's the name says it all when you go in there, and you basically know that it's a nice, clean experience. It's and again, you don't know, it's not going to be the same products every time. Sometimes it's store brands, but a lot of other third-party stuff that they're able to get good deals on. But they do have a little bit of everything, so you can pretty much get most of your groceries done in that kind of scenario. But again, it struck a nice chord. And again, if we head into some kind of global slowdown, economic slowdown, you're thinking that a grocery store that emphasizes on value would be great. But it's fair to say that everyone else, regular price supermarket store chains, if we do head into an economic slowdown, they're going to be approaching the same model too, and make sure that they stock stuff at the low end of the barbell pricing that makes a lot of traditional grocery stores work. But again, grocery stores, a traditionally very low margin industry. BBB Foods is no different, but at least now it's profitable, and you still have that healthy growth, which is very impressive. So yeah, I think it's an interesting but very speculative play, again, because it's something that you don't see in your own backyard unless you live in Mexico. But again, or in California or Texas, where it's almost in your backyard. But it's a very interesting company, growing a lot faster than just about any publicly traded grocery store chain here in the U.S. So it bears watching, but again, a risky stock by all means.
Jeffrey Mulvaney, 46 minutes ago, made a comment. Classic case of greed. I bought SoundHound AI, ticker SOUN, when it was in the $4 range. Went up to 25. I didn't sell, but I did sell some at 15. It was up 150%, and now it's down to 10. I'm up 150%. Is it going to go back up? Jim thinks it's a meme. I don't know if it's. I could see either Jim Gillies or Jim Mueller saying that, so I'm not sure which Jim we were talking about. But Jeffrey, I'll just share. I do not have a huge amount of experience with SoundHound. I know that they're working on conversational stuff, the AI based, speech type applications. So let's put it that way. But I will agree with, when you take a look at the way that this stock has moved, there have been periods of time when it has gone sharply up on encouraging news, and then something happens with that encouraging news that it doesn't quite pan out the way that everybody kind of expected it to, and or it got overhyped when the news came out and the magnitude of the move higher was more than was justified by the news, and so it came back down. It is in fact up. When you take a look over the past like 2 or 3 years, it is up from where it has been. It has been, as you noted, there was a long period of time when it traded well below $5 a share. It looks like from here, I'm going to see if I can do this. Yeah, it looks like it was down around $1 a share at some point before it rebounded back up. Do I think that it's going to, now we're at 10? We're down from 25, as you point out, so it's a 60% correction, but we're also up from your buying price up $150% from 4 to 10. Is it going to go back up? And Jeffrey, I just have no idea, because I just feel like the trading in this stock does not necessarily reflect the fundamental reality. Part of that just being that so much of this industry is in flux right now. There are so many disruptive companies trying to come up with ways of harnessing AI for different applications. You never know on any given day whether some new company is not going to come out with what could be a competing product or service to companies like SoundHound that are a little bit more established, that are a little bit more in the public eye. There's no guarantee that any established company is going to fare well compared to the new up and coming disruptor. And so I think you can expect volatility like this. I look at the volatility in SoundHound stock, beta 2.33 among the higher, even in the small cap category, just shows how much turbulence there is in this stock as a response to the news items that come out. Does that make it a meme stock? That I'm not really sure about that. But does it make it a stock that is difficult to invest in? Yes, it does. And you trying to make these timing decisions, like, it sort of makes me wonder, I get it, but like, what is your view on the business? Because if you have a view on the business being successful or not, trimming when you're up, when you have a quadruple, basically, like trimming, I can understand that. But in terms of, are you going to rebuy those shares? Are you going to double up? Are you considering selling out at 10 in the expectation that it goes back down to 4? Those are short-term questions that I don't have much to say about.
Yeah, and SoundHound, you'd mentioned earlier in the hour when Lou was still here that you were talking about, like, when a company changes its name, and adds AI to the end or something, it's not necessarily a good sign. But in SoundHound's defense, they started as a music discovery app. You may have even heard of SoundHound before it was a public company from that. Obviously, a lot of apps that do that, the Shazams and everything else of the world that are music discovery apps and the Pandoras and stuff. But with SoundHound specifically, then they tapped in, hey, if we're able to detect music, we can also do nice things with text, speech recognition, and AI and all these things. And to me, with SoundHound, and again, I'm not necessarily fully bullish on it, but I see the excitement that this is a company that was pretty much just kind of like a forgotten company, and then found this great catalyst for growth. And growth has been spectacular. But SoundHound, even now when it's basically still it's in single digit stock right now, it's trading for more than 45 times trailing revenue. And even though that revenue is growing at a very brisk pace, it will be vulnerable to sell-offs as we saw lately. And just AI stock, just having that AI on the thing, it was a badge of honor back in when Nvidia was leading this whole train higher. But now that even Nvidia sort of struggled, run some hiccups, you do a case where the stock will correct. I mean, in retrospect, you could have said, yeah, I could have sold back at 25. I could have done this. Don't worry so much about what you missed. Worry about where you are right now and how you feel about the stock right now. And assume this is your new starting line. And do you think it'll appreciate or not? And again, to me, the valuation is a little out of whack relative to the stock, but its growth prospects, at least the last 2 years of growth, actually. 3 years, it was like, less than 10 million in revenue about 3-4 years ago. It's clearly done a good job of growing that revenue. It's just a matter of where's that ceiling, and will they be able to get there? And that's my only concern with SoundHound. Just, like a lot of stocks that have corrected, but they're still overvalued on a fundamental basis. Is it still overvalued? And again, it's just a matter of how well. You probably know SoundHound a lot better than Dan and I do. But again, it does seem, a little up there.
What's next, Rick? Any questions come out or anything that, yeah.
So when I before I came on the air, like about 10 minutes before, but I was already on. You guys were talking about UPS, right? Was that busy? I heard Lou talking about FedEx. Yeah, okay. And it was just about the dividend question that was asked yesterday, or was that a different question?
So it was, some of it was about FedEx's report and the question about, why the stock went down and what it said about just levels of economic activity in the transportation sector. Generally, there was a specific question where doesn't it make sense at some point for Amazon to buy out a FedEx or a UPS at some point? And so I can't remember which of those questions that we were talking about towards the end of the hour that you picked up on, but that was kind of the general gist there.
Oh, okay. All right. So there was a question yesterday about the last night, I guess, about the UPS dividend, and I'm trying to find it now. If it's still there, maybe you guys answered it. But yeah, as far as the UPS dividend, it's always scary as an investor. You get really excited. You see UPS a dividend of 5.7% yield, and you tell yourself, well, that's better than like a utility that's not going to grow. That's better than a lot of high yielding stocks. A lot of REITs out there that are yielding a lot less than 5.7%. But there's a problem with that, and I think with UPS, can they cover the dividend? Yes, they can cover it right now. But the thing is, can they continue to cover it in the future? And this is the problem with all these companies. So UPS, it's struggled for many reasons that probably Lou and Dan may have touched on in saying that FedEx, while also not doing better, is clearly doing a lot better than UPS. But in UPS in particular, this is, let me pull this up. This is their how analyst estimates for their earnings have gone over the last just 90 days. It was $8.75 expected to earn this year, whittled down to $7.87 now for this year. So that's a very dramatic markdown. $9.93 for next year, marked down to $8.87. So basically almost a buck shaved, give or take, off their estimates just in the last 3 months. Will this continue? Will the operational struggles continue? Will there still be a lack of revenue growth? All these things that have been basically plaguing UPS and have driven the stock down to the point where its dividend is so high is the issue. And in theory, you're thinking, well, it's not too bad. I mean, the dividend, even though it's 5.7%, is basically $6.56 a share. And again, I mentioned adjusted earnings. This is what analysts are projecting. The actual earnings may be less, probably less. But again, the payout ratio is pretty high, but right now seemingly payable. But the first thing that UPS is going to have to cut is its dividend. If it's not going to be able to turn things around positively, or it's just going to say, yeah, I'm just going to be, the next Altria where, business will meander and maybe struggle, but we're going to, pay out a good dividend and reward money to shareholders before lawyers take it away. Not that would happen with UPS, but it is the kind of thing where it feels almost like a dividend trap in that don't buy UPS just for the dividend, because that dividend will be vulnerable if it doesn't change its business around. You need a high dividend. If you're buying a company that has a high dividend, you also need a strong business model behind it. And if you don't believe in UPS and you just believe in that nice big 5.7% check, that's a lot better than the money market yields that have fallen precipitously over the last year, I would be very careful with a situation like that. If you're buying it only as an income investor, you need to have a company that's stable to pay that dividend. And UPS right now is. And I'm sure they're committed to it in the near term. But I again, if the business keeps declining, if this is the analysts think revenue will bounce back next year, but they probably thought that last year too at this point, and clearly it's not happening. So it's just be careful with, don't be tempted by a big juicy dividend. It's sometimes not that they lie, the dividends lie, but sometimes they're misleading as far as to what a company's future potential will be. A lot of dividends will get cut. if the economy tanks, and it wouldn't surprise me if UPS is high on the list of potential dividend cuts. But hopefully, it keeps paying it because a lot of people are relying on investment income, regular quarterly income checks. That's a pretty good haul.
One thing that I like to take a look at when I have a stock that is where the payout ratio is looking a little bit dicey based on trailing earnings, and where I'm trying to figure out, is there a danger of a dividend cut? Is there a danger of an immediate dividend cut? One thing that I look at is free cash flow, because there are companies like Altria, actually, where earnings will tell you one story and free cash flow may tell you a different story, just based on the nature of the company. But nothing I see with UPS suggests that we have a really big difference there. I am pleased to see over the past 12 months, UPS generating $6.2 billion of free cash flow. But that $6.2 billion of cash flow, not really markedly above the $5.8 billion in net income. And so you don't have this situation where, some businesses just have a huge amount of non-cash charges, whether it's like depreciation and amortization, whether it's stock-based comp, like whatever it may be that hits you on the net income side, it doesn't necessarily have an impact on the cash. And so for companies can sometimes sustain dividends above their earnings, above their GAAP earnings, if they have free cash flow that exceeds what they're paying out in dividends. And so that's something I'd take a look at. But UPS, that it doesn't change the analysis that Rick just gave, because it's not markedly above what you're seeing UPS report in earnings in its quarterly reports.
Yeah. So Ed asked a question. Nike is just like Starbucks, ticker symbol SBUX. We all know Nike is NKE, and we all know Starbucks is SBUX. There are competitors that are better and less costly. Plus, every couple of years, you get another major player that is the next great thing. So, again, right now, the big challenge, and when Dan basically boiled it down to Hoka and On Holding shoes, it's better. I think most, at least active runners, would say yes. But as far as less costly, no, this isn't. You're paying triple digits even for the cheapest pairs of On Holdings and Hoka shoes. You can pay as much as $200 plus for one of the better pair of shoes that they have there. Nike obviously can play at that level, but again, you can get some Nike Air Max for $40-$50, and it'll be suffice as an everyday walking shoe and even slightly running shoe. So it's not the matter that I don't think Nike's priced itself out of the market. I think maybe they're assuming too much that their brand value can command this premium that maybe the market doesn't think. But again, the real competitors right now are at the high end of the market, not the low end of the market, which may be unusual for a company like Nike. And it may almost be insulting that their company's doing so well and growing so quickly, selling for shoes a lot more than the average pair of Nike sneakers right now. So yeah, tough times in athletic footwear for Nike.
But it may well be. I mean, that's an interesting point. It's like if Nike can flex its luxury brand stuff, I mean, maybe it's as simple as selling $1,000 shoe. And, if you have the marketing to back it up, if you have the celebrity appeal to back it up, if you have the influencer hype to back it up, maybe. I don't know. Interesting idea. Elliot, if you do that, I'll take a 10% finder's fee. How's that? Let me turn. We had a couple of questions about market conditions. And I mean, I preface this, RD 57 minutes ago, do you expect stocks to perform well in 2025 and then decline in 2026? And then Mayhol from 31 minutes ago, where do you see the market going in the next 3 to 6 months? I just preface this up front, guys. It is not something that if I make a prediction, I'm just as likely to be wrong as right. And that may be being charitable. I might be more likely to be wrong than right. These are short-term calls, and they're things that, I mean, like market commentators love to do them, and viewers love to see them, but like there's almost no value in it. I can't say that I have insight that is any better than the next person, but I'll tell you what I see coming up in the next 3 to 6 months, and I'll tell you what I see for the rest of 2025 and then for 2026. And then you can take that information and distill that however you want. at least for now, there is a lot of uncertainty about kind of big picture items at the macroeconomic level, at the geopolitical level. And that's going to be with us for a while because the plans for the Trump administration are ambitious. And a lot of the things that they're trying out are going to take time to play out. And so the future impact on the market, I think you're going to see ongoing volatility. You're going to see occasionally something comes out of Washington or somewhere else in the world that investors don't like, and you're going to see a move downward. Then some resolution to that may appear, and you're going to see a move upward. Or you may see a move out of a political center that people like, and it goes up. Then maybe there's a pullback from that, or some reason why that doesn't come to fruition, and you get a pullback down from the gains there. I mean, we've already seen this in microcosm, right? We saw a big stock market move higher in November after the election, in December, and then we've seen a big pullback in January and February as whatever people were expecting in November came to actual fruition and was made into concrete action in January and February and in March. And so, we've seen that volatility kind of play out. I expect that volatility to continue. It's been a while since we had a grinded out, extended downturn. Many investors who've been investing for 10, 15 years at this point, they think of a correction, they think of a bear market as something that lasts a few months and then you're back up to new highs before you know it. I don't think that has to happen. And I actually am looking forward to the next time that we see an extended downturn, because I think that it may well play out. It may retrain investors to pay closer attention to long-term prospects for the stocks that they own. At this point, the short-term volatility speaks to me of factors that influence the market that don't always reflect business fundamentals. That there's a lot of behavioral finance going on. There's a lot of behavioral manipulation that, you have the rise of meme stocks. You have companies whose stock performs in ways that don't at all mirror the performance of the underlying business. And there are consequences to that. And where you see those consequences happen is when you have an extended downturn where you have some kind of often macroeconomic pressure applied, and then you figure out which businesses actually have the potential to succeed on the business level and which ones were just kind of, hopes and dreams. And I look forward to that. That doesn't mean it's going to happen. I've looked forward to it for a long time, and it hasn't happened. I mean, the bear markets that we've seen, even 2022, I mean, it didn't take that long. As painful as it was for investors, it did not take that long for the overall market to bounce back. Sure, some individual stocks did not bounce back, have not come close to re-attaining their all-time highs, may never
Dan, I don't know if we lost Dan or lost me. Well, either way, Dan, you're frozen to me right now.
Qualified portfolios, our picture went out. Okay, now I can see me.
Yeah.
And now I can see Rick.
Okay.
Huh. That's fine. I was getting long-winded anyway.
No, it's good to be long-winded, but yeah. The whole thing with the whole 3-6 months this year, that Dan, you have a far better, crystallization of what your perspective is. To me, I think it's a really uncertain right now. And again, as Dan had mentioned earlier, it's obviously the Trump administration has done a lot of things, and some things would clearly be good for the market. It would be the cutting costs, possibly reducing taxes, all these things. But there are some other policies, the tariffs, the trade wars, clearly inflationary. So it's this weird kind of thing where you talk is obviously an inflationary environment. That possibly stagflation environment, there'd be a lot of concerns that, hey, the market can't do well in this climate when prices are going up at a point where we can't afford to pay them, and consumer confidence is waning. But again, if the cost cuts come in, as far as not cost cuts as a company, cost cuts as a country, which are also being championed on the other end, you get to the point, hey, maybe there'll be some more efficiencies. Consumers will have more take-home pay and all these things. Again, that's not going to happen in the next few months. There's not going to be a decree that you're going to have lower taxes immediately. At least I don't think so. But so a lot of things are going to happen. So it's very hard to predict it that way. But speaking sort of politically adjacent, there was a question about Tesla an hour ago. Dan, you and Lou didn't answer the Tesla question, did you? Or
not at all? No,
all right, I'll dive into that. So John Neely asked, "What about Tesla?" So it's kind of funny because right now Tesla has risen pretty nicely for 3 consecutive trading days. And while you may think, "Wow, that's great," Tesla's bottomed down, it's turning around. And I'll say this fully that a week ago, last weekend, Dan and I were talking about it's making a bold prediction, and I said, "Hey, Tesla's going to beat the market in the year ahead." And you think, "Well, wow, I'm probably doing pretty well." No, it's actually pretty much where it was at the last weekend. It just dipped down the last 2 days, big 2 hits on the first 2 days, then moved higher the last 3 trading days. But with Tesla, again, valuation is still high, even though the stock's been cut basically in half from its peak back in December. So the valuations don't make sense. Tesla is also hanging on things. It's not just, again, so projections are for double-digit growth and to accelerate into 2026. It's not necessarily that the existing fleet of cars will be carrying that load. It is, just like it wasn't like the Model S and Model X when the F3 and the Y, eventually Y came out. It is all the other products, obviously, the robotaxi, the technology, the Optimus, the robots, which again, that is further down the line. So there are all these things happening where the cheaper Tesla and possibly even cheaper versions of the existing, the mainstream models right now, that even that's possible too, especially in markets like China where they're losing ground. They're losing ground in Europe, definitely losing ground in China now. And the whole trade war isn't going to make them very appealing to people in Europe that obviously want to see their own brand succeed. And now, not Tesla. Same thing in China. But it's what's happening here is the company is dynamic and it does find a way to invent itself. So no matter what you think of Elon Musk, and you realize you say Elon Musk, that's a great thing at a cocktail party if you want to start a conversation for an hour, because everyone has a very vocal opinion about Musk himself. The company itself has an innovative history, and I'm a Tesla owner. I'm on my second Tesla now. So clearly I was satisfied with my first one. When it was time to trade it in, I got a second one. But it's not the kind of thing where I'm not a Tesla investor right now. I'm not an Elon Musk disciple. I'm not a crypto bro. I don't follow all these things, but I appreciate the car. I appreciate the technology. And I see what most of the bears may not necessarily see. And that's that as someone that has full self-driving in my car, and I don't use it all the time, but I see that there's there's a software update every couple of days now. The updates are starting to intensify in cadence. And again, these are updates and that you don't have to do anything. You just put a pressure button on your phone and just Wi-Fi takes care of it. These are over-the-air updates that is making the platform better. And again, I think it's making these little baby step advances that you get stuck on, sort of like I was just mentioning, like at the beginning of the hour, like the Samo that ran into a Waymo car and technology is terrible. But you're seeing these baby steps that contradict what your perception of what full self-driving and autonomous driving may be. And I think we may get there sooner rather than later, even though it'll never be perfect. But then again, regular, human driving is far from perfect, as we all know. So I'm optimistic on that side of the business. I can't say anything about, whether these Optimus robots that'll basically clean up, do all the chores around the house, if that will ever be financially feasible for mainstream America. But we probably said the same thing when we'd be vacuuming our house for years, and then boom, here came Roomba, and now there's a bunch of cheaper Roomba knockoffs to the point where Roomba, iRobot, the company that makes the Roomba, is struggling. So I do think Tesla, again, I mentioned it last week, it's just the stock is essentially the same. I could say that prediction means that I believe Tesla will beat the market in the next 51 weeks. 51 weeks from now, we'll have beaten the market. This past week was a draw, but I do continue to think that Tesla will come out ahead. But the valuation right now does not make a lot of sense. It is very overvalued, but you're putting a lot of faith into the stuff you don't know about Tesla, about products coming out and its ability to innovate, which I think Tesla has earned that right. But again, sometimes the rally gets so out of hand, as it did from November, from the election till like mid-December, like December 18th or 19th, whenever the day in December that it peaked. It sort of doubled. So if it loses half its value, it's almost back. Just like this week has been a round trip to nowhere. The same thing happens for the last four months. So it's the kind of thing where I'm not overly concerned about it, but it's a very speculative talk. But personally, I encourage. I don't own Tesla stock right now, but I'm encouraged about Tesla's bullish prospects in the future, especially at a price that's not cheap, but definitely clearly discounted deeply from where you could have bought it just 3 months ago. So 3 months and a couple days ago.
On the auto business, Tesla dealing with a Cybertruck recall this week, and it was what I'm going to call a real recall. A lot of time when Tesla gets something that's recalled, it's there's something in the software. And so like Rick said, the fix for the recall is take your phone and download the thing and let it download to the vehicle, and you're done. There's no trip to the auto dealer. There's no trip to anywhere. It's just done. That's the way it is with a lot of Tesla recalls that you hear about. But this one, actual equipment on the Cybertruck itself. Yeah. And so that is something that, people paid some attention to. And then, a couple of mentions in the mainstream about Tesla stock. Elon Musk reportedly talking to employees, urging them to have confidence in the company and its share price. And then a much celebrated and discussed comment from the U.S. Secretary of Defense with respect to Tesla shares as well. But Rick is spot on. There's a lot going on with this company. There's a lot going on with its CEO. And investors have very different opinions about how to take all this stuff, what impact they see, various things, what it's going to have on the company itself. Seeing all kinds of strange things happen with Tesla vehicles, both in the U.S. and abroad. People, finding ways to express their views about the CEO, and yet, I don't know. For me, the move that Tesla's made that I wonder if they will regret at some point, and I have not seen the financial implications of it, but. I'll tell you, my experience with electric vehicles, it has not been with Tesla. It's been with other providers. And I'll tell you, other providers of EVs, the charging systems that are available are totally inadequate, in my experience. And so Tesla made a really smart move, making sure that its supercharger network was available and accessible and widely enough so that users could feel comfortable, that Tesla owners could feel comfortable that they would be able to get access to electrical charge when they needed it in a timely manner. To me, that was their biggest competitive advantage. So when they sold off rights to use superchargers to other automakers, other EV makers, I hope they got a good deal. I hope they got a ton of money because it should have been worth a ton of money. Now, financial details of those transactions were not disclosed at the time. So I don't know the answer to that question. I may never know the answer to that question. But that is an asset that, to me, the success that Tesla had with the infrastructure eclipses the success that they had with the vehicles, because we've seen competitive vehicles. And in many car drivers' eyes, one EV is the same as another EV. But being able to charge it and being able to take advantage of technological innovation that may one day lead to being able to sit in the back seat and let your car drive itself to work or wherever you're going and get some stuff done while you're doing it. That, I think, is the bullish case for Tesla.
Yeah, and I think most Tesla drivers were not happy with that announcement when it happened. That again, and it's nowadays I charge at home mostly, but sometimes I'll be at a supercharger station, just convenient to go take care of that. And this was like the worst. I was charging outside of a Target, and first of all, because not all chargers have the chargers in the same spot. So there was like one car. It was non-Tesla. I don't remember the name right. I don't remember which one, but basically taking up two spots because it had to be facing forward at an angle so it could hit it. So and again, there were people waiting at this charger. So you're seeing a situation where if it continues to go this way, I think it's going to be very upsetting I mean, it's not upsetting. I mean, it's not the ideal scenario when you thought, hey, I'm just going to hang out with a bunch of Tesla drivers here, parking all, sharing the same situation with the cars that charge at the same speed. So you can have these quick charging situations. It's far from ideal. I have one question that I wanted to add. It was 21 hours ago, but I imagine not a lot of people cover a Sport Radar around here. So Besties asked Mr. Dio, what did you think of SRAD, that Sport Radar recent report, and their outlook? What do you think for this stock? So Sport Radar is a company, I believe either Belgian or Swiss, either way, European company that they specialize in data, sports data. And you think, well, sports data, what's the trick to that? Well, there are a lot of betting companies, media companies, leagues, media, as far as reporting, companies that are reporting events and need to get the statistics correctly, where companies like Sport Radar and Genius Sports, very differentiated models, but sort of the same purpose, are helping with the data, sports data transfer that's necessary, especially on the betting market. That's where it's really the most exciting. So they had a really strong quarter, Sport Radar. Also, guidance was encouraging. They said revenue expected to grow at least 15% this year, which is slower than it was last year, but definitely growth, and adjusted EBITDA growing at least 26%. So this is a company that's growing quickly in a market, double-digit growth, and the bottom line going even faster, which is encouraging as well, in a market where you think, well, people, it's the whole betting market is the kind of thing. It's not that it's recession resistant, because obviously you think, well, yeah, I mean, if you really have to guard your money, you're going to gamble it. Yeah, a lot of people, you'll see lottery ticket sales and stuff start to pick up when money's tight. It's not the right thing. It's a terrible approach financially, but people will do it. And betting right now is more socially acceptable. It's no longer you're doing something, you have to go to Atlantic City or Vegas or Reno. It's not something that you have to do, find, a Native American reservation that has legal gambling on their grounds to be able to gamble at the casino, or find a riverboat that's off water so you can just international water gamble kind of thing. That's not the scenario anymore. It's been legitimized. States have realized, hey, this is a good way to generate some state revenue, just like they did with lottery, state lotteries eons ago. And so it is taking off in that respect, where you're now watching sporting events and you're seeing actual stuff on the odds on games. You're seeing announcers talking about, if they kick this field goal, if you bet on the spread, it could hurt you. So it's becoming so popular from anyone's perspective that it's a very interesting market to want to play. And this is an interesting play because it's not just it's not betting on an actual individual player like DraftKings or FanDuel Parent Flutter, but it's a play on just the information that's necessary to make all this happen. So it's almost like a pick and shovel play, but a high margin one, because again, it's information. You just need to have the mechanisms to secure that data and then to transmit it. And companies like Sport Radar are doing a good job with that. So yeah, the report I thought was solid. And even though growth is slowing, I was encouraged. And at least 5 or 6 analysts raised their price targets following the report, which is a good sign that not only is the stock doing well, but analysts tend to think that it's going to continue to do well.
Sport Radar headquartered in Switzerland.
Switzerland. Okay. I knew it was Belgium or Switzerland. So yeah, I was half right. Yes.
I'm going to grab a question. It's a good question. I think we got about 5 minutes left in the hour. This might be a good question to end on, unless Rick, you've got a quick one that you want to grab. But Paul SF asked, how do you avoid or observe yourself wanting stocks you already own to succeed as you reanalyze when you consider adding? So yeah, Paul, I'll admit it can be an issue, and it's one that I've started to try to remedy by upfront having an idea of what I expect the company, what the company's progress is going to look like, what I expect the stock price to do, and then kind of give myself a game plan for how am I gonna deal with it. Because to me, the important thing is having a thesis when you buy a stock, and having a thesis for why do you think the business is going to do well. What are you looking for to measure that success? What milestones are you looking for along the way? How realistic are those milestones? What ideas have the company given you as far as how long it's going to take to achieve some of those things? And then how sensitive are you to if something happens and that timeline ends up not being correct, ends up being overly optimistic? Are you going to, how tolerant are you going to be of deviations from the investing thesis that you have set up for yourself? But, that only goes so far. And, there are some companies where it's sort of like, this is a great idea and it makes the world something closer to how I want it to be. And so I really want them to succeed, but it's not up to me. and regaining the humility and understanding that as one of billions of people in the world, that you only have a limited amount of say in what's going to catch on and what people are going to like. I mean, that's something that you learn over the years, and at some point you start to trust that when you think something that seems to be totally different from what the business community thinks, what the mass of consumers thinks, then maybe you're the one who's wrong rather than everybody else being wrong. That's kind of worked for me. Rick, any thoughts on that, or do you fall prey to this, or are you more disciplined and avoid that?
I'm disciplined. I'm an investor. I root for the companies to succeed, but it doesn't really impact how I'm doing things. But I wanted to do a different question from a different Paul. So thank you, Paul SF, for that. Paulie D just 3 minutes ago asked, as a young investor looks to at their future, at which stage of life is best for different shifts in allocation from high growth to dividend stocks or bonds? And Dan, I know this is probably a perfect question for you and Bro, since it almost feels like kind of like that retirement planning kind of situation. But my personal answer to this, and again, I have always been a growth investor. I was a dumb growth investor at the start. I think a lot of us are dumb investors, make a lot of mistakes in that capacity. And when David Gardner started the Rule Breaker service 21 years ago, asked me to be part of the initial the launch team, and I've been part of the Rule Breakers service, and that's why I'm TMF Breaker Rick as my handle since then. And it's the way I invest. But again, over the past couple of years, especially now that there's a little more pepper than a little more salt than pepper rather in my beard, and I'm getting up there in years. I find that many of my allocations, I'm like, okay, I really want that exciting growth stock, but it's almost like you're dieting and you're like, well, I really want to eat that dessert, but I should probably eat the salad instead. So I'm sort of also buying growth and also looking at value and income stocks, even though I'm not living off fixed income right now, but I know that it's going to be at some point, it's going to happen. And you want that there. So I'm sort of balancing myself. I don't know what the right time to do it in. To me, I think the big thing that set me off was when we were able to say, hey, my wife, she could retire early. So a year and a half ago, she retired as an educator for long decades. And I'm like, well, all right, now I need a little more of a mattress to make sure that, that if something happens to me financially, we're okay. So, and I don't mean insurance, I'm saying investing wise. So I do find that over time, I do find myself shifting that way. And I'm sorry we're at noon, but Dan, I don't know if you would have a quick answer or want to just hand off the hour to the next group.
I'll just say that I think some investors may well find that they gravitate to different investing themes more than others, and you don't necessarily have to swim against that tide. So if you're a young investor and you find yourself with a strategy that favors dividend stocks, that can work. You can achieve your goals. It just takes a different path to get there. So be true to your style and understand there's more than one way to succeed.
Yeah, and you're still here, I think. So you're for the next hour. I'm the one that's leaving, and Rachel's joining us. So, but yeah, sorry, you were saying, Dan. Yeah, what were you saying?
Yeah, so we're just here at noon on the East Coast, and I'm gonna bid farewell to Rick. Rick, thank you so much for joining me for this hour. I will plow on. Rachel Warren is about to join us, and we are going to continue. Hello, Rachel. How are you?
Pretty good. How are you?
I'm doing well. So, we're going to continue here with the Ask Us Anything theme. Please do get those questions into Slido. We are hashtag Fool24. And just to make it clear for all of our viewers who have not been watching us until now, we are here to provide guidance, to give our insights, to try to educate folks and give our views on the questions that you ask. We do invite just about any and all questions related to investing that you care to throw our way. Right. What we cannot do, however, is give personal financial advice. We can't give investing advice. We can't give legal or accounting or any of those things. You have individual professionals at your disposal that you should turn to for taking the things that we say and applying them specifically, getting the help that you want to apply them specifically to your individual situation. But we do our best to provide help. And so please don't be shy. Get those questions in. We will be happy to answer them.
Awesome. There's one question that I saw in the queue already that I wanted to hit really quick, and then depending on the flow of questions, maybe talk about some stuff that's entering this week. And Fools, I apologize if my voice cracks a bit. I've had a flu for the last week, so occasionally things go in and out. I have water by my side in case I start to choke, but bear with me. So I wanted to talk a bit about Intuitive Surgical. So Sergey was asking Fool's thoughts on Intuitive Surgical. If we are about to enter a recession, a lot of surgeries might be postponed. Is there any short-term impact on the business? I think there's a couple things to note with this one. So in the short term, I do believe this is a business that would be impacted in terms of surgical volume if recessionary pressures did cause patients to postpone their procedures. It's worth noting that about 91% of Intuitive Surgical's surgeries that are performed using its Da Vinci systems, which again are designed to assist with minimally invasive surgeries, but 91% of those are elective surgeries. Only a small percentage of them are emergencies. Their Da Vinci systems are used for a wide variety of surgical procedures across multiple specialties. There was a trend sort of in the latter period of the pandemic where Intuitive Surgical saw a similar dynamic where patients were slowing down surgical volume. There was also the fact that they have significant exposure to the Chinese market, which is another area that saw a slowdown in growth. But people were, for a time, postponing some of their elective surgeries, just given the environment at hand. And while I think this is, broadly speaking, not a very cyclical business, as is true of many healthcare oriented businesses, I think that it is realistic to expect that if, in fact, a recession happened, and again, I don't think that is a sure thing at this point. I think it would be foolish for me to try to make a prediction with regards to that. But I do think, as anyone that's factoring into their risk analysis with this type of a business, I think, yes, in the short term, that could have an impact on their business. Now, in the long term, which is, we talk about how we're long-term investors here at the Motley Fool, I still think this is a fantastic business to buy and hold for the long term. As I've mentioned, I talk about this company a lot. Intuitive Surgical is the leader in robot-assisted surgery. They also have had the benefit for over 2 decades of being first to market when they had their Da Vinci surgical platform that was approved roughly 26 years ago at this point, maybe more. And one of the things that's been so sticky about their business is they make most of their money through recurring revenue, which is generated from the instruments and accessories that accompany their surgical systems. These surgical systems are an incredible investment for hospitals and other medical providers that purchase them. A single system can run about $2.5 million per system. And once a hospital makes that investment, there is obviously a significant incentive for them to maintain that. So there are various services that Intuitive Surgical sells. For example, training and consulting services to ensure that medical staff, surgeons are properly trained to use these systems. They usually enter into long-term service contracts when they sell a system to a hospital, and a single service contract can bring in 100 to 200,000 of recurring revenue per system per year for the business. But then again, there's these accompanying instrument, tools, and accessories that have very limited life cycles of use before they have to be replaced. And that makes a significant portion of Intuitive Surgical's revenue as well. So because so much of their model is built around recurring revenue streams, they have really been able to maintain significant growth through the years, very consistent track record of profitability and revenue growth. And even though there was a slowdown a few years ago, when they saw a slowdown in surgical volume, which obviously impacted the top and bottom line, they remained profitable. They continued to grow revenue, and they continued to grow their installed base of systems. So there's a lot to like about this business over the long term, which I think is the light with which to analyze this business in. But I think it's absolutely fair to say that there could be a real impact to surgical volume if macro conditions worsen. That is more of a wait and see, I think, element at this point.
Agree 100%, Rachel. And the one thing that I will say is that investors don't look to the initial period of the COVID-19 pandemic as indicative of what you're necessarily going to see with Intuitive Surgical in terms of a reduction in surgical procedure volume in a recession, because a recession's different from what the pandemic was, obviously. And so, yes, there were economic issues with the pandemic, but there were also factors that played very differently. People, if they could avoid going to medical facilities, avoided going to medical facilities because it was a situation where you didn't want, there was a triage situation happening at medical facilities. There was, a decided effort among professionals to delay unnecessary elective, things that weren't absolutely crucial to happen. During a recession, obviously, the medical community remains open, and people have differing abilities, whether they are able to move forward with elective procedures or not depends on their own financial and economic situations. And so, yes, you're going to see a downturn in that situation, but you're not going to see the same kind of downturn. And so it's one where I would urge folks, if you're looking to kind of get a sense of what kind of impact you're going to get in times of economic uncertainty, I'd go back to periods like 2018 or, like the mid 2010s, which was sort of the last time. I don't think that it was officially a recession, but it was the last time where you got periods where people were kind of concerned with the slowing pace of economic growth. That will give you kind of a better sense potentially of what you'd be likely to see in what I'm going to call a regular economic downturn and what its impact in the short run for Intuitive Surgical would be. But that said, I think Rachel's points about long-term, more important for the long-term investor anyway. Yes, there's going to be recessions from time to time. Yes, there are going to be ups and downs in surgical volumes and therefore in the volume of consumables and other recurring revenue that Intuitive Surgical generates. But over the long run, the success of the platforms and the success of the company in achieving better patient outcomes should continue to play out. Just because, I mean, the company's had a great history of doing that. No reason to expect that to change really anytime soon. Let me grab a question from 17 minutes ago. Jeffrey Mulvaney asked, says that he bought Iron Mountain, ticker IRM, in a retirement account at $30 a share at the time, paying a 6% dividend. The share price of that quadrupled, went over 120 for a brief period of time towards the last part of 2024. We have since seen a drop, looks like a drop between 25 and 30%. We're back down to closed on Friday, 87.54. Still getting 6% dividend yield on investment. Should I have sold for capital appreciation? Jeffrey, again, and this is similar to a question that you asked about another company in the previous hour. There's always going to be a period of time where when you enjoy a very attractive upward period in the stock, where the stock seems to go straight up, there's always going to be a period of time where you're going to say, oh, well, should I sell? And the question is, what happens next? When you're in the middle of that upswing and you're asking that question, what can happen? One of two things can happen. One is that you're right and you pick the high and the share price goes down and you feel like you're super smart. But what often happens is it's very difficult to pick the exact top. And so, one question that I would ask you is, there was a time in 2022 when you were sitting on a double, that the price of the stock had gone from below 30 to about 60, and it kind of treaded water at that point. And you could have asked yourself the same question, is this the time to sell? I've gotten a double. It's not really doing anything anymore. What's going to happen? And I would have told you then what I'm going to tell you now, which is, do you still have conviction that the business is going to do what you think it's going to do? Iron Mountain have a long legacy of being a company that helps its corporate clients with record keeping. Used to have immense physical locations where, like, every single piece of paper that a company would have that they had to hold on to, whether it's for regulatory reasons or just because they wanted to, these large physical places where this information will be kept. As technological innovation has led to digitalization, Iron Mountain has shifted its focus and made a big push into creating data centers to store data and information digitally, with a huge impact, fitting well with the themes of cloud computing and digital transformation overall. And that is one reason why we've seen such a big rise in the stock. Now, why did we come off of highs? Well, data center trend had gone straight up, and then there started to be talk of, okay, is all this investment in data centers, is it paying off? Is it going to come out with the payoff that we all expected it to? Are we getting to the point where data centers are getting overbuilt? Are we getting to the point where energy consumption of data centers is going to cause a problem to the power grid? Are we going to be able to generate enough electrical power to handle the massive uptick in the number of data centers being operated across the economy? And I think that was one reason why you saw stocks that are exposed to the data center trend, like Iron Mountain, take a drop. So the question becomes now going forward, do you think that downturn is justified? Do you think that the data center trend got more attention, was overplayed, and that we're now readjusting to a new normal where, yes, data centers will remain important, but maybe not as important as we initially thought that they would? And if you think that is the trend, then maybe the stock continues to go down from here, and you look at trimming a position or even selling out of a position based on the fact that maybe your investment thesis from when you bought the stock has played out. On the other hand, if you think that this is just a short-term event, that the long-term prospects for data centers remain intact, that you still believe that companies are going to continue needing to retain records, continue to value their data, want to have their data stored in the most efficient way possible, and think that Iron Mountain will be able to continue to do that for folks and pay you a healthy dividend distribution along the way, then your long-term investment thesis may remain intact. And so you may well find yourself wanting to hold on to that and just dispel the fact that, yes, you may have been able to reap a shorter-term profit if you'd picked the exact top. But once you start going down that road, you're going to find yourself selling businesses that you actually find you have long-term conviction in. And then the question is, well, are you going to buy back? And I've seen a lot of people in my experience, they sell, they think that there's going to be a problem. Sometimes the problem happens, sometimes the problem doesn't. But what often does not happen is that investor buying back before the stock fully recovers and then continues to see an upswing. And then suddenly everybody who thought that it was a good idea to sell with an early gain is kind of beating themselves up for missing out on a much larger gain somewhere down the road.
There was a question that came in from Ed that I wanted to answer. Do you consider these healthcare stocks to be undervalued and a good opportunity no matter what happens in the economy? And he listed Humana, Pfizer, and Amgen. Well, a couple things I'll say, and then I want to talk a little bit about each of these companies because my perspective on these is a little bit different for each one. Healthcare stocks generally, I think, can be, and I say this as a healthcare investor, this is also a huge area of focus for me in my reporting and coverage for the Motley Fool. I think the healthcare industry as a whole has shown itself to be broadly more resilient in times of recessionary difficulty, economic difficulty. And obviously that goes back to the fact that these are companies that are often providing the products, services, medical devices, pharmaceuticals, vaccines, therapies that patients need, no matter what's happening, with the world or the economy. And so that does provide a real measure of resilience for companies that are operating in this space. Now, that being the case, it's very important to take these businesses individually, right? So the healthcare industry has historically been very resilient, but then obviously there's a lot of different companies in this space, and some of them are potentially, fantastic investments, and some of them not so much. Now, taking the actual companies that you mentioned here, one by one. In terms of, undervalued, Humana is currently trading at a price to earnings of about 26. I'm going to explain a little bit what's been going on with that stock, because that is a company that's been hit quite a bit by the market over the last couple years, and they have been dealing with some really unique challenges. Pfizer is probably the only one on this list that I would say is truly undervalued at about 19 times trailing earnings. Amgen, in my opinion, is not undervalued, but I do think it's a really solid business. They currently trade at a price to earnings of about 42. So let me take these, one by one. Maybe I'll start with Humana, which of the three on this list personally is the one that I'm, kind of least interested in, at least if I was looking at my personal portfolio. So Humana's a health insurance company. They offer Medicare Advantage and prescription drug plans. They provide health insurance plans for individuals, families, employers. They also offer dental and vision coverage as part of their health insurance plans. And they've been dealing with some unique issues the last few years. A huge part of their business is Medicare Advantage. And more recently, in the last couple of years, the Centers for Medicare and Medicaid Services had actually downgraded the quality rating of their H5 to 16 plan, which represents a significant portion of their Medicare Advantage memberships. And they downgraded that from 4.5 stars to 3.5 stars. And that obviously raised concerns among investors about the company's ability to retain and attract members over the long run. Now, like other health insurers, Humana has also been grappling with rising medical costs, particularly within their Medicare Advantage business. A huge part of that is also due to increased Medicare, utilization rates. Higher medical spending can lead to lower profitability. And then again, there's been this downgrade in their plans rating, which has impacted the Advantage business. Their core business revolves around their Medicare Advantage plans. And again, that's a type of health insurance that specifically covers Medicare beneficiaries. And these plans contract with the federal government to provide comprehensive healthcare coverage to seniors, including extra benefits like disease management, nurse hotlines, et cetera. And then the federal government pays Humana a monthly payment per member enrolled in their Medicare Advantage plans. Now, a couple years ago, or even about a year ago, Humana was having a difficult time. They were seeing in early 2024, for example, shares were trading near a 4-year low as they reported a surprise loss in their Medicare Advantage business, and they are still dealing with losses in that area. And again, there's this downgrade of their business. They're seeing a surge in older patients that are seeking care that's really tipped the balance between premiums and the cost of care. Historically, Medicare Advantage has been a highly profitable market. And that's something that has benefited businesses like this over the long run. But a rise in older patients seeking care has led to higher than expected costs. And this has been true for really all businesses with exposure to this space, because this is such a core part of Humana's business, and one in which their business really revolves around. It has impacted Humana significantly. Now, it's worth noting United Health Group, which is obviously another big insurance player, they have the highest share of Medicare Advantage membership among all the market's major players. And they had, for example, had said that they were adjusting to lower reimbursements from the prior administration, and they were really working to manage the pressure of those expenses. Humana has ranked second among Medicare Advantage plans, controls about 18% of the total market. We've also seen, smaller players like CVS, for example, that have been dealing with issues from their Medicare Advantage utilization rates. So, Humana is still dealing with unprofitability. They reported a net loss per share in the most recent report. These may be issues that they can resolve over the long run, but I do think the drop we've seen in the stock, at least the last couple of years, has been warranted. And I think that those are some elements to consider if you're investing in this space. With Amgen, this is a really interesting biotech company that I follow and I really like. They are focused on a wide range of therapeutic areas, including oncology, hematology, inflammatory diseases, and bone diseases. Some of their most well-known products include Enbrel, Prolia, and Xgeva. And Xgeva is used to prevent complications in cancer patients. Enbrel is a rheumatoid arthritis drug. Prolia is a treatment for osteoporosis. Then they have some newer ones that are blockbusters in their portfolio, like Tepezza, which is a treatment for thyroid eye disease. Amgen has done a really good job of growing profits as well as revenue through the years. When they reported their Q4 results most recently at let's see, when would that have been? In February. They said that 10 products delivered at least double-digit sales growth in Q4. Product sales grew 11% year over year. For the full year, total revenue increased 19% year over year. And again, 10 products delivered at least double-digit sales growth. 21 of their products achieved record sales for the full year. They are profitable under GAAP. They saw a short-term hit in earnings per share, primarily related to their acquisition of a company called Horizon Therapeutics. But this is a solid business, really interesting biotech. One that I think is a great example of an established biotech in this space that is profitable, has a really exceptional lineup of blockbuster drugs. So while I don't necessarily think they're undervalued, I think it's a great business. Lastly, Pfizer. This is one I've talked about a lot on the show over the months. I really do like this business. I think it has been unfairly hit by the market. I understand why investors have maybe lost a bit of interest in this company over the last few years, as the company has really worked to kind of normalize following this really extreme level of growth that it experienced during the pandemic due to the success of the COVID-19 vaccine it developed with BioNTech, as well as its oral antiviral drug. But one of the things I've brought up is that they have used the billions in capital that they brought in from those products to really exceptional use in the last several years. They entered into close to a dozen different acquisitions. One of the most notable was their $43 billion acquisition of Seagen, which is was a major oncology biotech. They have long been known as a leader within the oncology drug space. Their blockbuster drug Ibrance is just one example of that. But the acquisition of Seagen, which is specialized in antibody drug conjugates, is really key to their growth vision for the business moving forward. That acquisition alone, which was one of numerous, again, that Pfizer entered into, effectively doubled the company's pipeline, is a huge part of Pfizer's goal to have 8 blockbuster cancer drugs in its portfolio by the early 2030s. And Pfizer's also really shifting to focus on 4 main cancer types within its oncology business, which again is really huge for the company's vision of growth moving forward. And those areas are breast cancer, genitourinary cancer, blood cancer, and thoracic cancers. And this new blueprint for their growth, I think, is something that is really key to know. They're aiming to increase the number of biologics that they have in their revenue mix from 6% to 65% by 2030. They've also have roughly a dozen manufacturing sites that are churning out, oncology drugs in numerous continents. They also acquired, other companies that brought a really exceptional candidates or already approved drugs into their portfolio. This includes, new launches like the RSV vaccine, a Brisvo that they make, their oral pill for ulcerative colitis. Velsipity, Pasdev is another cancer therapy that's in their portfolio now. They also, I believe it was the acquisition of Biohaven, brought Nurtec, which is a major migraine drug, into their portfolio. One of the things that they're dealing with, as I kind of add my final thoughts to this, in addition to a slowdown in growth from the pandemic, they are also dealing with the very real threat of a patent cliff for some of their most notable blockbuster drugs. And so this stream of M&A activity that they entered into over a period of a couple of years is really key to stave off issues from that, as well as to kind of enter into a new era of growth post-pandemic. I do think that this is something that they will be able to achieve. They've already said that they plan to add more than 20 billion in risk-adjusted revenues to their top line by 2030. They, back in 2023, had more drugs approved by the FDA than any other pharma company that year. It will take several years, I think, to see the impact of this on their balance sheet. But it is worth noting that, prior to the pandemic, single-digit year-over-year revenue growth for an established pharma business like this was common. And in 2024, even if you took out their COVID products, revenue grew like 12%. year over year. So I think this is a really solid business. I do think it's undervalued. They've continued to really maintain their commitment to their dividend, which incidentally, because the share price performance has been so lackluster, that yield has been pushed up quite a bit. So Pfizer is probably one of my favorites on this list in terms of undervalued. I think Amgen is a great business, although perhaps not undervalued. Humana, dealing with some issues, but I think justifiably so, has impacted share prices. And those elements I mentioned, I think, are worth considering maybe before taking a position.
Before we move on, Rachel, I just want to make a observation on Pfizer that I found interesting, ticker PFE. Over $20 billion in cash and short-term investments on the balance sheet at this point. And that to me, I mean, I'm really impressed with their capital allocation discipline, because I saw other companies kind of made the mistake of when they got large amounts of revenue, and even though it was kind of one time in nature, once their share prices started to drop, they spent a lot of money on stock repurchases in some cases at share prices that turned out not to be anywhere close to the lows that turned out to be the case. I took a look just at the cash flow statements for Pfizer. It looks like they made a single relatively minor $2 billion stock repurchase. Yeah. And apart from that, they managed to avoid the trap of buying their own shares on the way down. And so now they're in a position where they have all this cash on the balance sheet. They can decide what they're going to do with it. They can make acquisitions to bolster their pipeline, handle, try to offset the impact of patent cliff issues.
Right.
They could turn around and make repurchases if they want. But that plus the ongoing commitment to the dividend, it really sets them apart from many of their peers, I think. Do you agree with that, or what do you have to say? Am I missing something?
No, I don't think you're missing anything. I think that's a great point, and I think it really just carries on the point that I was making about this business. I mean, they have been a really fantastic company in terms of managing the capital they have, and I do think that it's not maybe exciting to look at, but their pipeline and what they're working on, which is really key to their growth moving forward, and the numerous drugs that are widely expected by analysts to be blockbusters in the coming years. I think there's a lot of opportunity for this business over the next 10 to 15 years. I think it's also worth noting that in the life cycle of these pharma businesses, it is very normal for you to see strong periods of growth, slowdowns in growth as some of the most well-known drugs reach the end of their patent life cycle and face competition from generics. But businesses like this are planning for that a decade in advance. Pfizer has been doing so, and again, their financial position is incredibly solid. So I do think this is a company that has been really underestimated by the market. And I think maybe a lot of investors have seen sort of this fantastic uptick in growth they had during the pandemic, which would not have lasted forever. It was inevitable that would reach some kind of cliff at some point. And maybe some are missing the ways in which the company has put that capital to use to plan for the future while remaining in a really solid financial position. So yeah, I 100% agree with the points you make.
Pfizer also with the distinction of having been kicked out of the Dow Jones Industrials, but one surprising fact is that you'll actually see a number of companies after that happens. Just keeping in mind, Dow Jones Industrial is a price-weighted index, and so one reason that stocks get changed in and out is just when a stock price falls to the point where it no longer has enough price-weighted impact on the index, then usually the Dow will make a change. But interestingly enough, those moves often lead to outperformance over the long run for those companies. So we'll be interested to see what happens with Pfizer. Mark, the train operator, asked 27 minutes ago, you say in retirement we should keep 2 to 3 years of our investments in cash. Is a short-term floating rate bond fund like the Invesco floating rate ETF, ticker ICLO, or the iShares Treasury floating rate bond ETF, ticker TFLO, a good place to hold that cash? Mark, absolutely right. When Robert Brokamp and I are talking with folks on our financial planning shows, a lot of the time we will talk about the value of having a multi-year cash cushion once you have actually retired. And that can serve a couple of different purposes. One is that when you are no longer working in retirement, you need to be able to, you don't have money coming in from a job anymore. Any expenses that come up, whether they are expected or unexpected, need to come from cash that you have on hand. If you don't have that cash on hand, then you're going to have to sell investments. And the one thing that we don't want folks to have to do in a situation is put themselves in a position where they have no choice but to sell stocks from their portfolio, even though that stock portfolio may have gone down in value recently and be suffering a short-term drop that we believe in the long run is going to reverse itself, just like the stock markets, past bear markets have always reversed themselves in the past. But that may not happen. You may not get that recovery within months or even within a year or two. And so having that cash cushion available gives you the flexibility to decide, okay, yes, eventually I'm going to need to dip into my investments in order to finance my living expenses. But I get to pick when that happens. Hopefully I get to wait until there is a recovery in my investments so that I can sell at more favorable terms. And so the question becomes, okay, yeah, we're good stock investors. We don't necessarily pay as much attention to what to do with cash. How do we make sure that that cash works for us the best that it could? And frankly, for a large part of the 20 teens, it kind of didn't matter. You had interest rates very close to zero, high yield savings accounts, high in air quotes, because, you know, they're paying like 0.5%, 1%, almost nothing. And so the opportunity cost from not putting your cash to work in the best way possible was relatively low. Well, fast forward to today, you have savings accounts yielding in some cases 4% or even maybe even a little bit above. You have short-term treasury bonds yielding in the low 4%, around 4.25%. You have some treasuries, you know, some longer-term, intermediate-term bonds. Really, the shape of the yield curve right now not being rewarded for locking your money up for a longer period of time. Most of the yield curve kind of in that 4% range. And so taking zero by leaving money in like a checking account or something like that is costing you 4% a year. And so you don't want to deal with that. But multiple ways to take advantage of that. Bank CDs are a way to do it. High yield savings accounts can do it. Treasury securities can do it. And the particular kind of bond that Mark is talking about is what's called a floating rate bond. These bonds are a little bit different from the way that most bonds work. Most of the time when you buy a bond, up front, you know what the interest rate is going to be, and you're going to get that interest rate. That interest rate will stay the same throughout the timeline that the bond exists between the time it's issued and its maturity date. And so you can count on, no matter what happens in the outstanding interest rate environment, the bond that you own is going to continue to generate that level of interest that was established on the day that the bond was issued. Floating rate bonds are a little bit different. Instead of being tied to a fixed interest rate, these floating rate bonds, they will give you a fixed margin above or below a benchmark rate that changes over time. For instance, one type of fixed rate, or rather floating rate note, will look at the prevailing price of 3-month treasury bills, which are auctioned off every week. And so when the rate on those 3-month treasury bills changes, you do the calculation that's based on whatever was the case at the time the floating rate note was issued. Essentially, you'll either add something or subtract something from the prevailing interest rate that changed, and that will be the interest rate that the floating rate note pays for the next period of time. And then when the next period ends, or when this period ends and the next period starts, that bond will look again at its reference rate and make the appropriate adjustment and change its interest rate if the underlying benchmark that floating rate note points to has changed as well. What's the benefit of this? It means that your interest rates automatically change with the market. And so you don't have to worry about missing out if interest rates go up. you will be able to continue to enjoy that rate. On the other hand, if interest rates go down, then the interest that you're going to get from that floating rate will automatically go down as well. And that can be both a plus and a minus in that it allows you, I'd say that in terms of complexity, that these floating rate notes are maybe a little bit more complex than what you get from a traditional bond ladder, where you invest a portion of your money, say, for 1 year, and a portion for 2 years, and a portion for 3 years. Some people get even more granular than that and will add things like every 3 months, every 6 months. When you do that, the traditional bond ladder, it locks those interest rates in, but the fact that these maturities continue to mature over time means that over time, you eventually catch up to whatever prevailing interest rates are doing. It just means that you have a period of time before those interest rates adjust. If you don't want to wait that long, then a floating rate note can really do a lot of good. And one benefit of floating rate ETFs is that they won't see the same level of price volatility that you would see in a traditional bond ETF, because in many ways, the value of the floating rate note itself isn't going to change as much. Why? Because changes in interest rates won't affect the value of that floating rate bond, because the floating rate bond's interest rate automatically adjusts. And so that can lead to significantly less volatility in the price of the ETF at the expense of more volatility in the interest rate that you receive from it. And so would I suggest that a 100% allocation of your cash cushion to a floating rate note ETF was appropriate for most people? Probably not. I mean, there's some people out there who might be able to do that. But as part of a strategy, of a broader strategy that includes kind of a diversified set of fixed income options, yeah, I think it's worth taking a look at, just because of some of the unique features that it includes that you won't necessarily find in other types of bond investments.
Okay. I'm trying to pick. There's a question that retiree had asked: with drug companies like Amgen and Pfizer, how may changes in FDA workforce and policy affect the new approval process of drugs? There might be some short-term impact, but there's a couple things to understand with this. So FDA review timelines for drugs fall under several areas of legislation. One is the Prescription Drug User Fee Act, or PDUFA, and the other is the Generic Drug User Fee Amendments. And these regulate review periods for new drug applications, as well as abbreviated new drug applications. And those are set through 2027. There's also medical device approval timelines, and those fall under legislation like the Medical Device User Fee Amendments, and that regulates review periods for pre-market approvals, 510K clearances. Those are also set through 2027. So those timelines are not going to be changing, unless and until there is a shift in 2027. But obviously, if there are, continued or even those that have already been enacted workforce reductions at the FDA, that could lead to some delays across both drug and medical device reviews. That's something that is unclear at this point in terms of what that's going to look like in practice. I would say that if that's going to have an impact, it's obviously going to impact drug companies across the spectrum. I mean, whether you are a large business or a smaller company with only a few approved products. But it is worth noting that those review timelines do fall under specific prescriptive legislation that requires certain timelines be met, and that that legislation is in place without change until closer to the end of the decade. For example, the Prescription Drug User Fee Act, it covers the period for the FDA to review new drug applications with a standard review timeline of 10 months or 6 months for priority reviews after the application is accepted. And then these deadlines are for the FDA to review and make a decision on new drug applications, or what are known as biologics license applications. And then for standard review, again, the FDA is typically given 10 months. For priority review, they typically have 6 months. PDUFA, or Prescription Drug User Fee Act, it must be reauthorized by Congress every 5 years. So the current one was signed into law in September of 2022. It's set to run through fiscal year 2027. So hopefully that gives a little bit of color to how those processes work. The FDA aims to review and act on at least 90% of new drug applications for standard drugs within 10 months of receipt. And then there's other clearances as well that have their own specific goals. So there is definitely a reality in which some of that timeline could be impacted. But again, because these are prescriptive laws administered by Congress, there are specific timelines in place that must be followed. So hopefully that answers that question. I'm going to hit this one really quick. Ed, on Outset Medical. This is one that is not one I've owned, but I've had a lot of questions on this one over the months because I'm a healthcare investor and writer. Okay, so they announced a 15-to-1 reverse stock split, which I did not know until Ed mentioned this, and then I was looking it up. Is the end coming? So it looks like the company just announced on March 18th that they are enacting a 1-for-15 reverse stock split of the company's common stock, which will become effective at 12 a.m. Eastern on Thursday, March 20th. Okay, so this just happened. The company's common stock will continue to trade under their existing symbol. So I guess now it's at $10 a share. So reverse stock split, it's when a company reduces the number of outstanding shares, it increases the share price. Often this is to meet exchange requirements or to improve the perception of the stock. So instead of dividing shares like in a regular stock split, a company consolidates existing shares into fewer but higher priced shares. This can again be in order to hopefully avoid delisting or just generally to improve perception of the stock. So it looks like now shares trade for $10 each. Okay. But still down about 66% over the last year. I mean, if anything, this just makes me want to not go anywhere close to this company at this point. I've gone through their issues that they've been dealing with the last few years. The stock's never quite recovered from the news that they had received a warning letter from the FDA in 2023 regarding their Tableau system and saying that they were basically selling it outside of what the listed indications for this hemodialysis system was. Even though they did, take it off the market and address those issues, there's been other regulatory setbacks. They have struggled to become profitable. They also, I guess they had recently announced that they had raised nearly $300 million to help pay down some of their debt, but they are still, hemorrhaging losses, significant debt. As of, let me see if I can get this right. As of January, shares were trading around $1, to give you an idea of kind of where the difference is now with this reverse stock split. So I don't know if the end is near for the company, but this is not one that I would want to go near if I held shares of it right now. I mean, maybe I wouldn't be doing anything with them. I don't know. This isn't one I've ever owned, but I don't think this is a company that looks anywhere close to a turnaround at this point. So I'm watching from afar.
Yeah, just to be clear, the reverse stock split took effect at the beginning, before trading opened on Thursday, March 20th,
Thursday,
2 days ago. So
yeah,
that $10 price that we're looking at now, it would have equated to like about 67 cents a share based on the pre-split number. And so being below that $1 a share, that's often the trigger that New York Stock Exchange, NASDAQ will look at for potential delisting action, at which point somebody tries to figure out, okay, how big of a reverse split are we going to have to do to get the stock back up and not have to do another reverse stock split like next month or something like that. So just a difficult thing.
It's an interesting business, but the performance has been troubling. If they could turn things around, obviously I would applaud that. That would be great. But this is not a great sign. It's not a good look when a business does this. I get why they did it. I'm sure it was to avoid being delisted from the NASDAQ, but not great.
Let me take a question from BG from about half an hour ago. Celsius Holdings, ticker CELH, has gone from around $22 a share to around $32 in the last month. Is it a buy for the next 5 years? BG, absolutely correct. We've seen a bounce in Celsius stock. It's a much needed bounce, though, as the stock had fallen dramatically from highs. There was concern about increasing competition, some concerns about that, the Celsius had a landmark deal with PepsiCo, ticker PEP, that involved PepsiCo agreeing to open its distribution network to Celsius products. That dramatically increased the audience of folks getting exposure to Celsius. It led to immense increases in sales. If I recall correctly, sales doubled in each of 2 consecutive years. So 4x over 2 years was a big impact. Had a big impact on the company. But once you have that kind of growth, it's hard to come up with the second act. And as you know, as things kind of topped out as far as that hyper growth phase was concerned, Pepsi made some moves to adjust its inventory based on, changing consumer preferences. Celsius's market share, it kept going up, but not by as much as it had, not by the kinds of leaps and bounds that it had seen in the past. And so we got to a situation where, some of the perhaps overly ambitious growth expectations that companies had about how far Celsius could go, ended up being over. We had a pause basically in the stock. And then once the pause in the growth came, then some growth investors said, okay, yep, hyper growth phase over. We're going to move on to other stocks. And that kind of contributed to the big drop that we saw. Where the rebound started was in Celsius announcing that it would acquire a competitor, Alani Nutrition, better known for its Alani Nu chain of energy drinks. And that actually addressed one concern that a lot of folks had, that yes, Celsius did a good job of breaking its way into a market that was controlled largely by 2 players, Monster Beverage, ticker MNST, and Red Bull. But conversely, this industry has been subject to kind of the ins and outs of style and what consumer preferences happen to be. And so, there were some concerns that Celsius, it had its cool phase, but that other disruptive companies would step up and fill that gap and end up taking away some of Celsius's upward trajectory. And so in that vein, I'm going to share my screen here just to kind of give you a sense of what we were talking about here. I think that Celsius deciding to acquire Alani Nu made a lot of sense. Just take a look. I'm showing the product packaging here. So these are the cans of, if you buy a Celsius drink, what you're going to look at. If you buy an Alani Nu drink, what you're going to look at. Celsius made a big deal out of saying that the demographic audiences that these 2 companies were looking at were highly complementary, that they tended to have different demographics appealing to different sets of folks. Celsius, kind of a no-nonsense, fitness-oriented, originally got sold in gyms and fitness centers exclusively, only later in its history got pushed out to other distribution venues. Alani Nu, on the other hand, really catering to be more of a lifestyle brand, appealing to a broader kind of, more mainstream audience, and trying to, pitch the benefits of energy drinks more generally. And so you can kind of see, I get what Celsius is trying to do, and Celsius, I think there's something to be said for it. For long term, it's nice. Alani Nu had risen to number 4 market share in the U.S., behind only Celsius and Red Bull and Monster. And so combining number 3 and number 4, it's not going to make Celsius, the combined Celsius and Alani Nu. They're still going to be number 3, but it's going to be a more convincing number 3. And I think that the range of possibilities you're going to have for Celsius being able to introduce new product lines and, again, reach out to a broader audience, that's certainly the goal. And if they succeed, then I think that you could see Celsius getting back more on an upward trajectory longer term. I do think that, there's only so far that there's only so many energy drinks that are going to get sold in the world. And so there is a cap eventually to growth. But I'll tell you, I was the first to be shocked when Monster Beverage has become, one of the best performing stocks of the 21st century. Just the range in which it disrupted the beverage industry more broadly and made energy drinks into a lasting category that consumers of all kinds buy was incredibly impressive. And so if Celsius can match even a portion of that success, then yeah, I think that this rebound may have further to go.
I also love the packaging for Alani Nu, just from an aesthetic perspective.
It's amazing.
It's
so
awesome.
Beautiful. Yeah,
I know. I love it. So there was a question that Jeffrey Mulvaney had asked about an hour ago, Dutch Bros versus Starbucks. Yeah, this is an interesting one. I mean, obviously Dutch Bros is a much smaller enterprise than Starbucks. Dutch Bros has been around for a long time at this point. I mean, they were founded in the early 90s, but they have been really intentional, strategic, and gradual with their expansion. There's some big differences, right? I mean, Dutch Bros is still a domestic enterprise, right? Starbucks is international between the US and China. That's 61% of their business. Some of the biggest struggles Starbucks has been having recently is because their second largest market is in China. And within China, there are so many fantastic local options that there is immense competition for Starbucks. And Starbucks, I think, is really working to move beyond that. They are expanding a lot within Europe as well to try to, I think, lessen their exposure and reliance on China as their, basically biggest international market. But that's a huge issue for them. Dutch Bros is much more of a casual drive-through experience. It's all about kind of having unique, customizable drinks, going in, going out. It's not necessarily about going and sitting down and enjoying a leisurely coffee and, visiting with friends and family. They have very, very limited seating options at this point. For pretty much all of their locations, as far as I can tell. They are generally considered to be more affordable from a price point perspective than Starbucks. Like Starbucks, they offer a loyalty program, although it's certainly not as big or widely adopted as Starbucks is. Dutch Bros is obviously also probably in an earlier stage of their growth story. So they're experiencing really rapid growth at this point. That's been very apparent in their financials, which have been pretty stellar. And this is a business that I found myself increasingly interested in. Starbucks is known for having that more traditional coffee shop experience, having a focus on a wide range of food and drink options. Something that Dutch Bros management mentioned in their recent earnings call that I found particularly interesting was they were saying, we really haven't explored that much into the food category. We've really focused primarily on beverages, and food sales are a really, really small part of our business, but we really want to make that a bigger part of the business moving forward. And that's something where they see a significant opportunity for growth. So I think in many ways it's about, investing in a much more established international player that is having what I think are probably near-term growth issues versus a domestic, really fast-growing coffee chain that has a slightly different model in terms of how it operates its businesses. I think that there's a place for both of these companies in a long-term investor's portfolio. Personally for myself, with Starbucks, the other thing I'll note is they are doing a good job with their international expansion as they are working to try to lessen some of their reliance on China. They've had plans to open something like 300 new stores by 2028. They've really been focusing on the UK, France, Spain, as well as some other markets. They have also been really pursuing their strategy of mostly licensed and franchised operations in the EMEA region, so Europe, Middle East, and Africa. Partners like the Al Shaya Group and Alcia have been a really key partners within these different regions for them. That I think has been successful, and they're still kind of in the early stages of that expansion. So that's something that I think gives me a lot of confidence in the business over the long run. I like both of these companies for very different reasons. Like I mentioned, there's some overlap in their models. There's some really key differences. Dutch Bros is obviously still working to be consistently profitable. They did report about $67 million in net income in their full year 2024. For me, I look at Dutch Bros as this is a domestic player, fast growing, slightly different approach to the coffee shop experience. Starbucks is just this massive international enterprise. And those are two kind of different businesses in their way. But I think that there's a lot that they probably both have to offer over the long term, depending on what one is interested in as an investor.
Rachel, are you a coffee drinker? Have you been to one or both of these companies' establishments?
I am a copious coffee drinker. Anyone that also is on here with me regularly, I always have an espresso handy. Starbucks, yes. Ironically, so where I am here in Italy, Starbucks has been expanding more, as I mentioned, in Europe and in Italy specifically. And this is anecdotal, but it's been kind of surprising to me to see the success of Starbucks here in Italy. They have definitely catered the experience of these locations to be much more of, I think, what locals would want. But I walk by one or two Starbucks regularly here in Rome, and they're often filled with Italians, which is interesting. Dutch Bros, when I'm back visiting in the States, I'd like to go to, but I have not yet been to one. I've heard good things.
Yeah, same with me. I'm not a coffee person. I'm a hot chocolate person.
Oh, okay. I like hot chocolate.
And I have found that Starbucks hot chocolate is an acquired taste. I think if I had to say something, I'd say that they kind of try too hard. They're trying to make it something. And it's like, I'm just as happy with ripping open the package of the Swiss Miss or whatever it is and sticking it in water or milk and calling it good. Have not been to a Dutch Bros, but what I'm reading, I'll tell you, fools, be careful. If you search for Dutch Bros versus Starbucks, one of the first results that comes up is Reddit, and Reddit is always a funny place to be reading comments about companies. But one thing that I did find, I'll have to verify, but that apparently that Dutch Bros makes its mocha drinks with chocolate milk instead of taking regular milk and adding some other type of chocolate flavor. So it's an interesting take on it. I'm also interested in the size differences of the drinks. Apparently there's, Starbucks has its all fancy Italian names for the sizes of its portions, whereas Dutch Bros just goes with medium, which I think it can appeal to Americans.
Keep it simple.
Trying to keep it simple, but it'll be interesting. I've seen them around, but I have to say, like from my perspective, sometimes I work a lot from home. Occasionally, it's nice not to work at home. And so the idea of that third space that Starbucks offers is kind of part of the reason that I would go to a coffee shop. And so, I'm not the kind of guy who's going to sit in the drive-through at 8:00 in the morning and wait in a line that's 20 minutes long for my coffee. But nevertheless, it's something. I'll have to give Dutch Bros hot chocolate a try. When I do, I'll come back, Motley Fool members, and walk you through it.
Yeah, I had no idea they served that. So yeah, that's on my action item list when I'm visiting the States again in a few months.
All right, fools, that does it. It's 1 p.m. I think Rachel's hanging around, but I am taking a lunch break. Fools, thank you so much for joining us, and do stay tuned. We've got Neil Rozenbaum coming in to talk with Rachel again on an Ask Us Anything segment. But thanks so much. And Rachel, take it.
Awesome. All right. Well, I see Neil here coming in. Hi, Neil. How are you? Good afternoon.
Good afternoon. Yeah, good afternoon. Actually, good evening.
Or good evening. Oh, yeah.
It's
it's 6 p.m. where we are, isn't it?
Yep.
Time has flown, but it's 1 p.m. on the East Coast. So for many of our viewers who are tuning in from around the world, hello, good evening, good afternoon, wherever you are. We are here for another Ask Us Anything hour. So any questions that you have related to the market, to stocks, go ahead and get those in the Slido. We'll do our best to answer those. Something we always like to say at the top of the hour as well. We are able to give our personal opinions on companies, on stocks, but we are not here or able to give you, personalized financial advice about your portfolio, about what stocks to buy or sell. That is outside of the purview of our role here on Fool Live. But we are, delighted to share our thoughts as we go through this next hour on any companies that you want to ask us about. So go ahead and get your questions in there. The event code is Fool24. Maybe to start off this hour, we already have some questions that are here in the queue to go through. But something I wanted to hit also at the beginning of the hour as we're waiting for questions to come in. We had the meeting from the Federal Reserve this last week. Nothing major that came out of that in terms of anything that was outside what the market was expecting. But I'm going to take a few minutes to go through that. And then Neil, if there's a question or something that's in the queue that you want to answer and you want to look through there, feel free to do that. But the Fed decision recap, which, they had their meeting concluded on March 19th. The Federal Reserve kept interest rates at its target range of 4.25 to 4.5%, which again was broadly expected. The market has priced in 2 additional or even 3 rate cuts by the end of 2025. Policymakers have said they see 2 rate cuts coming in 2025. But broadly speaking, no one was expecting any changes for this last meeting. Now, the Fed's economic outlook also called for higher inflation, as well as lower economic growth. At the press conference held on Wednesday, Fed Chair Jerome Powell said a good part of the central bank's higher inflation expectation is related to tariffs. He also noted that economists outside of the Fed have generally raised their estimated likelihood of a recession, but that a severe downturn in his estimation is still not likely. Stocks surged that day when he was speaking at the podium at the press conference. Fed Chair Powell also said the central bank's forecasts for less economic growth and higher inflation in 2025 somewhat offset each other. He said the fact that the forecast for rate cuts this year stayed at 2 is notable. At the December meeting, the median was 2 cuts. This was a quote from one of the analysts reacting after the meeting. So this analyst was saying, so you come in and you see, broadly speaking, weaker growth, but higher inflation. They kind of balance each other out. There was a quote from another analyst saying, responding to how Powell was saying that outside of forecasters' recession projections have moved up, but still not high. Saying that economists outside of the central bank have generally, increased their estimated chance of a recession in terms of their viewpoint, but such a severe economic downturn is still not likely. Powell noted that there is always an unconditional probability of a recession in the range of 1 in 4 at any given time. And then again, going back to Powell's comments that a good part of the higher inflation expectation comes from tariffs. He acknowledged that on Wednesday, saying some of it, the answer is clearly some of it, or a good part of it is coming from tariffs, but we will be working with other forecasters to separate non-tariff inflation from tariff inflation. The Fed also downgraded its economic growth outlook while raising its inflation projection. The central bank now sees the U.S. economy growing at a 1.7% pace this year. That would be down 0.4 percentage points from what it forecast in December. Core inflation is expected to grow at a 2.8% annual pace. That's up 0.3 percentage points from the prior reading. And again, Powell also noted that the Fed will be carefully watching for signs of weakness in real economic data. Right now, the hardcore data has been pretty solid, even though survey data has shown rises in uncertainty, concerns about downside risks. For example, we saw that uncertainty reflected in the University of Michigan's recent survey indicating consumer sentiment and data. But again, looking at real economic data, it's still been fairly solid. One other thing as well, tariffs may delay inflation progress. Powell said, I do think with the arrival of the tariff inflation, further progress on that front may be delayed. He also said that some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures. And again, tariffs are being noted as a driving factor. He did say, however, that the Federal Reserve is comfortable keeping interest rates at an elevated level if the economy remains strong. If the economy remains strong and inflation does not continue to move sustainably towards 2%, Powell said, we can maintain policy restraint for longer. Powell also acknowledged the U.S. economy as being strong overall, even though there are some signs of weaknesses in spending among consumers. There was a comment following that press conference from Morgan Stanley Investment Management's chief investment officer. He said the Federal Reserve, in his opinion, is kicking the tires on the economy, but that will be a different story for its next meeting in May. For now, it's also worth noting that reciprocal tariffs are supposed to go into effect in early April. And so there also, of course, will be around that time, Q1 earnings will start to come out as well. There will be some additional data in there that could give some indication as to the state of the economy and the consumer. Again, though the Federal Reserve's outlook calls for 2 rate cuts this year, the central bank's picture of the economy still looks a bit uncertain. But as noted, they see the economy growing at a 1.7% pace this year, which would be down 0.4 percentage points from the December forecast. Core prices are expected to grow to 2.8% annual pace, which is up 0.3 percentage points from the last projection. And then one final note, the Federal Open Market Committee announced that it will slow the pace at which its balance sheet shrinks starting next month. Beginning in April, the committee will slow the pace of decline of its securities holdings by reducing the monthly redemption cap on Treasury securities from $25 billion to $5 billion. The committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at $35 billion. Obviously, for anyone that's been following this, the central bank has been working on reducing its balance sheet, which expanded significantly during the pandemic when they tried to calm financial markets. And the decision to slow that pace could be one of multiple factors in why the 10-year Treasury yield had moved slower since that statement was released. So a lot to follow there. Again, nothing particularly going on in that meeting that was anything different than what the market had been expecting or what investors had been projecting. Obviously, there is also a notable difference between the stock market and the economy. We know that economic shifts do tend to trickle down and have an impact on the performance of publicly traded companies, as well as on investor sentiment, which broadly speaking moves the markets and then impacts share prices. But it is important as investors to be aware of this news, even if it might have a variant impact on the actual stocks we own in our particular portfolios.
Very good summary. I think I'll have to take those notes for a later stream or video article. But no, it was interesting because up until that speech, it was as if you were reading only the headlines. It was as if everything has imploded already. We are definitely going into a recession. Everything is going down, negativity across the board. But then when you hear data, although there's definitely some negative data there, but like you said, like on the one side you have consumer sentiment that is quite low, but on the other side is like if you look at the data, people are still going to buy a new car. So which one is it? So all in all, I think we're far from, in my opinion, the US economy falling apart, especially considering what we've just heard from all of the companies in the last month and a half, 2 months. I mean, if you listen to the credit card companies, some of the cruise lines, for example, it seems like things are still fine, all things considered. Of course, it's still early to know what exactly is going to happen. So probably the next 2 earnings calls, so 6 months from now, we'll get a clearer picture of what exactly is going on, because everything that we're seeing today still hasn't really baked into the full effect of whatever's going on with tariffs, with cuts, federal cuts, etc. So the markets have already reacted quite aggressively, right? It went down 10%,
right.
I would say record pace. So we've got already a pretty negative and harsh reaction from the market. And now let's see if it's actually worth going down more, because we might be going to a recession or something like that. Plus, I would like to add that previous recessions, stock markets have always rebounded before the recession was over. So who knows? Maybe we might see the same thing happening now, but interesting times for sure. Interesting time for sure in the stock market right now. I do want to mention one thing from your previous conversation with Dan. I don't think I've ever ordered a coffee at Starbucks by using their venti or grande or whatever. It's like either small, medium, or large. That's all.
Yeah,
they should change that.
Yeah, maybe they should. Although I think I've used the different ways of ordering it here. Although to be fair, in Italy, I don't actually go to Starbucks that often. But one of the points that One of the
It's not good. It's not good coffee. You go to a Starbucks because there's nothing else, or you just want to have the social sphere.
Yeah, it's that. I think that also, like I was mentioning, the way, I mean, at least the ones they've built in Italy, I've gone to them in different parts of Europe. They're all very nice. And I do think their expansion in the EMEA region generally is going to be really important to their growth over the long term. But kind of anecdotally, the locations that I've been to in Italy, they have been, I think, very customized to cater to local customers, local demographics, and that's been really successful. I mean, you obviously have there's the massive Starbucks Reserve Roastery in Milan, which is like an entire experience, which kind of blew my mind the first time I went there. And then a couple of the locations they have here in Rome, they are much bigger and sleeker than some of the locations I've seen, say, in the US. And they are, as I mentioned, often filled with Italians, but it's also one of the few sort of places you can go to here and bring your laptop and work, because this is not so much true in other parts of Western Europe, but in Italy, the laptop in the coffee shop culture is not so widely adopted here. So most of the cafes here, you can't bring your laptop to work, but you can at Starbucks. That's something I've noticed.
Yeah, no, I've seen that in Japan as well. In Tokyo, I went to the Starbucks Reserve there. It's also incredible. But there you have that. Go to Starbucks and spend 3 hours of your day alone, of course.
Yeah.
Alone. You cannot sit with 10 friends at a table. It was an interesting thing. But yeah, the coffee itself, I know I love coffee. I drink Starbucks coffee because I couldn't find something else near me. And
yeah,
the hot chocolate ones, what Dan said, yeah, maybe I could agree.
Sometimes when it's getting warm over here, which it's not really warm yet, it probably in like a month or so, it's going to start to feel more like spring here in Italy. But sometimes when that season is kicking off, again, this is also a cultural thing here in like your average coffee shop, which we would call a bar. You can't really go and get a big iced coffee. That is not an Italian way of drinking coffee. But you can go to some of these bigger types of places like a Starbucks and you can get a big iced coffee, which, maybe that's just the half American in me coming out that I want that, but it is really good. So yeah, anecdotally, it's been a fun experience, but the reserves are like a completely different type of experience. I mean, at least the one like in Milan, you can go and have all sorts of different food. There's like this huge like restaurant buffet section. It's overwhelming. I encourage anyone who's listening, go to a Reserve Roastery if you can. They're all over the world. They're very cool.
Yeah, very cool. A bit more expensive, but it's part of the experience. I mean, as long as you don't order pineapple on pizza in Italy, I think you should be fine.
Oh no. My DNA would prevent me from doing that. I can't. No offense to anyone who has pineapple on their pizza, but yeah, that's kind of a sin in my family. So we can't do that. Okay. There was one question here I'll hit really quick and then I'll kick it back over to you, Neil. Ed was asking a day ago, Nike exec saying the turnaround will take longer than expected. Is Nike's above average growth over $67 still too high? I happen to think Nike is trading at a somewhat more reasonable valuation right now. Obviously, we can't tell you what price to buy or sell shares at it. They're trading at a price to earnings of about 23 right now, which is a fairly historical, I believe, low for the business. And obviously, there's a lot of factors at play here. There's also the reality that tariffs are expected to hit their results in the next quarter, among many other issues the company is facing. The CFO, Matthew Friend, has warned of the impact of the newly announced tariffs, which included 20% duty on all goods from China. So CFO Matthew Friend had said, we expect Q4 gross margins to be down approximately 400 to 500 basis points, including restructuring charges during the same period last year. And he said, we've included the estimated impact from newly implemented tariffs on imports from China and Mexico. So last year, in Q3, Nike reported a gross margin of 44.8%. In this most recent Q3, gross margins dropped to 41.5%. That missed estimates, which had been planning for about 43%. So the CFO, again, Matthew Friend, he said the team is navigating, quote, navigating through several external factors that create uncertainty in the current operating environment, including geopolitical dynamics, new tariffs, volatile for rates and tax regulations, as well as the impact of this uncertainty and other macro factors on consumer confidence. There's also the reality that Nike is in the midst of what is, a major turnaround for the business under CEO Elliott Hill. I've talked about a lot in recent days, the challenges that Nike's facing. Obviously, sales have been declining significantly in recent years. This is a function of numerous issues, including increased competition. You have companies like On, Skechers, Hoka, which is under the purview of Deckers, which have taken market share. And have been, broadly speaking, more competitive, more innovative than what Nike has proven itself to be in the last few years. They had a real push into online sales that basically involved them slashing a lot of their relationships with wholesalers. That really backfired and also paved the way for these competitors to basically ink new, really lucrative partnerships with these third-party retailers. And that has really helped cut Nike out of some key areas of the market. And they've also been relying really heavily on continuing to sell popular retro designs like Air Force Ones, Air Jordans, and Dunks for years without maybe pushing for newer, more innovative styles in the same way that these competitors, such as the ones I've mentioned, have. Obviously, they've been having major shakeup. They had a CEO change. Now Elliott Hill is really tasked with turning around the sportswear giant. They've also been working to restore relationships with key retailers. For example, they had previously terminated relationships with wholesalers like Macy's and Urban Outfitters. That was at least in retrospect, a not a good move for the business. So they're working to mend their relationships with retail partners, including wholesalers, after a period of really just focusing on only or primarily direct to consumer, which was not really a great move for the business. They are trying to move away from their over-reliance on classic styles and actively manage their inventory. I don't think that any significant milestones for the business should be expected to be noted in terms of financial growth until starting in fiscal 2026, most likely. Again, they have really emphasized that a huge part of their growth moving forward is sort of this return to sports, making all of their new designs and lines all about the athletic use cases, partnering with athletes to develop new lines and having that be sort of the underlying strategy for their growth moving forward, which in many ways is really going back to their origins and how they, came up with some of these most classic and iconic brands in the first place. So Elliott Hill has said that is a huge part of their growth strategy, is really pivoting back to their origins and focusing on athletes and creating products made for athletes by athletes. I think that that's something that could work for them. I think that they have a lot to prove. And then, like other retailers, they're certainly not alone in this. They are now dealing with the potential impact of tariffs and some of these other elements. And then also just, changes to the macro environment where consumers are cautiously spending in certain areas. We are still seeing consumers spend a lot on things like travel, but maybe a bit less on things. And so I think that that's something that can impact them as well. So I think it's probably a bumpy time ahead. I don't necessarily think that their era of above average growth is over if you think about the next 10, 15 years, right? Like a very, very long-term investment trajectory. I think in the short term, I think it is going to be a very bumpy road. I think that the type of results we saw from them in this most recent financial report are very much probably going to be more of the same, at least for the next few quarters. I think that probably, as I mentioned, fiscal 2026 would be the soonest I would expect to see any real financial turnaround. I think that, for investors who believe that this is a business that can succeed over the long term, there could be a a lot to like about this business, as shares have been beaten down to a much more, palatable valuation. But I don't think it's going to be an easy road ahead. And I think it will probably be a few years at least before we start to see the real impact of this turnaround take place, which, to be fair, is a reality for any business in the midst of a turnaround, whether it is an iconic brand like Nike or otherwise.
Yeah, no, I'd have to agree and disagree on some parts, because Nike, yes, is an iconic brand. So every time I hear people say, yeah, Nike isn't going anywhere, I'm like, you're right. Nike, the brand worldwide, probably is here to stay. It's not going anywhere, but maybe the stock might also not go anywhere. And that could be an issue. Even if you think they can turn it around, but can they outperform? That's the question. Can they outperform the market? Because if not, then what's the point, right? Why not go for a brand that is outperforming and that is taking market share, such as On, for example, or Deckers, although Deckers did take a hit this year. I think it's down over 40% or so the year to date. So definitely something went wrong in the most recent quarter. But then On, of course, much smaller, but they're still growing at 50%. So my question is, if you think there is a turnaround story, how big? Because it needs to outperform in order for it to make sense. Of course, in the meantime, you still collect a dividend. So at least there is that. But I just have a feeling, because at the end of the day, we're talking here about mostly footwear, because that's the biggest chunk of the revenue. Of course, they have apparel and some other segments, but we're talking about shoes. And today, we have way more choice than before. New Balance is back in popularity, out of nowhere suddenly. You have Hoka, you have On, even Asics are going up as well. So you have way more competition today. And despite them being an iconic brand, I'm still sitting this one out, because I like turnaround stories. I have a couple of turnaround stories myself in the portfolio. But to me, it makes less sense at the moment. Of course, a year from now, they're going to have quite easy year-over-year comparisons, so things could be looking much better. But at the moment, even with Elliott back at Nike, even he said it's going to take longer than expected. I just don't see why we should jump in right now.
That's fair. That's why it's great to have different opinions represented.
Yeah, no, for sure. But I do want to ask you, because the next week we have Lululemon reporting. They, of course, are also, if you look at apparel, they are competing with Nike. Lululemon has had a completely different story, right? Because they have high margins, super high margins compared to their competitors.
Yeah.
People thought that it was a fad, that it was going away. Clearly not. They continue to grow. Yes, there was that small issue, I think, last year or so, when they launched a new product. It didn't really hit. But the fact that they can have such high margins, they can continue to grow, is quite something. And yet another competitor for Nike to have to deal with, whether it's in the United States, in China especially, and in Europe. So do you follow Lululemon? If so, what do you think? What do you think about the upcoming quarter?
Yeah, I'm probably more intrigued by Lululemon than Nike if I compare the two. There is some overlap in their businesses, of course. But of course, Lululemon is also focused, broadly speaking, on athleisure. And a lot of that centers down to, athleisure apparel. And I don't even know. I think they might sell some footwear, but I'm not sure off the top of my head. I believe they do.
I think, and some men's clothes as well. Very comfortable, by the way.
Yeah,
very comfortable.
Yeah, well, that's the thing, and I've paid more attention to their apparel. So yeah, they do sell footwear, but a lot of their focus as well is outside of that, men's and women's apparel. They started really primarily focusing on women's apparel within this space, and then have very much expanded outside of that. And that's been part of their growth strategy that they announced a few years back, called the Power of 3 ×2, which was essentially focusing on doubling their revenue to 12.5 billion by 2026. And that's something they look well on their way to achieve. And they plan to do this through a range of initiatives, including innovating their core product, continuing to deliver really high quality, innovative athletic apparel and accessories, focusing on fabrics, technologies, and designs that really meet customer needs. And then also growing their presence in both existing and new markets with a focus on international expansion, particularly in China and in Europe. And then also really working on strengthening their digital channels. They also wanted to double their MINS and digital revenue. So their growth of their omni-channel business has been really key to this strategy. And they have been really effective at this. They've been investing heavily in their e-commerce platform, their mobile app. They also have opened region-specific e-commerce stores, like in Spain, for example. And so they have been opening new stores in Europe, including in places like Spain and here in Italy as well. And then again, focusing on really growing their MINS lines, which has also been really effective for the business. I'm very curious going into this next, set of financial results, how the market is going to respond. We actually had some updates from management in anticipation of their upcoming call. So back in January at the ICR conference, Lululemon actually updated its projections for Q4 fiscal 2024. They elevated their revenue guidance. They also elevated their guidance for diluted earnings per share. And where they had previously forecast that their gross margin would actually decrease slightly, they changed that to a projected increase of 30 basis points. So a lot of good things that came out of that meeting back in January. And again, this is a company that has been building a really, really solid financial track record for a very long time at this point. And I think is very well poised to continue to do so. I mean, back in December, when they reported their Q3 results, this is a business that in a single quarter delivered net revenue of $2.4 billion. That was a 9% year-over-year increase. Their Americas net revenue increased 2%, and partly that reflects a very mature business in that area. Their international net revenue increased 33% year-over-year. Comparable sales increased 4%. Operating margin increased 520 basis points. Income from operations increased 45% to about $491 million. So this is a really, I think, solid business. I think that like any of these companies that caters to somewhat discretionary purchases, I do think that there might be some impact if consumer spending shifts, but we're still seeing really solid growth figures from the business, even amidst that period of time. There's also the reality that their products are really designed for kind of duality of uses. People use their products to work out and go to the gym, but also to wear at home every day. And something that's been interesting to me as well with their expansion outside of the Americas is, athleisure is a very common apparel choice in the Americas. In certain parts of Europe, for example, where they're expanding, it is less commonly seen as something you would wear to, say, go meet a friend or go to the coffee shop. It's seen as something, you wear these things to the gym. But I have seen, both anecdotally and also from some data I've read, that some of that is starting to shift a bit. So there is a real opportunity for them in a lot of different target markets. So I think it's an interesting business. I think given the more recent projections we've seen from them, we should be seeing a pretty solid financial report. Now, how the market will respond to that, remains to be seen. We've seen some companies report pretty great results and the market still hits the stock pretty hard. So I won't make any projections regarding that. But I do think that it should be a fairly solid Q4 and full year of results.
Okay, no, fair enough. They're also starting to sponsor more and more athletes from what I've seen. For example, tennis player Francis Tiafoe signed with them, I think, beginning of this year. I've seen some golf players as well. So most of them, Lululemon, On Holdings are all starting to sponsor more and more athletes. The Nike strategy. So things are going to be very, very interesting. The question is probably going to be about if consumer spending does come down, are people still going to buy expensive yoga pants, as I say, as I call Lululemon?
Right.
That's the question, and
right.
Whether or not they'll decrease their margins. I guess that's going to be one of the questions on the call. Maybe it will be reflected in guidance as well. We don't know, but.
I think that the expensive yoga pants have a pretty like robust brand loyalty. So I think over the long term they still succeed. But I agree, in the short term it's hard to tell how consumers are going to respond, or are they still going to want to go make these, maybe purchases of 1 or 2 pairs and have a little short term joy, maybe amidst difficult economic conditions.
No,
Remains to be
I
seen.
agree. Mm-hmm. I mean, it's Thursday, right? The earnings report. So I guess we'll only have to wait a couple of extra days. I do want to touch on the question from Ed from 16 minutes ago about Elon Musk and Tesla. Is Elon Musk making all of the decisions at Tesla, or is he just the figurehead at Tesla and he has others running the company? So on Thursday, I believe we had a all hands meeting that suddenly came out of nowhere, first of its kind, because Tesla usually never does conferences or talks other than earnings report, earnings calls. Although I've been saying this for quite a long time, I think they should be doing a little bit more of the all hands meeting. So was quite happy. So Elon Musk, the guy, I don't know how he does it, but he finds time to still be CEO of Tesla, chief engineer of SpaceX, has boring company Neuralink, XAI, now Doge. Somehow he manages to do all of that in 24 hours a day. I don't know how. Maybe he has clones. Maybe he's an alien. Who knows? But I think at the moment, and I actually did this in the prediction show 2-3 days ago, I think 5 years from now, he's going to step down as CEO of Tesla. And we are already seeing today more and more of people under him pop up on podcasts, on shows, and speak up a little bit more about Tesla. So he's still running the company, but I think there is also a lot of power that has been going to people underneath him, people that have been with Tesla for more than a decade plus. But I still think that he is the captain of the ship. And I think the all hands meeting showed that he still knows exactly what's going on with the company and where he wants the company to go in the future. Timeline wise, of course, I'm extremely bullish on Tesla, but even I know that when he says June, then maybe it might not be June, might be August, October, or something like that. If it's 5 seconds, might be 10 or 15 seconds. So you have to know how to take in all of the information and make sure you adjust for the Elon timeline. But yeah, I still believe he's the captain of the ship, but I also think that 5 years from now he's going to step down.
There was a question about the NVIDIA conference this week, and there's some things I can talk about of what was said there, and I think this is also a company that you follow as well, so I'm sure we could both share some thoughts. Ed was saying, during the conference, did NVIDIA reassure investors that the future for AI and spending is bright? What positives came out? There was a lot that came out, and there has been, many Fool contributors who follow this company. I think including Neil, Jose Najarro is another, resident NVIDIA expert on our streaming that have covered a lot of what came out of that conference. But I will also speak to some highlights. In terms of spending, CEO Jensen Huang gave his anticipated, keynote address, obviously on Tuesday, and he, among many other announcements, he shared a chart demonstrating his belief that data center capital expenditures would reach $1 trillion by 2028. And of course, this is a huge area that NVIDIA's growth is tied to, given that data centers are where the vast majority of NVIDIA's revenue comes from. And it continues to control the GPU data center market, which of course are also the core infrastructure of AI applications like chatbots and AI agents. But there was a lot of other things of note as well that I think are worth noting. That meeting again concluded this last week. NVIDIA also announced the launch of the Open Llama Nematron family of models with reasoning capabilities. It's basically a launch of open reasoning AI models that are made specifically for developers and enterprises. And they're supposed to help these developers and enterprises have a business-ready foundation to develop advanced AI agents that could work independently or as connected teams to solve complex tasks. There was also the news that NVIDIA will be joining forces with Alphabet and Google to collaborate on the future of agentic and physical AI. They're going to be developing new initiatives to advance AI, democratize access to AI tools, speed the development of physical AI, and transform industries such as healthcare, which is of particular interest to me, given that that's a space I follow so closely, manufacturing and energy. CEO of Google and Alphabet said, "I'm proud of our ongoing and deep partnership with NVIDIA, which spans the early days of Android and our cutting edge AI collaborations across Alphabet." He also said, "I'm really excited about the next phase of our partnership as we work together on agentic AI, robotics, and bring the benefits of AI to more people around the world." So Alphabet engineers and researchers are working with NVIDIA to use AI in simulation in activities, including developing robots that have grasping abilities, redesigning the pace of what it looks like to enable drug discovery, and even for use cases like optimizing energy grids. Another thing as well is that NVIDIA will be the first external user of Google DeepMind's Synth ID, which is a solution that embeds digital watermarks right into AI-generated images, audio, text, and video. And it basically also Synth ID is designed to help preserve output integrity from NVIDIA Cosmos World Foundation models, which could help also safeguard against issues like misattribution and misinformation in video content. NVIDIA also announced they're building an accelerated quantum computing research center that's going to integrate quantum hardware with AI supercomputers to enable accelerated quantum supercomputing. They announced their NVIDIA AI data platform, which is sort of a new class of enterprise infrastructure. It's a customizable reference design that will be used by providers to build this new class of AI infrastructure for demanding AI inference workloads. They also announced that they're partnering with Oracle, collaborating on agentic AI inference. Another thing that also really caught my attention with this particular meeting, which had like 25,000 in person and about 300,000 virtual attendees, is that 700 healthcare companies from more than 40 countries were represented at the GTC to discuss AI applications in healthcare, from the promise of protein design and foundation models that can be used to digitize healthcare records and fully autonomous labs. Nobel laureates as well were present. Kimberly Powell, who's the VP of Healthcare at NVIDIA, highlighted how we've come a very long way in a short period of time, for example, in utilizing large language models and generative AI approaches for the field of drug discovery. She said, quote, "We're taking all the right models and packaging them up so people can access them. They're getting built into software and R&D platforms of the pharmaceutical industry. So far in 2025, we are seeing rapid adoption of these capabilities, and we know we need to keep pushing the capabilities higher." Another thing that's notable is this DGX Spark that's powered by the NVIDIA Grace Blackwell platform that they unveiled. It has the use or the utility of an AI supercomputer, but it's a desktop size, which is ideal for data science research workloads. That's also something that has a real application specifically for within the healthcare industry. Something else worth noting is a software development company that focuses on drug research called Sapio Sciences. They announced that they are going to be integrating the NVIDIA BioNeMo into their Sapio Lab informatics platform, which essentially brings computational drug discovery directly into their electronic lab notebook. And this means that within Sapio ELN, or their electronic lab notebook, researchers can access NVIDIA's BioNeMo NIM microservices to identify and optimize drug candidates and use it for molecular modeling, predicting protein structures, optimizing small molecules. There's a ton of potential there. This is obviously just one industry, but I thought it was interesting to highlight as well because I'm a healthcare investor and reporter here. So those were a few things that stuck out to me, but I'm sure you have a lot more to add to that, Neil.
Yeah, so the capex slide that we saw was, and he said that I think during an interview with Jim Cramer, it was only about data center capex, because he then said we're not even talking about AI factories, and that's his big selling point, I think, for the whole week is the AI factories, and that's not in that $1 trillion number by 2028, which, by the way, is a number that they took from a Deloro projection. So imagine data center capex worldwide by 2028, $1 trillion, and that's not taking anything from AI factories, which he thinks that every big company is going to have an AI factory. You're going to have Amazon retail store, you're going to have an Amazon AI factory, a Walmart AI factory. Tesla already has one for their autonomous vehicles, robotics, etc., etc. Because essentially, what you're going to have is humanoid robots, autonomous vehicles. They will always be talking, let's say, with that AI factory. So a robot needs to clean the house, fold your clothes, etc., etc., answer questions. All of that needs, of course, token generations, inference. You ask a question, you get something back. You need AI factories for that to exist. To have all of these things at scale, you will need AI factories, not only the data centers. And I think that's where the huge number of increase in compute is going to come from, which I don't think is quite baked in yet or at all right now. Because all I've seen, of course, it can be because of uncertainties. We don't know if there's going to be enough demand, not enough demand. If you look at the CapEx number first for this year from the big tech players in the United States, only the big tech players, not sovereign countries, other companies, you name it, it's over $4 or close to $400 billion. Most of that is going to flow to NVIDIA, since NVIDIA does have the majority of the market, over 80%. So again, short-term markets can be drunk. Longer term, I think the markets will realize, oh, okay, it's a company worth close to $3 trillion, but it's still a company that is growing much faster than lots of smaller companies. Yes, AI, robotics, autonomous vehicles, physical AI, manufacturing, all of that is going to be, let's say, run on top of an NVIDIA platform. And so eventually, I think NVIDIA, the stock, will start to move. NVIDIA, the business, is still moving, and I don't think anything is stopping it anytime soon. So yeah, exciting times again, especially in the AI space.
All right. I'm looking through here. I don't know if there's any questions that have stuck out to you. This is actually a question I answered briefly yesterday, but I'll share a few additional thoughts and then we can get it removed from the queue. Bill was asking, what are your thoughts on the future of pot stocks? Will they get higher? This is obviously this is a space. I also appreciate the pun. I very much appreciate the pun, Bill. Yeah, this is a space that has been just very afflicted, and it's one that I have followed and reported on a lot over the years. I mentioned yesterday, I used to talk a lot with company leaders of different cannabis businesses and, really had a kind of in-depth look into the space here. And look, there's a lot of companies that operate in this space that I think are interesting, depending on how the future of legalization goes, right? You've got ones like Green Thumb Industries, Trulieve, Innovative Industrial Properties, which, as I mentioned yesterday, they are a cannabis REIT. They only license to, they only lease to state licensed growers of medical cannabis. They operate under long-term triple net lease models, where most of the cost of operating those locations and facilities goes down to the tenant. They've been dealing with some issues recently where they've had to readjust some of their rental structures as well as their tenant structure, because one of their largest tenants, a company called PharmaCann, was actually defaulting on some of their rent obligations. The biggest issues you see are really going back to the mixed legalization landscape, because while legalization has expanded at the state level, you do have the reality of states where full legalization has happened. You can use cannabis both for medicinal as well as recreational purposes. These can be bordered by states where it's either totally illegal or legal only for medical use. And it is still completely illegal at the federal level. And because of that being the case, within the US, there is a reality that cannabis companies are often faced with a lot of issues from day-to-day operations because they are not able to access loans and other forms of capital from traditional financial institutions, often because of this mixed legality, because it is still prohibited at the federal level. So accessing capital like regular businesses do is very difficult. This often creates deep issues in terms of profitability and other financial hurdles. Companies like Green Thumb Industries which is a major multi-state operator, have traditionally been a bit more profitable, but that is a bit of a rarity within that space. That's why I've historically been a bit more interested in a REIT, like Innovative Industrial Properties, which is in the business of actually leasing the facilities out, but is not actually in the business of owning or growing cannabis. This is a difficult space. I don't think that you're going to really see an uptick in share prices unless you get clear comments, say, from the new administration of an inclination towards federal legalization. We know that in the prior Trump administration, he had voiced some support for changes at the state level, but had stopped short of referencing support for legalization at the federal level. I think changes in that regard would send share prices upward. Obviously, that does nothing in terms of the underlying businesses, which should be taken at an individual case-by-case basis. I think that unless and until that environment shifts, I think these are companies that, however promising they are still going to, significantly struggle over the long run. I think that, for investors who believe that this is a space that is set to succeed over the long run, maybe there are some fascinating businesses here to look at, but a lot of them, a lot of the actual stocks are trading for, less than $20 a share. A lot of them are seeing very significant share price declines. A lot of these businesses are deeply unprofitable for some of the reasons I've mentioned. So there are interesting, marijuana businesses, a few of which I've noted, but I think this is a space to be very, very, very cautious in. Because even though you have some of these major multi-state operators like Trulieve, for example, they are still dealing with a dynamic where however much progress is made at the state level, and there has been considerable progress made in terms of legalization, you're still dealing with an environment where it is illegal federally, and that creates a lot of challenges to expansion in the long run. I think this is an interesting space. It's one I've followed a lot, written about a lot, but I don't think, businesses, I think some businesses are faring better than others. Share prices, I don't think you're going to see a real uptick in share prices of these businesses unless there's some announcement or some major legislative shift. And when that would happen is unclear at this point.
Okay. I don't follow. I mean, I used to, because that was all of the hype when it started off, but lost interest because I don't know, too hard to follow, I think, for me. There was this one question from Larry Four-Card Poker. Your favorite small cap growth stocks to buy today and hold long term? Of course, this is not financial advice, personal financial advice, just our own opinion. Do you have any favorite small cap growth stocks that you're looking at or that you own?
I have usually gravitated towards some of these larger businesses. So there's probably some small caps that I follow, but I haven't really invested in small caps per se. I've usually gravitated a bit more towards mid and large cap businesses, as I have tended to find those more compelling. There's a lot of smaller cap healthcare companies that I have followed that maybe haven't been, the best investments, and so I've stayed away for that, very reason. I'm thinking off the top of my head if there's like one that's smaller is Viking Therapeutics. They have a market cap of about $3 billion. That's probably about as small as I would consider at this point. That's one I've been watching from afar, particularly as it relates to their GLP-1 candidate. I think it's an interesting business, pretty risky biotech stock. And for that reason, I have watched, but not actually taken a position at this point. But there's been a lot of interest in the their leading candidate, which is called VK2735. It's obviously it's a weight loss medicine, a GLP-1 drug. They've signed a major manufacturing agreement with a company called Corden Pharma for both the oral and subcutaneous versions of this GLP-1 drug that they are testing, and that would grant them manufacturing capacity of more than 1 billion oral tablets and about 100 million auto injectors. And there had been speculation that maybe Viking Therapeutics would get bought out. This type of a move seems very much to fly in the face of that type of news. So I think that this is an interesting company. I think that they also have produced really promising results from their phase 2 study thus far. And I think it's been, pretty impressive. Also, that candidate passed its phase 1 trial with really flying colors. And they're also working on drugs that treat numerous rare genetic conditions. But they're planning on moving forward with phase 3 studies for the subcutaneous formulation of their GLP-1 drug in Q2. So that should be coming soon. And they think that could, generate well over $1 billion in annual sales if approved. So that's maybe one that I find intriguing at this point in time.
Okay, no, I knew this one was going to pop up because we touched on that a couple of days ago.
Bit over the small cap threshold, but it's as small as I am intrigued by at this point, I should say.
Yeah, no, I mean, the small cap category I think should be revised a little bit because it's still small. I think $3, $4, $5 billion, all things considered, I think is still quite small. I have one name that I'm following. I mean, that could definitely be considered small cap. That's DLocal, ticker symbol DLO. That's a market cap of 2.6. Okay, maybe a bit over the high end. $2.6 billion. Latin American cross-border payment company, focuses on emerging markets. So this is my play for a growth story. It's a company that is still growing quite rapidly, above 20% year over year. TPV, revenue growth, profitable, and small cap. Yeah, I think I'd say 2.6 billion is still considered small cap. It's a competitive market for sure. Take rate wise, I think that's coming down for every other player, but you're going to make it up through TPV growth. So that's one. And then another one, I don't think it's a small cap anymore because it's worth close to $10 billion now, and that's Rocket Lab, the call it space company. It's one that I've had when it was a small cap, so when it was around $2-3 billion or so. So performance-wise, doing quite well for me. It's one that if you want exposure to that space economy, and of course SpaceX not being public, I think it's one of the best names out there. Although you might think it's only a launch company, launch services are actually only 1/3 of their business at the moment. 2/3 is actually space systems. Now this year they're going to hopefully launch the Neutron rocket, which is the equivalent of a Falcon 9 rocket, which means reusable rockets, which means more revenue, higher profits for the company. They really want to be that end-to-end space company. So whatever you need, you'll go to Rocket Lab, of course. Competing with SpaceX is quite tricky because SpaceX is already testing out Starship, and Starship is quite something. I have never seen it live, but the videos, every time you watch that huge building like rocket go up and then get back on Earth and get caught by these metal arms is quite something. So Rocket Lab is another small company that has become a bit bigger. That's on my it's not on my watch list. I own it actually. So hopefully that's a future multi-bagger for me in the future.
All right. We have a couple of minutes left. Oh, there was a question that came in earlier. I don't follow all these companies super closely, but Let It Ride was saying ranking. What are your thoughts on ranking the following for the next 5 years? DoorDash, Coupang, I believe that's the ticker for that, Uber, Grab Holdings, and Instacart. Interesting. So Coupang, I don't follow. DoorDash and Uber, I follow. Grab, I learned about more recently. Instacart, I follow a little bit. I like both DoorDash and Uber's businesses. I kind of for different reasons. I like the kind of broader diversification that Uber has. But I think that DoorDash has also been doing a pretty exceptional job. We actually, I think it was just this last week, did a deep dive on DoorDash. And that's a really interesting business. They have done a really good job of essentially dominating the market in North America. And then they have been a really effective as well at growing through acquisition, particularly over the last several years. That has expanded their international presence, although that is still a really kind of nascent early part of the business, and one that I think that they have probably only just begun to derive growth from. I think actually businesses like Grab Holdings could potentially be a competitive threat to the likes of DoorDash and Uber. You know, Grab is primarily operates, I believe, in Southeast Asia. They also have a much more kind of diverse business model in a way that has some areas that companies like Uber and DoorDash haven't really tapped into. For example, they have a whole financial services segment. They've got their Grab Pay digital payments business that enables online and offline payments. They have a lending part of their business that provides loans to drivers and merchant partners. They even have insurance products. They've got all these also smaller ones like Grab Rewards, which is rewards programs for users. So there's some overlap there with Uber and DoorDash. They've got an e-gifting platform. They have Grab Ads, which is an advertising platform for businesses. So that I think is a major contender within particularly the Southeast Asian market. Maybe if I had to pick, I'd say DoorDash, Uber, and Grab are the three I'm most interested in that order. Instacart, I follow a bit. I do think the business is kind of interesting. I haven't been quite as compelled by it, but I also have not had the chance to look into it as deeply. So since those are the three I know more, that's my answer for those.
Okay. No, I personally right now only own Uber. I know of DoorDash, of course. I know of Grab and Coupang. Instacart, I know the name. I've never really looked into that business. But interestingly, Uber does own 12.5% of Grab right now. It used to own way more than that, 27.5%, because they basically sold their Southeast division to Grab when they were competing one with each other. So I would still put Uber as number one because it does give you a small exposure to Grab as well. So 2 in 1, I'll take that. Grab being that super app in that region. I mean, in China, in Southeast Asia, you really have those super app players, which I don't think we're ever going to see in the West, unfortunately, but okay. And then DoorDash, there was some interesting news this week with DoorDash and Klarna. So you could like order your burrito and pay for $10. I was like, okay, are we going to finance burrito purchases?
The finance memes were going crazy.
This was quite an interesting one. So I think I'll just go Uber, Grab, Uber, Grab, Coupang, because I do think that they are very, very strong and financially strong in South Korea. And then DoorDash and Instacart, just because I just don't follow Instacart. So sorry to them, but they'll get the last spot here.
Yeah. And Instacart, I mean, the one thing I'll say as we run up to the end of our hour here is they focus a lot more on grocery shopping and delivery. And I know that DoorDash and Uber have both been working to kind of expand outside of what they're really known for, which is restaurant food delivery, and focus more on convenience store categories, grocery shopping categories. Instacart is really revolved around grocery a lot. That has been kind of what they've been known for. Customers looking for convenience and to have groceries delivered rather than going to the store would utilize that app. And then Instacart, I think, has been actually working to expand their reliance outside of that. So there is a way in which a lot of these businesses have overlap. And I do think because it is such a segmented market, there is room for multiple contenders within this space. And with that, we are at the end of our hour. For the top of the new hour, we have Will Healy and Dan Caplinger coming back to spearhead another fantastic hour of Fool24.
Hello, guys.
Hello, fools. How are you doing?
Good.
Very good.
Thanks Rachel.
Guys.
Thanks, Neil.
Thank
Thank
you.
you.
Come on.
Enjoy.
Will Healy.
Dan Caplinger, how are you
Holy
doing?
moly, we've never done a show together. This is kind of awesome.
I don't think we have. I think the last time I saw you was in Alexandria a couple of summers ago. So it's good to see you again after all this time.
6 summers ago. Geez, so it's just 2. Oh wait, no, there was what was it? There was some event I think that
in the summer of 23.
Fool Fest or something like that. I can't remember what it was.
Yeah.
But, yeah. So what are we doing? We're doing Ask Us Anything. Fools, get the questions in. Happy to be here. Slido is hashtag Fool24. And as always, Will and I are not in a position to give you personalized investment advice, financial planning, tax advice, accounting, anything like that. That is up to you and your team of dedicated professionals who are licensed and registered and permitted to give you, to apply, hopefully, the information that we try to give you here. Apply that to your own personal situation and get the help that you need in order to reach all of your financial and personal goals. But with that in mind, we aim to do the best that we can to point you in the right direction, share our thoughts and insights, understanding we are not infallible, not at least for me, not in the slightest bit, far from it. But we love to help. So please do. If you're around, just drop us a line. If you don't have a question, just say you're out there. It's always good to know on a Saturday afternoon, where at least on the East Coast in the afternoon, that people are watching, paying attention. We very much appreciate you, Fool members. That's why we are here for you whenever you have the time for us. We're happy to serve.
All right, and with that, let's see what questions we have today. I did see one I wanted to touch on. This was from a while back. There was a couple questions on Murphy USA I wanted to address. Not one that comes up often, but Tom from a day ago asked thoughts on Murphy USA, symbol MUSA. Tom commented that they are a strong share repurchaser, and that's true. The share count, I think, was down 17 or 18% in the last 5 years. It was I'm going off memory there, but it was pretty significant. It has slowed down in the last year, but yeah, historically they haven't repurchasing a lot of shares. For those of you who don't know Murphy USA, they've basically been Walmart's gasoline provider. Over the last few years, they've been trying to get away from that. They're still heavily tied to Walmart, but they're opening up more independent gas stations and convenience stores nowadays. Looking at the valuation, looking at the performance, that's been well ahead of the S&P 500. With that, their valuation has kind of gone up. I think they're about at 18 times earnings right now. Given the growth rate, I think that's kind of fairly valued there. The cash flows haven't been a bit strained with all the share repurchasing. It also has relatively heavy debt since it's made acquisitions. Personally, I'm not really that inclined to buy this. I mean, like I said, it's fairly valued, but it's a slow growth stock. The dividend yield, I think, is a little bit under 0.5%. I don't think you'll do horribly in the stock. But I think it's, now that its valuation is higher, it could struggle to beat the S&P 500. I probably think they also should probably refocus on reducing its debt, since the balance sheet is a little bit strained, but not one I'd recommend. But there are worse picks out there, to tell you the truth.
That's an interesting space, and as you point out, it's one that's often neglected. We've seen so much emphasis in the energy sector on integrated oil majors that tend to have their downstream marketing distribution stuff wrapped into their overall operations, and then so much attention paid to upstream exploration and production, just because that's where so much of the that's where the news comes from. There's not much news when it comes to Dan went down to the corner gas station, bought 10 gallons today. It's just not, it's a reliable business. It's part of why people get into that business, but it is an interesting thing. Nevertheless, yeah.
It is boring, but a lot of times boring businesses can be great stocks. I just don't know that I would classify Murphy USA at that point right now. If it comes down, if its valuation falls back to the 10 PE ratio range, then I might reconsider it again.
So let me ask you, because I don't know, and if you don't know, feel free to tell me you don't know, because it would be a totally reasonable thing. It's totally out of left field, but does Murphy refine its own refined products, or does it buy the refined products from elsewhere and just handle the marketing?
I don't know to be honest.
All good.
With you.
That's all good.
I don't think they do, but I would need to confirm that. So
because that's important. It's one of those things. It's like, you have to be careful with these categories, because there's a lot of companies. A company like Valero Energy, ticker VLO. I mean, you see Valero gas stations around, but they have their own refineries, and so the question becomes, but then you also have gas station operators and distributors who don't have their own refinery operations. They just buy refined products off the market. So it's important when you're looking into these companies to kind of take a look at that.
Yeah,
do that.
I definitely agree.
Let me take a question from Ed. Yeah, I'll take this question from Ed from an hour ago that I was going to answer, and then I ran out of time talking about coffee and hot chocolate at Starbucks and at Dutch Bros, and so I didn't get a chance to do that. But Ed asked an hour ago, what is the difference investing in bonds and REITs, real estate investment trusts? They both have an inverse relationship with interest rates, but wouldn't you have a better dollar opportunity with REITs? So, Ed, the argument in favor of real estate investment trusts, pretty much exactly what you say. You are getting exposure to real estate, and real estate produces income in two ways. One is usually you can rent out real estate and get a monthly payment from your tenant. And then two, historically over time, real estate, especially real estate that's well located and has consistent and ever-present demand, real estate tends to go up in value. And so the hope when you invest in REITs, real estate investment trusts, is that the real estate that these companies own, that the REIT will be able to rent out the property and get a reasonable return, much of which they will distribute back to REIT shareholders in the form of dividend distributions. And then also to see the net value of the assets inside of the real estate investment trust go up, because the properties that they have in their portfolios are well positioned and have at least modest growth opportunities. That is not the case with bonds. Most bonds have no growth opportunity whatsoever, and all you get is the interest rate. So Ed is correct that to some extent, both of these investments have their prices inversely related to movements in interest rates. When interest rates fall, the value of having a fixed stream of income, whether it comes from bond interest payments or from monthly rental payments from tenants on real estate, the value of those streams of payments goes up, because lower interest rates means that, like, whatever you would buy instead, you'd have to buy more of it to generate the same income. Conversely, interest rates go up, it takes more income to make an attractive investment, and so the value of these things tends to go down. The question that you always have to ask yourself is, what is the risk of loss? What is the risk that interest rates won't move the way that you expect them to? And what are the prospects for growth for the underlying assets that are involved? With bonds, the answer being none, or specifically defined by the bond instrument. But with real estate investment trusts, it depends on the kind of real estate. What we've seen, it's important to understand, real estate investment trusts aren't tied necessarily to a specific type of real estate. And so you have different REITs that follow different markets. You have some real estate investment trusts that invest in retail properties, things like shopping malls, things where vendors and merchants will enter into lease agreements to use that space and then open it up to the general public for the purpose of selling goods. You may have office real estate investment trusts where the company is primarily buying office buildings and other business space. They are leasing those spaces out to businesses, to sole proprietors, to anybody using it for a business purpose, often a professional business purpose. You can then also have other, it just goes down the line. There are warehouse REITs. There are REITs that hold self-storage units. There are REITs that hold various different types of properties. Most recently, you've started to see things like data center REITs, where you invest in a property specifically with the purpose of building a data center, putting a whole bunch of cloud connectivity and computing power into the space and working it from there. The growth prospects for those different niches can be different. And so, and they don't necessarily go up. And so, take, for instance, office REITs. In the past 5 years, we've had what many saw as kind of a new risk to office REITs that came at the beginning of the COVID-19 pandemic, but working from home kind of stuck. There are a decent number of businesses, the Motley Fool included, that chose not to come back to the office to operate on a fully remote basis. As a result of that, companies that do that no longer necessarily have a need to lease out office space. And so that puts office REITs in a position where they have vacancy rates, rental income may go down, the value of those properties may go down. It depends, because if they're in a good spot and if that spot has growth potential, then filling the vacancy is not necessarily a problem. But on the margin, if you have decreasing demand for office space, then you're going to have decreasing values for office-related properties. And so as a result of that, the value of the REIT may go down in an environment where the value of just a regular bond may stay relatively stable. So I'd say that the main difference is that you have that real estate exposure for good or for ill. And so keeping that in mind, and also keeping in mind the extent to which the income generating power of the real estate matches up with the income generating power of the bond, won't necessarily get the same interest rates, cap rate, just kind of depends on the investment.
Yeah, and one other thing about REITs is they do have to pay out at least 90% of their net income in the form of dividends, assuming there is net income. So that's the closest thing I think you have to guaranteed income in the dividend space, because most dividend stocks can add their dividend or even eliminate it on their whim. So, but a REIT, to say a REIT status, has to pay that dividend to get that income tax break on their operational profits. So that's one thing to keep in mind. So you're probably going to keep getting your dividend with those. Again, unless they stop making a profit.
Absolutely right. Yeah.
A few minutes ago, Sanjar had a question. Thoughts on quantum computing stocks? Should I consider investing in those quantum computing companies now, or put money in AI? That's a good question. I would lean more towards AI right now, personally. I've been looking at quantum computing a little bit, and it looks like a solution without a problem to me. Most of the contracts related to quantum computing have to do with research. You have a variety of companies in quantum computing right now. You have larger incumbents such as Alphabet or IBM. You have small startups such as IonQ. However, IonQ is losing a lot of money right now, and like I said, most of the client base is going to be research based. So of the quantum computing stocks, my favorite right now is Alphabet, even though quantum computing is not going to show up in their financials, but I think they're the they're the most stable in that space. Maybe IBM also, if you're more income oriented, but I would look to those two rather and just take more indirect exposure into it, rather than trying to go for direct exposure in IonQ, which has very few clients.
Yeah, I can't add very much to this. I mean, these small companies, I'll tell you, it seems like these days there is a new sub-classification of stocks that grabs the attention of the high growth, looking for the next million bagger type investor. And I just feel like my ability to add value in that environment is so low. I'm inclined to stick with the kind of approach that Will was just talking about. I'm an Alphabet shareholder, and I count, I'm not going to get a 1,000,000% return on that stock from here, but I'm not going to get. I find my odds of getting the 1,000,000% on a tiny company in the quantum computing space as being so close to zero is to be like not even worth mentioning. And so sticking with a company that I know that already has an established business, that if quantum computing turns out to be the next big thing, I think will participate in it. But if quantum computing turns out not to be the next big thing and something else takes its place, then I think Alphabet has optionality there to pursue that as well. Yeah, I mean, I don't know. Will, what, like, let me ask you just a question off the top of my head. Are there any trends like this where you felt comfortable like getting in on the ground floor and picking companies that hadn't yet established themselves, these sorts of microcap and, I mean, what would be microcap companies, except that there's enough attention paid to them that they have enough investment flow that maybe they aren't quite as micro as they would have been in a past market environment. Have you done anything with any, in any category like that?
I have not. I really don't like to, unless at least I see a path. Unless I see some application for the technology first of all. And I know a lot of these companies aren't going to be profitable and may even be years away from profitability. But I'd like to see some plausible path to profitability before I go in. So I want to see the obvious need for their technology, and then a way to build with which to build a feasible company that can sustain itself long term.
Yeah. And I mean, my experience, having gone through the internet boom and the subsequent .com bust in the late 90s, early 2000s, the lesson I took from that is that a lot of time when the trend booms, everything's going to go up. Conversely, when the trend kind of goes bust, just about everything goes down, including some of the higher quality companies that are actually going to make something out of it. Mm-hmm. And so, it's like Amazon. If yes, you missed out on gains by not investing in Amazon in, whenever it went public in the late 90s through like 1999, early 2000. But then it went down and it was attractively priced. And so you could get in at that point and say, look, this company is a survivor. This company's distinguished itself from a whole bunch of other companies that, on their face at the beginning may have looked kind of the same. I mean, online bookstore, is that going to go anywhere? Like, who could say? Maybe in an alternate reality, pets.com was the winner and Amazon got relegated to the garage door. But yeah, so I'm not feeling like I'm going to miss out on anything. If there's a company that does well, this trend will follow an up and down course. And maybe it's after you have a big hype cycle and then you have a big bleed out where a whole bunch of companies end up, stopping doing business. Those companies that survive, they may well be the way to win. It's worked in other places.
Exactly. And you just never know what's going to happen either. I think there was a patent office head in the late 1800s that said everything that possibly could be invented has been invented. Well, we all know that. We don't know that didn't age well, to say the least. So, I mean, it's always possible they can find some application to quantum computing that will lead to massive societal change and massive stock returns. But I think you have to wait for that to actually happen before trying to capitalize on it.
Tim Jungles, I apologize. Tim, 13 minutes ago. And Tim, I apologize. I took 2 years of German, so I see that name and I mispronounce it just based on German pronunciation. So I do apologize for that. If you watch certain networks, they try to talk people into selling Magnificent Seven stocks per the rotation. What say you? Tim, I mean, networks are trying to get you to do stuff. I mean, it may well be, you know, like, when did you watch? Because when you were watching, the commentator said, oh yeah, sell your Mag 7 stocks and buy this instead, right? Well, maybe when I was watching 2 hours later or a day later, I was watching somebody else and they were like, oh, stick with the Mag 7. They're going to go the distance. So you can't count on consistency from networks. To be fair, you can't necessarily count on consistency here either, but bearing in mind, I mean, we see that as a value. I mean, I'm me and I have my views. Will is Will and he has his views. Other commentators, they have their views. We don't necessarily agree. That is why we are Motley. But together, hopefully we learn from each other and we try to figure this stuff out. So I think the case for selling Magnificent 7 stocks in a rotation is if you think that the valuations of these Magnificent 7 stocks have gotten ahead of themselves, and if you think that the valuations of other stocks that have been kind of neglected along the way now look attractive on a relative basis, then moving some of positions that you may have in Magnificent 7 stocks into other stocks may be prudent. It may be prudent for a number of reasons. If you have highly concentrated positions in Mag 7 stocks, then maybe you've gone above your acceptable risk tolerance level. And it's just a matter not of selling out of them, but just of trimming them. And so as a result, you know, somebody says trim it, that's a different argument for me than, oh yeah, dump them all and move everything into something else.
Yeah, personally, I'm not really a fan of the classifications like Magnificent 7, because these are 7 individual stocks, and they could possibly go 7 different directions. I mean, you know, when I first started the Fool more than 5 years ago, the trend was the FANG stocks, which was Facebook, Amazon, Apple, Netflix, and Google. Well, Netflix, had some problems a couple of years later. They got kicked out, and 4 of those stocks were incorporated into the Magnificent 7. So these seem to be like kind of catchphrases. They sort of make the lives of people like myself and Dan easier because we have an easy way to classify top stocks. But at the same time, these are 7 different companies, so anything can happen with them, and they're not necessarily going to follow the same path over time.
Yeah, and I mean, think about that, right? When did people start saying, oh, FANG stocks, let's not do anything about that? It's probably when Netflix went from, where to go from $600 a share, close to 700 in late 2021, all the way down to below $200 a share in 2022. And then everybody's saying, oh, there's a rotation. Go ahead and sell your Netflix. Okay, what's happened to Netflix since then? 5-bagger. We've gone from 187 to, it's at 960 as of Friday. I can't remember if it managed to poke above. I think it did manage to poke above $1,000 a share at one point recently. So yeah, I mean, that's one thing that we pay attention to, Tim. It's just the benefit of the long-term investing philosophy is that you don't have to get yourself wrapped up in this stuff. I mean, financial networks, they got to do a show every day. They got to talk about something. And the professionals that they have on there usually have a book of business that they're trying to run for themselves. And a lot of them just talk their book. It's a promotional thing. It's a professional thing. And so understanding that, as long as you understand the incentive for why they're doing it, you can still get value out of it. But you just have to keep in mind that maybe their interests aren't aligned with your interests. And so if your interest says, I'm going to be a long-term investor and I have conviction in these companies, doesn't really matter if they're part of the Mag 7 or if they're small cap or whatever it is, until you see something happen with the business that changes your investing thesis for why you decided to buy that stock. The rest of it is probably noise. And you can just kind of sit back and say, yeah, all these guys are scurrying around like ants on a dropped candy bar or something. But I can just sit back and enjoy the long-term growth in this business that has done well and that I hope will continue to do well.
Yes. So about 11 minutes ago, Michael Pittman asked, do dividend index funds, ETFs, or mutual funds actually pay dividends? Well, the short answer is yes. They'll sometimes be called distributions, but that is essentially what a dividend is. I'd have to. It's been a while since I've actually looked at the space closely. I can't remember what the difference is between a dividend and a distribution per se, but yeah, they actually do throw off cash to their investors. So if you're looking for income, that can be one way to go.
That's it. Well, that's it. Come on, 30-second answer. Oh, that's great. You're good. You're so good. I tend to be too long-winded when this sort of stuff happens. The thing to pay attention to with any fund is making sure that if you get a tax return at the end, take a look and double check and make sure that the distributions turn out to be the way that they expect it to be. Because sometimes, doesn't happen all the time, but sometimes what you might get from a fund, from an income-oriented fund, won't turn out to be all dividend income. Sometimes it may be a return of capital. Sometimes there may be embedded capital gains in there. Not so much with ETFs, but with mutual funds, sometimes this happens.
That's a good
Not
point.
so much with index funds either, I have to say.
Yeah.
More commonly with actively managed funds. But, technically speaking, what you get from a fund is a distribution, and that distribution may be entirely dividends. But the thing that most funds have in common is that they pass through the character of whatever income that they get. They pass that through to you, and you're the one, if you're investing in a taxable account, you're the one responsible for paying the taxes on that. And so, yeah, if it turns out that a fund is actually earning stuff that is not technically dividend income, that'll get reported to you generally at tax time, rather than at other times.
Yeah, I think that put a lot of people off the mutual funds. Years and years ago, people talked a lot more about them. You don't really hear that much about them today, even though they're very much still around. So I think that's one disadvantage that kind of pushed more people towards index funds and ETFs and such.
Yeah. There was a question from a while ago that I was going to get, and now I can't find it.
Oh, I could take this one while
take one. Yeah, it's good. Thank you.
Okay, but about 7 days ago, Paul asked, what is your take on SoFi? Well, for those of you who don't know SoFi Technologies, SOFI, it's an online digital bank. It started out as a student loan provider, but it's kind of evolved from that. Since then, they bought a bank, so that made them kind of a fintech with a bank charter, which is kind of unusual, but it's kind of important because at least in the United States, fintechs by themselves are not allowed to make loans. They have to partner with a bank in order to make loans. So one way around that is to buy a bank, like SoFi did, and they can kind of be both. And SoFi acquired a lot of interesting platforms like Galileo and Technisys. I was in this. I think I bought it below 5 originally, but I kind of got frustrated with the stock, and I sold it. It's I don't really know what to make of it, to be honest with you, because it is a fast growth stock, but it doesn't seem to get a lot of respect for whatever reason. Its PE ratio is only, I think, 27 right now. But I don't have the growth numbers in front of me per se, but let's see how it did on the.
It's a funny stock. It goes all over the place. I'll tell you. I mean, it's I think some of that is its SPAC roots.
Yeah,
it was one of those popular. SPACs from in the IPO. It was IPOE and the IPO X series basically, and I think that because of that, it still gets sort of this SPAC investor following, even though with the attendant volatility, even though it has very much transformed into a real and substantial business.
Yeah, most SPACs that ultimately ended up not working out, but SoFi is one of the few that just does seem to be a legitimate contender, for lack of a better way to put it. So yeah, I like the performance. Looking at it grew. It's going to grow revenue by 22% this year, or that's the forecast anyway. profits are expected to nearly double. And considering that a 27 PE ratio is pretty cheap, but for whatever reason, it just doesn't seem to take off. And I guess I lost patience with it and unloaded it. We'll see if that we'll see if that turns out to be the wrong decision over time. But
no, I'll tell you. I mean, the person to talk to about SoFi is Matt Frankel, and so next time Matt's on, I would suggest Paul go ahead and ask that question again. He's really bullish on SoFi. I've talked with him. I've had occasion in the past to work with him on it. I tend to be a little bit less bullish about it just because I tend to focus on their customer acquisition costs, which in my opinion are kind of ridiculously high. I appreciate that as a consumer. I tend to get the rewards of that. I am a SoFi customer, but I don't think that they're making enough money off me compared to what I'm pulling down in rewards and bounties and things like that. So, I assume that the bank is getting more stuff from other customers. And so, they have made big strides towards profitability. They have seen substantial revenue growth. They've seen their name plastered all over the place on stadiums and things like that. And so, we'll see. I mean, it's past some of those first hurdles, but in the end, I wonder if they're just going to be like, is their aspiration to become a big bank? Because last I saw, most big banks, market didn't seem to appreciate that business very much. You can get, high quality, too big to fail Wall Street banks, with PEs in the teens easily, low teens in some cases. And so, I'm not sure that's necessarily what you want to aspire to. But as Will pointed out, some of that underlying technology, everybody's trying to be a technology company now. Why? Because technology stocks get higher valuations, get higher multiples. But long term, I'm not sure whether they can make more money off the technology or whether they end up just looking like their core business. So we'll see.
It's not really clear what the competitive advantage is going to be long term, because there's just so many banks out there, and all of them are adopting technology. And SoFi's technology is a little bit more fascinating than the average bank, but I'm not sure if that's going to be enough or not to really make it perform long term.
I mean, it's an app and it's easy to use, but somebody else can make an app and it'll be easy to use. And it's financial services is tough to have a competitive advantage, because at the end of the day, what you're doing is you're moving money. You're either getting money in or you're putting money out. I mean, it's very simple. So what you build on top of that is what determines how much money that you make. But, we'll see.
Yeah.
It's a tough one. Cena NYC from about a week ago asked, what are your thoughts on using a framework of target annualized long-term returns for a portfolio and picking a number of positions in it to determine a position size range per position? So kind of complex question. I'm going to try to translate it, and seeing if I get it wrong, then I know you'll let me know. But I think what we're trying to get here is that when you put together a portfolio, when you're doing some long-range financial planning and you're trying to figure out how to get from A to B, where B is a long way away and may require a decent, a pretty substantial return. A lot of the challenge is, how do you measure your progress along the way? Because markets will do their thing. I mean, if you start investing at the end of 2021 and then you have a bear market in 2022, odds are you lost money. Does that mean you're a failure? No, because the market went down. And even if you outperform the market, you still may have gone down. And so are you a failure? No. And by some measures, you're a success. But did you make progress towards reaching your long-term financial goals? Probably not. I mean, you're probably sitting there hitting yourself on the head saying, oh, I should have skipped that year. I should have just, gone and had fun. And then come at the beginning of 2023, and then everything would have been great. And yes, the problem is you don't know when 2022 is going to be. And so, the best time to start investing is now, because you don't know what's coming, and now might be right before the next big move upward. What I think Cena's trying to do here, though, is to try to target long-term returns on an annualized basis, and then figure out how big to invest in what types of positions in order to try to get a certain return. And here's part of what you're trying to do with that. If you there's parts of financial planning, there's simple math. And so if you know that you have a number, $10,000 in savings right now, if you know you're going to be able to add a number, $500 a month to your savings each month indefinitely into the future. And if you know that you expect to do that for 30 years before you want to retire, then you can do the math and make assumptions about what the market's going to do and make assumptions about what your future financial needs are going to be and come up with a target for how much you want to make each year in the stock market on average. And based on that number, you can figure out what kind of investment strategy that you want. If the number is relatively low, then you can have a more cautiously positioned portfolio, maybe with a little bit less in stocks. Among the stocks, maybe a little bit less in the high growth, high speculation stocks, maybe a little bit more in dividend type stocks, value type stocks, maybe something in bond investments, fixed income, maybe something in real estate investment trust, that kind of thing, and a decent cash allocation as well. On the other hand, if your financial goals are ambitious and you're going to need to have a above average, historically an above average market return in order to achieve them, then maybe it makes sense to look at your portfolio and say, yes, I need to be more aggressive. I need to buy stocks that are perhaps more speculative in nature, where the odds of loss in any one position are much higher than with more cautious stocks, but where the ones that work out are going to work out a whole lot better and produce the kind of multi-bagger growth that you're going to need in order to reach those ambitious targets. And so my thought on that is, yes, that does make sense, but bearing in mind that there are elements to your risk tolerance that aren't as simple as just flipping the switch. It may well be rationally that you come to a decision of, boy, if I'm going to save what I have to save, and if I have a particular financial goal in the future that I want to achieve, I'm going to have to get 2 percentage points above what the market has historically returned. You're going to need 2% outperformance every year. And so I'm going to invest in a bunch of highly aggressive, highly speculative stocks, understanding that they may go down in value significantly during unfavorable markets. Well, then the unfavorable market happens and you're down whatever you're down. Maybe the market's down 10%, but you're down 20 or 25%. It's often only then that you get a hint of, well, gee, maybe I didn't actually have that risk tolerance. And so maybe the mix of stocks that I bought based on that mathematical exercise, maybe I shouldn't have done that. Maybe I should have done something that took more into account my behavior and my risk tolerance. So if you're going to use a framework like this, from an analytical standpoint, I think it's a valuable exercise to do. But then I think when you come out with what the recommendation would be based on that, I think then you have to sort of give yourself a gut check and say, okay, well, what does that entail? Well, what it means is that it may be that I suffer a much larger loss in a downturn than I would in just an index fund. How do I feel about that? Maybe I don't feel so good about that. Maybe I'm going to panic in that situation. If I panic, then I've blown the whole strategy. And so the strategy was flawed from the beginning. Much better avoid the panic, adopt a strategy that maybe analytically is second best, but it's one that'll get you close to your goal without sabotaging your whole plan. Will, have you done stuff like this? I mean, how do you handle your own portfolio? Do you just invest in what you like and it'll take you wherever it takes you? Or do you specifically target more cautious stocks, more dividend paying stocks or higher growth stocks? Or how do you figure out what balance you end up having in your portfolio?
Well, to be perfectly honest, I'm catching up from a bad few years. I've taken a little bit more risk than I might otherwise have taken, but I typically like to find the top stocks in their fields that are down for whatever reason. So that's going to go into my next question in a minute. But I first wanted to comment on the idea of targeting annualized long-term returns. Yeah, that's hard because you buy your stocks or you buy your index funds, and they're going to do what they're going to do at the end of the day. So just looking at the S&P 500, which is 500 companies, I believe the long-term returns on that going back almost 100 years, I think is about 10% or 11% or something like that. But you just look at the S&P 500 by year. So far this year, it's down almost 4%. But it was up 23% last year, up 24% in 2023, down 19% in 22, and then up 27% in 2021. So it's just all over the place, really. So you always have to be prepared to deal with the volatility. I don't think you can really, you count on a specific amount of returns. I think you just have to, make the best decisions you can, and I guess you have to rely a little bit on hope, which I know is a horrible strategy, but you can't predict the future, and again, what's going to happen is what's going to happen, and you have to prepare to deal with it. But I think if you do your due diligence and pick the right stocks, I think you'll make more good decisions than bad decisions, and no matter how things go. So I wanted to take this question. Excuse me. I wanted to take this question from Besties about 9 minutes ago. What stocks are you following and think are a great opportunity as this correction unfolds? Because of this correction, I have been doing a little bit more buying. I had been building up cash for most of last year. Because I was basically copying, Warren Buffett and Berkshire's strategy, for lack of a better way to put it. The fact that they're up to, I think, $334 billion in cash, it says to me, one can build up cash for many reasons, but when you built up that much cash, it says to me that you don't like what's out there at the current valuations and are waiting for better deals. I personally think that's what they're doing. I guess we'll get more insight on it in a couple of months when they release their next 13F report on showing what they bought and what they sold. But yeah, I was accumulating cash. I've been putting more money to work lately. I actually this week I bought some of the trade desk because the stock is down 60% from its high less than 4 months ago. It made a huge unforced error, by missing its own revenue number, and it was highly valued, so the market hammered it. I think it went a little bit too far, though. Trade Desk is still a leader among advertising platforms. I think that's going to continue. I think it's still going to be a rapid growth stock. So I did take a position in that. I also bought Uber more or less for the same reason, just because Uber was a little bit more valuation oriented, but Uber had fallen to a very low valuation. It's still a leader in rideshare. I think it's going to be a major player in autonomous. And honestly, with that one, I wanted to play Waymo, which is owned by Google parent Alphabet. But Waymo is such a small part of that huge company that it doesn't show up in the financials. I think that's actually I think a company like Uber may be a better way to play Waymo, even though it's more of an indirect way. Also, this was a little bit more risky, but I took a position in Celsius also. For those of you who don't know Celsius, it's the third most popular energy drink in the company, or the country, I should say, right now. It's more health, nature oriented than the others. So I think it's a leader in that particular niche of the energy drink market. The stock had fallen 75%, and the PE I think was in the high 20s when I bought it, which it had been probably overvalued when it got up to 100. I bought it, I think, in the high 20s. So between 70 and 75% off. I also added to my position in AMD. AMD has lost, I think, about 60% of its value in about 13 months. I think that's being overly punished because their gaming segment is suffering, but gaming has fallen to less than 10% of that stock, whereas data centers, which is the AI accelerators, is now about half the stock, and that's still growing very rapidly, as is their sales on PC chips. So yeah, those are some of the opportunities I found lately personally. I'm sure there are a lot of others that I missed because there's thousands of stocks out there, but that's what I saw.
Yeah, I mean, my view tends to be that a lot of, I mean, if you've got a wish list of stocks, if you got stocks that you're watching, a lot of people are always sort of like, oh, yeah, that stock's too expensive. I'm not going to buy that stock. I'm going to wait for a pullback. Well, here it is. Like, here's your pullback, which didn't say like every stock did pull back. I mean, some, have continued to move higher, but a lot of those high flyer stocks, they move down. Now, oftentimes what that turns into, that feeling of, oh, yeah, if I get a pullback, I'll buy it. Then the pullback happens, and then suddenly people change the rules, and they say, yeah, if that pulls back 20% instead of 10% like we've seen, then I'll buy it. Because the only thing worse than buying at the absolute high is buying too early right before the stock goes down. And I get that. I mean, that is an existing thing. But you got to do the math. I mean, you got to look at the numbers. If you refuse to buy the stock because it was too high and then it drops, and then you're not going to buy the stock at this point, then the question is, do you really have the conviction in the stock? And the answer is probably no, because if you had the conviction, then you wouldn't keep making excuses for not buying it, which is fine, because there's nothing that says that you have to invest in any one given stock, and that even that you need to have a good reason not to. It's just that you have to recognize that about yourself and understand that, yeah, when a high conviction stock comes along, maybe you're not going to pay as much attention to valuation. Maybe you're not going to be quite as concerned about, are you paying $80 a share or 85 or 75 or whatever it is. The thing that if you are concerned about that sort of thing, the suggestion I usually make is inch in, take a position, but decide up front that you're going to enter that position in a certain number of times. So instead of investing $10,000 in a stock, invest $2,000 in the stock, and then you've got 8 left. Commit that 8 to the stock and decide up front, okay, I'm going to make my next $2,000 purchase like a month from now, or 6 weeks from now, or 2 weeks from now. And then see what happens. Like sometimes that'll have been a really smart move, and stock will go down after your first purchase, and then you get a chance to buy some new shares at a lower price. That's great. Sometimes the stock just kind of goes up, and then you realize, oh, I would have been better off if I'd put the whole thing in, but I didn't have the guts to put the whole thing in. So at least I put some of it in and got the full rise. And then eventually you get the whole thing in, and then you hope that your long-term conviction remains the same. So that's kind of where I fall on these kinds of questions when it just comes to capitalizing on a correction, or when an individual stock has a big hit because they missed earnings by 2 cents or something, and everybody panics, and it's sort of like, it's 2 cents, people. I still think this company is going to do fine. Let's see. Ed, 15 minutes ago, asked, is there any hope for home builders with high interest rates, high labor costs, high materials costs, tariffs, inflation, recession, layoffs? What else could go wrong? Ed, I'm not going to answer that question. It was a rhetorical question. But what I will say is that there's a whole lot of macroeconomic factors that are working against home builders right now. And what you see generally in the home builder industry is that these things are cyclical, and the cycles don't last forever. They can last longer. The downward part of the cycle can last longer than you want it to, but it doesn't last forever. When things turn, they often turn for the better, and they turn quite quickly. One thing I will say, home builders, I think, have the structural benefit of, we are in a situation where available housing stock is at a premium. There's not very much of it. Anybody who's gone house hunting lately will attest to that fact. And so home builders have some advantage in being able to capture demand, just because the existing home market isn't capturing that demand. And so in a lot of markets, especially hot markets, new home construction is the only place to look. On the flip side of that is all this uncertainty that you're seeing, along with the fact that, especially that with interest rates where they have been at high levels, a lot of home builders have had to resort to what you see in the auto industry for decades, where you'll have a home builder, in order to sell a house out of inventory, will offer financing that is more attractive than what you could get at a bank. And that's fine. All it does really is effectively lower the purchasing price, because, you know, these companies, either they retain the financing in-house, or they sell it off and, you know, take whatever. If they only get 5% in a market where a mortgage should normally be 6%, then, you know, they get 98 cents on the dollar or whatever it is. They take the hit up front, and then it's done, and it all falls down through profit. But, you know, Ed, I mean, it's tough because, yeah, there's no guarantee that we're going to see interest rates drop. We had the Federal Reserve this past week, kind of lukewarm on when rate cuts are coming, how many there'll be, how long they'll last, and a whole bunch of other stuff that's hard to predict going on right now. But, you know, is there hope? In the long term, I do think that there's hope, because in the long term, I do think demand for housing outpaces supply. The question is, how do you get there, and how do you navigate all this macroeconomic stuff along the way? And it's tough. But again, if you have the conviction, then, you know, inching your way in and trying to take the average, you know, get an average price, I think it works out in the long run.
Yeah, I don't follow the home builder segment as closely as Dan does, but yeah, I found that everything finds its way to equilibrium eventually. I agree with Dan. I think the overriding factor, aside from the high interest rates, labor, tariffs, inflation, etc., is just that demand exceeds supply, and things always have to find their equilibrium eventually. That's not this. I think it's going to be a long time before we have equilibrium in the housing market, just because it's been through so much just in this century. We had in the 2000s, we had a lot of home building amid the low interest rates, and that all came crashing down in 2008. So as a result, there were very few homes built for a long time, and that went on too long. So, with all that's happened, now we have a shortage, and so it's got to find equilibrium again. So I think we're on that long journey back. I do think that the high rates, the high labor, material costs, etc., may slow that down some. But I think the overriding trend is going to be back toward equilibrium.
Hey, you wanted to grab, or should I keep going?
If you have one, go ahead and take it.
I'll take Besties from 17 minutes ago on Accenture, ticker ACN, and Kyndryl Holdings, ticker KD. What are your expectations? Bestie says, consultants will never taste the fruits of their labor. What do you think of this misalignment when investing in Accenture and Kyndryl? So, Besties, I understand that sentiment. I think that the trade-off for consulting companies is that they get business. Their business is reliable. It is predictable. If they do a good job, they get recurring revenue from their loyal clients because they keep delivering value. And they aren't necessarily, they're able sometimes to generate value even when the underlying business of their clients, obviously they have to demonstrate enough value to keep that client business going, but it may well be, the question always ends up, okay, well, how does the benefit of what the consultant is suggesting, how does that benefit get allocated? Is the client the big winner? Is the consultant the big winner? Is it a 50-50 split? How does it work? Sometimes that professional relationship collaboration is well-defined. Probably the best well-defined is in the plaintiff's attorney situation, where a lot of plaintiff's attorneys who take work on a contingency basis, it's like, hey, if I win, I'm taking a third of whatever we win. And if I don't win, then I'm not taking anything, and we'll see how it goes. And there, the incentives are very clear. And Besties, it sounds to me like maybe you would say that they are aligned in that sense, because the success of the plaintiff's attorney relies on the success of the client and vice versa. Not so much the case for an Accenture or a Kyndryl, but I do think that, one benefit that you get is a lot of time when you are doing work for when you're doing work in-house in trying to build efficiencies, you're doing everything from scratch, you're doing everything for the first time, and there is a learning curve that you have to climb, and oftentimes the cost of that learning curve can be high and eat into the benefits of doing whatever it is that you were doing. What Accenture and Kyndryl get to do is if they have 1,000 clients who have the same need, then they invent the wheel once and then they sell the wheel 999 times. And the question becomes, at what price do they get to sell that wheel? And the answer often is somewhere in between. So that, yes, if it took them 100 hours to come up with the solution the first time that they did it, maybe they can't charge 100 hours a time to client A. But if it took 30 minutes for them to do it for client B, I promise you they're not just charging 30 minutes. They are amortizing with the initial 100-hour investment and making sure at least that they recoup that investment that they made up front. And that makes client B a much more profitable client. And so on and so forth. That's the purpose for both of these companies specializing in the technology area, is that the innovations that work for one company often work for every company. And so it's just a matter of fine-tuning a process that's already well established. And once you have that proprietary process that's well established, it is easy to scale that up and to scale it up very profitably. And so it doesn't bother me necessarily that, you don't have consultants that are essentially on a contingency basis to reap the benefits of what they get. That doesn't necessarily bug me. As long as they have the expertise to maintain loyal customer relationships, as long as they can continue to add value, then I think it works for everybody. And if you try to align those things too closely, then you run the risk of those consulting firms seeming like they're too greedy and actually pushing their clients away. That, I think, is probably the last thing that you want.
Okay, so we have about 3 minutes left. I'm going to get to this question from Danny 6 days ago. For retirees, any thoughts for best income generation stocks now? And that's a good question, because a lot of retirees want to turn to dividend stocks to earn income. It can be a good strategy for some investors. I do think you need to be engaged in these stocks, just because things can change very rapidly. I also think you need to have some knowledge, at least some basic knowledge of financial statements, because the thing with dividend stocks is dividends can be taken away at any time, with the exception of real estate investment trusts. So to me, the dividend stock should be paying significantly above average. The average for the S&P right now is 1.3%. I look for stocks that pay at least twice that. Now, I don't go for the highest dividend payers, because the higher the payout, the dividend yield, the more likely it is it's not sustainable. So that's where you need some of this knowledge to be able to look at cash flows and see if they have the cash flow to keep paying that. I also look for dividend streaks where the stocks that increase dividends annually at least once, because again, a company can take away a dividend at any time, but if a company pays a dividend or I should say, if they increase the dividend for 30 straight years and then stop, that's usually somewhat of a reputational hit to the stock, at least in terms of its finances. So I look for those things. What I do like right now is Realty Income, symbol O. They specialize in single tenant properties for commercial purposes. They own more than 15,500 properties that are about 99% leased. So I think it's a very stable business. The dividend yield right now is a little bit above 5.5%. And yes, they can pay it. They've suffered in the higher interest rate environment, I think, and that's put pressure on the stock. But they've grown their property base and actually made a major acquisition, despite that. So that's what I'm looking at. if you're more tech oriented, IBM could be good. It doesn't pay quite what it used to, but they've increased their dividend for 29 straight years. Even with the big rise in the stock lately, it still pays about 2.75%, which is about double the S&P average. Chevron, Exxon probably also fit in that same category. So those are two I might look at. But yeah, this can be lucrative. But again, you really want to do your due diligence and be able to follow it at least periodically to make sure those dividends are sustainable. And with that, it looks like our time is up.
That's right. We are at the top of the hour, Fool. So for Will Healy, I'm Dan Caplinger. Thank you so much for joining us for our Ask Us Anything segment. And do stay tuned. We have Rachel and Asit are coming back. Rachel Warren, Asit Sharma coming in for taking the baton and here to answer your questions. Folks, good to see you.
Good to see you guys. Nice hour.
Thank you.
Well, hey, Asit.
Hello, Rachel. How's it going?
Doing all right. How are you?
Good. Coming along. Had a very nice evening yesterday with some friends. And today it was just a lovely spring morning here in North Carolina. So nice. I'm getting into the gear of spring. Of course, I have a fall shirt on because what better way to welcome the vernal equinox than with a flannel shirt? But that's
very spring-like. It's very spring-like fashion there. I appreciate it.
How are things on your end?
Good. Well, let's see. What time is it? I always get mixed up because I have my computer on U.S. time and then my phone is on the time zone I'm in. So it's 8 p.m. in Italy where I am. It was kind of a cool, rainy-ish day. Just a chill spring day here.
Nice. One of my sons recently read a book by a philosopher who took up running in Rome. And it looked very interesting, but there's so many books, so little time. So it's going to stay on the bookshelf. But every time we are on together, I think I want to read that book. And just the thought of a philosopher running through old streets in Rome is enough for me. Maybe if I don't even get to it, I like that image.
Sounds like a good book.
Yeah,
I like the image too.
I'll find you the title and shoot it to you on Slack. Okay, so we have 58 minutes together, and I think our theme is Ask Us Nothing. Just kidding, folks.
Do not put your questions in the Slido.
That's right. Ask us something.
We have nothing for you.
Well, let's get started from a question that Matt has addressed to both or either of us for a company that I haven't paid much attention to in many years, which is the Cheesecake Factory. But I'm going to take this at face value and give some thoughts. Matt asks, Asit, Rachel, do you think that 15 times earnings is too much to pay for the Cheesecake Factory, CAKE? Cheesecake Factory is a franchise operator. And so I have to tell a quick story here. I'm nearsighted, and I see, Rachel, you're a responsible person. You wear glasses. And
I do when I must, yes.
Okay, so
not always.
Same. In fact, never for me. In my 30s, I found out I was nearsighted, but I have perfect vision for where my computer sits. And the world is actually pretty in focus for me. Maybe as I go further out, it gets a little blurrier. And I remember one day I was in Florida and had dinner with my sister and my dad and mom. And my sister and I are 11 months apart. And we were inside a Cheesecake Factory. You know how you clown around with siblings? So I pulled her glasses off and put them on, just clowning around. And I stopped and I said, "Oh my gosh, this place is gorgeous." Like several people at the table looked at me like, what is this guy going on about? It is nice, but it's the Cheesecake Factory. You're in a mall. What's up with that? And I realized that I should have been wearing my glasses because my vision had deteriorated more than I thought. But weirdly enough, it self-corrected a little bit, not perfectly. Having said that, this is an operator that is interesting to me because it had a rapid expansion, like a few decades ago. So I'll start with this question. I don't know if you've followed this in a while, and then I'm going to pull up a few things while you're talking to check in. But 15 times forward earnings sight unseen for a good franchise operator that has sort of a mathematical business model, which is slow expansion, maybe some pricing power. If you're Cheesecake Factory, it's like activating frequency in your comparative sales. So making sure that people who love the product are coming in as often as they can. I would think that growth must be pretty slow to be trading at 15 times forward earnings if it's a forward number. And I know from other questions that Matt can be value oriented and looks for some value plays. So I'm going to stop here to see if you've checked in with it more recently, what your thoughts are. And then I'm going to give a slightly deeper cut of analysis. I'll look at this right as you're talking.
Yeah. So, I mean, talking about just the business itself, right? So they are known obviously for their network of Cheesecake Factory restaurants, but there are other restaurant chains that are owned by the Cheesecake Factory brand. Yeah, these include North Italia, Flower Child. Those are two of their, major brands that they own as well. And the thing that's interesting about this business is their core is revenue generated from customer dining at their restaurants, which is this wide menu of savory and sweet items. Obviously, they've got their bakery section. They're known for their cheesecakes. They have their bakery division that produces cheesecake and other baked goods for their restaurants, but then also sells them to third-party customers, to international licensees. And so they've tried to really position themselves as a leader in experiential dining. And while they're known primarily for their kind of extensive footprint in the US, they do have an international presence through licensing agreements that allow other companies to operate Cheesecake Factory restaurants under their brand. For example, I think there's a Cheesecake Factory in Dubai. I have to check on that, but I'm pretty sure.
Sounds about right. Yeah.
That sounds about right. I'm going there soon. And so I was researching this clearly. Okay. But in terms of how the actual business has been doing, and as that feeds into valuation, something that we've seen statements from other restaurant brands recently, like Darden Restaurants, which owns, Longhorn Steakhouse and some of these other types of Olive Garden is another one that they own, as well as from Brinker International, that are indicating numbers that are like, look, customers are cautious with their wallet spend right now, but they are still going out to eat. They're still prioritizing going out to eat. And there's that similar type of price category that you see reflected in a business like Cheesecake Factory. In their most recent fiscal year, they had pretty slim in terms of year-over-year revenue growth. It was roughly flat from the prior year, but at about $3.6 billion. Net income was up notably, though, from about $101 million a year ago to about $157 million in the most recent fiscal year. It's an interesting business. One of the questions we had gotten about the company more recently was asking about them as a dividend business. And I said, and I think this might have been yesterday actually, that this was a company that might be interesting as a restaurant stock play, but maybe not so much for me personally as a dividend investor. They have paid a dividend most of the time since 2012. Like a lot of companies, they suspended their dividend in 2020. They reinstated it in 2022. That dividend growth, however, has been incredibly moderate, to say the least. While their dividend is up from a decade ago, it's still below 2018, 2019 levels. So that's one element I would consider as well. I think there are higher growth, restaurant operations to consider, but it is a solid business. And there's nothing I fundamentally dislike about it. I think I'm just more intrigued by some of these other restaurant brands.
Yeah, Rachel. So just skimming and listening to you while you were talking, I'm going to index on the word solid. So looking at this, I don't ever like to say this is not a business that I'm interested in. I'm interested in every business on some level, even businesses that I might not invest in today. Teach me something about the industries that they operate in, and they could be businesses that are very attractive to me tomorrow because of pricing or a change in that business. But I think solid, it's a great word to describe this. What stands out to me is the lack of operating margin for a company that is a franchise business. So I haven't delved into the 10K, and I was about to do some Control F searching But I will say on the surface, and we were talking about
I have
this
a few
yesterday.
more thoughts I can add too,
Yeah,
if you need some time to look through.
Not at all. Sanmeet and I were talking about this yesterday. The difficulty of getting an answer from, let's say, a large language model or one of us here on Fool24 versus going to a 10K annual report and maybe control Fing. So searching with the control F function for supply chain. We're trying to determine, because neither of us could remember, it had been a long while since I looked at Trex, the decking company. And a viewer wanted to know about the supply chain. Are they vulnerable to tariffs? So their supply chain is almost entirely North American. And I was just extolling the virtues of that. You can get to some key things that you want pretty quickly. But before I go any further, just to finish the thought, looking through just their income statement, they have a really low, unexpectedly low restaurant level margin. I don't see that they present it, but just looking at the line items from their consolidated statements of income, it looks like food and beverage and labor take up, like 56% of every revenue dollar. So that's not just a revenue dollar for sales. It could be, and again, this is something that I would control F if I had more time, but perhaps the way they're setting up, they have some sales to franchisees, I would guess, in their supply chain. Maybe they have a bit of a Dunkin' model, you may know that, in which they're getting some revenue selling materials to franchisees. So the ones that they do operate, it's surprising because I would think there would be more pricing power in that model. So the net result of that, not having the margin at the restaurant level and not having enough of a licensing boost to contribute margin to the bottom line, is sort of telling. They have operating margins of around 6%. So between those two numbers, looking out at sort of what analysts estimate they will do in revenue the next few years, and maybe a hampered ability to grow profit margin, not knowing the business better. Now that market assessment, like that quick market trading multiple that Matt mentions, makes a little more sense. So, and of course, there's going to be a lot about this business. It'll be fun. Maybe next week. I'm almost enticed to spend some time with it this week. Matt, come back. Go ahead, Rachel. What are your thoughts?
There's a couple. Yeah, there's a couple things I found as well while you were talking about this. So worth noting. So they are not actually primarily a franchise operator, and that was something I wasn't clear on until
You misled us, Matt. Come on. He'll be okay with that. I know he won't mind me saying that.
So it's kind of a mixed model. So they primarily operate their restaurants in the US and Canada as company owned and operated, not through franchising. And then they expand internationally through license agreements. So as far as I could tell from what I was reading, they don't franchise or joint venture in the US or Canada, which again is where their primary, at this point, concentration is. All of these are company owned and operated. Then their licensing agreements are how they expand internationally. And then the Cheesecake Factory has licensing agreements in place for restaurants in the Middle East, Latin America, Asia. These include ones in the UAE, Kuwait, Saudi Arabia, Bahrain, Mexico, Hong Kong, just to give some examples. And based on what I've seen from some recent news, they don't have plans to franchise or joint venture domestically. That's something that obviously could change in the future, but as of now, the other thing I would note as well is if you're looking at their financials, you'll see that they report, under Cheesecake Factory, and then they talk about their Flower Child brand and North Italia, and then FRC. So FRC is short for Fox Restaurant Concepts. That is a company that they acquired in 2019. That's a company that's known for a portfolio of restaurants, including Flower Child, which is one, as well as brands like Burger Bars and Burger Wine. And when they acquired Fox Restaurant Concepts in 2019, that also included the remaining interest in North Italia. FRC operates 45 restaurants in 7 states and DC. They're experience focused. And it's been said that Cheesecake Factory plans to really lean into these Fox created concepts for a significant portion of its development in the future. Now, it's worth noting that Cheesecake Factory also in Q4 of 2024, opened 9 new restaurants. This included 2 FRC restaurants, 3 North Italia locations, 2 Flower Child locations, and then they relocated a couple Cheesecake Factory restaurants. In the next fiscal year, so the one we're in, 2025, they're planning to open 25 new restaurants. That would be 3 to 4 of those would be Cheesecake Factory, 6 to 7 North Italia, which is a bit of a higher end price point as well. It's a bit of a cut above, I would say. And then 6 to 7 Flower Child locations and as many as 8 to 9 FRC restaurants. So really well diversified among those different brands.
Got it. Okay, great. So Matt, here's what I would do next. Listening to Rachel as she was laying out sort of the near term with restaurant expansion. Yeah, I would probably next just sort of figure out the contribution of like legacy stores versus the new concepts and try to figure out or back into some margin that they would contribute and just estimate what cash flows might look like in a few years to really get to the nugget of your question, seeing how this is more of a direct operator than a franchise concept. But yeah, brands that we're familiar with that stick around and have staying power, they're always fun to study because there are times when it becomes very attractive to buy them. And you mentioned Darden Restaurants, which has, a great portfolio of restaurants that the top of it isn't high end, but higher end all the way down to more casual places. I've always admired sort of how they built their composition of revenue between a mix of concepts. So maybe this is somewhat like this, but thanks a lot for that, Rachel. That was great filling in some of the details and walking us through that. And we'll keep moving with the questions, but I've made a mental bookmark to spend some more time with cake because I love to eat cake and studying cake sounds like the next best thing. So I'm going to tackle one and then ask you, Rachel, to choose the next one. Maybe we can just trade off from there. Ed says, Asit being a contributor to Stock Advisor, do you and the team at times struggle coming up with a recommendation for the month? If yes, what are the reasons? And yeah, I think the answer to that is, of course we do. And it's not for lack of ideas, Ed, but there's so many factors that go into a recommendation. It can be very difficult to settle on a company. I can give you some of the reasons for this. One is that the IPO flow has really slowed, as everyone knows, ever since before the recession. So what we're doing is studying great businesses that are more known in this space. Not that we recommend companies straight out of an IPO. For example, companies that I sort of like, but maybe for valuation purposes, wouldn't be in our research queue are companies like Reddit, which have been public now for a few quarters. So we sort of get the rhythm. We've seen some of the initial assertions of management in their regulatory disclosures to investors in the S1 statement play out. And you have a chance to evaluate the business at a closer level. That used to be a really solid flow. And it's just slowed for various reasons in the US capital market. So then what you have are companies that everyone knows quite a bit about. The information is disseminated in the marketplace, and you're trying to find companies that will complement the current scorecard and make sense to buy now. And we get panned a lot of times on the rule breaker side of the scorecard because we have a bit more aggressive bent. Sometimes we'll take a higher valuation. We will take a swing at Wingstop to see that business go down 2 successive quarters after earnings. We still believe in that case for the long term. Having said this, other factors that make it difficult or why we would struggle with a recommendation is just working through like the risk scenarios and then advocating and arguing for different businesses, the merits of those businesses. And on our side of the scorecard, we have a wide team approach. Emily Flippin, Andy Cross, and myself make the final decision. So we have some structure where we have our analysts present research reports, we have group discussions, and then Andy and Emily and I will close those discussions out. And sometimes we'll, get into the thick of trying to figure out the last 2 candidates, this versus this, what makes sense now, which is the stronger business, which fits our sort of 7 criteria the best, which has a rule breakery component. And that can be a struggle. The fun thing is there's never I wouldn't say there's really a struggle for ideas. It's just trying to figure out what makes a company sort of the best idea you could present in a month. If you have high ambitions, then it's harder. If you set the bar lower, which is like, then I think it's easy. It's like, let's just put something out. But the people on the team are really, really committed to trying to play something that we can look back at 5 years later and say, that was a good decision. It may not have made sense, and we may have caught some flack for it when we push this recommendation out. But in retrospect, our thesis played out. We were able to visualize what the risks would be. And all in all, this was a great business to recommend. And of course, lastly, you can't win them all. In any good diversified portfolio, some of your businesses are going to underperform vis-a-vis your expectations. So you have to consistently try to find the businesses that represent the best chances to do well, given their position in a sector and in the economy and against competition. So trying to bring a quality idea let's move out of Stock Advisor. For all of us, trying to bring a quality idea into our portfolio on a consistent basis is the struggle. And it's also like the really fun thing about this journey. I will end this mini speech with saying you can find great businesses and keep learning about them and adjust your positions as you go along. You can buy companies over a span of years as you see them perform, understand them better, have more faith in management. And that's why you'll see sometimes like a slew of re-recs in certain months. We just re-recommended ASML for the second time. So we have 3 recommendations on the scorecard, but we believe it's a really great buy at this time if you're looking out 5 years. And with that, we can move to the next question, and I'll also see what else is in the queue.
Sure. So there was a question that Besties had asked a day ago. Anyone have an opinion of BX, which is the ticker for Blackstone? It's been sliding for months. Why? What are the catalysts for Blackstone? So shares actually have been hit quite a bit in recent months, although it's still working. Worth noting, the stock is up about 15% over the last year. It still trades at a price to earnings ratio of about 41. I don't know if I would call that cheap, but not necessarily expensive either, especially in light of the roughly 180 billion market cap for this business. But for anyone that is not familiar with Blackstone, they are essentially the world's largest alternative asset manager. They have over $1 trillion in assets under management, focused on investing in areas like real estate, private equity, infrastructure, credit. They serve both institutional as well as individual investors. They basically specialize in managing investments that are not traditional stocks or bonds, such as private equity, real estate, and infrastructure. Their investment strategies also span other asset classes, including in the life sciences, growth equity, credit, real assets, secondaries, and hedge funds. And then, as I mentioned, they serve institutional investors, which could be pension funds, for example, endowments, as well as individual investors. They have dealt with some challenges recently, although the business is actually still doing exceptionally well. And I would argue that some of the sentiment you're seeing afflicting the stock has to do with the broader environment at large. Interest rate hikes, obviously by the Federal Reserve, have made borrowing more expensive, and that's impacted the profitability of their real estate investments. And commercial real estate remains a huge element of their business. And then as borrowing costs increase, the value of real estate assets can decrease, which leads to potential losses for the investors that they serve. Investors are also, hesitant to sell in a slowly recovering market, which limits liquidity, and that's crucial for managers like Blackstone to generate cash. And they are really working to diversify their real estate portfolio, but a lot of their commercial real estate, and again, commercial real estate is a huge element of their overall portfolio, goes down to office space. And that's obviously something that's faced challenges and sort of volatility in the last several years. They have accumulated a large amount of cash over the last several years, but then market conditions can sometimes make that difficult to deploy effectively. And, since the interest rate environment that we've seen the last few years, even though there's been slight cuts, private equity firms, and then including firms like Blackstone, have seen a slump in returns. And, some funds are not delivering the returns that investors had grown accustomed to. For example, previously, the president at Blackstone had said that multifamily construction is down about a third. That obviously indicates a slowdown of new supply. They have been working to increase their exposure to really structurally growing and attractive real estate markets, including data centers, logistics assets, warehouses, medical labs, student housing, to give some examples. Again, as an alternative asset manager, they primarily generate revenue from management and performance fees that are charged for managing portfolios in its investment advisor firms. So they receive an annual management fee, which is typically a percentage of a fund's capital commitment or invested capital during the investment period. And then they also set performance fees for generating higher returns. That's often a share of the profits that are generated by specific investments. And again, real estate has been a significant revenue driver for Blackstone. But besides that, they're also involved in all these other areas I mentioned, like private equity, credit infrastructure, hedge funds, and secondaries. They are, generating as well revenue from providing capital market services, such as advising on mergers and acquisitions and providing debt financing. Obviously, that's been a highly fluctuating environment in the last few years as well. I think broader concerns about the state of the macro environment, as well as some of Blackstone's exposure to different areas within commercial real estate, have impacted some of the sentiment on the stock. But it is worth noting, they released their Q4 and full year 2024 results at the end of January. The CEO commented at the time that Blackstone reported one of the best quarters in our history. Earnings growth accelerated sharply. The key drivers of our business, inflows, investment activity, and realizations all reached their highest levels in 2.5 years. So that is very, very positive for the business. Now, GAAP net income was $1.3 billion for Q4, $5.4 billion for the year, which is, I think, notable as well. To give you an idea of total revenues, those were about $13 billion for the year, compared to about $8 billion in full year 2023. They also effectively doubled their net income compared to the prior fiscal period. Fee-related earnings were about $5.3 billion in 2024 alone. That was a 21% year-over-year increase. Distributable earnings were about $6 billion. That was up 18% year-over-year. It's a solid business. Again, as I mentioned, real estate, private equity, credit and insurance, multi-asset investing, those are their key segments. And the real estate segment has been one that continues to be hit the hardest in terms of growth. For example, their core real estate portfolio only grew about 0.1% in 2024. Their opportunistic segment of their real estate reportable segment was actually down about 3.7% year over year. But then in all of these other areas, for example, corporate private equity, they saw growth of 16.6%, private credit, 15.7%, infrastructure, which is another area of investment for them, 21%. So in terms of net accrued performance revenues, it was also a pretty solid quarter and year for the company. So there's a lot going on with this business. I think its exposure to real estate and the concerns about the continued volatility in that space, particularly commercial, but also residential, has impacted a lot of sentiment for the business. But if you're interested in investing in an alternative asset manager like this one, and you're looking at how they're performing as a business, this is still a company that is performing really well on the fundamentals.
I'm going to take a question on EPAM Systems, which I think was from a few days ago. Maybe it was a few hours ago. I lost it in the queue. And I think it was from Vihan. Maybe it's, where did it go? Sorry. Yeah, so from yesterday, can you please help with the current valuation of EPAM Systems? EPAM is the symbol. Your thoughts at current prices for the long term. So yeah, Vihan, all of the IT consultants and technology consultants are under sort of a cloud of questioning now, given the ease of using artificial intelligence in an engineering setting. So you and I can use, let's say, a large language model to teach us about things and to ask for Python code that we can use. The models are very good at that. On an engineering level, there is some, I think, process that large language models can help with internally. Still, for project-led work, you need teams and pretty good consultants like EPAM Systems or competitors like, well, here at the Fool, we invest in companies like Globant, for example, and Dava and Accenture. So these are names you're probably familiar with. I think in this case, this company has had trouble really recovering since the Ukraine-Russia war, when Russia invaded Ukraine, because they had a concentration of engineers in that region. And so what we see is a lot of different headwinds just coming to the fore with this business. I think it's actually a pretty strong business. I like all of the consulting companies I just mentioned because I think they're differentiated and they all specialize in different verticals, which have some insulation from this whole dynamic of AI and its relation to the ability of companies to get stuff done internally. But I think too, one of the things that we have to monitor going forward for EPAM systems, it's like its peers, it's pretty acquisitive. So in the past, when we didn't have these headwinds, you could reliably expect these businesses to hit somewhere between 9 to 12% organic growth, and then they would get the rest of the growth off of frequent acquisition. So you acquire smaller consulting companies and roll that up, and that becomes organic growth later on. Part of the reason why these businesses acquire smaller competitors is because it opens up new practice areas for them. So you buy specialist companies, but also it helps shore up the attrition rates of this business, which can range anywhere from like 12 to 20% in a year. One of the best numbers that I've heard in a while, I think, came out of Kyndryl, which is another consultant in this space, symbol KD, which they have worked their attrition down to 10%. So in most industries, you would say, you've got 10% turnover of your employees? I want out. But in the consulting industry, that's pretty good. So you acquire then more talent because talent's going out the door and project work is difficult. So I think what you're looking at is, maybe a company vis-a-vis its forward potential that is clearly expressed for its risks, even though they've largely solved the problems of their labor base in the last 3 years. Now they find themselves confronted with the issues that we're seeing if you look at any of these consultants. So it may be a while, but we sort of believe in a few of these business models because they are, as I said, differentiated. So you can look at EPAM Systems as a company that still has some inherent risk in it, but it could be a sort of glass half full scenario if you're patient. Then the question becomes, will any of these businesses hit their former growth rates when you look at a Globant or Endava or EPAM? Those three are most like each other amongst foolish companies. And I'm skeptical that they'll be 20 to 30% growers ever again. I'll be honest with you. But could they be mid-teens, high-teens growers, especially if some of the economic uncertainty clears and they successfully navigate a new world where they have to stop trying to sell everything because companies can do much more in-house? I think they will. I think that they can resume somewhere 10% and above. So I guess vis-a-vis valuation, your question, it's probably fairly valued here and reflective of some good potential, but I'd be cautious and I wouldn't, invest a lot in EPAM just now. I keep monitoring every quarter's results, and yeah, I mean, it's slow going with these companies. You look at them and you're like, why aren't they rebounding? Because it's a time of transition.
So there was a question that came in a few days ago, actually 4 days ago, about Luckin Coffee. Do anyone remembers the scandal about this one years ago? Yeah. Good morning. What are your thoughts on Luckin Coffee? This is not a company I currently invest in, but I thought it'd be interesting to talk about what's been happening with the business over the last few years. So for anyone that followed what was going on with this company years ago, they faced a pretty big scandal in 2020 when they admitted to inflating their 2019 sales revenue by something up to 310 million USD, I think. That led to the stock price tumbling. They were subsequently delisted from the NASDAQ. Their chairman and CEO was also fired. And then also Luckin was fined, I believe, $180 million by the U.S. Securities and Exchange Commission, after which, or around that time, they filed for bankruptcy in the U.S. in February of 2021. They then received court approval in December 2021 to restructure their debts and settle outstanding class action lawsuits. It was a restructuring bankruptcy. They emerged from bankruptcy in 2022 after completing the restructuring of their financial debt. Since that time, they have more than doubled their store count, and they now reportedly have several thousand more company-operated stores than Starbucks even does. They are a major player in the Chinese coffee market, where they have outpaced big names like Starbucks in terms of store count and sales. I was talking about Starbucks earlier today and this afternoon about how one of the biggest challenges they have faced is their second largest market, and their largest international market is China, a place where there are significant cohort of local competitors that are, great quality coffee, fantastic businesses for, if someone who wants to go get coffee from a local player and chain, and there's a lot of local competition there that's doing really well, and Luckin Coffee has been one of them. And they have, obviously, after this period of scandal and bankruptcy, they have rebounded through a combination of management changes, strategic marketing, private equity investment. They've been focusing more on a leaner, cost-effective model. They had reached a settlement with the SEC. A company called Centurion Capital stepped in with a roughly $240 million investment to help Luckin Coffee with their legal fees and fines. And then they really shifted over to really strategic marketing and brand repositioning. So positioning themselves as like a young, professional, fashionable coffee brand. They started leveraging social media platforms popular among their target demographic. They started leveraging celebrity endorsements. For example, they also have then experimented with these very unique product innovations and collaborations. They had a specific drink that went viral on Chinese social media. And they have done all of this while kind of focusing on a very bare bones model for their actual store locations. And so kind of combining these approaches, rapid store expansion, really effective influencer brand social media marketing. They have, doubled or more than doubled their number of stores over the last few years. They've increased their revenue by the high double digits, and they've also begun expanding internationally. For now, with a focus on Southeast Asia, for example, they've really expanded in Singapore and Malaysia. There had been reports of their thinking about entering the US to disrupt the low-price coffee market. I would imagine those might be plans that could be put on hold for the foreseeable future. So that might be something to follow as well. They've certainly done a good job of cutting Starbucks in China. So it's not difficult to see that they could do that in other markets, even within the region. There had been reports when they had been talking about, entering the US, that they really wanted to go into cities with large numbers of students and tourists from China, such as New York, because they saw that being a really strong opportunity for them. And, they're known for selling these really affordable drinks. I mean, somewhere in the ballpark of $2 to $3 USD a piece, which would obviously, attract customers seeking value. And they have a very technology-driven grab-and-go model. Their coffee shops are largely cashless. They focus on digital payments through their app. You often just order through a mobile app, pick up your drinks at the store. They're designed for speed and efficiency. And so the idea is you have high-quality coffee at a lower price point. It may not be the same type of experience you would have at a Starbucks or another, less casual brand, but this is still something that seems to have really resonated with customers, and they've been able to make a remarkable recovery in China. I think they are now one of the largest, if not the largest, coffee retailer in China. And again, they're planning or in the midst of launches in Hong Kong and Malaysia and other markets within Southeast Asia. So they've come a long way the last few years. I think the business model is interesting. To give you an idea of how they're doing in terms of financially, they reported total revenues of about $4.7 billion in their fiscal 2024. That was a roughly 38% year-over-year increase. They delivered 6,092 net new store openings in 2024. 6,071 of those were stores in China, including 5 stores in Hong Kong, 21 stores in Singapore. Their total number of stores increased 38% year over year to 22,340. 14,591 of those were self-operated stores, and then 7,749 were partner stores. They said average monthly transacting customers were 71.8 million. That was a 48.5% year over year increase. Same store sales growth for self-operated stores was negative, but revenues from self-operated stores was up 43% year over year. And then the revenues from partnership stores were up 24% year over year. They also are working on being more consistently profitable. They reported GAAP operating income of 485 million. That was a 17% year over year increase. So this is one I find intriguing, particularly as I've talked about, I have sort of historically stayed away from companies operating within China, not because I don't think that that is an absolutely exceptional area to invest in. I think it is, but I think given a lot of the regulatory concerns that have faced some of the companies operating there, really great businesses have not always turned out to be really great stock performers. And that's something where I have sort of watched, and also as a newer investor have been more hesitant to invest. I talked about yesterday how I've been starting to really investigate more Chinese EV makers and have found that to be really fascinating.
Yeah.
And so this is a company that I find really interesting, particularly because I follow companies like Starbucks and Dutch Bros so closely. And talk about a turnaround story. I mean, this is a business that looked like it was completely on the way out, and they're now one of the biggest operators in China and rapidly expanding.
Yeah.
Will that continue? Unsure. I'm not taking a position right now, but I find their turnaround story fascinating.
Yeah, I think for Luckin, there was a real core of a great business there when the stock just imploded and it turned out there was fraud in the operations. And what was so interesting at that time is that, it went against the China model of Starbucks, which Sunmeet and I were talking about a little bit yesterday. But Rachel, as you're well aware, Starbucks was the experiential occasion coffee in China years ago. And it was, a different type of model than Starbucks is here in the US. And so in the face of that, Luckin took off, which is let's get the smallest lease space we can. If we can lease a counter in a hotel, let's do that. Let's parachute in with a density model in tier 1 cities. And if we can open, 30 locations and have people delivering on bikes, let's pour our CapEx into that. Because, the Chinese are avid tea and coffee drinkers. It's just that most in the US misunderstood that market because of the way Starbucks approached it. And I totally agree with you on so many fronts with this. It's still in the penalty box in Stock Advisor. I was explaining yesterday that that's on Tom's side of the scorecard. I have some ideas, and I'll try to ask him when I get a chance. I have some ideas why it's still in the penalty box there, because they do have some imitators in competition that's rising, and the model itself is not designed to operate at a huge margin. So probably, I would say, should we have pulled it out sooner? Yeah, but at this time, he's got some question marks. So that's very interesting to contemplate itself. Why is it still there? But looking at that U.S. expansion, I will be interested to see what type of real estate they would operate out of. Is it? And I would guess, Rachel, it's going to be something that if they're starting in New York, in Manhattan, where you're going to have very small space, and potentially as they expand out, it'll be more Dutch Bros type model. So smaller footprint, drive through, focusing on throughput. They won't be having broistas. And that's such a fascinating business to study as well, because Dutch Bros does two things that are in direct opposition with each other. They encourage frequency and loyalty through conversation while trying to speed up throughput. And they have some novel ways to do that. They have some good techniques that they can achieve both at the same time. So just contemplating how Luckin would operate here, where in the major cities, the real estate is as expensive, or if not more, than tier 1 real estate in China, leasing that out. I envision it'll be really capital light and it'll be a fun challenge. But the US market it's got so many variants already. And I will be so curious to see where they have to start. Like just in Manhattan, there's so many amazing chains of every price point. But I think this is a talent of the Chinese. They always have something to teach us about margin and your expected profit margins and how to engineer something that can be barely cash flow positive but scale. So we'll see. That's an interesting test case, this U.S. market. But yeah. Luckin.
I'm unclear, if they're going to continue with that right now. I haven't seen updates on that, but I agree.
What's your guess? If you were expanding into the U.S., knowing what you do about Luckin, which admittedly, as you said, it's not a business you've spent a lot of time with recently, but just everything that you just went through and knowing a lot about the Chinese market and how different global chains operate their coffee businesses, how would you begin to expand in the U.S.? What would be your footprint? How would you approach it?
I mean, I think the way that they have outlined, where they want to have these very intentional but rapidly growing footprints in these very core cities where there are a lot of consumers that might already have regularly transited a Luckin Coffee location overseas, back in China, for example. I think that would be key. But I also think that there would be a lot of interest from American consumers who have interest. Now, again, at this point in time, given the environment and what we're seeing in terms of concerns regarding trade with China and some of these other elements that are impacting other businesses based in China and their expansion plans to the US, I would be surprised if this expansion continued as they had hinted it would. So I think alternatively, something that you're seeing is these are also businesses that can then advance in other regions, like the EMEA region, Europe, Middle East, Africa.
Totally.
Ton of opportunity there.
Yeah.
Any loss that we would have, at least in the short term in the US, is potentially the gain for many other booming markets, which present considerable opportunity. So that would be my next train of thought there.
I like that. I think this Starbucks model has really trained many entrants into the coffee market in a misleading way, in that they had such a massive footprint, they were able to exert pricing power. So Dutch Bros is a business that demonstrates this, because you would think with the type of beverage you get at Dutch Bros that the price points would be $6, $7, and $8. And Kirsten Guerra, who is on the Stock Advisor team, was traveling, and she did a lot of fun on the ground research. And also we looked at some menus, and I'm surprised. Like, have you been to Dutch Bros by any chance? You've been in Italy, I think, for a while, right? Many years. I'm seeing.
I have not been to Dutch Bros though. I want,
because I'm on the East Coast.
Go.
Yeah. So what we found out is like, none of those price points are like $4 and $5 for drinks that I call concoctions because I'm a black coffee drinker, but well below like a Starbucks price point. So there's room for disruption. At this price point you call out, like $3 to $4 USD. Let's translate that into euros. Let's just say 0.9 for now. That's not a bad price point in a lot of European cities, and especially the Europe, Middle East, Africa market that you mentioned. It's just interesting to contemplate where that goes. Okay, so I love to talk coffee. We should keep moving, and I see we have some more questions. Let It Ride asks, could you share your thoughts on the use and value of the valuation rating in the quant analysis on the Motley Fool website? So yeah, that's basically a scale that our quants put together. Maybe let me pull up a company. We'll come back to this question actually, because I'll see if I can pull up a sample company and talk through it. Is there another one that you see that you would like to take just now, Rachel?
There's one. Yeah, there's one I could hit really quickly. Ed was asking. Ed was asking about, I think he's referring to a new bill that had been introduced, but the concept's not new, about credit card companies. Would they be concerned interest rates they charge could be capped at 10%? And if so, how would they make up for lost margins? So if you're listening to this and are unsure what this means, there is a bill that was introduced, I believe, in February by Senators Bernie Sanders and Josh Hawley that would cap credit card interest rates at a 10% annual percentage rate, or APR, for 5 years. It's an idea that has been floated by many on both sides of the aisle in the past. So that's something as well to note. It would be something that would cap credit card interest at a dramatically lower figure than what they have been. Credit card interest rates have been hovering at essentially record highs, despite the moderate cuts we've been seeing in terms of actions from the Fed. There's data that shows that almost half of credit card holders carry debt for month to month. In 2022, for example, credit card companies charged consumers more than $105 billion in interest, more than $25 billion in fees. That was according to a 2023 study by the Consumer Financial Protection Bureau. But again, it's not a new idea. In 2023, for example, Hawley had proposed an 18% rate cap. Sanders had proposed a 15% rate cap back in 2019. There has been different surveys of Americans that have supported, that have showed that Americans broadly support a cap on interest rates. But there has also been, notes from experts that while a 10% rate cap could sound really intriguing or appealing as a consumer, there's a lot of intricacies of how it would be structured. For example, there was an attorney that commented in a CNBC article that was covering this, that you could have zero interest and still have an incredibly, expensive credit product. Rate caps could potentially also restrict access to credit. There's a lot of different ways in which it could apply. Also, the new bill may not apply to existing debt, even if it was signed and fully passed. You think of companies, though, like MasterCard, for example, which I think a lot of people think of when they think of credit cards, right? So this is a business that does not make money off of, selling credit to consumers.
It's a charge card network.
It's a charge card network.
Yeah.
That was the example. They're charging financial institutions fees based on the gross dollar volume of transactions on their branded cards and network, as well as fees for things like cross-border transactions and data processing. They are not reliant on consumers paying their credit card bills on time in order to generate revenue. Most of their revenue is tied to transaction volume. And I named that company because, they're not a direct credit issuer, but a lot of people would think of that business when you're talking about this sort of an idea. So I think that some of these companies, whether private or publicly traded, that are in the business of issuing credit and credit cards, I think that they would find other ways that might make those products more expensive. I think that they would adjust to factor for those costs accordingly. But again, this is an idea that has been discussed for many years and has never made it into finalized legislation. So it's very hard to say at this point what that would actually look like in practice.
They probably have a plan B already, but I agree. I think maybe the most exposure might be a company like Amex, which has some of its net income component coming from basically interest income, and they incentivize their more creditworthy customers, to have balances. So, but I'm sure they have a good plan B. So the question is gone for the queue. I'll just briefly tackle that question. It was asked about valuation in Quant 5Y scores. And I thought what the answer was really about is the quant projection score that you see when you pull up a recommendation in Fool IQ. So I had just pulled up our latest recommendation from Team Rule Breakers, which is ASML. I mentioned earlier, investing type moderate, quant projections, estimated annualized return of 5% to 27% with an estimated max drawdown of minus 37%. So what does that actually mean in terms of valuation? It means where the stock is priced today, our quant models, we have a team of quantitative investors. They're actually investors, are not just like math guys. They construct portfolios for us, and some of you have subscriptions where you have access to quant portfolios. Basically, their model is taking a range of probabilities of where a stock may have its returns on a 1-year horizon, and then they extrapolate that out, and also what the volatility of that stock might look like. So we roughly correlate volatility with risk. They're not the same thing, but it's just easier for our members if we can talk in terms of how volatile a stock might be to give you an idea of how risky it might be. And you can think about this as not as an absolute forecast. The last presentation that I saw on this, which is maybe about a year ago, our quants gave us a very nice slide presentation. Basically, it's a bell curve of probability distribution. So they're lopping off some of the extremes of the outcomes and trying to give you what's most likely to happen if you look at a range of possibilities in that stock price. And that's what that range is representing. It's not trying to be precise at all. It's trying to be more directional. And if that sounds like a contradiction or something flip, I'm not being flip when I say they're not trying to be precise at all. I think precision isn't the goal here. Really what we're trying to do is directionally indicate what might be something a member should prepare for if they purchase a stock. And so that's what their models are after. And I would take those as like a data point when you are evaluating a recommendation that we put out. I use them. I use those scores and try to understand what they're telling me about a business. I do look at beta's business, stocks, a business's beta. It's sort of volatility in relation to the S&P 500. So that's something we give a lot of data points at the Motley Fool, depending on the services you have. And we've got the Moneyball database, which has a lot of great information. And we try to put in a lot when we write our recommendations to talk about potential and risk. At the end of the day, I'm always encouraging members, try to figure out where you stand, think through every recommendation, argue with it, give it some love and brownie points where it's confirming something that you think. There's no rule that says you have to buy every recommendation. I really love the question, which is trying to get to the heart of what do these numbers mean that you guys put in front of us? So we've got about 3 minutes left. Rachel, what do you see that you want to tackle?
Yeah, there was a question that had come in about a company that sometimes this will happen. It'll be a company I'm not familiar with, and I get to learn about it a little bit in real time,
Nice.
which is kind of fun. So Vincent had asked about 5 hours ago, what are your thoughts on Monogram Technologies, ticker MGMR? This is a small cap company. They're about 109 million market cap, although it looks like shares are up about 40% over the last year. And that seems to be broadly tied to expectations for the upcoming approval of their TKA system, which is a robotic knee replacement system. So Monogram Technologies, they are an AI-driven robotics company. They are focused on commercializing AI-driven products for orthopedic surgery. They plan to generate revenue in the future by commercializing their robotic surgical equipment, orthopedic implants, related software, and other instrumentation for reconstructive joint replacement procedures. This is a company that is still in the pre-revenue phase. This is something that's important to note. I think a lot of excitement around the stock has been generated since they received the FDA's 510K clearance for their MBOS TKS system, which is, again, their robotic knee replacement system. That is designed to enable more personalized knee implants and better fitting knee replacement. FDA 510K clearance is essentially a pre-market notification process for medical devices. It's when a manufacturer demonstrates that their new device is, quote, substantially equivalent to a legally marketed device, which means it's safe and effective. And this is one of a few very crucial steps to allow a device to be marketed within the US. It is important to note that 510K clearances doesn't mean the FDA has approved the device. It just means the device is deemed substantially equivalent to a legally marketed device. And then once that submission is cleared, they are able to market that device. But now they're in the process of actually getting full approval to commercialize the device, which I believe is expected to occur in terms of garnering the green light from the FDA in the coming months. So again, this is a pre-revenue business. They're still operating at a significant net loss, which is quite common for businesses at this stage of their growth story. This would be their first ever approved product. This is an interesting little business. I'm curious to look into it a bit further. One of the comments from management is, we remain diligently focused on FDA clearance for our 510K submission. They received an additional information request from the FDA regarding their submission at the end of September, which placed the application on hold pending a complete response. They held a teleconference with the FDA in October to address those questions, and then they conducted what's called a positive submission issue request meeting with the FDA in December. So they've completed all of the elements required in terms of responding to that request received from the FDA. So it looks like now they're just waiting for the final 510K clearance, which is a crucial step for them to be able to actually get to commercializing this product. So interesting one to watch. This is one I would definitely pay attention to and maybe add to my watch list now.
I love that you mentioned that it's pre-revenue. That's always something to consider. Some thoughts on that at another time, because we're at the 4:00 hour. And Rachel, it's been a lot of fun. And Tim Beyers is coming up next, but you'll be back, I think, after. Is that correct? After tonight?
Tomorrow, I think I come back.
Okay.
I think this is my last show for the day. I did 3 shows today. I'm sure fools are sick of seeing my face now. So
we had a note here from Bill. I think our producer behind the glass, and I think I just misread that. But get some rest, have fun.
Thank you.
It was a pleasure, and I'll see you soon.
So fun. Thanks, guys.
Yeah.
All right. Thanks, Rachel. Good afternoon, fools. Hey, Asit. I'm
Tim, hello.
Beyers. For another hour of Fool24. How you feeling, Asit?
Pretty good. Lovely spring day here in North Carolina, Tim.
Nice.
And so how about yourself?
Doing all right. Yep. We have some earnings to get through. I have 2 that are on the list, plus a bonus one if we want to get to it. But we're going to talk about Accenture, and we're going to talk about Micron Technology. I've got a few things that we can show.
Cool.
As per usual, go ahead and get your questions in. Before we dig into Accenture and Micron, Asit, have you looked at either one, and do you have a take on what you saw from either one of them? And if the answer is no, then this is going to be even more interesting.
Yeah, so we'll take it half and half. I had a brief look at Accenture's results.
Okay.
And Micron is a company that I've looked at a few times, and I'm very interested to hear your take on earnings. I have some interest in their business, so I think this is going to be a lot of fun, and I'll be chiming in as we go. But I was able to look briefly at Accenture's earnings yesterday, and that very it's going to be a fun hour.
Yeah. Okay. So let's get into it. Accenture earnings down, or I'm sorry, the shares were down 4% on the week. The initial reaction to the earnings report was down 7%. Asit. So the market didn't love it, but there were some good things to like, to your point. So I apologize for not looking into the camera right away, fools. I'm going to be just reading some things that I think are important to give you some detail. Revenue up 8.5% in local currency. 9 of the 13 industries that Accenture covers, they cover a lot of different industries. They deploy consultants to a lot of different types of businesses. And in 9 of their 13 core industries that they serve, the consulting overall revenue was up in the high single digits or higher. They also increased the data and AI workforce to approximately 72,000 now. I'm going to have a take on that in a second, but they are headed towards 80,000. That is their goal. For those that do not know, that is about 8.9% of the total workforce. And if I were to share my screen briefly, you will see that it is, whenever you can get that up there, you can see a little more than 80,000. I'm sorry, 801,099 employees. So 72,000, just under 9% of the workforce. Pretty good. That is not bad. All right, let's stop sharing my screen there. So that was pretty interesting. So they are doing well. They're a broad-based consultant, and I think part of the issue that Accenture is doing better than other consultants here, Asit, is that they are broad-based. They have a big workforce that can handle really big AI projects. This is one of those cases where a lot of the niche consultants that do, kind of have their niche that they really exploit, it's been a little bit harder for them. It's been kind of this blunt force market where we're looking for a lot of AI talent, a lot of big ticket projects, and those are going to, the more muscular of the consulting companies, and there's none more muscular than Accenture is. Couple of other thoughts here, just so we could get to this. They have said, Julie Sweet, the CEO, said they are not seeing any pauses in client activity, but part of the reason that the stock was down is that they did, they issued some caution, like they don't know what they will or will not see in terms of federal contracts. And that obviously didn't go over that well. But they didn't give any. What's interesting here, Asit, is they didn't give any numbers on hey, expect federal business to be down by X% over the next few quarters. They didn't say that. They said that there is they are being cautious about their federal business. And remember also, one thing that does, even though it's easy to forget that this is true because Accenture is such a big name here in the United States, Accenture is an Ireland-based company. They are not a U.S. company. They are an Irish company. I mean, that doesn't mean that it causes them any particular trouble here, but just for argument's sake, if we are going to see more business pointed towards U.S. companies, there's a chance that Accenture maybe moves down the pecking order. I'm not so sure I'm going to see that we're going to see that happen, Asit, because they're such a dominant company. But just for argument's sake, just so we're clear, that is a thing. Gen AI revenue has grown significantly, and they mentioned this. It was a bit of a throwaway line, but it was in the earnings call. 1.1 billion in revenue in the first half of 2025, of fiscal year 2025. That is already greater than $900 billion for the entirety of fiscal 2024. So they are profiting from AI-based projects. I'm going to move to a couple of other things that I can show. We're going to do a different screen that I need to share here, different window. Yeah, let's go here. I'm going to move to, I got to come here. All right. Can you see what I'm looking? Yeah. All right. This is okay. Accenture quarterly revenue. I want to point out here, look at that per share dividend. This is something that has been a feature of Accenture forever. $1.48 per share in quarterly cash dividends. That is up 19% year over year. I'm sorry, 19 cents and 15% year over year. This is what Accenture does. They have been like clockwork every quarter, Asit. They increase the dividend by 15%. That is such a powerful tailwind to this stock, and it's why I still like it. We're going to calculate the free cash flow a little bit differently here, but I will say 929 million in dividends paid and 1.4 billion in share repurchases. Keep those numbers in mind because we're going to come back to them. And then dividends, again here, just to highlight the point, this is for the 6-month period, $2.96 per share in dividends. What is that? Up 15%. Again, this is what they do, 15% every quarter, all the time. They are always hiking the dividends. I love that about Accenture. But if you wanted to highlight something that is not a problem, but just something to be aware of. So here's your Accenture cash flow statement here. And you can see that net cash provided. I mean, it's probably hard to see this. Let me see if I can make it slightly bigger. Hopefully now you could see the net cash from operating activities for the 3 months, 2.85 billion. That's up significantly. And then you have some debits here. Your share-based compensation expense, significant, but it doesn't kill your cash flow. What you're going to see in a minute is that your purchases of property, plant, and equipment, that's CapEx, not too much. Accenture buys businesses every single quarter.
Sure.
So you can see here how I do the cash flow here. I want to highlight this point and just maybe park on this for a second, Asit. Can you see that as a debit here, I took out the stock-based comp. I also took out the core CapEx, the cost of acquired businesses, but then I added back the proceeds from the sale of businesses because, I mean, you're an accountant here, Asit. Like, what is normal business practice? Normal business practice is every quarter, Accenture buys some businesses and they divest from some businesses. And so those divestitures should count as credit. That happens every quarter, and that should be counted in the cash flow computation, in my opinion. So that's why I count it. I think it's right to do that. But let's talk about the things that are this they do as well. They are always buying back shares, roughly 1.45 billion in share repurchases for the quarter, and then your cash dividends of 929 million. So once you take all of that out, that's roughly 621 million in cash burned for the quarter. Is that bad? No, it isn't. But it's just to say that we could pull this down. I want to keep this screen share in the background because I'm going to pull this back up again in Micron, but you could take it down and just leave it in the background. Perfect. Thank you. So I thought this was interesting, Asit. They do this every quarter. They burn a bit of cash because they are consistently repurchasing shares and they insist on paying those dividends. I really don't have a problem with that. They have plenty of cash on the balance sheet. They manage their capital quite well. Their returns on invested capital are over 25%. I have no issue with this company and the way that it uses cash. But if returns on capital were very low, if they were issuing just outrageous amounts of equity, such that the amount of equity that they were issuing, the stock-based compensation number, was higher than the share repurchase number, yeah, would I have a different take on this? I might have a different take on it. So your thoughts on what we've shown here, Asit?
So it's funny, a similar looking formula in a different company, Procter & Gamble, not every dynamic the same, but sort of similar, is sort of like my favorite whipping company poster for like how not to manage your capital, but they don't have the margins and they don't have the return on invested capital that this business does. So that makes a lot of the difference. As to your adding back in the proceeds from the sale of businesses and lumping in acquisitions with capital expenditures, I'm of the same mind. If a company is doing this consistently, that is your CapEx. Like, why would you, as an investor, say, well, I understand subtracting fixed asset purchases from operating cash flows, but acquisitions are something different. They are if you don't do it regularly.
Right.
For some companies, I will say no. The free cash flow was operating cash flows minus the property, plant, and equipment cash expenditures, and this acquisition, is something else. But if this is the course of your business, and we know that these companies, I just said this in the last hour, they acquire other businesses because that's billable talent. You have to keep expanding that pool. And there's a lot of attrition in this industry. So simultaneously, you acquire expertise in different verticals and put that to work to raise revenue. And some of it's going to come out of the bucket. So you've you've got to buy businesses on a regular basis. So for sure, if you are then selling businesses as well on a regular basis, that proceed, even though theoretically it doesn't feel like an operating type of cash flow, it feels like something in investment financing. Actually, I would put that in a free cash flow calculation if every quarter we see that. It's quasi operations for this company. They deal in people. So, yeah, I agree with the way that you look at that. And because Accenture does such a great job of signaling to the market that we're a formula business, we're not a formulaic business, we're a dynamic business.
Yep.
We are investing heavily in AI. We have cost optimization always running here, but we have a formula you can rely on that's predictable, it's great returns. Because they're doing that, I think it's fair for us as shareholders to then ask, okay, what's the impact of the share repurchases you're doing? What's the impact of the dividend payouts, which are growing on a per share basis? And that's how you should sort of model what you can get out of the business. They're not trying to be a smaller company. They're trying to keep scale dominance and expand in all the verticals that are represented. And then finally, just to wrap up here, to go back to one of your very first points, they're having an easier go of it in a difficult time because they are so geographically dispersed among different areas of expertise, industries. They're massive. And that scale advantage is some comfort to investors who may be, holding some smaller consultants and wondering like, wow, what's going on with the prices there? Now, just on the cautionary side, yeah, I think it's interesting, Tim. They mentioned like the potential impact of a cut in spending on the federal level
the federal
that we
side,
see going
yep.
on. And all they did was just to call out, look, just to remind you guys, it's 8%. So federal sales to the U.S. federal government are something like 16% of sales to the Americas, and I think 8% global was what they mentioned. Nothing more, nothing less. Just to give you a piece of data, if you're going to model that out, what could be the impact? And all in all, the stock was down. How much do you remember? How much it finished yesterday?
Yeah, it was down about 4% for the week.
Okay, yeah. So all in all, investors are like, okay, thanks for that note of caution. No one's fleeing the stock wholesale. It is a attractive business. And so my first impression from what I saw briefly yesterday and then listening to you is, nothing about this earnings report scares me. There's a lot of positives in here, but like every other company that we're looking at in 2025, you just have to evaluate the impacts of policy. And I think GDP growth, global GDP growth, is another good thing to look at this year in relation to how your company fits in that big puzzle.
Yeah, just so we're clear. So I like Accenture, just to be perfectly clear about this. I like Adventure. Adventure. I do like Adventure, but I like Accenture as a buy. I like it as a buy. I like it as a conservative buy. And the reason I like it as a conservative buy is it's very unlikely to be just flat going away. Even with cuts in federal spending, it's still unlikely to go away. It is massively diversified. It has more than enough capital to buy peers or rivals that are distressed and can buy those distressed rivals at cheap prices and tuck them in. They have a history of doing this because they have high returns on capital. They generate more than enough cash to do things like they could always ratchet back the share repurchases anytime they want. They're not going to cut the dividend purchases, but they could easily just give themselves, just like that, 1.4 billion more in free cash flow by saying, we're just going to hit the brakes on the share repurchases, because they consistently do take down the share count. But there are two things in addition to what they do with, driving earnings. For a common shareholder, they give you two things that are significant tailwinds for you to earn returns. First, they draw down the share count, and they do this relatively consistently. Like, say, what is it? 634 million, I believe. Yeah, 634 6.2 million diluted shares in the current quarter. That's down from 636.8 million. So they draw down the share count, driving up your, as a common shareholder, claim on the earnings of the company. You get more value for the shares that you hold because they're repurchasing and knocking down the share count. And for all of those shares that you hold, you are getting a 15% increase every quarter on the dividends you get from those shares. Those are twin tailwinds that are, if you hold that over a really long period of time, I think you're going to be pretty happy. That's what I like about Accenture. It's a conservative investment, but it's a good conservative investment, a really good one. So I went on a little bit of a screed there with Accenture. We'll pause quickly, see if there's any. Let's see. We'll come back to that. We'll come back to that. I don't see any as far as, nope, don't see any Accenture questions yet. So we're going to keep moving. All right, let's bring the screen back up because we're going to move to Micron and want to talk about Micron cash flow. So Micron Asit was down 8% on Friday. And I think part of the issue for that is Micron's overall results were quite good. Like, I think it was earnings per share up more than 200%, operating cash flow up more than 200%. But I want to point something out here that I think should not give investors pause, but it may be an explainer. So you can see here, overall, there isn't much in the way of stock-based comp as a contributor to those net cash provided by operating activities. And it was up massively. Operating cash flow up absolutely massively, more than doubled. Really great. Just a good number for the 6-month period. Okay. However, I do think you should take a look at that line under cash flows from investing activities, and you could see that expenditures for property, plant, and equipment, this has been fairly common for Micron. It's getting close to even, Asit. You could see the year prior, the expenditures for CapEx was way above, like roughly 500 million above the cash provided by operating activities. Here, it's almost a wash, but still, Micron is not generating, just to be clear, Micron is not generating free cash flow from its operations right now. Now, there's a big caveat to what I just said there. So overall, it's true. Mathematically, it's true. Micron not generating free cash flow right now. It just isn't. On a pure basis, the CapEx is massive. And there are two things to consider there. The CapEx, they are building, and they're building pretty big right now. Nothing wrong with that. In fact, you could argue that's great. You would want them to keep building. That's that's actually ideal. And I'm hopefully this is gonna show in my browser in a minute here. You should be able to see this. Did that pop up? Yes, it did. Okay. So on that point of what they are investing in, we broke ground on a new high bandwidth memory advanced packaging facility in Singapore. We're growing our HBM capacity on existing manufacturing facilities. And we have, you can see what I highlighted down here. We have a new DRAM fab. DRAM is dynamic random access memory. That is roughly the core product of Micron. Crucial memory. That's that's Micron's business here. Construction in Idaho completed, and that enabled the receipt of the first disbursement of funding from our CHIPS grant for the project during the quarter. That is very interesting. Now, the administration has said we can pull this down now. We don't need it up anymore. We can maybe come back to it. It's very interesting, Asit. The administration said they would like to dump the CHIPS Act. Maybe replace it, maybe not. We don't know. But Micron's got some money. They are investing incredibly heavily. Now, there's another thing that they said during the call. It's that they have some underutilization. They have some supply chain problems. They are not fulfilling all of the demand that they can fulfill. And so their inventory number, they haven't drawn down inventory. They haven't overbuilt inventory. They've been trying to manage inventory because the fulfillment has been, it sounds like a little bit hairy. And I think that's part of the reason that demand is really hot, and Micron's ability to fulfill all of that demand is like, yeah, okay, but not like we're filling every order we possibly can. There's some questions around the supply chain and around fulfillment, and that leaves, I think, investors feeling like, well, maybe we don't want to get too overexcited here. Good business, but very capital intensive. Going to be capital intensive for the foreseeable future. Has some real challenges to overcome as far as the supply chain goes, and it deals in a commodity product. It does happen to be a commodity product that is very necessary, because in order to do AI build outs, you need memory. You must have memory. And the advanced memory, that the HBM stuff, the high bandwidth memory stuff that Micron is working on, is highly attuned to the need in AI. So they're fairly well positioned. They just have a commodity product and they have investments to make. And so my feeling on this, Asit, is they're nowhere close to harvest mode. And does that mean it's a good time to be buying? I'm willing to just kind of keep waiting and watching. This is one that I've never fully gotten my hands around and felt confident with, and I'm still not confident. That's not to say it's a bad business. It's just I don't really know how to make a great forecast here and feel confident like, yep, this one's going to be a winner for me. I just don't have that confidence. Your thoughts on Micron? Oh, are you muted?
Excellent walkthrough, Tim. There are a few companies, just looking out through this semiconductor landscape, that are expending that much in capital expenditure. We saw that $7 billion number. And so that's really interesting. It's the first thought that crossed my mind. They're really in build mode. So there's a yield out there in the future for them. And there are two ways to look at this. NVIDIA just had its GTC conference. They were talking about moving up from HBM 3E, which is just a year ago, was like the most advanced memory that companies like NVIDIA were going to incorporate into their GPU structures, now to the next generation, which is HBM 4E. I don't know if there's an E after that, but let's just call it HBM 4, which is going into Vera Rubin, their next generation chip. And we heard Mark Papermaster last year. I think he's the chief technical officer over at AMD. That's his title. Also talk about the importance of high bandwidth memory to the future of AMD. And AMD just got a nice order from Oracle. If you saw Oracle's latest earnings, that tens of thousands of GPUs that are dependent on HBM memory. So there's one side of the coin, which is, hey, the future it's looking okay. They're going to build out so that they can supply the demand. There, a couple of pockets of risk are just, one is it, I think, sort of a question I've asked Tim before. I think maybe the last time we were on, we've thought about, which is, okay, is there a point where customers outrun the need to upgrade every generation of NVIDIA's GPUs? And they're coming so fast. I was just thinking about this
every year.
In the context of AMD now, which is trying to keep up. They're at their MI 3500 series accelerator, but the MI 4 series is coming out, 400 series is coming out in 2026, which will compete with Vera Rubin on a rack level. So I had this little bit of question in my mind about the timing of supply and demand in this industry. All in all, I think you'd rather be Micron in this competition between memory makers, where you're one of the preferred vendors of what's right now not as much a commodity memory as the DRAM is, but it will be someday, right? This will just move up now, and at some point that becomes commoditized. But that's where you want to be, and you want to see them building as an investor if you're invested. So I think the tone of voice I hear from you, Tim, is sort of spot on, which is there's opportunity here, but you really want to just watch this stuff evolve, because you might get some hiccups in demand for their product if customers stop balking. And we also have to follow something else Tim and I have talked about is the prevalence of, for some workloads, companies like Amazon Web Services, Microsoft Azure, increasingly turning to ASICs, so just single purpose chip complexes that can do some of these AI workloads at a cheaper cost for customers. Not going to replace GPUs, but you'll see cycles where these chips will provide that alternative for those who are buying AI workloads off of the big hyperscale providers. And that news cycle will be a little bit of a headwind for GPU demand. I will point out here that we haven't really been through many of these ASIC cycles, and it's very possible, because they're so purpose-built, Tim, that you'll have a faster replacement cycle. Amazon will have to replace those ASICs a little faster than investors expect. It might not be the magic bullet for them ultimately to consistently offer cheaper workloads. Time is only going to tell with a lot of this stuff. So I really like the way you've presented this, that you want to see Micron investing. If you're a Micron investor, you should feel sort of good that they're putting their capital to work for what they produce, which ultimately is a commodity product, but one that's going to be in demand for a long time. But don't be surprised if there are some hiccups in the stock prices. I think this is going to play out over a couple of years. There'll be some volatility in between, and that's been the story of Micron in recent quarters, at any rate, hasn't it, Tim?
Yeah, it has. And if you were to do a valuation on this, and maybe you can deal with this in the next hour, what you would want to do is you take that, the trailing 12 months cash from operations, and you would look at the depreciation and amortization and maybe strip that out to get to, and Tom King is the one that had me thinking about this. And I think it makes a lot of sense. Like if you stripped out the depreciation and amortization, what is the core CapEx? Like what's the maintenance CapEx? And the answer is it's probably a lot less than what that CapEx number is. Like you take the core CapEx, subtract depreciation and amortization, and that's probably what your maintenance CapEx is. And I bet it's a lot lower than what, Micro, like they are. I would guess, Asit, that like 80%, somewhere in there, of the CapEx that they are laying out right now. So in other words, fools, like $7.2 billion over the first 6 months of the fiscal year, $7.2 billion in capital expenditures to build up the company, build up hard assets for the purpose of growing the business. So how much of that, this is what we mean by maintenance, how much of that is like replacement cycle stuff? They just have to do this every year or every couple of years, just because that's the nature of this business. And how much of it is like opportunistic, new, it's pursuing new business ideas, or what we call growth CapEx. Maintenance, growth. I would say 80% of what we are see Micron spending, I think it's growth CapEx, Asit, because they're going after a market that they believe is going to be expansive over the next several years. So at some point, in order for the thesis to play out, so how you think about this, somebody asked the question like about Pure Storage. I don't do a very good job of following Pure Storage, but Pure Storage or Micron, I don't have a good answer for which one I would take, because both are, I think, in some ways sort of chasing commodity businesses here. You do need more solid state storage for, handling more data in an AI intensive environment. And that's a good situation for Pure Storage. So are they better positioned, or is Micron better positioned? It's a good bet that both of them are making growth CapEx type of investments here. But if you were going to do some kind of valuation work, what you'd want to see is like at some point, this growth CapEx is going to start drawing down and you're going to get into some kind of harvest mode, at which point the valuation's going to reset and be like, wow, okay, yeah, there's a massive cash generator and the stock gets bid up. I mean, I don't know. It may take a while for that to happen. We don't really know.
So Tim, hopefully I'm not on. Good. Did I mute myself
you're
again?
good. Yep,
yeah.
you're good.
So, I would come at it a slightly different way than Tom King was, but at the end of the day, I would be fine with those rough numbers. The interesting thing about Micron, which I learned from being a little bit more familiar with Lam Research, is the tooling for these companies, the CapEx that goes into the actual machines. Those machines actually last a long time, more than you would expect. It's not like if you look at the rest of the landscape, a data server, which might have a 5-year life cycle or a 7-year life cycle. In some cases,
less than that.
Yeah, or less than that. In some cases, less than that, right? So this way you can also just look at the notes and their financial statements and see what the balances are split between. And there is, I'm looking at, of course, I'm getting this from the annual report. So this is way back in August of 2024, like way back, but still there's about 71 billion in equipment, Tim, which is of a slower depreciation. But then you've got about 3.4 billion in construction in progress. And I'm guessing that number is appreciably bigger today. Some of that 7 billion is going straight into there. So there's a way you can sort of extrapolate just from the notes there, how they're investing. And again, I think as an investor, understanding where that money is going, what the time frame for the yield is important, because you're also playing, again, to bring up the C word, you're playing a commodity cycle, and these businesses are cyclical in and of themselves. Almost every business that I've looked at in this space, you have to strip away the AI potential from the usual cycle that they're exposed to. And DRAM has its own cycle. It used to be that's what you looked at first. Okay, where's Micron relative to the DRAM cycle today? And that still exists, but with so many businesses, we think first in terms of trying to understand the AI component. Just as Accenture, that's actually the first thing that I'm sort of curious about. They're investing so much in AI. Is that really growing? And it is. In Accenture's case, it's still a fraction of the total quarterly revenue. I think it was something like $1.4, $1.6 billion in AI associated revenue this past quarter.
1.1 billion.
1.1
billion for the first half of the year.
Okay, so versus what's quarterly revenue? Something like 16, 17 billion? So I should look it up. Tim knows so many things off the top of his head. I should not lean on him to pull numbers out of the thin air, but let's just say it's fractional, but that's what investors are looking for first in many of these companies that have a relationship with the AI space.
For the 6 months, it was 34.3 billion. Okay. So it's a very small fraction. It's good. It's growing. It's like doubling, but it's still a small fraction.
Exactly. But my point here being that I do the same thing. I look first out of curiosity and trying to see where growth can happen at the AI part of the story. Same with Micron. And it's a nice story. It's just picking apart, as Tim just did, what's the part of this spend that's going to that future growth that they're going to get a yield out of. And I think layering onto that, understanding underneath that, suppose that this demand wasn't there, where are we in the rest of that cycle? Those are the sort of some of the nuances that maybe this is why neither of us have really embraced this business model and are intimately familiar with it, Tim. It's a lot of work when there are other businesses that it's sort of a clearer analysis of how they might get a yield or when that might happen. Perhaps it's the cyclicality of that underlying business that for me is putting some hedge there.
That's what I want to double underline here. And then I've got a bonus. We can get to it, but I don't want to. I want to come to the questions. And then if the members are clamoring for the third, I'll do the third. but otherwise we'll get to the questions. But just to make the point about this, to contrast these two earnings reports that we just talked about, Accenture is not a cyclical business. Accenture has been a consistent performer for years. It has been an essential partner to large businesses around the globe for decades. It raises its dividend by 15% just about every quarter. I can't remember the last time it didn't raise its dividend 15% year over year in a quarter. That is extremely valuable. That is the very definition of a slow and steady, but highly resilient business. So if I can only use myself here, if I were in the business of like, I would like to get a defensive stock to give me some stability and some kind of anchor my portfolio a little bit, make sure I get some dividends at the same time. This is for my money is one of the great ones for that particular purpose. Micron is trying to surf a cyclical wave of AI demand, and it's doing a decent job with it. But the amount, the issue for me and why I find it hard to evaluate is the amount of capital that it must reinvest to harvest really strong cash flows that would justify big increases in its valuation and returns to shareholders. It's really hard for me to evaluate. So one, really rock solid, Accenture. The other, really, really volatile. Neither is a bad business, but I prefer the one that is really, really rock solid. That's the point I wanted to make about this. I'm not intending to slam Micron here. It's one that I find hard to evaluate. Go ahead, and then we'll get some. We'll get into some questions.
Totally. I see we already have 2 votes for the third report. So I think there's a place when we think about this just to consider allocation. Maybe not Micron for me, but then I can think of other companies where I'm taking a little bit more of a commodity cycle risk. But I gravitate myself, Tim, towards propositions that I understand better. I feel like probabilistically I'm right. If a business has high returns on its invested capital, I love to see free cash flow.
Sure.
There are not a lot of questionable flags, then I'm going to just shift more money there over time in my portfolio. I'm going to invest in companies that I don't understand as well. I'm going to take some peanut shell investments, follow some along, and I'll even, place a few wagers on binary outcomes. But the magic of it in trying to have a good investing outcome is understanding how you're allocating your money. Yep. And so for most of us, that means anchoring on the companies that we really understand and we can see a clearer path towards consistent generation. And we should never underestimate the high ROIC boring businesses. Some would call Accenture that. We shouldn't underestimate that because over time, those are the ones that, as Tim was just showing you, give you a bigger stake for your share of ownership in the earnings through their return of capital activities. So yeah, I'm of the same mind. I do like risk. I won't deny it, and I like growth, but it's a whole puzzle picture that you put together over time. So we can move on to some questions, Tim, and also
we can
let's do this. Let's answer some questions, and then everyone wants to hear the third business.
Yeah, it's fine. We can get through these relatively quickly. 26 minutes ago, we already answered this one from Besties. Outlook for Pure Storage. I just don't have a great answer to that. Is it Pure Storage or Micron? I'm neither one of them. I have evaluated these Besties, and I've not been willing to pull the trigger on either one because just some of the volatility and unknowns. They are great businesses in commodity markets, and I don't have enough good insight on how long these commodity markets are going to extend such that it's really going to drive serious tailwinds for both these businesses. So for me, at the moment, it's a neither, but we could take that one down.
I'll chime in on that one.
Yeah, go for it.
and I'm going to lean Pure Storage.
Okay.
Then this is another thing about investing is you can be ambivalent about a company and still buy shares if there's something in it that you really like. So we have Pure Storage on the Stock Advisor scorecard. We have a real advocate on the investment team, Yasser. He's very much in favor of this business.
Yeah, I know he is.
Yeah, I feel net positive about it, but I am ambivalent. And one of the risks we discussed a lot was the fact that over time, flash memory is a commodity, even though Pure Storage has a different approach to flash memory versus all its competitors. And it has something that's very Arista Networks-like in that it utilizes software to provide part of the solution, and it does that very well. Of those two businesses, I personally feel more confident in Pure Storage just because it has more of a, I think, scaling demand in front of it. It's been working with some hyperscalers to prototype its products and then expand those within data centers. They're finally proving out some cost of ownership, total cost of ownership, or TCO propositions that have been there for a while. Doesn't mean there aren't commodity risks and cyclical risks with Pure Storage, but I just understand that one and can see those outcomes a little bit more clearly than I can with Micron. Now, over a period of 10 years, as I evaluate more information, could I start to see Micron's eventuality more clearly? Sure, it just is not so convincing to me just now. So I would slightly lean Pure Storage on that, and that is a recommendation that Team Rulebreakers made on the Stock Advisors side of the scorecard. And Tim, there's a question about Amazon here too. I'd like to take a quick stab at, and
sure,
eager to hear your thoughts as well. Matt says, for a company that doesn't currently do any buybacks, is Amazon overly dilutive? I'm seeing that Amazon's share count is up 2.18% on a year-over-year basis. And Matt, this is one of the few companies that I follow that tends to be dilutive, that I am willing to live with it. I think that Amazon has demonstrated something that some companies that I see that do a lot of share-based compensation dilution don't do, which is that they allocate it very well. So the compensation that they spread out really goes to a lot of engineers. Yeah, does the C-suite get some nice stock-based comp? They do. But there's a yield on that Amazon really seems to churn out. And when you stretch out the dilution over the long term, market capitalization is always well in excess. They've diluted share count by like 12%. I was just looking at a graph over the last 10 years, but the market cap has grown well in excess of that. So I guess I would begin to worry if over time the returns that Amazon is able to deliver start to diminish. And then I'm getting into a situation where that bit of share count dilution just isn't working in my favor anymore as a shareholder, because the price is more static, but the share count is going up. I'd be more concerned there, but I like your question. It's perceptive. We should apply it to businesses that we own, and we should ask those tough questions. Okay, if you're diluting me, the person that's getting those shares, are they increasing the value of the business or not? That's an important question to try to get to the heart of.
Yeah, you need to, every time you dilute, you are creating a growth anchor. And so you have to outgrow that anchor. So think of it this way. You are sailing and you have the sails open and they aren't with the wind. That's what's happening. So that could stop you from going where you want to go. You would prefer to have the sails with the wind. It's not like you can't do it. If the sails are not with the wind and you have a motor on your boat, you're like, well, just kick in the motor and I'm going to get where I want to go that way. You just need growth. You have to be able to outgrow the anchor that you are creating. All right. So quick one from Patricia. Please, Patricia, tune in to the Retirement Hour with Robert Brokamp and Dan Caplinger. Bro and Dan are expert at these type of questions. I would also encourage you to go to the game plan part of your Motley Fool membership, the site. Go to game plan. There's lots of great resources about Social Security. And then beyond, I love Neil. And so if Neil's got a great answer on Micron, I think you should pay attention to that That's my opinion. I just don't have the answers, and I would bet that Neil has better answers than I do. So I don't know that I'm a bear here. I just don't know that I know enough to model this out. And if Neil does, I am super curious about it. So that's just for what it's worth. And then another, I'm rapid firing here before we get to the third report. I'm going to make a statement about, so it's not like you can't ask me about this business again, but I'm going to make a statement about this business so that I make it clear how I feel about it. So we're talking about Sports Radar and about analytics primarily for sports gambling is my understanding of it. Now, somebody convinced me otherwise. If Sports Radar is not about analytics for sports gambling, if it's not, great. This is one of those where I think I have arrived at, folks know I like my sports ball. Asit, I hate sports gambling. And the reason I hate it is not because it isn't fun or that it isn't interesting, but I think it's just really bad for people. I think it does a lot of damage. And you are welcome. I am not going to judge you. If I should never judge anybody about anything. So if you think this is perfectly acceptable in a great industry and you are fine with it, go with God, son. You are free to do so. This is a free country and this is American capitalism. You are free to do what you want, to put your investment dollars where you want. I don't think this one's for me, Asit.
Yeah.
I just don't think it's for me.
Tim, I will say the same, that one person's sin stock is another person's golden goose egg.
Absolutely.
And I don't really prescribe to anyone what they should invest in, and I hope there's no one out there who's trying to prescribe to me what I should invest in. On a personal level, I get really queasy around stocks that promote gambling because here's the reason, folks. Technology today is so different than it was when we're thinking in gambling in the 20th century. I was pumping gas, interestingly enough, in a really urban neighborhood, lower income neighborhood, and the screen on that gas pump, they play videos, was promoting some educational lottery in North Carolina. You wouldn't see that in the more affluent neighborhoods. That's not what I see when I pump gas. Not that I live in a super affluent neighborhood, but in my neighborhood, I don't see that. Also, college students, I think, are targeted because of the ease with which you can reach people and say, hey, here's how you can have fun watching sports. Gambling is addictive. And just as social media is really hard for us to grapple with in this day and age, I think, too, the tools are making it easier and more addictive to gamble. And that's just, my own personal perspective. But there are investments out there, too. And I have analyzed these companies with fools who think, and enjoy these business models. That's part of my job, and I don't mind analyzing them. I know I've talked with Nick Seipel. It's been a few years now about different companies that promote gambling. So this is not to say that you shouldn't do it, but I also want to just say, for me personally, with anything in life, folks, try to do things in moderation. We're a community here, so Tim and I are gonna give you some love sometimes. And if we're old men and call it some things we just want you to be careful around, humor us.
Yeah.
Say, okay, Grandpa, I got you. You can go back to your app and place a bet on that basketball game. That's fine. Listen to some old men for a couple minutes. It's a few minutes out of the hour, and we can keep moving with that.
You are free to say, okay, Gen Xer, move on.
Right.
All right. So quickly on this one, Matt, we can always talk about this one later if you want to. As far as his principle of adding winners, would it be fair to say that David G was almost completely oblivious to a stock's valuation? No, I don't think that's fair at all, Matt. Sixth sign of a rule breaker around considered overvalued by the financial media is absolutely a quest to understand valuation in the context of this stock, trying to understand whether or not there is a genuine price dislocation available in this stock. So no, I do not think that is even remotely fair. It's just that David's view of understanding where a price dislocation exists is not the same as running your standard DCF or reverse DCF. It is understanding what does the market think about how much growth there is to be had here. Does the market think like we do, that there's a lot of growth to be had, or is there a lot of skepticism? And we like to move in on the skepticism as it relates to rule breakers. So in that sense, that is the value side of the rule breakers equation. Okay, so we've got an Ask Us Anything in a few minutes here. So that is going to be Brian Orelli and Dan Caplinger. Let's go to I have no screenshots for this one, but the third one is Five Below. So this is our third report. This is our bonus report. I'll be fast on this one, Asit. Stock was up 4% for the week because the guidance was better than what they expected. And they've done the work of kind of getting through the bad period here, like comp sales. And there were some numbers that were not great for Five Below. Let's be clear here. They had $20.5 million worth of write-off of inventory. For those who don't know, Five Below is a discount retail store. The gimmick there is items for $5 and below. So $1 items, $5 items, a lot of novelty stuff, a lot of stuff made by Five Below. Has been a popular store in the past. It's gotten absolutely murdered as a stock over the past couple of years because just things did not go well. Some of their merchandising, they tried to sell slightly more premium products. They're getting back to their strategic knitting here, Asit, and doing a little bit better. Comp sales down 3%. Of course, there was an extra week in the period last year, an extra sales week. So take that with a grain of salt here. They're going to focus on the $1 to $5 price points and raising the bar above $5. They really don't want to do that very often, and they got to be really good products that they believe in when they're going to do that, is the message they gave here. They are assuming about 100 basis point impact from tariffs for the full year. That includes some selective price adjustments, some negotiations, and diversification. So they are trying to mitigate that presumed impact from tariffs. So about 100 basis points. Honestly, that's not that terrible. All things being equal, that is a percentage point. And retail, that's meaningful, but I think it could have been worse. If that's where they are navigating, I think that's decent. They also have gotten some decent results, and they're focusing on really sharply reducing shrinkage. In other words, shoplifting, like product that goes missing. They've had some real success there, and that's a good sign. They believe that they can get some real leverage there in terms of their positive adjustments in shrinkage in the back half of 25 and into 26. Good news. So overall here, this is a company that is still very much in turnaround mode, but all things being equal, not bad. I mean, honestly, not bad. And I'll say this, for the fiscal year, this includes everything. I'm stripping out everything, including the stock-based compensation and all of your share buybacks as well, which may be unfair, but everything, you still got roughly $51 million in free cash flow. They're doing fine, Asit. They're not doing great. They're still in turnaround mode, but this is a company that's got a decent balance sheet, is generating free cash flow, is getting back to its strategic knitting. I would not. This does not convince me that I should be going out and getting ready to buy this thing right now. But should I feel a little more positive than I did? Yeah, I think so.
A discount type model that can survive in this prolonged period of higher interest rates and inflation is one that's sharpening up its bona fides for when things get a little bit easier for these models. We never realized it. Yeah, we didn't know it, but like dollar stores and discount stores are a cyclical business. Just we hadn't seen much of any movement in interest rates for like a few decades, but they're in a cycle actually. So I admire the models which are figuring it out as they go along. It's a tough time to invest in these models, but what you mentioned about shrinkage says a lot to me. Just getting that under control is actually more difficult than it seems.
Yes.
Just ask companies like Target and Walgreens. That's the example I was looking for. But anyway, with that, it's 5 p.m.
It is 5 p.m. So, fools, please stay tuned. We have a round of Ask Us Anything with Brian Orelli and Dan Caplinger. Brian's got a pretty impressive. I mean, he's got a good show coming up tomorrow. I'll let him. Yeah. I'm not gonna tease anything. Brian can tell you what it's all about here. But very interesting show coming up tomorrow.
Not to miss.
I mean, speaking of old guys, we're passing from one set of old guys to another set of old guys.
It's a young looking group,
Gen Xer, whatever, yeah. No, let's move on here. Thank you very much for tuning in to our earnings hour. Thanks, Asit, and Fool on, everyone. Go ask Brian and Dan all the difficult questions.
See ya.
I don't know if you caught that. They were before I think you ended up backstage. They were talking about how they were old and complaining about they were ranting, I guess.
Geez, I bet they can't. I find myself having to curb that impulse as well with a lot of things, actually.
Yeah,
and not always succeeding, I have to say, but part of the aging process, I guess, Brian. So always good to have fellowship with people who can understand what you're going through, for sure.
Yeah, and speaking of fellowship, I've got 25 years under my belt.
Congratulations,
tomorrow.
man!
Yeah, 25 years of being a fool as of tomorrow. So I'm throwing myself a party in the 5 o'clock hour. So this hour tomorrow, if people want to come and hang out, I'll be answering questions about what it's like to be a fool for 25 years.
That's amazing.
A member, I haven't quite been working for the Fool for 25 years, but I joined as a member when I was in grad school. So, got another 8 or 9 years or something, 7, 8 years till I'm 25 years of being a contractor, at least with the Motley Fool. So
it's always interesting. I was the same way. I was a member for a few years before I started doing work with the Fool, and it's an interesting journey to see things from all sides of the coin, from the member coin side and from the sort of internal side and everything in between. So I'll look forward to hearing the stories that you tell tomorrow, Brian. It should be a good show.
Yeah. So I got one that from 2 days ago that we could lead off with. MH asked any thoughts on Biogen. The ticker is BIIB. And so this one's been, of the big biotechs. So let's say Vertex and Biogen and Amgen and AbbVie. So not quite pharmaceutical companies, but not small biotechs. This one's been a pretty poor performer. And it hasn't really done that great. So let me share my screen here and we can look at the performance over the last few years. So they were really into multiple sclerosis and they got outperformed. And so the company, the sales of their multiple sclerosis drugs really had a hard time. I don't think it was so much that they went into a patent cliff as they just weren't able to sell much. So, if you see the growth, there was some sales decline here, so we're looking at negative 24% year over year growth in sales here. But for the most part, over the last few years, it's just been like you know, a little bit of a decline, but just enough to, you know, it's hard to grow your revenue, grow your stock value when your revenue is in a negative, you know, even if it's only slightly negative. It's just your valuation just isn't going to change. Your valuation and your stock isn't going to change that much. I don't even have price on here. So let's see so the price is now in green. So you can see, you know, it got it, you know, was in, you know, upwards of the 400s, and it's down to 140 right now. And you know, the price to sales ratio and the has come down just as quickly as they, you know, because they're just, I mean, it's sort of surprising that the price to sales ratio didn't drop nearly as much as it has, because, you know, the revenue has actually gone up, you know, slowly. The revenue growth has gone up and the price to sales ratio has actually gone down. So, you know, I mean, I guess you could say this is a better value at 3% growth and 2.125 price to sales ratio. I mean, that's certainly cheap compared to when it was growing at -4% and its price to sales ratio was, you know, between 3.5 and 4. So, you know, but I still, it's not super exciting to get you know, I'm not super excited about 3% growth. I think I would, you know, if I'm going to buy a biotech, you know, in a drug company, I'd like to see, you know, at least high single digit growth and preferably, you know, into the double digits. And so I'm not super excited even at this level, even though, you know, I think you could argue it's really, really cheap right now at a 2 price to sales ratio. If they could keep this at, you know, I mean, if they could grow this a little bit more, you know, the revenue, the price to sales ratio would presumably come back up. And so that would, you know, they would have the benefit of growing revenue plus the benefit of a higher valuation multiple could result in outsized returns. But I mean, I don't know that I really feel comfortable buying right now at this, you know, even though it in theory, it looks cheap right now.
Yeah, these companies that have, I'm going to call it non-standard growth patterns, it seems like the market has some trouble coming up with a consensus valuation for them, just because, you know, there's so many companies out there that are in demand where you have high levels of growth, and yes, the growth slows over time, but it still doesn't slow to this point. Then you have mature companies that can see ups and downs in revenue and ups and downs in profits. And, you know, compared to some of these small companies, their businesses are relatively stable, they're somewhat predictable. And yet it is hard to get too excited about them because, you know, you know what you're going to get. There's not that kind of unlimited upside that you seem to have when it comes to companies that haven't yet fully established themselves. And on the other hand, you still have some of the same risks that you have with any company: exposure to macroeconomic issues, exposure to company specific threats, that kind of thing. Just kind of gets difficult to go through.
Yeah. I mean, you know, Biogen was a fairly fast grower, although even then it was, I guess it's been sort of up or down in terms of the growth. But they were, you know, growing in the, you know, closer to, you know, fairly fast growers back when they were launching their first couple of drugs. It's just now that they've sort of matured at this point.
Yeah. Let me grab a question from a couple hours ago. Ed asked, when the stock price of a real estate investment trust starts going up due to interest rate cuts, is the dividend reduced? So Ed, let's take this from two perspectives. From one perspective, when the stock price of a real estate, if interest rates go down, often the stock price of a real estate investment trust will go up because the stream of dividend payments that REIT makes looks more attractive in a lower interest rate environment. The reason for that with real estate investment trust, for the most part, is that the stream of income that comes from rental income that the REIT receives from the tenants who lease out the properties that they own, usually that is either stays fixed or it is subject to escalation clauses in the contracts, in the lease contracts that REITs sign with their tenants. And so ordinarily you don't see a reduction in the amount of income that REITs will get, even in an environment where interest rates may be going down. Indeed, really the thing that you're looking for with real estate investment trusts is making sure that their properties are high enough quality that current tenants renew their leases. Best of all, if you can renew them at favorable terms to the REIT. And when vacancies inevitably do come up, that the REIT is fast to fill them, to find new replacement tenants, those properties enough in demand, not so highly specialized that nobody else but the original tenant would be interested in them. If that income stays the same, then you would not expect a dividend cut. You would expect dividend payments to remain stable, or again, if you have escalation clauses in the contract, perhaps even go up. The question to ask, though, is when you're looking at dividend yield, just bear in mind dividend yield being the amount of dividends the stock pays out divided by the stock price of whatever the stock or the real estate investment trust, whatever investment that you're talking about. If the price goes up, if the price of the stock goes up, but the dollar value of the quarterly dividend stays the same, then the dividend yield will go down. And so when you look at the yield, you'll see, oh, price went up. Oh, dividend stayed the same on a per share quarterly basis. That means that my dividend yield has gone down. It does not mean that the REIT cut its absolute dividend. It does not mean that if you have exactly the same number of shares that you won't get the same or even potentially a higher amount of dividends. It just means that compared to the market value of your position, whatever dividends that you are getting, it is a smaller percentage of that. Again, simply because the value of the shares that you own went up.
All right. And I guess we should pitch that, if people want to ask us questions, get them into the Slido. The code is Fool24. This was asked from Sadaf a day ago. It was asked to other people, but I think we can maybe go for it. Any potential five baggers in stocks in the next 5 to 10 years that you're excited about? So, I mean, I think that, to get a five bagger in 5 years, I think, requires the market.
The math.
Yeah, the market to be, completely missing the current valuation. And, I mean, the expectations have to be either really, really low or they're just, not seeing the potential, right? I mean, it's either they're really, really low and or it's high and they're actually, it's, technically going to be higher. So I think that's a really hard question to answer. I mean, like, I think Moderna is probably undervalued right now at its current valuation. It's got, and in 5 years it should have a couple more drugs on the market. And so if those drugs are multi-baggers or multi-billion-dollar drugs, then, let's say they might have, 10, let's say they might have 5 billion in sales in 5 years. And so if you figure they're going to have an 8 price to sales ratio, that's a $20 billion company. Did I do my math right? 8 times 5, $40 billion. $40 billion company, for 8 price to sales ratio and a $5 billion sales, which I think is reasonable. And they're at 14 or 12 or something billion. So that's not a 5.
That's a 3x, right?
Yeah. I mean,
I'd
be perfectly happy with that. So
yeah,
I mean, I don't know that you really want to be, investing in. I think the companies that could potentially be 5 baggers are also companies that could potentially be negative return on investments. That they're, if the investors if the current investors are right because they're valuing it at this price, then it's not going to do anything, and therefore it's going to not be a 5 bagger. Which, if they're wrong, then it could be a 5 bagger. But I think that you have to be realistic about your potential growth rates of companies. And I mean, I don't know, I mean, there certainly are companies that turn out to be five baggers. I think they're more likely, they're the ones where investors have high expectations, and then the expectations become even higher, and therefore they, end up being oversized returns. I think also maybe they get to the point where they're so that there's over exuberance, right? So their valuations, to get to a five bagger in 5 years, you probably need there to be a valuation change to the over exuberant side of the valuation, where it almost makes sense to sell at that point, because it's become overvalued compared to what the potential of it is at that point 5 years from now.
Yeah, 5x in 5 years is a 38% average annual return each year for 5 years. 5 bags in 10 years, a little bit more reasonable, 17.5%. We've seen that in some of the major market averages. I can't remember what the NASDAQ 100 has done over the past 10 years, but it's pretty close to that. And that's an extraordinary period. I wouldn't count on that happening every decade, but it can happen. It's just not something that, I think that this is an area where the foolish mindset of having a diversified portfolio of 25 or more individual stocks really plays in, because you can have ideas, you can have good conviction about, a pretty large number of stocks and their potential to generate these extraordinary returns. And yet not all of them will. In fact, I'd hazard a guess that most of them probably won't. Most of them will have, more modest returns, and some of them will lose money. But if you get just one or two that can generate these kinds of extraordinary returns, it really makes a big difference to the return of your overall portfolio. And so, it's like, yeah, I could come up with 25 names, but, I'd tell you that probably 20 to 22 of them, might not do a whole lot, or might see returns that are quite a bit less than, a five bagger in 5 to 10 years. That's for sure.
Yeah. And I mean, I think it's mostly, if you could probably pick 20 and you might end up having one or two, right? And so I think that you just have to, if you stick with that theory that I don't need to figure out which one of them is going to be the 20 bagger or 10, 5 bagger in, 20% change year over year. I just need to pick enough of them that they're going to be one or two, hopefully, that end up doing that, because again, because I think it's probably because expectations end up being even higher than the value, than the high expectations had already occurred. Some very David Gardner rule breaker type companies where they're, the valuation doesn't make a whole lot of sense, but you go ahead and, you just buy and hold your nose on the valuation, and it ends up going up even higher because the growth ends up being better than anybody actually expected them to.
Yeah. But like you say, I mean, to get that big of a return in that short a time, you almost need a transition from out of favor to one of these David Gardner style, it's like the perception has to change that much positively in order to get you over the hump for it. So,
yeah.
Susan B from a day ago asked, how do you factor portfolio income into your 5-year cash position guideline for people who are in or near retirement? So Susan B, just bringing everybody up to speed. Oftentimes when Robert Brokamp and I are doing a retirement show or a financial planning show, we will talk about a 5-year cash cushion for people in or near retirement. And the idea for that is, we talk about in the middle of your career having an emergency fund. A lot of financial planners will throw out 3 to 6 months worth of living expenses, so that if something happens, if you have a major repair that you need, if you lose your job, if some other unexpected financial expense comes up, then you're not in a situation where you immediately have to start liquidating investments, that you have that cash on hand that you can tap, that you can meet those needs, and give yourself at least a little bit of breathing room to figure out next steps if things end up being taking a little longer than that to resolve themselves. In retirement, though, things change because you don't have income, you don't have the ability to, and your time horizon isn't quite as long as it was earlier in your career. And so as a result of that, having that cash cushion around is very helpful because it means that you can cover a lot of living expenses without having to tap into your portfolio. And that can be extremely handy if you have a market downturn that lasts longer than some of the market downturns that we've seen lately. Think back to 2020. We had a big cascading downward move at the very beginning of the COVID-19 pandemic. But by the end of 2020, we were back up. We'd recovered all those gains. And so technically, maybe it was a bear market, but it didn't feel like a bear market. It felt like kind of a correction, a really deep correction that quickly resolved itself. Then 2022, a little bit longer, bear market lasted most of the year, but then you have really big returns in 2023, 2024, you're back at new highs and pushing way into new highs in relatively short order. And so there you can kind of see the value of having a 3 to 5 year cash cushion, because you didn't have to sell any stocks in 2022. You didn't even have to sell stocks at the beginning of 2023. And then you could wait for the market to recover. 2024, you're back at new highs. You can then turn, if you want to replenish that cash cushion, turn to that and say, hey, yeah, I'm selling some stocks, and that's fine because they've rebounded. We're at all-time highs. Everything looks good. And so the question, Susan, being, okay, yeah, but if you got 5 years worth of cash, that cash is actually generating income. How do you treat that? And the answer is that I think that what you can do with that is just basically say, when it comes time to replenish that cash cushion, you don't have to replenish it as much because you haven't spent it down as much. Because if you've been taking withdrawals from it, at the same time that you've been taking withdrawals, you've also been receiving interest payments on what you've gotten. And so, how much is that going to make a difference to you? You would expect that 5 years, if you have 5 years worth of living expenses saved up, that is 60 months. If you can get 4% annual interest rate on 60 months worth of expenses, 4% of 60 is going to be 2.4. That's 2.5 months. Every year that you have that money invested, you're getting basically 1/5 of your year is covered by the interest payments. And so that means liquidating less stocks when the time comes, and it gives you potentially extended period of time beyond the 5 years or however much you have saved up, gives you extra time on top of that. If the purpose of the question is, if the follow-up question would be, well, if I've got that income coming in, does that mean I can have a smaller cash cushion? And the answer is yes. Just be careful there to make sure that you take into account the possibility that interest rates may go down. Federal Reserve's been slow to reduce interest rates lately, but they are still anticipating cuts at some point in 2025. And that would reduce the amount of extra income that you're getting from that cash cushion, which means tapping more into investments when it comes time to get yourself back up to your full 3 to 5 year spectrum with that. So that's how I would suggest handling that portfolio income in that sense.
And so how do you think about people who are near retirement versus people who are in retirement? When do you start building up that cash cushion, do you think?
So I think you can be opportunistic about that too, Brian. I mean, if you're in a good environment where it makes sense to, where we're doing a quick liquidation of investments to get yourself up from wherever you have been up to that 3 to 5 year realm. If the timing is good, then that can be a useful thing. Just bearing in mind, obviously, if you're talking about investments in a taxable account, then you might want to take a more measured, kind of a more incremental approach to it. If you have a whole bunch of stocks that you're selling off in order to generate this cash, and those stocks are at substantial capital gains, you want to be careful and consider the tax consequences of doing that all at once, and compare that to the tax consequences of trying to space it out over a few years. And so, one other thing that I can suggest that people consider is if your portfolio is generating income even before you retire, and talking about all of your investment income, not just any cash that you have, but also your stock portfolio. If you have dividend stocks, for instance, it may well be, some people, they reinvest that money into additional shares earlier in their career, But when it starts coming time that you're going to want a larger amount of cash available, take those dividends instead of reinvesting and buying new shares. Just add those to your cash balance, and then slowly but surely you will start to accumulate a larger cash portion, and that will require less of a move as you enter retirement. It'll be less abrupt. You'll have kind of had a nice upward track over time that would eventually get you to that extended cash cushion.
Does the when you would start the cash cushion sort of depend on whether you're in a bull or bear market?
Yeah, that's kind of what I'm putting. It's kind of what I'm going at, is that depending on where you're going to be getting the money from. So, if you're going to be liquidating investments to get the cash cushion, then you're probably going to want, all other things being equal, assess the situation where the market is at any given time. On the other hand, if you know you're 5 years from retirement and you're in a situation that you're still earning a decent income, then you may not have to liquidate anything at all. It may well just be redirect the money that you would ordinarily have invested earlier in your life. You would have invested in stocks, take that money and put it in a cash cushion instead. And then at that point, maybe it's enough that you don't actually have to liquidate anything. You've built up that cash cushion the same way that you built up your investment portfolio over the course of your career.
All right. Kim, a couple of days ago, asked Matt, and I'm going to answer it for Matt. Can you comment on ARE, that's Alexandria Real Estate Equities? And so, I mean, Matt's obviously big into REITs. I'm not so much, but I do follow Alexandria Real Estate Equities because the company mostly invests in lab space. So they build buildings specifically to rent them out to small biotech companies, and even maybe some larger companies that need multiple buildings and don't necessarily have a campus in the different areas. So they have lots of buildings in San Diego, some buildings in quite a few buildings in Cambridge and Boston, and then I think they have some buildings in San Francisco as well, and they may even have some international business. But I think you got to be careful with this one because there's so many biotechs that are trading at less than cash right now. That tells you that the valuations aren't that great, and so their companies aren't going to be able to raise as much capital in terms of doing secondary offerings, because they don't want to do a secondary offering when their valuation is so low that that investors aren't giving them any, even all the credit for the cash they have, let alone the credit for their actual pipelines of drugs. And so I think we're going to see a shrinking of the biotech industry over the next few years. We've already seen it a little bit. We've seen quite a few reverse mergers where companies have, they have drugs, but they haven't been progressing very quickly, and they have tons of cash. And then there's a biotech that is a private biotech that needs additional cash to start to get into their clinical trials. And so what they'll do is they'll do a reverse merger where the company that has lots of cash but no real great assets buys the company that has great assets but needs cash, and then the new company changes its name and back to the name of the company that was purchased, and they start developing those drugs that were the promising drugs that needed the capital, and the things that are on the parent company end up getting put on the wayside and potentially sold off. A lot of times there'll be in these sort of deals, there'll be a contingent value rights where there's a company that the shareholders of the parent company end up getting a contingent value right that says, if we're able to sell off these assets, you'll get 90% of the value, and those will be paid out to everybody who owns the contingent value rights, and everybody who is a current shareholder before the reverse merger, will end up getting one of these contingent value rights for every share you own, and then eventually you'll get a percentage of the payout that if those assets are being able to be sold, and then you end up owning an entirely new company, and then you have to make a decision whether to hold on to your shares or just sell the shares. But I think going back to Alexandria real estate equities, I just think you got to be careful, because if there's some shrinkage, that's going to result in, that reverse merger is going to end up resulting in half as many biotechs for every reverse merger that ends up happening. And those companies aren't going to need lab space and, office space. And so they're eventually going to end up not needing, not being able to pay rent on that space, or letting the leases end up going off, the leases end up expiring, and then they consolidate into less lab space, and that will result in Alexandria getting hurt. So I think that you have to be careful with Alexandria in terms of the near term, whether the biotech industry actually expands in terms of the number of companies needing to rent lab space. There's also quite a bit of competition with some other companies that are also doing the exact same thing.
Yeah, that was kind of the question I was wondering about, Brian, was that, when you see biotech mergers, a lot of time the emphasis is on, in the press releases, the emphasis is on whether the programs are compatible, whether you're getting complementary exposure to, certain, treatments for certain diseases, things like that. I haven't seen as much as in other industries talking about synergy benefits and things like what you're talking about, where it's like, well, if company A's got a lab somewhere and company B's got a lab somewhere, and you come together, do you still need the two labs or not? And it sounds to me like what you're saying is that sometimes the consolidated post-merger company will say, yeah, we're not going to need that space. And so they'll come to Alexandria and they'll say, we're not going to renew our lease because, we don't need two labs, essentially, is what it comes down to. Is that consistent with what you've seen? Or?
Yeah. And I think a lot of times that'll sometimes happen with pharmaceutical companies that buy, the whole biotech company, right? So they'll leave them alone for a little while and let them do their own thing, and then eventually they end up getting merged in with the pharmaceutical company. And so if the pharmaceutical company is, Eli Lilly, and has their main campus in Indianapolis, then they're going to end up, the people are going to end up moving to Indianapolis. The program's going to end up moving to Indianapolis, and then they won't, then they won't need the campus in San Diego or Cambridge or one of the other, major hubs for biotech industries. So, of course, there's also companies that are getting formed, and there's still venture capital, funding companies, and therefore those companies are needing new office space. So there is some rotation, and so it's not, I don't want to make it as bleak. I don't want to make it bleak and like say, oh my goodness, the biotech sector is, going to hell in a handbasket. But I do think that it's a difficult time right now for public companies to raise capital, and when it's difficult to raise capital, it's difficult to expand, and therefore they don't necessarily need as much lab space and office space, and so that could hurt ARE. I mean, I think just on the synergy side, I think there's also whether there can oftentimes be synergies when a commercial company gets sold, right? So when there's a drug on the market and a pharmaceutical company buys that drug, oftentimes they can use the same sales reps that they're already going to see whatever specialty that drug is, and just that now they're selling one extra drug and promoting one extra drug to those specialists. And so there's some synergies there where it makes sense that it will cost the pharmaceutical company less than it costs the biotech company to market that same drug, and therefore the profits are better, and therefore the pharmaceutical company can pay more for the biotech than investors are giving the biotech credit for on a valuation standpoint. So, both can be right. The pharmaceutical company can buy it for 30 or 40% higher than the valuation is currently. And, the investors can be right in valuing it at that level, and the pharmaceutical company can be right at valuing it at the higher level just because of those synergies that can play into it.
Yeah. Let It Ride a day ago noted, tariffs are coming April 2nd. The stock market drops after tariffs are announced. Why not wait until after these tariffs are announced to buy stocks? Let It Ride. I hear what you're saying. I guess my response, and I don't mean to be too glib about it, but it may come off that way. If it does, I apologize. But nevertheless, I'm going to say it. Are you sure? Because, if there's one thing that I've learned in the past couple of months, it's that some things are unpredictable, and actions that have been telegraphed, sometimes they work out exactly the way that they were planned. Sometimes they happen, but in a different way than you might have expected. And sometimes they don't happen at all. And so obviously, if you knew that something was going to happen, and if you knew that the impact was 100% certain to be one way, then yes, you could take steps to take advantage of that when it happened. But it's not certain. Just because an announcement has been made that something is going to happen in a week and a half doesn't mean necessarily that it will in fact happen. There may be things that happen between now and then that lead to a different result. We have seen that with tariffs in the past, where a tariff was scheduled to go into effect and then it didn't, and then maybe it did for a minute and then it came off again. Maybe the amount was changed. So that's one thing. Number two is that just because the stock market has reacted a certain way in the past doesn't necessarily mean that it will react the same way again. In fact, it may well be that if a tariff announcement, people are now kind of used to the idea that tariffs may be coming in, and they have expectations about what those tariffs are likely to look like and how, what the percentages might be, what the consequential impacts would be on various industries. And so if the reality turns out to be different from those expectations, it may well be there's situations where the stock market might go up after a tariff announcement, because the tariff announcement, maybe it's a situation where the industry that was affected turns out that it's not going to be as adversely affected as people had thought. And so, yes, in that situation, well, maybe you would say, well, darn it, I got two of those things right. There were tariffs on April 2nd, and they affected an industry, but they didn't affect the industry as much as people thought. And so I was wrong about the direction of which way the stocks would go. And so, no, I should not have waited until April 2nd to buy. I should have bought now, and then I would be better off. In the long run, I don't think that these things are as important. And so I don't necessarily get all worried about buying a stock, whether I buy it right before an earnings report comes out, whether I buy it right before some external news event comes out, or if I buy it after. Like, it's 6 of one and half a dozen of the other. Sometimes that stock price is going to go up after I buy it. Sometimes it's going to go down. And yeah, you feel silly when it goes down right after you buy it, and you feel kind of good when it goes up right after you buy it. But I think if I went back and looked at my track record on that stuff, it'd be close enough to 50-50 that I wouldn't try to analyze anymore. I would just chalk it up to chance. And so, yeah, I just be careful when you see something in the market that looks like an obvious opportunity, an obvious profit winner. There's usually a reason why it isn't. And it doesn't mean that you won't win if you go ahead and follow your strategy. But there may be a risk of something else happening, and you may be assuming that risk in doing what you do. Again, doesn't mean the adverse situation will play out, but the fact that the adverse situation was possible justifies the fact that when things worked out the way you expected them to, that there was some sort of extra benefit from it in the form of maybe a higher share price or something like that.
I mean, the other thing is if it is 100% chance, right? Like let's just, I don't know, like
Sure.
if it is 100% chance, then it's going to be 100% priced into the stock by April 2nd already. So you're not actually going to get necessarily any benefit by investing after April 2nd, because in theory, the stock's not really going to go down on April 2nd because it's already priced into the fact that everybody already knew it, and it was 100% chance of the likelihood of success.
Indeed.
I think your answer is probably better, that it's probably not 100%, and that, who knows what's going to happen. And so there's some factor that's, factoring into that. And if you're wrong, then that could be an issue.
Yeah.
So Norman asked a couple 4 days ago, would you consider a firm that is strongly free cash flow positive and consistently reducing their share count as a dividend stock? So this is, basically I take this question as first of all, we could just answer it. Do you think it's actually called a dividend? Would you call it a dividend stock? I think maybe the broader question and the more interesting question is, which do you prefer? Do you prefer the company to give back their free cash flow in the form of a dividend, or do you prefer to give their free cash flow back in the form of reducing their share count? So I think my answer is maybe it depends. I think that if it has regular free cash flow that's coming out every quarter and there's not much variability between the quarter, then I think doing a dividend makes more sense. I'd rather have the cash and let me decide whether I want to reinvest it by buying back more shares or using that cash for some other reason. I think if there's variability in the free cash flow, and sometimes it's there and sometimes it's not, sometimes it's higher, sometimes it's lower, then I think it maybe makes more sense to let the company go ahead and reduce their share count by, which will result in a higher earnings per share, which if it keeps the same price to, earnings per share, then therefore that will result in a higher price, and I'll get price appreciation and value that way. So, I think my answer is it sort of depends, but I think that for the most part, I prefer dividends if they're steady, and if they're not steady, then I think it makes sense for the company to buy back shares. I think there's, obviously a third answer, which is that if the company is growing well, then maybe they shouldn't be doing either, and they should be using that free cash flow to invest in the company. And, the free cash flow doesn't actually exist. It just gets, they just increase their expenses more, and therefore, invest those in, research and development or whatever, increasing the size of the sales force to result in higher sales, which, eventually will result in more value, will create value in the company, and therefore the price will go up that way. So there's sort of two ways to generate additional value in a company. You can either reinvest it, or you can buy back shares and therefore have a higher earnings per share, and therefore have a higher value.
I wouldn't call it a dividend stock if it doesn't pay a dividend.
Yeah, I think that's
pretty simple. Yeah. And I get your point, and I think that there's probably a term for it. I can't remember. It's like there's some people that instead of using the dividend yield, they use, they take free cash flow, they take stock buybacks. Sometimes they add that together and they call it a yield. And I can't remember what they call the yield. It's like a shareholder return yield or something like that. And that can be, some people find more value in that because that measures, by one definition, that measures the shareholder friendliness of a company's capital allocation plan. And so, yeah, if a company pays no dividend but spends 10% of its revenue each year buying back stock, and has done so, year in and year out, then shareholders are getting a solid chunk of capital back every year, and that may be something that has a beneficial impact on share price, has a beneficial impact on earnings per share as share counts go down. It there are positive elements for a company like that. I just wouldn't call it a dividend stock because that would be confusing. And, it's like a lot of people, if I'd be curious to see what the returns of stocks like the one that our listener was talking about is compared to stocks that pay dividends, that have higher yields or that have track records of growing dividends over time. Because the businesses are the business performance can look roughly the same and be equally attractive. And it's just a question of what decision the company made about the method of returning capital to shareholders. So it'd be an interesting exercise to do, I think.
Yeah, I think a lot of times they're not necessarily buying at the best prices, right?
Sure.
I think if you do studies on these sort of things, that companies don't necessarily buy at the best prices. So, in theory, I think that it's probably always, it's almost, on an average, I guess it's better for investors to have the money returned as a dividend compared to buyback. The average buyback is not as beneficial to the shareholder as the average dividend is. But of course, if you're just going to go back through and buy back this, buy shares anyway, then it doesn't really matter because you're going to be buying it at the good prices and the bad prices.
Yeah. With the only thing being, in a taxable account, the dividend gets taxed, but the repurchase doesn't. And that's the interesting thing about it. And it's a big part of why so many companies do the stock buybacks instead of the dividends, is that their investors in taxable accounts are like, you're paying me a dividend, I'm just buying more shares, and I had to pay taxes on this. Why'd you do this? So, wanted to address a couple of questions we got, sort of related. It was a question, or it was a comment, and then it was a comment on the comment. So Matt, 22 minutes ago, noted that over the last 10 years, the Texas Pacific Land Trust, ticker TPL, has delivered average annualized total returns of just over 40%. Larry Fourcard Poker agreed and said, yes, I just looked it up. Unbelievable performance on Texas Pacific Land Trust, ticker TPL. Never listed as a Motley Fool pick. So I looked. It is not, you're correct that it is not a current recommendation at this time. I didn't have time to check the archives to see whether it had ever been a recommendation or not. But the point I want to make about this isn't really about Texas Pacific Land Trust. It's more about investing. And basically, here's the thing. There are always going to be stocks out there that you will miss. And they will go up, and you will not have identified them. You will not have purchased them for your portfolio. And you will be, some investors get very upset that they missed out on a stock that did well. But let me assure you that you do not have to find every single stock that has extraordinary performance in order to have the investment returns that you need to achieve your financial goals. There are myriad ways of getting yourself from point A to point B when it comes to investing. And many of them are mutually exclusive to each other. Many of them follow very different patterns. They don't own the same stocks. They don't hold for the same periods of time. They don't invest in they don't use the same kinds of accounts. We're talking about taxable accounts. We're talking about, versus retirement accounts. Many, many ways to be successful. You don't have to, you don't have to feel like you've missed out just because there is one stock out there that has done extraordinarily well, because it doesn't take very many extraordinarily good stocks to give yourself extraordinary returns. And frankly, it may well be that you never invest in an individual stock that, is a 100 bagger or, whatever it is. As long as you're getting average market returns on your portfolio, if you have the time horizon, if you have the amount of savings that are necessary, and your financial goals aren't overly ambitious for that, you can be successful. You can reach all of your goals. It just matters, you just kind of have to take what the inputs are and then figure it out from that. And so, I'll say, yeah, sure, the Motley Fool has not identified every single stock as recommendations, every single stock that has done well. And that's okay. You can still have a market beating track record, even if you miss out on opportunities like that.
Yeah. And I just looked at the stock chart, and, at one point in 2020, 2022, it was over $800. And by the middle of 2023, it was almost at 400. So, it's not, yes, it's done well, but it's also had, massive pullbacks that, some people can't stomach. And so, as you pointed out, there's more than one way to get through, to get to the stock market and end up, achieving your goals. And maybe, one of your goals is to not lose that much money. And so, you may not want to be owning that sort of type of company, because if you do, you may end up selling at that
exactly
down so much and never actually got to the point where you could actually, you could actually achieve those returns.
Yeah.
Besties asked 3 hours ago, China has made tremendous advances in innovation and production of pharma molecules. What U.S. pharma benefits the most from this boon in new and lower cost API? So API is the pharmaceutical ingredient, the active pharmaceutical ingredient. So that's the actual part of the drug that's doing something, versus the inert ingredients that just stabilize the molecule or make it so that it gets absorbed in your body or something like that. But otherwise, so the active pharmaceutical ingredient is the main thing. So yeah, I think there's a lot of companies that are using China-based contract manufacturers to develop to synthesize their molecules for both. They start off with a clinical trial partnership where they it's really contract. It's not really, it's a one-sided partnership where the company is using them as a contractor, and they're allowing them to synthesize enough of the molecule to run the clinical trials. And usually these are set up so that if the drug is approved, then it phases into a new contract where there's much higher rate of production, and they get the pharmaceutical company gets more of the drug. The other side of this, so I think every pharmaceutical company is going to benefit from that, and it's not just pharma; it's also biotechs. Biotechs arguably are benefiting from it more, because the biotechs can therefore make their molecules without having to invest in all this capital in production facilities. So very few one drug companies actually have production facilities. They're almost all using contract manufacturers, whether they're US based or China based. And China obviously, by keeping down the costs, forces the US companies to keep down their costs. And so whether it's being China or the US, I don't think really matters. There's some, potential political issues that could cause, China to be a problem, especially if we get, in a trade war with China, and if we end up, also just, end up, worrying about intellectual property in China and the US, and so if we end up sort of having those battles, that could potentially be a problem. And so maybe companies want to have a backup system where they have a contract in China, but they also have a contract in the US, and they sort of split the cost, the production. And then if they end up having an issue with their China contract manufacturer, they can potentially ramp up the US manufacturer, and therefore meet their needs, but also they've got this second one under contract to while it may cost them a little bit more to have the US one, it hedges the bets, because anytime a company wants to manufacture a drug, they have to get approval from the FDA. So if they go to a new building, even if it's the same company, same process, they've got to get reauthorized. If they want to change some minor way they manufacture the drug, because they think it, will result in higher yield or whatever, they have to get approval from the FDA. So this is all after the FDA has approved the drug based on the clinical trials. Then every time they want to change the manufacturing, everything from where it's manufactured to how it's manufactured has to get reapproved. And so obviously that would be a long process. If you ended up only having a China manufacturer and you just lost your China manufacturer, you'd sort of be stuck, and you'd have to go through this whole process, which could take maybe a year or something to set up a new one and get everything approved by the FDA. So you either have to have a year's worth of drug, ready to go, or to reduce your risk, or a lot of companies are doing this split thing where they have a U.S. manufacturer and they have a China manufacturer, and that allows them to lower their costs a little bit, while theoretically hedging their bets and not taking on as much risk as if they just went with a China manufacturer. The other issue here is that China is competing with us for not in the manufacturing, but in the discovery and trying to develop new drugs, and that's become has become more obvious over the last, let's say, year to 18 months. The number of deals coming out of China has just grown substantially. I think in January and February there were like 18 deals for drugs out of China that were discovered in China and then were licensed by U.S. companies. Oftentimes the Chinese biotech will hold on to the rights in China and sometimes all of Asia, and the U.S. biotech or U.S. pharmaceutical company will have rights outside of the to the rest of the world. So the large markets of the U.S. and Europe, and potentially also Japan, which is a fairly large market. And so the weird thing about this is that of those 18, only 3 of them went to large pharmaceutical companies. So there's a lot of companies that are going to China looking. They're like startup companies that don't have any molecules. They're not trying to go into the lab and develop drugs and try to discover them. They're going to China. They're maybe a serial entrepreneur, so they're able to get venture capital funding, guaranteed, that says, you're smart, you've done this before. Venture capital is going to fund this company that doesn't have any products, and then they go to China and they look for products and they find products that they're interested in, and then they license them and create a U.S. company based on these China molecules. And so that's a whole nother bottle that I don't think Besties was really asking about, but I think that's probably of the, if we're talking about competition for API lower cost and competition for new drugs that are going after possibly the same molecules, the same targets that the US companies are going after, that's going to be a big competition that they're able to generate. What they're doing is somebody's discovering a new protein is involved in a certain disease, and then the company, and then a U.S. based company is developing those drugs, and so is a China based company, maybe multiple China based companies, and even though the China-based companies is farther behind because the U.S. company obviously knew about this target before they published the information, they're now China is working so much faster, and they have so much more capacity to do preclinical tests that they're able to run these preclinical studies faster than the U.S. companies are, and they're actually able to gain on them in terms of their abilities. And so I've been to a couple of conferences, and a lot of the the advice that they've been giving to startups is don't publish, where it used to be that you wanted to publish and, you get your patents in order and then you'd go ahead and publish because that's what, academic people do. But now they're pushing back and not releasing the information on what their targets are for as long as possible. Eventually you have to, because once you sort of get into clinical trials, you sort of have to, but you can get all the way to clinical trials before you actually have to disclose your target. And so a lot of companies are keeping that secret just so that they don't have the Chinese companies saying, oh, this is a good target, we're going to go after it too, and try to catch up to them.
That's fascinating. And I didn't know all that about production facilities and making minor changes to the process and triggering a big regulatory event that, requires brand new FDA intervention. That is just, it speaks to, a lot of the time when you're thinking about current events, when you're thinking about things that can happen to a company and you think, oh, well, if we just change this one aspect, then it fixes everything, right? But so often there is something out there like a need for a regulatory reapproval that you just get to the point where like it's not that simple, and you may have a decision, you might think about a decision and it seems like, oh yeah, we can set that up in a month or two, and it's like, well, no, if you have to wait for a year to get the approval to go forward with it, then suddenly it may not work as well as you thought, and you may end up sticking with what has become a second best option just because you can't get the rapid movement that you would need to make what you consider your best option an actually viable option.
Yeah, I've seen people like on Twitter that have like posted like, I don't think they disclose what the companies were, but they said like, I did my postdoc and I figured out a way to increase production by 10%, but the company didn't end up doing it just because of the hassle that it would would require the, whatever financial savings they would save by being able to get a 10% higher yield in the product. The cost of manufacturing is so low compared to the gross margins are so high, right? That the cost savings is going to be minimal compared to the sales. And then you've got all these regulatory issues that you have to jump through. And so there's a cost associated with jumping through all those hoops. And so whatever those cost was didn't end up resulting in higher, those costs, upfront costs of doing that didn't result in higher, didn't justify the savings of the sales of the manufacturing costs down the line.
Yeah. Let me pause for a moment. It is 6 p.m. here on the East Coast, 3 p.m. on the Pacific Coast. And just want to wrap up this first hour of Ask Us Anything with Brian Orelli. And I'm Dan Caplinger, happy to be here with you. Let me just pause for that before we start hour number 2. And we are back. And it's... it's always good to do these 2-hour shows in a row. Always good. Fools, please do get those questions in. We are happy to be here with you. We try to have an extensive schedule so that whatever your schedule is, you can get your questions answered in a timely manner. We are happy to do that. Hashtag on go to slido.com and we are hashtag Fool24. I had a question lined up, and now that I've done up, here we go. So Amit Mehta asked a couple days ago, if someone wants to contribute to a backdoor Roth IRA, can they open a traditional IRA, depositing after-tax money, and then just transfer that traditional IRA money to a Roth IRA in order to take advantage of tax-free growth? I mean, you just described perfectly the backdoor Roth strategy as it works for most people. And it is a 2-step process. Bearing in mind, the reason that you're doing this, you might ask, well, why the heck would you do this? Why not just contribute to a Roth IRA? And the answer is that there are income limits above which, if you make too much money, you may not make a direct contribution to a Roth IRA for that given tax year. You can always make a traditional IRA contribution. What you cannot always do with that traditional IRA contribution is deduct the amount that you contribute. Again, income limits, different income limits, apply for deductibility of those IRA contributions under certain circumstances. But even if you make a non-deductible IRA contribution, there are no income limits on converting that newly formed IRA, traditional IRA, into a Roth IRA. And if you make that contribution with after-tax money, you make a so-called non-deductible contribution to a traditional IRA, then under certain circumstances, if you convert that to a Roth IRA, there would be no immediate tax due, because the tax basis of the traditional IRA that you made, you already paid tax on that money. You didn't hold it long enough for that money to grow. And so the amount of conversion basically the same as the amount of the contribution with no tax impact. There is an issue with this, however. If you have other pre-existing traditional IRAs, and if some of those IRAs were deductible, you were able to take a tax deduction for the contribution at the time that you made them in the past. If those IRAs are still out there, you are not allowed to basically tell the IRS, yes, I had these old IRAs that I deducted, but I just did a new one and I didn't deduct that, and I want you to treat the conversion as just those funds that I just contributed. You can't do that. The IRS instead imposes what they call a pro rata rule, where they look at the value of the non-deductible contributions to the IRA. They compare it to the total amount in traditional IRAs, and they only give you non-deductible treatment for that percentage of the converted amount that applies to that's the proportion of the non-deductible to the total. So if you contributed, let's make up some numbers. If you did a non-deductible traditional IRA contribution for $5,000, but you already had a $15,000 IRA, traditional IRA, for which you had taken deductions in the past, then if you went and converted that $5,000 that you just contributed, IRS would say, yep, we know that that's non-deductible, but you had $15,000 that was deductible. You take the 15 plus 5 is 20. 5 out of 20 is only 25%. So only 25% of that would be treated as a non-taxed conversion. The remaining 75% would be taxed. You'd end up having your taxable income increased by 75% of that $5,000, or $3,750. And that is not the result that a lot of people want. And so in a lot of those situations, people just don't do it. And so that's something to pay attention to, is if you have those previous IRA contributions in a traditional IRA and you did take deductions for them, then that can be an issue. Same thing if you had a 401k that you rolled over into a rollover traditional IRA. If you took deductions for those 401k contributions, then that can be a situation where you're going to have that pro rata rule make some of your new conversion taxable. One thing to bear in mind, though, if the money's still in a 401k, 401ks are treated separately. So you may have 401k retirement money, but if that's your only retirement money, you don't have a traditional IRA, these pro rata rules, they don't look at the 401k. It's only inside the traditional IRA, inside of that ecosystem, that you're looking. So that's what you need to pay attention to when you're considering whether to do this backdoor Roth strategy.
All right. So Larry, Four Card Poker, asks about Medtronic, ticker there's MDT. Is it a good pick to beat the market over the next 10 years? So Medtronic has definitely had its ups and downs, and a lot of downs recently. They were working on insulin pumps, and so there's sort of two schools of thought. One is to have a glucose monitor separate from an insulin pump. So you have a glucose monitor that monitors the glucose levels in the patient that has diabetes, and then you have a separate insulin pump that pumps insulin in when the glucose monitor says, hey, the glucose is getting too high, we need insulin. And so Medtronic decided, oh, hey, why don't we integrate both of those? We can get the money for both of them. We can charge more than the insulin pumps without the separate glucose monitor. It turned out that they had a huge manufacturing problems, and so they've been losing to the market in terms of the insulin pumps. The insulin pumps by AbbVie and Insulet have been doing much better than the insulin. Sorry, Abbott, not AbbVie, have been doing much better than Medtronic's insulin pumps. More importantly, I don't like Medtronic mostly because I find it really hard to value. So while Big Pharma tends to release all their different drugs, at least their major drugs, and they tell you exactly how much their sales were this quarter and last quarter and last year, and maybe they throw their bottom 5 or 6 drugs into the other category, but that's a very small amount. The 5 or 6 combined don't even have the highest sales as the next highest, the lowest drug that they actually give the amount of sales, individual sales for. Medtronic and many of the large medical device companies don't break out their sales. All they do is they throw them into like 3 or 4 classes of different types of medical devices. So heart medical devices, and maybe diabetes medical devices and that sort of thing, but they don't break out the individual sales of the individual products. So a lot of times they'll let you know that they've launched a new product, that it's doing well, but since they don't break them out, and we don't know how much of the total sales they are, it becomes really hard to figure out, okay, that's great that it's growing, but what does that tell me in terms of its ability to generate more of the market share than Medtronic's competitors. So I don't really like Medtronic for that reason only. And, it could potentially be a good market beater over the next 10 years, but I'm not going to invest in it because I can't figure that out, whether it's going to be a good market beater over the next 10 years, because they don't give their investors enough information to tell them what exactly they potential sales are going to be in the future, and what the sales have been in the past, and then that allows me to guess what the potential future sales are going to be based on the growth rates.
Let's see. Pauly D 16 minutes ago asked thoughts on Deckers Outdoor, ticker DECK, down 42% year to date. So Deckers Outdoor, the maker of Uggs, Hoka brand running shoes, Tevas, and some other brands as well. And I'm gonna share my screen here in a minute, just because when you take a look, absolutely right. We've seen a really big pullback in the stock. Closed at 118 on Friday. It was up well above 200, towards around 220 as recently as end of January. So yeah, we're talking about just in the past 2 months, we've seen a pretty big pullback. Let me take a pause just for a second to share my screen here, and we're going to get the chart up just to kind of give you a sense of what we're talking about here. This is the Fool IQ page, by the way, that I'm sharing. This is something that is available to in some form. I've got the plus version, so it may well be this differs a little bit from level 1 Motley Fool subscribers, but at the same time, I think that you can get at least some of this information, and you can kind of see that when you have a situation that you have here, just take a look at this chart. I mean, this is a 5-year chart, and you can see here the returns down here, 5-year return, 522%. So we come back here to March of 2020, we were below $20 a share. We ran from 20 up to around 70 or so in 2021. We got the bear market in 2022, where that stock was down by roughly half at one point during the year, bounced back at and finished 2022 pretty close to where it started the year. And then 2023, 2024, very good years for the company, as Hoka, really the brand that kind of took off. A lot of people were surprised by that. Hoka was purchased in the early 20 teens, largely as an afterthought. I mean, they paid next to nothing for that company. And yet, really what Deckers at the time wanted, they wanted some exposure to the athletic shoe market. At the time, Hoka, known as kind of a specialty among ultra marathon runners. We're talking about longer than the 26-mile length of marathon. Ultra runners often running like 50-mile races. Very elite group of people, and Hoka catering to them with footwear that kind of met the unique needs of, when these folks are out on the track for, 7-8 hours. Oftentimes these ultra races also are taking place on terrain rather than on a road or something like that. And so very much a specialty area, but it's really taken off, and Hoka has expanded its coverage to, go well beyond its original specialty. But recently, and I'll change the stock, I'll change the chart back to a 1 year. Yeah. I mean, we've seen a big pullback in the, again, in the past couple of months. This is not an unusual thing based solely on the fact that when you have a stock that has gone through a hyper growth phase, oftentimes you have investors that are interested in it, in riding it up while the growth lasts. These so-called momentum investors, they will wait for a sign that hyper growth phase has ended. And then as far as they're concerned, the appeal of their, for them is short-term, they'll stick with it as short or as long as the trend lasts. And then they'll move on and they'll look for other stocks that exhibit or that are in earlier stages of this hypergrowth phase of their existence. And so much of this decline came after Deckers announced its most recent quarterly financial results. The results themselves were better than expected, had a good holiday season, and yet what investors were a little bit concerned about were guidance projections that kind of suggested that the current quarter wouldn't go particularly much better or even at all better than the same period a year ago. Investors kind of took that as, wait, is the growth story ending? And so at that point, we saw a downturn. That came at the same time that you were seeing a broader downturn among growth stocks generally. And so, that has exacerbated the drop at this point. Does that mean that, Deckers will continue to drop? I don't know the answer to that. At this point, we're kind of in a short-term move. And so, all I can say is that as the share price goes down, the stock begins to look more attractive, unless you think that there is some fundamental issue that's happening. Took a look this past week. We saw Nike struggling. One question that you have to ask with that is Nike struggling because competitors like Deckers are eating their lunch, which is one way of taking it? Or is Nike's weakness a sign of industry-wide weakness that could have a negative impact on Deckers? That I think we're just going to have to wait and see on. But I think that is what is going on with Deckers. That's the reason for the big drop. And again, for long-term investors, you may well be in a position where you still have pretty sizable profit on this, even with this big pullback that we have seen since the end of January.
I have no opinion on Deckers as an investment, but I'll just say that Hoka, the people who the shoe that people like because they can run far in it is also the shoe that people who run slow like because it's the same sort of like padding that you need if you're going to run slow. So I'm a slow runner and I run in Hokas, and I've never run more than a half marathon, and I don't think at this point in my life I'm probably ever going to run even a full marathon, let alone an ultra marathon. But I will continue to run in Hokas because while they are big and clunky, at least the style that I run in, they're also really good and don't make sure my knees aren't dying by the end of a long run.
Yeah, we talked last hour about being old people, and yeah, that's an old people thing. And old people, I'll tell you, the older you get, the more willing you are to wear things that are kind of funny looking. if they make life a little bit easier for you, and I can totally relate to what you're saying, Brian. Totally.
Yeah, and spend more on it if necessary. Vihan asks about Tonix Pharmaceuticals Holding Corp. The ticker there is TNXP. He knows that it's up 26%. Is this some active trading or some positive news? So let's look at the stock chart and we can see that it's, I don't know, we can guess together. So here's the stock price. I've got the price in orange and the market cap in purple. Just they should be, for the most part, trailing each other, except for the fact that maybe we've got some sales of shares that could result in the market cap not growing as fast as the price not growing as fast as the market cap, which seems to be, I don't know, maybe the opposite of what we're seeing here. But at any rate, you can see that it has grown substantially in the last. This is only a year-to-date chart. So it was all the way up here at $42 a share and dropped all the way down to less than looks like about 3, and now has jumped up to 23. So kind of crazy. And so I don't actually know much about this company, but I just went ahead and did some basic research, and they only have 90 something. They have $98.8 million in cash, and they have a market cap of 148. So about $50 million is putting on value onto this company, the drugs in this company's pipeline. They have one drug that they've already submitted to the FDA. So that's this PDUFA is Prescription Drug User Fee Act. So the FDA they've created a law that allows the prescription drug companies to, when they submit their application, they basically pay for it to be reviewed, and in exchange for them paying for it to be reviewed, the FDA agrees to try to get it reviewed by a certain date, and that date is determined by whether it's a regular application, which takes a year from the submission date, or a new drug application, which takes a priority review, which takes 8 months from the application date. So that's what this August 15th is. So the FDA doesn't actually have to make the decision by August 15th, but their goal is for the 90% of all the drugs that are submitted under PDUFA to be reviewed and given a positive or negative outcome by that date. So this drug is for fibromyalgia. That's a pain issue, and they note that there hasn't been a new drug treating fibromyalgia in more than 15 years. So that sounds great, right? Oh, we've got a new drug, but also the fact that there hasn't been a new drug in the last 15 years means there's probably quite a few drugs that are generics that treat fibromyalgia, that are approved to treat fibromyalgia. So I think that that's probably the reason why they're not the investors aren't giving it very much credit for the fact that they've got a drug that's about to be approved. If we go down here, it looks like they published a study that said that that showed durable pain reduction in 2 double-blinded randomized phase 3 studies. So presumably, if the FDA agrees that they were able to show that there was pain reduction in 2 phase 3 studies, the drug's probably going to get approved, right? Because that's sort of the definition of what you need. You need 2 phase 3 studies. You need them both to be positive, and you need them both to show a positive result in whatever the problem is. In this case, fibromyalgia has pain, and if you were able to reduce pain compared to presumably placebo here, then they're able to gain approval. So let's just assume it's going to get approved. The thing is that I think that investors are probably betting that it's probably not going to have a very easy time in gaining sales, just because of because the issue is that there's a lot of generic competition for patients with fibromyalgia, and so patients are going to start off on the generics, and two, insurance companies aren't going to pay for this drug until patients have tried all the different generic options. And so, the issue is they've got 98, what did we say, 98 point something? Gotta find this. 98.8 million in cash. They say that'll easily, presumably that would easily get them through August 15th, the PDUFA date, and then they expect to launch in the fourth quarter. So, presumably that's enough money to get them through 2025. But how much further, 98 billion or million might get them, somewhat into 2026, but probably not that much. And again, this is a $148 million company. So let's say they want to raise another $50 million. Let's say they're spending approximately $50 million a year to get, to get this drug ready to be approved, and then building up the sales force, and then having a sales force. Let's say it's $50 million. So now they've got to raise another $50 million. They raised $50 million and they only have a market cap of 148 million. That means they're diluting their shareholders by a third. So the valuation is the share price is going to drop, theoretically by a third if they're having to raise that much money. Now, if they could raise at $240 million, or, if we look back here and the valuation was, upwards of, no, it looks like that was pretty much the peak, was $240 million. So, even at $240 million, raising an additional $50 million is a 1/5 dilution. So obviously better than 1/3, but not nearly, very, not that, still quite a bit of a dilution. So I'd be concerned at buying a company that only has $98 million and is expecting to launch their first drug towards the end of this year, and only having a market cap of 150 million. Maybe it's counterintuitive, but it's almost, I would almost feel more comfortable buying at a $500 million market cap than a $148 million market cap, because I'm expecting there to be dilution. And so if I can be diluted less, then the valuation is, would potentially be, the share price isn't going to go down as much when they announce that they need to raise that capital. So.
Yeah, that's the tough thing about these things. I'll tell you, I'm always jealous. So often I see companies, they raise capital, and you get the announcement that we're going to go out, and different companies do it different ways. Some companies, you don't get the announcement, you just get the results, and you find out that institutional investor X just bought X number of shares of this company for $5 a share less than where it closed. And you're sort of like, gosh, if I'd had a chance to buy at $5 a share less, I would have done that too. Oftentimes the share price of the company will drop in tandem with that. And so sometimes you actually get a chance to buy those shares on sale. But it is an interesting thing. And it is an interesting kind of almost paradox that you talk about, where it's like, you'd think that a less expensive company would be more attractive as a value, and yet you get to a point where if you are going to need outside capital, having a low valuation is just fatal, because you can't offer enough of your company in order to get the cash that you need without totally, it just ravages the current investors. It just makes it completely unviable, and eventually you get to a point where you're just kind of stuck, and what cash you have is what cash you have, and if it's enough to get you to where you're making some revenue, great, and if it's not, then you're probably turning to an outside investor to to buy you out, or you're looking at filing for bankruptcy protection or something to try to salvage the value of what you've put together. I will take Rose's question from a few days ago. Rose asks, if the owner of a 529 college savings plan is not the parent, not the grandparent, and not the beneficiary, not the student, how does that 529 impact the student's applications for financial aid? I went to my go-to source for college savings information, that is savingforcollege.com. And they tell me that based on the current rules that took effect, bear in mind, we just had a rule revamp of the federal aid for, it's the federal application for student aid, the FAFSA form. And so some of the guidelines, some of the rules, some of the terminology changed. But fortunately for Rose's question, it's a pretty simple answer. 529 plans that are not owned by the student, not owned by the parents, are treated the same, and they are treated such that the assets in the 529 plan are not included on the student's FAFSA form. They will have no effect on the aid eligibility. And in a change from past law, how are distributions treated under the rules? Again, the rules of this simplified FAFSA process, 529 plan distributions that are qualified and are made for qualifying educational expenses from accounts owned by people that the people that Rose is talking about, not the parents, not the student, not reported as income on the FAFSA. That used to be a big issue, is that maybe the assets held by somebody else were not treated as assets for financial aid purposes, but they were treated, when you actually made distributions from them, they were treated as income, which was even worse, because the guidelines generally expect that a student will spend more of their income, a higher proportion of their current income, towards college expenses than they expect them to tap into their saved assets. And so income was kind of the worst answer for folks. But here things have changed, and that does open up some opportunities for more distant family members and non-family members to consider using 529 plans to help student beneficiaries in a way that won't necessarily have as big of a impact on financial aid.
All right. Bill asks about if anyone is close to developing an oral GLP-1 or GLP-2 drug. I think they asked about GLP-2, but I think GLP-1 is probably, makes more sense to look at. I believe that Eli Lilly has one that's expected to read out in 2024. Let me find it here. Yeah, they have an oral medication in the second half. It's supposed to read out in the second half of 2024, and then I think Novo Nordisk has one, but I don't know if it's going to read out. Or sorry, 2025, and I don't know whether Novo Nordisk is going to read out in 2025, or we're going to have to wait until 2026, and then there's a long acting, so a 1 month drug from a company that just IPO'd recently that should start this year. The clinical trial should start this year, so that should read out in 2026. And then Viking Therapeutics has a GLP drug that's going to read out in the that's an oral drug. So they're going in with their insulin, their injected drug in 2025. So I would expect them to run the phase 3 clinical trial for the oral medication in maybe starting in 2026. So that would put them in 2027. So there's definitely some oral medications coming along, and that's the reason why I'm a little concerned about Eli Lilly's valuation at this point, because while they're currently the leader with Zepbound, there's going to be a lot of drugs coming on the market in the future, and so therefore the drug, whether they're going to be the leader in year 4, in 3, 4, 5 years out, I think is a big question mark. If their drug ends up being number 1, their oral medication ends up being number 1, possibly, but I'm not 100% sure that that's going to be the case. We're going to have to wait and see. And so I think that is a risk involved in owning Eli Lilly right now, is that they're growing at 40% year over year, and that should be a huge benefit to them. But can they continue to grow at 40% year over year? Is a question mark that I don't think can be answered, because you don't know what the results are going to be of all these different options that companies are going to have, that patients are going to have, if the companies are able to show successful phase 3 clinical readouts. So there's so many phase 3 clinical readouts happening over the next, let's say 3 years, that by the time that they, once they get to being positive, Eli Lilly's might end up, their next generation drugs might end up being the most likely to be successful. But it's just as possible that other companies might also, end up being better than Eli Lilly, even though Eli Lilly has the current market leader.
Yeah, it's interesting to me, that risk is out there, and we like to think that those risks would be priced into the stock already, but it's never really, it doesn't look like it, or if, I don't know. Do you think that it is already priced in, or do you feel like the Lilly shareholders might be in denial about the actual prospects of this going forward?
Yeah, I mean, I think that I think there's probably some fact that they might not, think that they're going to end up being the loser on the losing end of the next set of clinical trial battles. And then the other thing is that, they already have the leader. So, you could argue that it's going to take some, decent data to result in something that's going to result in patients and their doctors being more likely to want to use something else, right? So one
Sure.
is obviously an oral medication or a once monthly medication. Those don't necessarily have to beat the Zepbound. They only have to meet Zepbound's future, prospects, and what the weight loss that it's produced, in the 20% range. If they can show that they can do approximately the same, but can be an oral medication, or can be once a month versus once a week, that could help. Also, you could figure a company could have the same injection schedule of once a week, but if it has better tolerability, then that could also beat the company, even if they don't have better weight loss. I actually don't think that we're competing on weight loss pretty much at all now, because I don't think that if your options are lose 20% of your weight or lose 25% of your weight over the same time frame, you're probably not going to care that much compared to all those other two options of oral versus injected once a month, and also the tolerability issues. Those are going to be much bigger concerns of a patient than whether you can lose 20% of your weight or 25% of your weight, especially if there doesn't seem to be a plateau in the weight loss. So, basically the difference between 20 and 25% is over, X amount of time.
Another few months.
It was, let's say it's 70, that's at 52 weeks or something. And so if we look at, we could just assume that, if we looked at 52 weeks for the one that can do it 20%, and let's say we have another one that only does, 17 or 18%, but has much better tolerability, patients will stay on it much longer, and therefore it should have a better, they will eventually end up hitting that 20% weight loss. It'll just take a few more months.
Right. Vihan with a question 24 minutes ago. Dan, I rolled over a 401k to a traditional IRA in 2022, then converted 80,000 from a rollover to a Roth in 2024. Did not take any deductions. Can I take a deduction in 2024 or pay taxes? Vihan, this looks very much like you're asking for individual advice. I can't give you individual advice, but I will note some observations that I see that I'm kind of wondering about. One is, you say you did not take any deductions. I'm not really quite sure what deductions you would be thinking about taking, because a Roth conversion generally is not going to create any deductions. It is a question of whether you are going to have taxable income added to your other sources, or whether that that Roth conversion will somehow be tax-free, or a portion of it may be tax-free. If the original 401k was completely done with pre-tax money, if you receive deductions for the 401k contributions, that would be consistent with the rolling over to a traditional IRA. Most people, when they take 401k assets, if there are after-tax Roth 401k assets, those will get rolled over to a Roth IRA rather than to a traditional IRA. So if all of that traditional IRA assets were deductible, then when you convert that 80,000 from that rollover traditional IRA to a Roth, then presumably, unless you have other, unless someone had other assets that were non-deductible where that pro rata rule might apply, then the full amount generally can be taxable. And as far as you're saying that this happened in 2024, and you're wondering, is there a deduction that you can take in 2024 or pay taxes? I think the answer is likely going to be that you're going to pay taxes, because you're in a situation again, this is very individualized. And so as I often do with your questions, this is one that you should bring to your accountant and tell them what you're doing, and have them tell you what the tax treatment needs to be. But in general, I'm not sure. I don't know. If you have some deduction in mind that you're talking about, let me know, type it in Slido. Let me know what you're talking about, because I'm not really quite sure. A Roth conversion would generally not create a deduction that I can think of.
All right. And we have another question from Vihan about, he asked about BioNTech, Genmab, Chimera Therapeutics, and Roche Holdings, and then wants the gold, silver, and bronze out of those. So if we can bring up my slide share, we can look at the chart. Bill yep, there we go. Okay, so we've got one very large pharmaceutical companies and then three biotechs. So we've got Chimera does not have any drugs on the market. BioNTech has drugs on the market. They're the COVID-19 vaccines, and then Genmab has some drugs on the market, mostly I think through partnerships. I don't think they have their own drugs. So if we take and we look at the revenue, we can see that Chimera basically has no revenue. That's some partner revenue or something at $47 million annually. And then you can see that the valuations actually flip-flopped here. So Genmab actually has higher revenue at $3.1 billion compared to BioNTech's $3 billion in revenue. And then obviously Roche is way up here, as a large pharmaceutical company. So if we go back to price, I have a hard time seeing why you would buy BioNTech. Let me look at market cap, not price. Why you'd want to buy Biotech at a $23 billion valuation compared to Genmab at 12.5. Chimera is still a ways away from being on the market, so I'm not sure that I would put. While I'm a shareholder, I'm not sure that the valuation is fine right here, but certainly not that. I mean, it's not, it's not super cheap. It could potentially become, a 5-bagger or not 5-bag. It could potentially, get five times as much, up into the $10 billion range if it could launch its first drug. But I think it's a ways away from that. So I think I would probably put Genmab as number 1, Chimera as number 2, and then I think comparing Roche and BioNTech is kind of a little difficult. I think the potential wise, I think BioNTech probably has more opportunity to grow than Roche does, just because it's a large pharmaceutical company, and it's had some issues recently with some phase 3 failures. So I'm going to put Genmab as my gold, and Chimera as my silver, and BioNTech as my bronze, and Roche as my runner-up.
Yeah, there should be a 4th place medal. 10 or something like that.
Yeah.
Let's see. I had a question from way back, and there, give me a chance to find it. Oh, Sandy C from about 3 days ago asked, if I inherit a traditional IRA that I have to take required minimum distributions from over 10 years, how is the required minimum distribution calculated after the first year? Because there will be growth or loss. So generally how these inherited IRA required minimum distributions work is the first year you will get a life expectancy factor that is based on your age when you inherited the IRA. That is present in an IRS table. And you will take the value of the IRA as of December 31st of the end of the previous year, and you will divide that number by that life expectancy factor that you got, and that will be your required minimum distribution for that year. In subsequent years, what you do 2 different things. One is that you reduce the life expectancy factor that you use by 1 year, because you are 1 year closer to the end of your initial life expectancy. You also update the value of the inherited IRA. So you took money out of the inherited IRA. Let's do an example. Say it was 2024. You took money out of the IRA in 2024 to meet 2024's required minimum distribution. Also, market forces happened. So as you point out, maybe the investments went up in value, maybe they went down, maybe they stayed the same. You look at the value of the inherited IRA, the remaining value of the IRA as of December 31st of 2024 to determine what your RMD for 2025 is going to be. So you take that end of year balance, end of year 2024 balance, you would divide it by the new life expectancy factor, which is 1 year less than it originally was, 1 year less than it was in the previous year. And that will tell you what your required minimum distribution for 2025 is. Same thing will happen in 2026. You'll look at the value, the then value of the inherited IRA as of the end of 2025. You will reduce that life expectancy factor by another year because another year has passed. And you'll do the same exercise. You keep doing that exercise until you either run out of assets or you run out of life expectancy based on the initial estimate. It's not to say that you can't outlive your life expectancy, because it was determined at the age at which you inherited that money. But that is how that happens. And then, as you point out, if your overall withdrawal strategy is subject to the 10-year rule, then you're not generally going to outlive your life expectancy. You're going to have to take whatever's remaining in that 10th year. And so because of that, that may end up being a lot more than what you have had to take in RMDs along the way. That could have a tax impact. And so a lot of people, they will look at changing that, maybe taking more than is absolutely required under the RMD rules in years 1, 2, 3, 4, or years 1 through 9, so as to avoid that really big tax hit in year 10. But other people may just use the RMDs and then use other strategies to try to smooth out their taxable income. Any number of ways of doing that. There's no one right answer here, but just being aware of that tax impact is important because it will tell you what the best answer is for you to minimize your overall taxes over that entire 10-year period, take maximum advantage of the legacy that you've gotten by inheriting that IRA.
So does the amount ever go up if the life expectancy, if we have some like super great drug that then, results in increasing the life expectancy? Would it ever go up over a year, or they recreate these tables every year or every few years, or what?
It's very infrequent that they recreate the tables, but it has happened, and exactly what you described has happened. I have an inherited IRA that I got from my mom, and they changed the tables, and I got an extra, I think it was almost 2 years added to my life expectancy. And so that allowed me, again, you divide by the life expectancy. And so when that number went up, it meant that I was dividing by a bigger number, which meant that my required minimum distribution actually went down that year. Often, the other thing is that the change in the value of the IRA itself can have a big impact on RMDs from year to year. If you have a really big market year, then you may be in a situation where your RMD really goes up the following year. Conversely, if you have a bear market year, you might be in a situation where even though your life expectancy got shorter, even though you're dividing by a smaller number, the number that you're dividing by, the numerator of the fraction went down more than the denominator did. And so you end up having a smaller required minimum distribution after that big market drop.
So Ed asks, do you see any blockbuster merger or buyout takeover that will occur in the pharmaceutical industry over the next few years? So I guess there may be two ways to think about this. Are we going to look, will we see sort of a large pharmaceutical company merger like we've seen, in the last 10 years, in the previous 10 years? So we saw Wyeth be bought out by Pfizer, and we saw Merck by Schering-Plough. Those both happened, I think, right around the 2010 range, I think. So maybe that was like closer to 15 years ago. We haven't really seen any major pharmaceutical mergers except for Pfizer and GlaxoSmithKline spinning out their respective consumer healthcare divisions, and then combining those into a new company, and then that company IPO'd. But besides that, we haven't seen very much mergers between those companies. Now, obviously, we've seen a ton of large pharmaceutical companies buy small biotech companies. We could, from small being maybe Seagen and large being, Seagen and Celgene both got purchased by Pfizer and Bristol Myers Squibb, respectively, over the last few years, I think. And then there's been, a multitude of smaller biotech companies that have been acquired. I was talking to a venture capitalist yesterday, and he was saying that pharma has most recently had a bigger appetite for private companies than for public companies. So they have typically in the past mostly, bought a lot of public companies because they want the risk to be reduced. They're willing to pay more for a reduction in risk. So let the thing get developed. If it fails, then they're not on the hook for it. And then if it's successful, they're willing to pay extra for that success, right? So, buying something, let's say after phase 2 development compared to buying preclinical or phase 1 assets. He was saying now, of course, he's a venture capitalist, so he wants his companies to be bought by pharmaceutical companies so he doesn't have to IPO them, because obviously that's a whole other issue with IPOs in biotech right now. And so he was saying at least that the pharmaceutical industry is sort of moving earlier stage, and that's making it easier for private companies to be acquired because pharma is more interested in buying those companies. So maybe that means that companies that have 1 or 2 drugs on the market that are public companies might end up continuing to be public companies, where in the most part, we would have seen those companies, end up getting acquired before they end up launching their second or third or fourth drug. There's only been a handful of companies that have gone from not having any drugs on the market to having 5 or more drugs. I think it's about maybe 8 or 10 companies. So most companies actually in the biotech sector get acquired. And so I think over the long term, you should continue to see that. Will Vertex get, Vertex is probably the biggest biotech that is, sort of that mid-range biotech that might get acquired. Obviously they're, I think, I don't know, Biogen is bigger than them at this point. And then we've got AbbVie, which I would consider, I don't know whether you consider that a pharmaceutical company or a biotech company. But then we've got a lot of companies that have 1 or 2 drugs in the market. And so, I think the one thing you don't want to do is buy something because you think it's going to get acquired. That's never a good sign. And if you want to, example of that, just look at Viking Therapeutics. The market cap was, 2 or 3 times higher than it was right now, just a few months ago, and certainly in most of 2024. And the reason why it's dropped so much is because it doesn't seem like anybody's going to buy them for their obesity drug. And so as pharmaceutical companies have bought other assets, the Viking Therapeutics valuation has changed, even though they've had successful phase 2 clinical trial data, and they should be valued based on that. The valuation was so much higher a year ago, solely based on the fact that investors thought that the company was going to get acquired. So I don't think investing based on the thinking that the company is going to get acquired is usually not a good idea. Obviously you might be right some of the time, but I think the potential to be wrong and end up having a company lower have its valuation go down substantially and their share price go down substantially, even when there hasn't been any bad news, is like, I mean, that's like the worst thing to do, like to stomach, in my opinion. Way harder for me to stomach than having betting that a phase 3 clinical trial will be successful and it's not, and then the stock goes down the same 75% that, or whatever it is that Viking has gone down. At least then it's like, okay, I bet on something and I was wrong and it wasn't successful, and there's a reason why it's gone down. In this case, it's literally just it's going down because everybody had it previously assumed that it was going to get acquired, and now it's not, or at least doesn't seem like it's going to.
Fools, we got about 3 minutes to the top of the hour. I'm going to try to grab Larry for a 4-card poker's question about Alphabet. Is Alphabet ticker GOOGL an undervalued company that should keep pace with market performance in the next decade? Larry, I tell you, I own Alphabet. It has always been sort of a compelling value, in my opinion. It has for long periods of time trailed the valuations, had less expensive valuations by typical metrics than other companies kind of at the top end of the tech spectrum. There are reasons for that. I think that there's kind of an ever-present antitrust issue when it comes to online search. Interestingly, the risk now that you are seeing from AI-based information retrieval and the impact that it may have on people not using traditional search engines as much as they did in the past. I mean, that in theory should be a good argument in favor of Alphabet, saying, well, there's no antitrust threat now because there are all these AI substitutes that you can use. And yet that potentially is a business risk. Right or wrong, Alphabet has the reputation of having been a little bit slow off the gun when it came to AI-powered search and information retrieval. There's a sense that Microsoft and OpenAI and the other companies were kind of faster to adopt AI and to take full advantage of AI. I do think Alphabet has worked hard to get that going. I like the fact that Alphabet has the Waymo self-driving subsidiary under its corporate umbrella. I think that that's an interesting play. You don't hear that much about it in comparison to companies like Tesla, ticker TSLA, and the full self-driving capabilities that it has been working on for years and years. Don't even hear about it as much necessarily as what you've seen with other companies that are more specialized in it, just because it kind of hangs out as a relatively small piece of the entire Alphabet puzzle compared to the dominant position it has had in online search. So I remain bullish on Alphabet. I think that it can, the suggestion that you make about it keeping pace with market performance, I think that is a very rational expectation. Nobody's asking, do I think it's going to 5x in 5 years? My answer to that question would be no. But yeah, I do like the stock. And I'll tell you something that is always funny to me. You use the ticker symbol GOOGL, which is the voting class of shares. There is a non-voting class of shares, ticker GOOG. For some reason, the non-voting class is less expensive, is more expensive than the voting class, as if the voting right had negative value. I own the voting shares because I like a bargain when I can get it. And that takes us to 7 p.m. That is it for Brian and for me. Please do join Brian tomorrow, though. Brian is going to be celebrating his 25th anniversary as a member of the Fool community. And I think that if you have a chance to be there for that, I think that's going to be a fascinating story. But for Brian, for our host, for our team of hosts behind the scenes, making sure that we can get everything in front of you properly, I'm Dan Caplinger. Thank you so much for joining us, and stay tuned. We have a replay. You will see Brian's face.
I'm time traveling
along with Bernd Schmid. This is a pre-recorded that happened last Thursday. It is our latest in our bold predictions sequence. Please do stay tuned and have a great night, everybody. Thanks for being with us.
All right, Fool on. Hey, Burns, how's it going? You're on mute. There you go.
I'm on mute.
You're good.
You're good. How are you doing?
Good. So you want to start us off with your first bold prediction?
Well, happy to do so. Maybe a quick pre-frame. I think you probably don't have as much clue about what I'm talking about, and I don't have as much clue as you about what you're going to talk about. It's going to be really interesting. I'm looking forward to these questions, and also if viewers have some questions, I'm looking forward to this. My first prediction is a bold one. I think it is that Beyond's market cap is going to at least quadruple in the next 2 years, and right now the market cap is about $250 billion. So we are looking at $1 billion.
Hey, Burns, how's it going? You're on mute. There you go.
I'm on mute.
You're good.
You're good. How are you doing?
Good. So you want to start us off with your first bold prediction?
Well, happy to do so. Maybe a quick preframe. I think you probably don't have as much clue about what I'm talking about, and I don't have as much clue as you about what you're going to talk about. It's going to be really interesting. I'm looking forward to these questions, and also if viewers have some questions, I'm looking forward to this. My first prediction is a bold one. I think it is that Beyond's market cap is going to at least quadruple in the next 2 years, and right now, the market cap is about $250 billion. So we're looking at $1 billion. And why I think that's going to happen, I think the market has been just extremely negative over the last year. The business is not doing super, but it's doing fine. There's actually more than $3 of cash on the balance sheet. It's a $5 stock if you buy it, so you get 60% of that already in cash. Gross margins are improving, so the core business is actually doing better than the market thinks. But the actual thing is, on top of that, Beyond owns quite significant stakes in blockchain businesses, and they are doing really, really well. But it's not publicly visible because they're not being reported very well. However, I don't think the market will be able to ignore these for much, much longer. Especially one business, a grain chain, for example, Beyond owns 30% of that company, according to the latest filing. And this company is growing, basically doubling its revenue every year. This year, one of the core investors predicting about $100 million in revenue. So 30% of that attributed to Beyond would be 30 million. It's already 10% of the market cap. And remember, this company has doubled its revenue in the past couple of years. And I don't think this is going to change that soon. It might slow down, but there's very strong revenue growth. And the market won't be able to ignore that much longer. And also, actually, what I like most, the new CEO came on board 1.5 years ago, Marcus Lemonis. He's compensated with nada. He doesn't own any base salary, but he's going to be rewarded if the stock hits $40. $40 is 8 times from where it is today. I think it's a realistic goal. Maybe not in the next 2 years, but I think the next 2 years, 4x is very possible with the CEO, with this excellent operator on board, a business that is improving, and blockchain businesses behind them that are going to have a chances to be so big to even overtake Overstocks. Oh, I'm talking about Overstocks. Beyond it used to be Overstock. They changed the name 2 years ago. Forgive me for saying Overstock. When I say Overstock, I mean Beyond. But these blockchain businesses, some of them might be even bigger than what Beyond is right now.
So what do you think is the best metric for looking at Beyond stock? Is it price to sales? Is it price to earnings? Is it, some other metric for valuation?
Yes, for value, I would look at the book value, but the book value is grossly undervalued right now because all these blockchain businesses, they're basically valued at cost or even lower. So you don't see the grain chain business growing. You don't see in a balance sheet. So in fact, you can actually not really see these numbers in the balance sheet of Beyond. And I think that's one reason why the stock right now is so low. But at some point, it will have to be valued upwards.
And so where do you see that the valuation can change? Is it that the valuation metric will increase or decrease, I guess, so that the valuation actually increases, nothing has to change, but the valuation metric goes lower, or are you expecting the valuation metrics to increase?
It will absolutely increase, in my point of view. The book value itself will increase in a very, very delayed way, right? Because if you invest into a company as a public company, as Beyond has done, into all these blockchain businesses, you have the value of this company basically in your balance sheet is only basically the price that you paid for that company. But these companies were bought years and years ago when they were super small. And so you don't see this right now reflected in the balance sheet. It will have to be in the future. Once the market sees the value of these companies, the market will recognize that the current value that they pay for the company might reflect the value of the core business, the retail business, the home business, right? They're supplying home furnishings, etc. But the value of all these other businesses that are behind it and that you own a share of is reflected with 0. And I don't think this will stay that way.
Yeah. So how do you see overall valuation changing? So, like, let's say, assuming your prediction is correct and that they 4x in 24 months. So, what would you see as the, what if, like, we're looking 24 months in advance? What do you think that has happened at that 24-month time frame that has resulted in the capitalization changing, microcapitalization changing going up 4x?
Perfect question. Yes, thank you for that, Brian. What will change is that the market will start to recognize. So it's basically investors seeing the value of these companies. Marcus Lemonis, the CEO of Beyond, held a Twitter Spaces on the 1st of January, where he said, we made one mistake. And even the previous management made one mistake. They didn't understand how to integrate the technology business, all these blockchain businesses, together with the core business, because they're basically not related. However, they can be used with tokenization. That's one thing that they do I didn't even mention. But also in a way that they will help these blockchain businesses with their technology know-how to accelerate the growth. I don't know, doubling the revenue every year is already good enough. But this won't be, as I mentioned, not reflected in the financials directly, but once the market hears Beyond talking about these businesses in a more direct way. I also mentioned that in the previous earnings call, if you listen to them, these businesses were not really mentioned. They were kind of ignored. And that's why the market doesn't know about them, ignores them. But this will change. They cannot be ignored. They're so big right now. Some of them might be bigger than Beyond in just a year or two. And so they will be talked about in the earnings calls. And I think valuations will be given to them by analysts.
All right. So our polls are open. If you're in the Slido, the code is Fool24, so you can vote there. You can also ask questions if you have other questions for Bernd before we close out this prediction. And so we're doing well. We got another minute or so, and so if you have questions, get those in right now. And then maybe my final question is let's say, so you're predicting that the market's going to change their sentiment, basically, right? So if that doesn't happen, you think that, that seems to be your main argument right here, right? So how much of it is sentiment, and how much of it is potentially the company is going to change their outcome, and then that's going to change the sentiment. It's
100% sentiment right now, where the stock is right now. Actually, a year ago, it was still trading at $20, which would be the 4x from where it is today. So the stock would only need to go back to where it was a year ago. Right now, the sentiment is so bad. I'm actually not sure what the market is actually thinking. Is it thinking that Beyond is going to go bankrupt? So it's absolutely the sentiment is the key driver behind all of it. Once people will see, and that they're actually, I'm not the only one, right? It sounds like I know something that others don't. Much of the information is public. Some of it is a bit difficult to find. For example, the revenue numbers of BrainChain, they are not in the earnings calls, but they're out there. And I believe once the markets, especially CEO Lemonis is starting to communicate more directly in its earnings calls with analysts about the development of these blockchain businesses, how big they are going to get, that will change, in my view, the sentiment of the investors.
All right. And then Besties asks, Lemonis, was he the CEO of Camping World? Is that the same company?
That's right.
Same person?
Yes, he still is. I think Chairman
thoughts
CEO.
on his experience with Camping World, and how you think that's gonna help him in beyond?
That's a great question. So what I saw in Lemonis already before, he's just an excellent operator. He knows which metrics to tweak, what to look at, how to optimize marketing, deriving strategies, and really putting a business on very, very solid footing. And I haven't seen that for Beyond in the previous management. I actually was quite convinced, but they did acquire assets from the Bed Bath & Beyond bankruptcy for a very low price. I think that was a big bargain. But the integration of that, and also how they changed the marketing, it was a big in my point of view. And that is also actually one reason why outside investors pulled Limones in and said, hey, look, here's a company. It has such a solid foundation. It has all these other assets, but we need somebody to really operate that in a very efficient way. And you're the right guy. I'm glad he accepted. And I do think he's going to show that with Beyond.
All right. And then one last question from the audience, and I will then make my prediction and might make my, whether I think my prediction agrees with you, and we'll read out the poll. So anybody who's looking to vote, please vote in the Slido app. The ticker, the thing that you want to enter after you get in the Slido is Fool24. And so then Dizzy Fool says on Beyond is the thinking that there's been an overcorrection and the stock has been a crash from here.
Yeah, that is not totally just because the market changed sentiment just out of nothing. It is really when Limones came on board 1.5-ish years ago, he made very, very bold forecasts. He was extremely confident and I think overconfident. He didn't manage to change as much as he anticipated to change. If you look at the stock price from the time on when he joined over Beyond, the stock actually almost doubled, I believe, from 20 to 40, roughly. And then suddenly the market, and I also had to realize I was also one of these, okay, now it's going to change, but it was not the time. It actually got worse. They also had to divest. That is part of basically cleaning the business. They're making it now very clear. I think the strategy is clear, but that had to result in selling assets or at least, shutting down certain business segments. And this disappointed the market. And so I understand that the stock has gone down a lot since, but yes, I do think as the market is, it overreacted by way too much.
All right. So let's move on. I'm going to vote against you. And I'm going to say that the Beyond's market capitalization won't 4X within the next 24 months, mostly because I feel like the main issue here is market sentiment. And I'm not 100% convinced that market sentiment is going to change. And then if we're looking at the poll in Slido, it looks like they agree with me that they disagree that the market capitalization will increase 24 months, will increase 4X in the next 24 months. So we'll move on to my next prediction, or my first prediction, which is, pull mine up. So my first prediction is that Pfizer's, the ticker there is PFE, won't cut its dividend in the next 3 years. So the dividend yield is currently at 6.56% as of the close today. The company in 2024 issued $9.51 billion in dividends, and they had an operating cash flow of $12.74 billion. So that's a $3 billion difference between the dividends that they paid out and the operating cash flow that they brought in. I mean, obviously there's some in addition to the operating cash flow and the dividends, there's obviously some CapEx that is in that prediction. And if you want to be like a total bear, you could argue that the dividend got up to 12% in the early 1990s, and before the company Pfizer cut its dividend, and after it acquired Wyeth. So the difference there that I think that obviously history says that if it gets high enough and there's not enough money to pay the dividend, obviously they're going to cut the dividend. So they've since they cut the dividend, they've obviously, it's grown back in the past, and most recently they've only been increasing it by $0.01 per quarter per year. So, every year they've been increasing it by about 4 cents. So not much increase, but I think that they will continue to at least keep it level and probably increase it over the next 3 years. And they don't seem to have much like downside. There doesn't seem enough downside compared to how they were when they cut the dividend previously, where Lipitor was a major. Lipitor faced generic competition, and Lipitor was a major contributor to the top line growth and the top line, sales. Where now they are facing some patent issues like they had in Lipitor, but they're smaller drugs, and there's a couple of them. So, a couple of them combined is, somewhat close to the sales of Lipitor, but the sales of Lipitor back then were much higher than the sales of the drugs going off a patent right now. So I think that overall, I think the dividend feels very safe.
When was it that they cut the dividend the last time?
Let me look. I don't know off the top of my head, but I think it was it was in 1990s. So it was in conjunction with the Pfizer acquisition of Wyeth. So let me see what that was.
Oh, so it's a really long time ago. Where I'm trying to while you're looking up, I'm you got it?
I don't have it, but go ahead.
During this, call it 20 years or 25 years since they haven't cut the dividend, did they have stronger periods where so it sounds like they're paying out almost 70 to 80% of the operating cash flow that they have as a dividend. I'm wondering if in the past, has it been the case that they continued maintaining that dividend despite operating cash flow or other such metrics decreasing substantially? And let me also add to how I also mean the question is, say operating cash flow went below 9 billion next year. Would this lead them to cut the dividend, or would they say, no, we want to keep our dividend history, we take this 1 year, swallow it, and we'll pay out the dividend?
Yeah, so the Pfizer acquired Wyeth in 2009, and that's when they cut the dividend. And it was, everybody thought that the dividend was going to get cut because they had Lipitor that was coming off patent, and they knew that the earnings from Lipitor, the cash flow from sales of Lipitor were going to be decreased because they were going to have generic competition. And so they were expecting that the dividend was going to decrease. And that's the reason why the dividend went up to 12%. The dividend yield is only defined by the past, right? It's not defined by the future because we don't know what the dividends are going to be in the future. So the dividend yield in the past was 12%, compared to what it is right now, which is 6%. But in the past, I think everybody was accepting the fact that the dividend was probably going to get cut, and so that's the reason why the dividend yield went up, which was caused by the price going down, right? So the price went down because the past dividend, is what it is, right? That's a fact, right? So the dividend yield is based on the fact of the past plus the current price, and the current price is determined by what do we think the dividend will be in the future. So in this case, the dividend, everybody thought the dividend was going to get cut. So everybody was factoring in the dividend cut in the future. And then if you look at the dividend yield, that's based on the dividend in the past. And so you can say the dividend, the dividend yield was 12%, but that was only based on the fact that investors were expecting a smaller dividend in the future. And then that turned out to be the case as they acquired Wyeth in January of 2009. And then that resulted in them cutting the dividend. And I think that's the last time they've cut the dividend. Since then, so I think they cut it in half there, and then they've raised it since then. Sometimes only by a penny per month, per quarter, so 4 pennies per year. But so I think that they've made the at least inclination that they will continue to raise the dividend in the future.
Okay, and if the company were to struggle in the next 1, 2, 3 years, call it operating cash flow suddenly being cut in half, do you think they will maintain the dividend if this were to happen?
I mean, yes, but I don't think that their operational, revenue is going to get cut in half, because it's a pharmaceutical company that has pretty much fairly steady revenue. So I don't really see that happening. But yes, if the revenue got cut in half 100%, they'd probably cut their dividend. But I don't really see that as being a likely occurrence.
Okay. So as I understand, your prediction is basically this is a very stable business. It will continue to throw off cash, and because of that, they will be able to continue to maintain their dividend.
Yeah, exactly.
Is there, what are the biggest risks for the business? I think Pfizer probably, I don't know their financials really, but I imagine they got a big boost through the 2020 to 2022 years, the COVID years, maybe with the vaccine.
Yeah, they had a COVID-19 vaccine, and they had a COVID-19 treatment. So both of those definitely generated additional sales. And so that increased the valuation slightly, but also didn't increase the valuation as much as the revenue, right? So if you look at a price to sales ratio, it went down over that time frame, even though the revenue was going up, right? The sales was going up, and that's because everybody assumed that those sales weren't going to happen forever, and so they were expecting those sales to come back down. So I don't think the valuation has really been horrible compared to the overall the valuation on a price to sales ratio or a price to earnings ratio hasn't come up as much as the valuation would have if you incorporate all of those sales. If you assumed all those sales were going to continue forever, which I think investors haven't, and I think that's the right idea.
Got it. Do I make a correct assumption if I think that Pfizer's financials call it revenue cash flow is not really dependent on one drug or on a small subset of drugs?
No.
So
I mean, they have, I know they have 20, 30 drugs over the, and so, it's a large pharmaceutical company, so they have a lot of drugs, and the sales, the sales are going to be determined by the, obviously the, sum of the total, and they have some drugs that are going off patent. Not this year, but maybe in the next 2 or 3 years. So that's sort of driving the valuation, so that people are, if you look at a price to sales ratio, the valuation has come down, and that has driven up the yield, the dividend yield, because the dividend has stayed the same and the price has come down, right? So if the dividend's the same and the price is lower, then the dividend yield is higher, right? So the question is, will the price continue to stay that high? And then will the dividend yield continue to stay that high, right? So if both of those stay the same, then the dividend yield will stay about the same, and my prediction will come true.
Last question. So these call it expiring patents over the next 3 years, do you have a rough idea of what percentage of revenue would be affected? So all these drugs
Yeah,
that are
yeah.
into-
I don't have it off the top of my head, but it's a smaller percentage than when Lipitor went off patent, right? So when Lipitor went off patent, it was, I don't know, maybe pushing 20% or something of the revenue, but it's about the same amount that Lipitor was, so in the $10 billion range over the next couple of years. But one, it's over the next couple of years. Two, Pfizer's sales have increased since 2007 when Lipitor was going off patent. So therefore, the 10,000-ish dollars is a smaller percentage of the overall. And then so I think that the issue is not as big of a deal as it was when the last time they cut their dividend.
Got it. I think, I mean, it's such a well-diversified business generating strong cash flows and probably relatively consistent. So with all your assessment, I would agree. I think it's too strong, even a business, for it to cut its dividend in the next 3 years. I'm really curious to see how that plays out. I'm looking, I didn't see any questions. If you could help me, maybe I oversaw something.
Yeah, it
But
looks like
with
the poll says 70% says that I agree with the pharma giant. So agree that Pfizer's dividend won't get cut. And there's 20% that say that the dividend might get cut, and 10% that say they need more information. So everybody, most of the people agree with you that 70%. 70% of the people think that Pfizer's dividend won't get cut. All right, so let's move on to your second.
Sounds like we have. Yes.
Let's move on to your second prediction, which is that Bitcoin won't cross $150,000 per year this year. So, what are your thoughts on why you think that that's the case?
I think that was a communication mistake. My prediction was the opposite. I think it will hit 150,000 and probably surpass 150,000 even this year.
I think that's what I'm sorry. I thought that's what I said. Yeah.
Okay.
Yeah. Bitcoin will cross 150,000 this year. So what's your what is your thought there?
It's the major thing is macro, that I think right now the economy in the US is struggling quite a bit, especially due to Doge savings, all these things. If you look at airlines, they have to cut their forecast strongly, even though in January they said we will have a great business in 2025. So there will be a strong struggle I don't know how strong, but there will be struggle in the US economy. And what I think this will lead to, it will be a lowering of interest rates, potentially money printing again. We just had 2 days ago, or was it even yesterday, I believe, the Fed even tapering its QT from 20 billion a month or day. I don't look at this very often, to 5 billion. I think that was a strong move. So they're still withdrawing money from or adding to its own balance sheet, but I think this will reverse. And if you look at correlations of the past, whenever financial conditions loosened, Bitcoin went into its parabolic state. And I think this is where we're going to go in the second half of this year, maybe even earlier. The second reason is suddenly in November, there was such a magnificent shift from we don't like Bitcoin. Actually, we think crypto is dangerous. I'm a bit over-exaggerating here in the US, especially the biggest economy in the world, to an administration that's very pro crypto and even saying we're going to have a strategic reserve of Bitcoin and other cryptos. And I believe other countries are going to follow. I also believe this opened the gate for institutions that were hesitant, thinking, should I do that? Should I not do that? Like most people still didn't follow Michael Saylor. I think more and more people will follow this, since even the US government is going to do that. And this will lead to a flood of more buying, driving the price higher in the medium term. And I think, these drivers will be strong enough to catapult Bitcoin over 150,000 by year end.
All right. So what's the current price of Bitcoin, and where do you how much is that going to? So it looks like the current price is 84,000. So we're looking at almost a double. I mean, not quite a double, but pretty close. You know, if 75 would be a double. So, you know, that seems like a substantial increase. And what do you think is going to drive that? I mean, so if obviously, I mean, let's just say the government, puts Bitcoin as the currency that, is the cryptocurrency that is the main cryptocurrency. I mean, I think everybody would assume that 150,000 is probably, or is reasonable, right? So assuming that doesn't happen, what else could possibly drive the price up to 150,000?
Actually, I do think I should also preface, I'm not really a big fan of Bitcoin. I don't own very much of it myself. And I don't think it's a necessary condition that the government, US government, or even other governments are going to start buying heavily Bitcoin. I think just the announcement and the more positive, news, the next government announcing we're also going to make a strategic reserve, or the next sovereign wealth fund, or another pension fund, which are starting to add Bitcoin. I think just this announcement, there doesn't need to be really the buying, but there will be this shift in liquidity coming at a later point of time that the market is going to anticipate. The market is not going to wait until the US government and all these others are going to throw all their billions and more into Bitcoin, but they're going to buy that earlier. And what there will be the major shift in this year, that's why I'm having this year, is really the change in the economy. The outlook has been relatively positive, and I'm not even sure if we're going to have a recession. And I'm not sure if analysts agree. I'm not the best macro analyst. I'm listening to other people. There doesn't seem to be consensus for a recession, but I think there will be enough pain for the Fed having to continue to change gear, maybe to quantitative easing again, but definitely lowering interest rates so that there will be more liquidity coming into the markets. And this liquidity has to go somewhere. And I believe Bitcoin will be one of these avenues, for the reason that people are expecting in the future more and more people will buy it. So those who will get liquidity today, they are going to allocate a certain percentage of it into Bitcoin.
All right. So get your answer to the poll in. Will Bitcoin cross the $150,000 mark this year, and then into Fool24? Pro Shop Guy asks, is Bitcoin notes that Bitcoin has tracked with the NASDAQ, and then how do you see the how does the equities market correlate with Bitcoin? And if it's 1-to-1, then do you really think that the NASDAQ's going to double? Because you're saying the Bitcoin's going to double. So I mean, I'm reading into his answer, his question, but I'm gonna extrapolate there. So if Bitcoin is tracking with the NASDAQ and you're expecting Bitcoin to double, do you also expect NASDAQ to double? And if it doesn't, then why do you think that those two are gonna separate from each other?
A great observation. I think I think the past, I don't know, is it 2 years, is it 4 years, or even more? There has been a strong correlation between Bitcoin and tech stocks. And the reason, I believe, is exactly what we were talking about earlier, all this liquidity. It will not only go into Bitcoin, but it also goes into especially the Magnificent Seven, driving the NASDAQ, driving the S&P 500. And so there has been a very strong correlation, but a strong correlation doesn't mean that prices are, moving in equal magnitudes. For example, Bitcoin was, I have it in front of me, in September last year, which is, called it half a year ago, you could buy it for 52,000. And in December, which is, call it 3 months after that, Bitcoin was at 100,000. So Bitcoin doubled in a matter of 3 months. And the NASDAQ also, probably, I haven't checked it, also increased significantly. But if you talk significant increase in the NASDAQ, which has a market capitalization, I don't know where, but significantly higher than, actually should be significantly higher than Bitcoin, because already Amazon, I believe, has the order of magnitude of market capitalization of Bitcoin. And then you still have Google, similar market cap, you have Tesla. So it's way more heavyweight that needs to push. And then maybe it moves 10%, which I think is a very strong move for the NASDAQ in the short period of time. But Bitcoin can and will, I think, have a much higher so-called beta to the upside. So Bitcoin can double easily. But we just saw it between September and December, it doubled. At the same time, it can decrease 30% in a matter of a couple of weeks, which it did until a month ago, which the Nasdaq doesn't. So there's a correlation. They kind of move in tandem because I think these liquidity forces are the driving factors right now in the main markets, but the magnitudes are different. First, because they are smaller. Bitcoin is much smaller. Actually, I think that's the main reason.
All right. I'm going to try to get us back on track here for try to get through 6 predictions. So we're halfway through and slightly halfway through the hour. I'm going to say that, I don't know, I'm going to guess. This is a wild guess for me because I have no idea. There doesn't seem to be any reason to think that Bitcoin will or won't move up or down in any given day or month or year. So I'm going to say no because it's halfway there and that's a long time to get there, because I don't know. I don't believe in cryptocurrency, and I don't understand how anybody can value it. So I'm going to say no. Bitcoin doesn't cross the $150,000 value per this year, and I don't have any reason to go with that other than that I don't have any reason not to. And it's, double. If it was 10%, then maybe I'd say yes, it would go 10% higher. But, doubling, I'm going to say no based on that. And then if we look at the poll, we're at currently 50%. So 50% of the people agree with you that Bitcoin will cross the $150,000 per year mark. 40% say they don't agree with that horizon. So, maybe it will, but not in the year. And then there's 10% of people who think they need more information. So I guess I'm halfway okay with the other people. And then my second prediction is that Vertex, ticker is VRTX, they've launched a new pain drug called Journevax. So JOURNAXV. So figure out how you pronounce XV, and you can pronounce it that way, and I'll just try my best. So I think the sales of that drug are going to be less than $100 million. I think that the valuation, if you look at the valuation, I think that the valuation is factoring in larger than 100 million. And I'm a shareholder, so I'll be happy to be wrong on this prediction. Obviously, like if sales are more than 100 million, I think the valuation is probably going to go up, and I just don't see the revenue being higher than 100 million. What I've seen from analyst predictions, they're around 105 million. So I'm, maybe slightly under. I mean, I'm on the under, but not that much far under the under. And then, so this is a drug that has the main reason for using this drug is not that it works better. It's that it's a non-opioid drug. So the opioid drugs right now, think things that are addictive. Those drugs are used currently as the current prescriptions for patients who have acute pain. So, somebody who has undergoes a surgery, and then they come out of the surgery and they're obviously in pain because whatever, they got cut open, and so they get a pain medication. So currently what they would, previous to Vertex getting its approval of Journevax, those patients would get an opioid drug, and the issue is, will those patients end up being, get addicted to the opioid drug? And so the Journavax is a non-opioid drug, so potentially they'll, not get addicted. I mean, they won't get it. There's no reason to think they would get addicted to Journavax. So the question is, will doctors prescribe Journavax, which is a branded drug, and it's like $15 a pill versus a generic opioid, which is cents, 10, 20, 50 cents a pill drug. So that's the competition right now.